It's also extremely negative for emerging markets and money flows because the higher U.S. rates just increase the risk orientation towards emerging markets.
Seth, Jeff, thanks so much for joining us this morning. Very interesting perspective from the both of you.
Thank you.
All right, let's very quickly take you through what happened in trade yesterday. Domestic institutions once again bought, and you had foreign institutions that continued to sell. That remains the case. But you saw quite a bit of chop and churn and eventually a gain for the benchmark indices and indeed the broader market. So broad-based gains for the equity markets as a whole. The Nifty 50 ending with gains of about 0.9% or thereabouts. The mid-cap up about 2.4%. Small cap up about 3.2%. At yesterday's close, you have the Nifty 50 that's down about 12% from the 52-week high. 13.5% for the mid-cap index and about 16.4% or thereabouts for the small-cap index. But as we've stressed very often, the cuts for individual counters are much, much higher, particularly in the broader end. IT was the best performer in yesterday's trade, gaining about 2.6%. And in fact, it is only about 7% below its 52-week high, having fallen less than others. Realty, media, pharma, metals and auto all gained in trade yesterday, but the one pack that was underperforming was FMCG, but no big losers. Dabur, for example, was the biggest loser in that pack, losing about 1.4%. Last point, VIX continues to remain elevated ahead of the budget. It is at 18.64.
Yeah, well, and you know, all of that put together very quickly on the trade setup. I mean, just trying to think out loud, right, as to what could and what can't happen, if you will. Quiet opening, anticipated, but a choppy second half, simply because for our own doing, we have expiry. And even on a very marquee day before yesterday, we saw that the second half, the last half an hour, 45 minutes, the markets did come off. So that's probably the thing. But the good part, guys, and today I know our list is peppered with some very good numbers. I think the market rewarding stocks, which came in either pre-market hours day before yesterday, which is AMI Organics, Suzlon, the likes, or KPIT, which came out and just made a small change to the guidance, not even dramatic, and the stock was rewarded with the 10% uptick. So just somehow feels that until day before yesterday, the market was just not in the mood to reward good numbers. Yesterday was the first texture of the market really going out and saying, if you're delivering good numbers, very happy to bless you with rewards. I mean, 20% uptick for an AMI Organics was quite something really. So that is great. And a lot of talk around hotel companies and the numbers that have started to come in, because it's a large sector now, right? People look at Indian hotels, but there is ITC Hotels, which is now listed, so large, and a clutch of others. A lot of chatter around good numbers, but I didn't somehow see too many positive surprises from the hotels, the two that have come out thus far.
Yesterday, yeah.
Yeah, so good numbers, no big surprises, no great runaway growth in a very busy quarter. Let's see. I mean, somehow reserve my thoughts on hotels having a large reaction, but just the fact that finally mid-cap portfolios are seeing some green,
and
which is actually on the side.
I would suspect still a long way off from the levels they were. I mean, it's just a bandage on a gunshot wound right now as far as those portfolios look.
I like the tweet you shared about early retirement being pushed by 140 years.
I mean, the stuff on social media is interesting. People saying, looking at portfolios, yeah, look at retiring only then.
Yeah.
I think also just to the point, just very quickly, the hunt and hunger for some good news is enormous. So hopefully some that we can give today. Just a quick word on public sector banks. Not so much there as well before I get to my three stocks. Newspaper reports today that a haircut of up to 20% will be taken by key public sector banks because of their loans to MTNL. So watch out for that clutch. Public sector banks as well as MTNL specifically, which will see some pain. But specific news and stocks, Allied Blenders is what I'm starting up with. It's a thumbs up. Revenue is up about 13% at 973 crores. Above the estimates at 964 crores that came in. EBITDA is up 97.5% at 116 crores, also a beat on estimates. Margins have also jumped up pretty decently. The expectation was already 11.5%. Your margins are close to 12%. And year on year, that's an uptick from 6.6%. So a healthy number there. Net profit at 57 crores versus a loss of 4.4 crores. So a volume growth of 11% has helped. Profits have grown due to state brand mix, so they're in more states now, cost optimization. Their premium category is what has really pushed the numbers up about 41% year on year. It's just the growth in their premium category, which is why a thumbs up of Allied Blenders. Look out for that. Brigade is the other one that I'm looking at. Thumbs up again. Revenues up about 25% at 1,464. EBITDA up 58% at 414 crores. Again, a beat on estimates. Margins have also improved from 22.3% to 28.3%, and net profits are at 236 crores versus 73 crores. So that's also beaten estimates. The pre-sales volume, which is what everyone looks at when you see a real estate company, those volumes are up 29% to 2.19 million square feet, and the sales value is up 63%. We will be speaking with Pavitra Shankar of Brigade later in the show, and we'd like to understand what her outlook really is and what has worked this quarter. But for now, I think that stock, which has already run up a fair bit yesterday, might see some interest there. I don't know if rate-sensitive stocks overall might see some impact of Fed that could peter things out. But on its own, Brigade Enterprises is a good set of numbers. Not so much for Voltas. Thumbs down for this one. Revenues are up 18% at 3,105. EBITDA up 594% at 197. Margins of 527 basis points. Have gone from some 1% to 6.35%, net profit at 132%. And you're going to be wondering why we're saying it's a thumbs down. That's because the net profit has missed estimates. Revenues are in line, and their market share has slid a tad, to some extent gone to Blue Star. Projects business has grown 21%. The unitary cooling product segment, which grew 20% year on year. International projects business, projects in the UAE and Saudi Arabia, though, continue to perform well. It's the engineering segment which was facing headwinds, and the engineering segment revenue declined 16% year on year. The share of loss from Vortec also stood at 334 million, down 10% year on year. So Voltas might see, on the face of it, numbers seem okay, but not really living up to what expectations are.
I would start with the good news first, and Hitachi Energy looks really, really good. Look at the numbers. It was up over 6% in trade yesterday. Maybe an inkling that the quarter was going to be good because revenue was up about 27%. But take a look at the expansion in the EBITDA margin. It has doubled. It is coming at 10.3% versus 5.3% in the comparable quarter. And you have the net profit, which has jumped quite considerably. It's coming at 137 crore rupees versus 23 crore rupees. Now, I was looking at the performance. It's actually gotten beaten down a fair bit as well over the course of the last 3 months, and perhaps to a certain extent some bit of clawback of gains in the recent past. So there you go, down about 25% over the last 3 months. This is something that the street will probably look at positively. SRF, it's a good number, and I'm happy to say this for a chemical company, and maybe really the corner is being turned because revenue has increased about 14.4%. The margins have come in at 17.7%, lower versus the comparable quarter, but certainly above estimates, which pegged it at 17.1%. The net profit has increased about 7% and come in at 271 crore. Once again, this is sizably above the expectations, which had pegged it at 236 odd crore rupees. What is the fine print saying though? The chemical segment is, the beat in the chemical segment rather has been driven by higher demand for refrigerant gases. We were speaking about that a short while back, maybe a couple of weeks back, and the demand is coming in from domestic OEMs. The specialty chemical segment continued to experience some overhang though because of inventory build-up among the agrochemical customers, but the numbers looked decent. The one you want to come in on that? Yeah, just on SRF, I think the larger reaction though on SRF will happen post the con call today. Yes. That's usually the template. Yes. So 2:30 p.m. the con call, expect some fun and games around the 3 p.m. mark for SRF. And maybe it'll set the stage for the rest of the numbers that will come through over the course of the next couple of days. Yeah, but you're right, Alex, because I think we've seen the fluorochemical companies yesterday, Gujarat Fluoro do well, Ami Organics do well. Yeah. Individual levers for each, but for SRF, the con call is so important. Absolutely. 2:30 p.m. is what you should mark. Tata Motors is the down tick, or rather the thumbs down that I should talk about. And it's a miss on all fronts. Where do you start? This is a company that has over 70% of its revenues that are contributed by Jaguar Land Rover, and it's not a pretty picture for Jaguar Land Rover. It's a return to the black for this company, but the margins have come in much below expectations. The pain really emerges from China, where the sales are not as good as was anticipated. In fact, you have China sales down about 38% versus a comparable quarter, and the PBT down about 17% or thereabouts. There are a few other pockets that were good. However, it's not such a good number for Tata Motors overall. The net profit on a consolidated basis down about 22%, coming in at 5,451 crore rupees. The estimate had pegged it, Neeraj, at 6,435 crore. We'll be talking about this more, but those are the numbers that stood out.
Yeah, interestingly, one of the notes, I think it's Bank of America, saying that very weak quarter, but the Q4 guidance seems to probably be the saving grace for Tata Motors. So let's see if that were to happen or not. The first stock on my radar is Whirlpool of India, and not necessarily for result reasons, but much like last year, Whirlpool of India at the start of the year is saying that they want to pare down stake and interest in the company. The holding company Whirlpool Corp will sell down about 20% ownership interest in the company by mid to late 2025. I wonder if this has an overhang on the stock today. Remember the last time Whirlpool sold its stake at about 1,200 or 1,300 or thereabouts, the stock went up all the way to 2,100. So the parent knows that they are not the best identifier of when to sell, but this time around they are saying mid to late. I just think it will remain an overhang on the stock today, possibly, maybe for the near term, but today too. So Whirlpool of India is the first one on my list by virtue of this decision that the parent has given out. So keep an eye out for that. From amongst the large names, I think the brokerage notes on Bajaj Finance are very interesting. Citi, for example, is saying that they are maintaining a buy and they have hiked the target price to 9,060. Amongst everything else that they have said, driving credit cost improvements, expanding growth horizons. The last line in their note, or one of the last line that we mentioned as a takeaway from the Citi note, is that the MD has exhibited intention of staying at Bajaj Finance and playing an active role in executing LRS strategy. This always is an overhang, whether Rajiv Jain, for how long will he stay, will he go away, etc. This one stood out for me from the Citi note. Morgan Stanley, of course, says that it's well set for a strong FY26 and the visibility of 25% plus EPS growth has improved in FY26, subject to the macro climate. So keep an eye out for Bajaj Finance. It has had an up move for sure from the lows of 6,200 a couple of quarters ago to 7,729. We talk about how the markets have given up gains and stocks have not done well. If you invested in this one at the end of quarter two at 6,200, you made some serious money and safe money. So that's the second one on my list, a thumbs up if you will. And I have one more thumbs up, guys. There are lots of thumbs up today. Bansal Wire, Ask Automotive, but I've chosen Arvind Smart Spaces. Very good numbers. In line with estimates, if you will, on the revenue front, 210 crores versus 84 crores, but a strong number nevertheless. EBITDA margins at 28.3 versus 23.6. The estimates were 24%. Net profit number, 47.7 versus 9.4 crores. The estimate was 32. So beaten estimates and the corresponding quarter quite handsomely, and therefore watch out for Arvind Smart Spaces. Could be a stock that reacts in addition to the Raymonds and the Ask Automotives and the Bansal Wires and the Electra Green Techs of the world, and we'll talk about some of these a bit later on in the show. But strong numbers today. So a lot of good news from Tamanna, Alex and me on the first on the list.
Should we do a collective thumbs up?
Well, if that works.
Patajala, on expiry day, markets are not in a thumbs up mood at all.
Yeah, but some of these stocks.
Yeah, remember we talk about what the numbers are showing us, and then of course every day is a different day.
Hey, if it works, I'm happy to do it every day.
Right, we'll take a very short break, but we're coming right back with the F&O setup and of course what stocks you should look at for the day. The day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs? And what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
Well, the union budget is right around the corner, and we get you some of the major wish lists according to Bajaj Broking, the key sector expectations, as well as the 3 key stocks that you should watch out for in this particular budget. Let's start with, some of the key budget expectations in terms of sectors. In terms of banking, they have mentioned that, they're expecting no favorable terms in terms of deposits to come in, but capital infusion for PSU banks as well as insurance companies will be something to watch out for. When you move on and look at the other key expectation from banking, they are expecting that the focus of the banking and the financial space will be on sectors such as cement as well as the metals, which haven't done too well over the last 2 years. Import duty changes to support any kind of domestic production will be something to watch out for, especially for the metal space, because we are expecting and hearing rumors as well in terms of some anti-dumping duties on metals coming from China. When you move on and look at the key other expectations from the infra space specifically, a key sector to definitely watch out for, capex allocation for roads and railways is something that's been standard. It's been increasing steadily over the last 6 to 7 years, and this time again it will be something to watch out for. Apart from that, announcements of any kind of large-scale projects according to Bajaj Broking, likely a new freight corridors, will be something to watch out for as well. When you move on and look at specifically from the auto space, it is expected that the allocation for PM E-Drive and the auto PLI policy will be something to watch out for. Do note they've already announced.
Welcome, this is India Market Open. We're looking at how things are panning out as far as the futures and options space is concerned. First, and of course, it is the monthly expiry for a month which has been extremely volatile. Let's see how things are panned out at the moment. So I'm going to start off with the Nifty. Well, as far as rollovers are concerned, they were subpar, and this was perhaps on expected lines because as we move into the big event, I'm sure that a lot of traders out there will want to keep a relatively smaller position as compared to what they have been used to. That said, we have started seeing a little bit of an increase in OI towards the February futures. Let's bring up the Bank Nifty as well and see how things are faring there. And that's where the rollovers are slightly on the higher end, coming in at around 51.7%, but not as high as what we have been used to, as I was mentioning. Today is that, monthly options expiry for the Nifty as well. It does seem like 23,000 is where the most amount of traction is with respect to calls as well as puts. And it also seems like it's going to be one which will play a little bit of a pivot, a fulcrum, if you will, considering the fact that there's been so much writing in both calls and puts around 23,000. I want to point out the next weekly expiry as well as far as the Nifty is concerned to see what range we are looking at least as far as the markets are concerned, as we move into the Saturday's event. And based on that, we still have a lot of call writing at the 23,500 call. That's where we are pegging some of your call writing to be. On the lower end, as far as puts are concerned, a little bit more traction as far as 23,000 goes, but 23,000 calls also have enough amount of calls being written. The idea here is that once you see the event pass, what really happens is there's a considerable contraction in option premiums in general because your volatility comes off considerably. And I reckon that at least a handful of traders out there are probably playing that bet, which is why they're placing their short calls and puts at around the 23,000 mark. But let's move on and talk about stocks as well. Well, actually, we can't really talk about stocks at the moment because we are in rollovers, but just want to mention that a handful of names like Reliance Industries, HDFC Bank, as well as ITC will continue to be in focus today. And of course, that said, the Nifty implied open, looking at a marginal move, it's something that we'll also keep an eye on, but it's going to be a volatile day of trade, or at least that's what the expectation is, considering the kind of movement that we've seen through the course of the month.
Hagam, thanks so much for those details. Now, we have briefly spoken about Bajaj Finance and a very good set of numbers, and more importantly, the outlook on asset quality, and in fact, the credit cost is going to be something that the street will focus on today. We've got Harsh joining in to tell you what was said in the numbers and also, of course, what was said in the conference call. Harsh, you're looking happier than you normally do when we talk about Bajaj Finance in the recent past. What stands out?
Well, what stands out is commentary is far more constructive and generally, or rather positive, and generally when you speak about Bajaj Finance, giving positive commentary generally trickles down to the sector as a whole and therefore positive for the sector at large as well. But talking specifics, credit costs likely have peaked. They'll probably come down by around 0.1% in the next quarter, and thereafter taper to sub 2% on the credit cost number, on the absolute credit cost number, which is currently at 2.16%. So clearly positive. Two-wheelers, three-wheelers, probably some bit of asset quality issues still there, but rural B2C, growth coming back and asset quality improving. And that's the key, because that's been the one big drag over the last couple of quarters at the very least. So that's the one big positive. What brokerages seem to be suggesting. One, we see brokerages hiking target prices. I'll give you two examples. Citi maintaining their buy. They've hiked target price to 9,060 from 8,150. Morgan Stanley hiking target price to 9,300 from 9,000. Huge increase by Citi. Second, credit cost improvements continue as what Citi says, and growth horizons are expanding. The 3.0 strategy along with the Airtel partnership will enhance growth prospects, and the managing director exhibiting his intention to stay with the Bajaj franchise is obviously another big positive as per Citi. Morgan Stanley, on the other hand, they believe well set for FY26. Lower stressed asset formation is what they are already seeing. They're seeing visibility for 25% EPS growth in FY26. Again, a very big positive. And they believe that this makes Bajaj Finance an interesting quality large cap in a tough market. That's how they term it.
Okay. Harsh, we also have the MD Rajiv Jain's comments from the conference call. And in fact, what he was highlighting was about the unsecured loans portfolio, and that remains a key area of concern. But the company is hopefully looking for an improvement going forward, what you were alluding to, in fact. Let's listen into what he had to say in that conference call.
On a full year basis, we estimate loan loss to average AUF to be in the range of 2 for quarter 4 to be in the range of 2 to 2.05. So clearly the downward trajectory should continue as we move from here. GNP and NPA stood at 112 basis points and 48 basis points respectively. Continue to be amongst the lowest. Clearly, as I've said many times to investors, that last year was a record low in many ways, and it reflected even in GNPA and NPA, but we remain significantly within the range of our medium-term guidance on GNPA and NPA. We had shared with the with investors that clearly 3+ unsecured loans is an area of concern. So across the board, we have brought, reduced share of such customers now significantly. As we exit Q4, we will be back to where we were at a pre-COVID level. So we have been continuously pruning. We pruned significantly even in Q3, and we would be below or equal to where we used to be pre-COVID as we exit March 25.
So look out for Bajaj Finance today, and could be a good day for them. What else is on our watch list? Well, on the positive side, Brigade Enterprises pre-sales are up 29%, and collections are out also 27%. So that's one of the stocks to watch out for. Triveni Turbine, UBS has initiated a buy with a 44% upside. ASK Automotive, strong EBITDA beat. Afcon's infrastructure has received a 1,283 crore LOA from Hindustan Gateway Container. Azad Engineering is the other one that you should keep on your watch list, as have we. They have an 811 crore agreement with Siemens Global Energy.
Okay. SRF is something we've spoken about already. It was on my watch list. It has beaten estimates across all metrics. Maruti Suzuki, very strong numbers coming through, in fact, and you've had the brokerages that have also raised target prices. Of course, the market did factor in results for the third quarter. It came during market hours. On the other end of the spectrum, in the automotive space, Tata Motors was also on my radar for being an underperformer in the third quarter. Jaguar Land Rover revenue guidance has been cut by a small margin, but still it has been cut, and so it's a negative. Voltas is something that we marked as well, and it was on Tamanna's list. EBITDA and net profit have both missed estimates.
Okay, well, let's talk about a clutch of things with our guests. Nirav Asher, Head of Equity Research at Latin Manharlal Securities, joins us to talk about the fundamentals. Nilesh Jain, Head AVP Technical and Derivatives Research at Centrum Broking, to talk about the derivative piece as well. Well, so much to talk about. Nilesh, can I start with you because it's the expiry day? Our expectation is that it might be a muted open, but a choppy second half. How would you trade just the expiry day? If somebody wants to trade today for the day, what would the trade options be like on the Nifty or the Nifty Bank?
Very good morning to you. Absolutely, today is going to be an extremely volatile session that we are expecting, where we have Nifty, Bank Nifty expiry today. Also, we have mid-cap expiry, Nifty Next 50 expiry. So it is going to be extremely volatile session. It is advisable to trade with a caution. And the strategy would be, if at all we see any dip towards 23,100, that will give a good opportunity to go long, and one can buy option of 23,200 shy. If at all, on the contrary, if we open on a positive side on a gap up note, and if Nifty touches the mark of 23,250 to 23,300, that will give an opportunity to trade on a negative side. That's a buy put option, because we expect market to remain volatile and likely to oscillate in the range of 23,100 to 23,300. So that's the 200-point trading range from today's expiry point of view. Similarly, for the Bank Nifty, in fact, Bank Nifty, we are expecting some outperformance today, given the kind of setup that we have seen yesterday in the heavyweight counters like Axis Bank, ICICI Bank. So overall, structure-wise, Bank Nifty looks positive. It is advisable to buy call option of 49,200. If at all we open on a muted note or on a negative side. So in the underlying, the stop loss should be placed below 49,000 level. And on the upside, we are expecting a move towards 49,500 from today's intraday point of view.
Okay. You've also got the picks, Nilesh, and there are quite a few stocks that are on our radar. What's on yours?
Right. So I have two buy recommendation. First of all, we are expecting stock specific action to continue. So Indian Hotel is something that is looking very attractive. Technically, it has formed a good base formation near about 750 level. And yesterday we have seen a build up on the long side as well. So we are expecting a follow-up move towards 805 to 808. So that's the immediate target on Indian Hotel. Stop loss can be placed below 760. Other stock that is from the NBFC space, because overall financials are looking positive. We are expecting a short covering rally to continue. So LTF is something that is looking attractive at current level. We can expect a move towards 151. Stop loss can be placed below 143.
Nirav, hi, good morning. Just wanted to get your take on Bajaj Finance and Maruti and Tata Motors, if you've looked at them.
Thank you for having me on your show. I think Bajaj Finance, a very strong set of numbers and a very strong commentary, very strong outlook. And we've seen the quality players. They have used this stressful time to get their act together. Basically, trying to focus on the deposit mobilization, trying to contain the credit costs, working towards net interest margins improvement, improvement in the net interest income. So I think this is a result which ticks almost all the boxes, right? And I think the outlook is also looking quite good going forward. So I think Bajaj Finance would be a positive from here. And as far as Maruti is concerned, I think it's been a result which has been in line with the expectations. So I think a lot of it is factored into the price at this point of time. And I think going forward, we will have to see what kind of sales mix is emerging if they are able to maintain their momentum going forward. The third result, I think Tata Motors was slightly below expectations, and I think it's a work in progress. They are making improvements. So from a stock price perspective, I think it's a good time to really look at Tata Motors start accumulating with a medium to long term perspective.
Okay, since we're talking about Tata Motors and Maruti, let's just get a quick roundup of what brokerages are saying. Numbers were out. Puneet is tracking, of course, both companies. Let's start with Tata Motors, Puneet.
Yes, thanks for that. So Tata Motors, I would say it's a miss across all fronts for the company this particular quarter. And the downside is that they've cut the guidance for JLR, and I think that won't be taken very positively by the market. Now, they mentioned, but there is one positive thing in the guidance cut, that the EBIT guidance of 8.5% has been maintained. So they've cut revenue guidance to 29 billion pounds versus 30 billion pounds earlier, and that will impact the ROCE as well in this particular year of FY25. That's been cut to 20% versus 22%. Apart from that, they also had a positive impact on EBITDA margins for the passenger vehicle space, in fact of the PLI, 150 basis point. But despite that, the margins have fallen, so another key negative. And brokerages have, cut their target price accordingly as well, because of the guidance cut mainly. So when you see Morgan Stanley, they maintain while in equal weight, but they've cut their target price to 853 from 920 rupees earlier, and they mentioned that while the guidance cut and they maintain the EBIT margin, as I mentioned, and they will relook at the FY26 guidance as well, because there they mentioned that EBIT will go to 10%. Also, one of the key aspects is that, to meet the FY25 guidance, they expect a very strong Q4 again. And, that's going to be one of the key things to watch out for, because they're saying they'll do more than 10.5% of EBIT margin in Q4, and that might be something to watch out for. Goldman Sachs, they've also cut their target price to 800 from 830 earlier, and they've said that the JLR China market has fallen by roughly 27%, which is the locally produced market in this particular time frame, and they're also expecting a very modest volume growth of just 2% CAGR over the next 2 years. And finally, on Nuvama, they've cut it to 720 from 750 earlier, and one of the key things in the report is that, because of the guidance cut, the earnings have been cut for the next 2 years by 4% each on the revenue as well as on the EBITDA side, and they're expecting a muted performance of just 1% CAGR for the next 2 years in the India CV division as well. So overall, target price cut across brokerages on Tata Motors, and I think stock might react negatively in that aspect.
Puneet, just very quickly, 30-second answer. Because the guidance for Q4 is not that bad, can the stock bottom out after a gap down?
Well, it could potentially need us, because that EBIT margin guidance has been maintained at 8.5%. But as I mentioned, they'll have to do more than 10% EBIT margins in Q4 at 10.5% to maintain the FY25 guidance of 8.5%. And that seems very difficult in the current market, especially since no recovery in China is visible, because they've had dealerships which have had some cash crunch in this particular quarter as well. So something definitely to watch out for in Q4, specifically on the EBIT margin part.
Got it. Okay. Just hang on, Puneet, because let's hear out the group CFO, right? P. Balaji, who announced a gradual improvement in demand likely in the fourth quarter. Exactly the point that we were talking about. Listen into that.
We do believe the growth impetus from infrastructure investments will continue to feed into it. Buses are doing well. So I think there's enough and more ammunition available for us to drive growth. And with a little bit of support from the macro factors, I think we should be able to get this back again. As I said earlier, Q4 in normal course is a seasonally strong quarter that should help build momentum. and we should ensure that we continue to build that momentum into Q1 and beyond. Currently, we'll need to wait for clarity to emerge on that. And as far as UK is concerned, I think UK balance of payment vis-a-vis the US is actually the other way around. Actually, US exports more to the UK than the other way around. And therefore, we'll need to watch and see how that plays out. There's nothing concrete at this point in time. And in any case, we will have to continue to ensure that we drive all degrees, all the levers that we have, both on the demand side and the cost side, to navigate whatever comes our way. You also have to keep in mind what happens to the currency in all this. And the fact that our cost are in pound sterling, any depreciating pound will also help us in this journey. So let's watch rather than getting ahead of ourselves in terms of what's going to be.
Okay, so that's Tata Motors, but there's also Maruti Suzuki. Remember, it's a company that posted its numbers during market hours, but there's a lot in the way of commentary that came in post-market hours. And of course, people had the time to go through the numbers as well. Puneet was one of them. Puneet, you listened to the conference call. There were comments that were made about electric vehicles, a space that Maruti Suzuki has been a little bit slow in getting to, but they've got big ambitions. There's also commentary on the small cars. What stood out to you?
Well, just three key points in terms of Maruti. While revenue was in line, there was a slight miss in EBITDA. But brokerages have mentioned that this is just a 10 basis point miss in EBITDA and should be okay comparatively. What we've seen in terms of Hyundai as well as Tata Motors, a bigger cut in EBITDA margins in this particular quarter, over 200 basis points, and hence they've hiked target price. The second and the most important thing, according to me, was commentary on e-Vitara, which they expected to launch in this particular quarter. They mentioned that they aspire to be the largest manufacturer of electric vehicles in India in the first year of manufacturing itself. If that is to be the case, and the numbers that they're projecting, while they've not mentioned any, Nuvama is expecting 72,000 to be produced in the first year, and that will be more than across the competitors, including Tata Motors, which has been doing this for the last 3 years. And I think that will be taken very positively. It's going to be a domestic as well as an export product, with export being more in focus in the first year and the first couple of years, because the battery is getting imported in India right now. So cost might go up, but that one particular line just caught my attention too much. The other aspect is that the new launch Desire, now it has a 5-star safety rating, something that none of the Maruti cars have. And they have pending bookings of almost 20,000. It's outselling what the previous model did of the Desire. And one key question in the conference call which was asked that, why can't you just replicate the new features of the new Desire across the models? Where the management didn't mention much, it's something that Maruti has been able to do in the past as well, because the new Swift as well as the new Desire has the same platform. And hence, I think brokerages have maintained positivity. Let me get the price hike. So BofA has maintained their target price of 14,000. But something like a CLS has increased it to 13,446 from 12,631 earlier. And Cities also mentioned that it's one of the top picks at 13,700 target price. So it's going to be very interesting, because Maruti has outperformed Tata Motors as well as Hyundai in this earnings season of Q3. And M&M is going to be one to watch out for, because that could be the only challenger to Maruti in terms of growth. So overall, it's a beat for Maruti, just EBITDA miss, but I think that's going to be looked ahead. And the e-Vitara and the Desire is something that's going to drive the stock performance going forward as well.
Yeah. Okay. Detailed, analysis there on Maruti, and that's going to be in focus as well. Shrikant Chauhan also joins in. Shrikant, very good morning to you, and great to have you on as always. Before we come to your stocks, what are you seeing when it comes to Maruti and Tata Motors this morning?
Good morning, Tamanna. Good morning, Niraja, and everyone. For Tata Motors and Maruti, our view is that based on technicals, both the stocks are showing upward activity. Even though Tata Motors is the stock has reported weak numbers, I am of the view that already that negativity is priced in. The stock is diverging positively. Yes, today we may see a lower opening, but after I think opening lower again, it should come back to the levels of at least maybe 850 or 900 in next maybe few weeks or a few months. But at this level, if there is any correction, then we should look for adding Tata Motors also to the positional portfolio. We like Maruti. It is still above all its important averages. And based on its technical formation, yes, I am of the view that the stock is heading for the levels of at least 13,000, 13,500 in next few weeks.
Okay. Okay, so why don't we talk about, we've not spoken about, Shrikant, your opinion on how things will look on expiry day, right? What are the key talking points in your opinion? And we've seen quite a bit of chop and churn in the past couple of sessions. Do we, if there is momentum, do we sustain that momentum?
Yeah, the way there is a divergent activity in mid cap and small cap companies and Nifty stocks or Nifty, I am of the view that yes, we are going to see gradual upward activity towards the levels of 23,400 or max could be 23,500. But till the Nifty is not crossing 23,500, I am expecting market to remain in a range. And the ideal strategy should be to look for reducing long positions close to 23,300 or 350 levels. Yes, we may look for adding few stocks to our trading portfolio because a number of stocks are rebounding after completing their correction, especially mid-cap 50 index completed its corrective pattern and it is now rebounding. So based on its technical formation and the way the Nifty has corrected in the past few days, I am of the view that stock specific activity is going to rule for next few days. In case if there is any correction, then yes, certainly close to 23,100, 150, we should look for adding Nifty. But at these levels, if there is a higher opening, we should look for keeping more stock specific view.
So let's come to stock specific, Shrikant. What are you picking today?
See, like from the broader market, we like defense stocks. I think they should do well. Railway stocks should do well because there also we saw good amount of price expansion as well as volume-based activity in last 15-20 days. Especially we are bullish on IRCTC, which is currently around some 765 levels. Based on its technical formation, we could see the levels of at least 780, 790 in the near term. We can keep stop loss at 754 for taking trading position on IRCTC. We also like Railtail, we like RITES, we like RVNL, but IRCTC looks promising bit at current levels. We also like Bharat Electronics, which is currently at 268, 270 levels. There also I am expecting stock to move towards the levels of 285, 290, and we can keep stop loss somewhere close to 262.
Okay. So those are some of the calls coming in today. I'm just wondering, and let me come to Nilesh here very quickly. How are you seeing a Voltas and a Brigade today? Both will have some kind of action perhaps on news flow. Their results have come in. Voltas not so great, or maybe missing expectations actually, and maybe some pressure on market share. But what are the charts telling you for a Voltas and a Brigade? Voltas has also had a management change, so that might also hit the stock today.
Right. So yesterday we have seen a reversal candle in Brigade actually. So if you see the structure, we have seen a big spurt of close to 8%. So looking at the volume attraction as well, yesterday, Brigade is looking positive for a up move towards 1150 to 1200. So on immediate basis, the risk and reward is certainly not favorable. So better to wait for some dip towards 1060, 1050 to go long, and one can keep a stop loss below 1030. So overall, Brigade looking good for a strong pullback, or I would say a dead cat bounce. Voltas comparatively is looking slightly on a weaker side because yesterday we have seen a pullback, but it is trading well below its all long-term and short-term moving averages. So there are possibility of this pullback to get sold into near about 1500 to 1520. So better wait for a decisive breakout above 1520 before initiating any long position. And if somebody is already holding the long position, can keep a stop loss below 1440 and one can stay put.
I'm just going to come to you, Nirav, and of course there are lots of earnings that have come through, but I want to focus on a couple that were on my radar, right? Hitachi Energy for me stood out as a very, very strong quarter. I'm not sure if you saw the numbers, but what's leading to this kind of outperformance in your opinion, and is it sustainable?
Well, yes, it's definitely sustainable, and we did get a chance to see Hitachi Energy numbers. Very, very strong set of numbers, and I think an all-round beat, whether it is revenues, whether it is margins, whether it is profitability, and the order backlog is at a record high of 18,500 crores, close to 18,500 crores. And this has been boosted by the HVDC order which they have received, that is the high voltage direct current, which is a very high technology intensive power transmission and distribution technology. So I think the outlook remains quite strong, and from what we have heard and what we have studied, I think there is a possibility of Hitachi Energy bagging a couple of orders on similar lines in the near future.
So let me ask you this then, for a stock that is down over 25%, if I'm reading that correctly, over the last 1 month, and it is trailing, from what I can see from my screen, at a trailing PE of 138 times. It's still significantly below what it has traded in the past, right? And would you say that it's a great opportunity for investors, long-term investors, to go out and buy the stock today?
Well, not in one shot, but I think investors can definitely start nibbling into these stocks, because if you see the entire space, the power T&D space, entire space has been beaten up, whether it is capital goods, equipments. But yesterday we've seen very good quality numbers also come, and the market has given a thumbs up to these numbers, whether it is BHEL, whether it is CG Power, or whether it is Hitachi Energy. I think all these transformer companies, all these capital goods makers are trading at very high valuations, and this is on account of the fact that the revenue visibility and the prospects are very, very strong. We are seeing a highway of growth till 2030, especially with respect to power transmission and distribution. So actually, I think this is an opportunity when you have limited number of players in this space and who have the technology backbone to execute such large contracts. So it does make sense to start nibbling into these stocks, at least at this point of time.
Okay, more earnings in focus, and we want to pack in for you as much as we can on the stocks that could react today. Mahima is joining us with the details on Raymond, Allied Blenders and Blue Star, among others.
Right. So I'll start with Raymond, where, in terms of the numbers, revenue was up 50%, EBITDA up 75%. Margins have improved to 14.5 from 11.6, and net profit was down by 61%. But this was because the base year, that is Q3 FY24, had a profit from discontinued operation, which was from demerged lifestyle business. Otherwise, the net profit is up around 74%. In terms of the key highlights, real estate business grew by 11%. However, bookings have slightly come down. The company is sitting on a net cash surplus of 696 crore, and engineering business revenue doubled, but margins have declined from 13.8% to 12%. This is due to adverse product mix. And in terms of the real estate business, the margins improved to 23.8%. The next counter is Allied Blenders. The revenue is up 12.8%, EBITDA up 97%. Margins have significantly improved from 6.6 to 11.9, and it's turned profitable to 57 crores versus a loss of 4 crore. Now, in terms of the key highlights, volume grew by 11% overall, and the premium volumes grew by around 41% for the company, and this is what has brought the growth in top line. The value growth stood at around 52%, and profits have grown due to a better state brand mix, which means that they've sold more volumes to states which are more friendly in terms of selling alcohol. The next counter is Blue Star, where revenue is up 25%, EBITDA up 34%. Margins have improved a tad bit to 7.5%, and net profit was up 32%. Their order book remains strong at 6810 crore. In terms of their different segments, the electromechanical project segment grew by 32%. Unitary products saw a growth of around 22%, and the professional electronics segment declined by around 22%. So these are some of the counters to watch out for in trade today on the back of earnings.
Okay. Blue Star, definitely. I think I would see Blue Star and Voltas together, because competition from Blue Star is also one of the reasons Voltas might seem weak today, hit in their market share. But we are focusing on the budget. 2 days to go. And what are the expectations of industry? Today we're speaking with Sivaram Krishnan Ganapati, Vice Chairman and Managing Director of Gokuldas Exports. Thank you so much for joining us today on NDTV Profit. Always a pleasure to speak with you, Mr. Krishnan. Can I start by getting a sense of what is the kind of boost the textile industry needs? The textile sector is at a very important juncture with what's happening in neighboring Bangladesh, the opportunity that the Indian industry now has. What are the submissions that have been made to the Finance Ministry?
It's important to understand that it's at a crossroads, as you said, and it is, poised for a good growth in the, years to come. Primarily because, we have such a tiny share of the global market share in textile exports. And the market itself is so big, over 500 billion. We are seeing that increasingly United States and Europe are, leaning less and less on China. They're, consolidating their supply chain outside of that region. And with problems in our neighborhood, which is Bangladesh and other countries around, we are seeing more and more, large retailers looking at sourcing from India. So that's a good sign. And this is the right time to capitalize on such events, which rarely happen. There's a confluence of several events. There's a demand growth which is happening in all those markets, as well as supplies consolidating out of India. So, given all of these situation, we should really, from a budget standpoint, encourage manufacturing industry, at large, and textiles in particular, because it's also very labor intensive. This sector employs the highest amount of labor compared to any other manufacturing industry, and also becomes a feeder to other manufacturing industries as well. So from that perspective, there are incentives which state governments give, which incentivizes companies to set up units in their states. But if the center can also strengthen the PLI, where it's at the current one is a bit restrictive, and only focuses on exports of certain segments. But if we can make it more broad based, all of man-made fiber, all products out of India, rather than restrict it to certain products, it will help give a boost. Let the markets decide which product is in demand, rather than we choreograph certain products out of the country. That's one. Second, we have to also encourage, the PM Mitra parks, which has been announced and which are under process as we speak, to make sure that they are world-class and competitive globally. Sustainability is a big theme going forward. I would hope that some of these parks build those sustainability themes, which requires a lot of investment upfront. But then that would give us a formidable, competitive advantage with other countries from an infrastructure standpoint. So that's another. Logistics and infrastructure. I mean, look at how China benefits from, easy access to Western markets, especially US markets. We need to have many more shipping lines, direct shipping lines from here to Europe and US. All of those can reduce the cost and reduce the lead times of delivery. So these are macro aspects, I would say, but you have to think strategically for boosting our manufacturing sector, and that's what I would hope that the budget does. The other area I would say would be on the labor side itself. We have had in the last budget, we saw some incentives to labor, where first-time employees, we get PF and ESI support to the companies. I think some of this really needs to be looked at and maybe even enhanced, so that the industry can go and aggressively recruit more new labor. All those norms have to be announced, so that the benefits flow to the labor, and thus get ourselves access to a larger labor pool to tap into.
Mr. Ganapathy, want to talk about, of course, you've spoken about quite a bit that the finance minister should take up, and hopefully she's listening to some of what you're saying. But talk about on the cost side, right? For your industry and for your company as a whole, raw material is something that you're looking at, of course. Can something be done, in your opinion, on the MSPs? And will that have any bearing, if at all? And you can't really do too much of that in the budget, I would think, right? But can something be done on the raw material side?
See, I think, the raw material side has got several other constituents who get involved, right? Particularly on when I get into MSP, et cetera, et cetera. What we have today is, an open, market. But I would think that, the import duties on cotton probably could be reduced to help the sector. From an export standpoint, I don't think raw material costs are that big a deal at this moment. We really need to focus on capital creation, in my opinion. We also need to think through as to how do you expand the MMF value chain in India, which is still not really that strong compared to the Far East. So the polyester value chain, the nylon value chain, etc. Those are the areas where we probably need to focus on from a raw material standpoint. So having those kind of fabrics being available in India, so that we can get a little larger share of those segments as well.
Mr. Ganpati, thanks so much for joining us this morning, and very interesting some of the points that you've raised on what should be done to bolster manufacturing.
Thank you.
Let's talk about the big brokerage call of the day, and we've got several to choose from, but we've chosen to talk about UBS, which has initiated coverage on Triveni Turbine with a buy rating. The target is set at 900 rupees. I haven't looked at the stock price. Harsh, what's the upside potential, and also what are they saying in this report?
42% upside from here. UBS initiating coverage. Triveni Turbines, first off, on the business, it's a global player in the renewable steam turbines market. It's a market leader domestically in steam turbines. Really strong growth is what UBS is penciling in, much ahead of consensus. So I'll talk about the levers first. One, energy efficiency and a multi-year growth tailwind on that count. $3 billion market opportunity is what UBS sees here. 100 megawatt steam turbine space is where Triveni Turbines operates, and the scope for market consolidation there is large. Shift in global supply chain further will add to the positivity here. The healthy growth in biomass and other sustainable avenues for captive power presents a large opportunity, and there's a very solid cost and capacity advantage which Triveni enjoys and will continue to enjoy. Now, in terms of what could the other levers be? One, increasing exports of both large machines as well as services over the next 12 to 18 months, and a credible global scale-up is what UBS is really looking for. This, they believe, is underappreciated by the consensus. The margin upside in terms of potential because of growth is very, very strong. They're expecting a 23% growth in product, 28% growth in after-sales service, FY24 to 28. We'll come to number expectations now. 14 and 34% revenue CAGR in domestic and global opportunities is the top line CAGR expected, and they're pricing this at 50 times price to earnings, which is a 25% premium to other peers, but justified is what they're saying.
Okay, so Triveni Turbine is something UBS is excited about. Shrikant, I'm just wondering if you're tracking this stock? Shrikant, if you can hear me?
Yes. Yeah, I think, see, this type of stocks, they show some activity whenever there is specific development on the fundamental side. Otherwise, if we see the overall technical pattern, then there is hardly any major thing to notice. The stock was it was around its important crucial levels, and it was finding difficulties to cross the level of 850, 860. Now it is very close to its long-term averages. So close to these levels, risk-reward ratio looks quite favorable for those who are want to buy with a view of next 6 to 12 months. But with a very short-term view, I think it is still it will need some more time to consolidate and to move upward. So at this level, for traders, I think we should look for taking a pause.
Okay. So Triveni Turbine, what else are we spotting this? Look at the markets this morning. Interesting pattern. Bajaj Finance in action after the numbers and showing an uptick to some extent in the pre-open session. But what comes to mind is Tata Motors. Tata Motors perhaps set up for a rough start. Shrikant, are you looking at Tata Motors closely? Anything that you're spotting after the pre-open session?
Yeah, I think, see, it is based on the numbers, we can see a lower opening, and I think it is opening somewhere close to its lowest levels of 700. But if we consider the technical pattern, then I think the bad news is already priced in. The stock has fallen to its extreme levels before the announcement of the numbers and all. So it is diverging positively. I am of the view that if there is any lower opening or further more weakness in the near term, we should look for adding these stocks with a positional point of view.
What levels would you add Tata Motors?
I think close to 700, or maybe in the worst case scenario 670, 75. So I'm not expecting stock to fall below the levels of 670 so easily, but there are a fair amount of chances that the stock can again move back to the levels of 850.
Okay. Nirav, based on the earnings pictures that you've seen so far and based on the reactions that you've seen, are there any stocks that have moved very substantially on the downside over the last couple of weeks that have moved too far, in your opinion, that provide buying opportunities as things stand today?
I think as we spoke, there were a lot of stocks in the mid-cap space which have borne the brunt of the fall in the market. And as we see the numbers coming in, I think slowly the sentiment is changing. We saw stocks like SRF being beaten down. We've seen stocks like BHEL being beaten down, CG Power being beaten down in trade, Deepak Fertilizers correcting substantially. But come the results, and I think most of these stocks have reacted positively to the numbers. So I think we have to wait and watch for the numbers, and hopefully things should turn around, because we've seen a ray of hope, especially from all the numbers which have been announced yesterday. Why not these numbers? I think even Exide has performed quite well. So there's been a whole host of numbers. Particularly, I think we found SRF very, very encouraging on the numbers front.
All right, 20 seconds to go for the market to open. Expect a flat start, but not a day which is bereft of action, because remember, you have expiry coming in, 2 days to go for the budget. Focus will be on key reactions to numbers. Bajaj Finance on the one end, Tata Motors on the other end. That's what I'm assuming you will see on the heat map when it opens. But then let's take a look at the first ticks coming in as we open for trade today. Completely flat, as the Nifty implied showed you. We'll see if we even hold up at these levels. Key supports getting activated perhaps through the day, but very range-bound kind of a day. I want to pull up what the Nifty PSU banks are doing if I can. The Nifty Bank doing okay, not half bad. PSU also fairly flat, but more red than green right now. The bias seems to be on the negative side. Can I see Nifty IT just very quickly and see if there's any impact there at all? Well, completely flat. So flat day, not too bad. I think in the kind of market we are in, not too much action will also be a good thing. Let's pull up the heat map very quickly for you, and one would expect that you would have a focus more than anything else on results. Well, as we said, Bajaj Finance top of the charts there, but Tata Motors taking a knock to the chin, miss on all fronts. Positive commentary is not making the cut. Brokerages have also cut their EPS targets. 8% down on a Tata Motors. Remember, the word from our technical analyst on the panel today, Shrikant Chauhan, is that maybe it's a buy on dips. Is it at these levels? We'll come back and ask him. But apart from that, it's a pretty range-bound market. It's Tata Motors on one end and Bajaj Finance on the others, as we expected. Bajaj Finance, Bajaj Finserv, good set of numbers, something that the street was hoping for. It's a panacea for the street right now, and that's why we're seeing that pack in the green. Everything else is sort of middling, and in a range of, 1 to 2% is the price action on the upside or the downside. ITC Hotels, of course, is here, kuch dino ka mehman, so that's pretty much flat, nothing great happening there as well. More action, I suppose, on the broader end of the market, Alex, and that to stock specific rather than the indices.
Indeed, and that's exactly what I was going to say. There's going to be a lot of action. For now, though, the mid-cap index at the benchmark level, let's also mark that. 0.3% for the mid-cap index, about 0.2%. So not too much to speak of at the index level, but really the action is going to be in individual stocks, and we've marked so many of them already. Significant updates coming through. Let me start with a comment. Actually, before we do, let's also mark the sectoral indices, because Tamanna has talked about IT. It really was the hero yesterday. It's not doing too much in trade today, though. What is doing well is realty, and it continues to bounce back from what some might call an overreaction over the course of the last couple of weeks. In January, it has fallen over 20%. Energy is up about 0.7%, but not too much in the way of big movers. Auto is down about 0.9%, but that's largely on account of Tata Motors. Motors. Let's talk about the individual stocks then. And Whirlpool of India is the first stock that I would like to mark. It was in Neeraj's watch list, and indeed this is a stock that is reacting very, very sharply on the downside, and this is primarily on account of the announcement that the owner, or rather the parent, is going to be selling stake over the course of the coming quarters. Brigade Enterprises, very strong numbers coming through, and it is reflecting in fact in the stock price. Hitachi Energy was on my list. Wow, what a good set of numbers, and more importantly, as Neerav pointed out to you a short while back, the order book looks very, very strong, as a result of which the outlook for the company is as strong as the result that it displayed in the third quarter as well. SRF, we spoke about this as well. It was on my list. Let's see if, okay, so it's not doing too much right now. It's down about 0.2%, and let's see if that changes over the course of the day. But decent set of numbers. As Neeraj pointed out, 2:30 is when the conference call takes place, and perhaps to a certain extent, traders, investors are waiting for some clarity to emerge there as well. It has turned into the green while I've been speaking to you. Blue Star is up about 0.8%, decent numbers. Bansal Wire also posted a good set of numbers in the third quarter. We've got Voltas, which disappointed though. It was a miss, and in fact, it was a miss on the bottom line and on the EBITDA front, as a result of which the stock is taking a bit of a battering. The other one that we didn't point out, JK Paper, was a bit of a howler in terms of results, and that really is being reflected in the share prices down as much as 7%. Allied Blenders, on the other end of the spectrum, has had a decent quarter. In fact, this was on Tamanna's radar at the start. She pointed out it was a thumbs up, and it is reflected in the stock price today.
Just a brief bit on the advanced decline, if we can just pull that one up. Look at that. I mean, decent outing, more so at the market-wide level, right? Which is actually something that you want to see. Very quickly, a few names. From some companies from yesterday's show, right? So bring up Suzlon, for example. Is it starting off on a good note again today? Ami Organics. I thank my producer for actually pulling out the right company first. Suzlon is up 5%. It was up 5% yesterday. Ami is up 4% because it was up 20% yesterday, but it's a right stock to bring up. Bring up Ami Organics once again if we can. 4% higher after the 20% up move yesterday. So, yep, Sohana, Mahima, whoever it is, thank you for that. The other thing is Keynes Tech, which got hammered day before yesterday. I think had a bit of a lean period yesterday. Let's see what Keynes Tech is doing today. So that's the other one. KPIT is the fourth one that I want to bring up. Keynes Tech, just kind of caught up in something. KPIT, another 7%. And here's, I'll tell you why. I think the commentary from the management, you will hear from them at about 9:50, but I think the commentary from the company is not bad. JP Morgan's target on this one is 1800. So they say it's a very strong one. So keep that in mind. The last few days, Anantaraj has been caught in the eye of a storm. I wonder if today is the same case. So should bring that stock up as well. No, a semblance of sanity for this one, much needed for shareholders there. So keep that in mind. Alex would have marked Hitachi, but I'm tempted to just mark it again just to see what it is doing now. 13% and counting. Last couple of stocks. Agility, very good acquisition in the US. Let's bring that stock and see if that is reacting. 5% higher. Triveni Turbines, UBS initiated coverage. 50% upside, 900. Again, maybe Alex has marked that, but positive start to this one too. So good, strong show by a clutch of names. Shrikant, I'm coming to you first. Anything that stands out? Part one of my question is that. Part two of my question is two stocks from yesterday, which are continuing the up move today. Suzlon up on a 5% upper circuit. KPIT up 8% yet again.
Yeah, I think Neeraj, if we go through with KPIT, then there technically also it is showing a lot of strength. It has spent a lot of time whenever the stock has fallen to the levels of 1300, 1350. We saw a good amount of buying attraction, and yesterday also after the numbers and based on the commentary and all, we saw a good amount of buying interest in the stock, and the stock has reversed almost all its multiple highs of last few days. So based on its technical formation, I am of the view that the stock is heading for at least 1650, 1700 in next few weeks. It will take some time, but broadly the stock has reversed its bearish trend. For Suzlon, I think it will take some more time. But again, if we consider the technical pattern, then I am of the view that the stock is like going to consolidate some the stock is going to take some more time to like perform from here. So we may see the stock to remain in the range of maybe 60 and 45 on the downside. So in case if there is any weakness in the market, then the stock can fall to the levels of 45. And if we go through with other stocks, broader market, then I think defense stocks should do well. Yesterday, we saw good amount of buying interest in railway companies. We are expecting further more upward activity in next 1 or 2 days of time before the announcement of the budget. And we also like Hindustan Aeronautics as well as Bharat Electronics. So both these stocks should be on the watch list to take short-term long positions for ahead of the budget.
Okay, let's look at some more key movers this morning, and what really comes to mind is what is happening with the Brigade Enterprises. Let's talk about Brigade just for a second. We're going to be talking to the management in a few minutes from now, and keen to see how you look at it. Shrikant, I'll come to you first on this.
See again, technically, if we see all these real estate companies, then most of them have hammered badly in this month. This stock has also broken its important support line at 1100, 1120, and now it is like reversing after the management commentary and all. But otherwise, I'm of the view that at higher levels we should be careful. In fact, we should look for reducing positions if there is any pullback in the near term, close to 1200, 1250 levels. From the real estate basket, we like Lodha developers, I mean to say Macrotech developers, and we also like DLF. But I think at these levels, we need to be very, very careful while adding them with a long-term perspective. Yeah, with a very short-term perspective, certainly we should look for taking some trading bets.
I just wanted to get your take, Nirav, on Whirlpool. And of course, news factors, which is why you're seeing that stock 20% down, further step down of stake to the foreign parent. But how do you look at the developments and Whirlpool? Of course, we probably stuck in a socket for a better part of the day.
Yeah, actually, Whirlpool has been reporting a very, very lackluster performance since the last couple of years. I think we've been tracking the stock, but I think nothing really positive in terms of the performance. And no improvement in the performance. The competitive intensity in the market is going up, and there's stiff competition in the marketplace. And now this talk about the promoter pruning down the stake, I think is definitely adding to the problem. So I think their problems are likely to get compounded from these levels, and I think it's on the downward trajectory.
Okay, Nirav, leave it at that. Thanks so much for taking the time out and being with us. The interesting part about Whirlpool, and if we can pull up the 1 year chart of Whirlpool, and that tells you a story. It was around these levels in Feb last year when the management sold the stake. Look at that chart. It's coming back to those levels, but in between, the stock is down. Yes, if the business is doing well, it is not always that a management sellout is the indication of the value that the market perceives the stock will have at that point of time. Because you can argue that ek saal ke baad kya hua, the stock is back to those levels, but in between the stock went up to 2100. So that's the point. I mean, I'm not saying that this reaction is unwarranted. Yes, for a global major to cash out twice in less than 13 months from their Indian arm and in such large quantities is a red flag for sure, and therefore the reaction is duly warranted. But I'll be really keen to understand from the managing committee in Whirlpool India about how is it that they are seeing the business independent of the call that the promoter entities is taking. So certainly want to watch out for that. But it's very interesting. Here's a company which has presumably done well in India, and amongst a group of MNCs, wherein a clutch of MNCs, Tamanna, everybody that we spoke to in Davos is increasing exposure to India.
They're running for the door.
And they're running for the door. Is this a sign that they are wanting to expand business in India, but taking advantage of the valuations that the Indian market is giving? Because Hyundai is a classic example of a company which doesn't get valuations in Korea, but does the IPO in India. So is this the sign that people will do business in India, list in India, take advantage of the valuations, and let that not be an indicator of what the business will be.
I don't know. I mean, we'll only know if we get a clear voice from the management. I'm not sure if Whirlpool in market share, etc., with a lot of now competition heating up, has had that same kind of move going forward. I mean, I don't know if Shrikant, no point really of a view from Shrikant on Whirlpool because it's on a circuit right now. But Shrikant, just very last take on anything that you have spotted and want to talk about in the first, I would say, 10 minutes out of trade?
Yeah, see, like this defense and railway stocks, they are like really doing well. They are participating in the current uptrend of mid cap and small cap companies. In that, prominently, we like Hindustan Aeronautics as well as Bharat Electronics. From the railway basket, we like RVNL, we like Railtel. In fact, IRCTC is also doing well. It is up nearly 5-6 rupees from its previous close. But if we go through with few other stocks from the NBFC basket, then there we like Bajaj Finance. It has broken its, I think, all-time highest levels, close to 8100 levels. And based on its technical formation, now the stock is heading for the levels of at least 8500. But yes, currently it is much higher than from its previous lowest level. So in case if there is any correction because of any reason, we should look for adding Bajaj Finance also to the positional portfolio. We like Shriram Finance also. So I think NBFCs, railways, defense, I think these are the sectors where we should look for taking some short-term bets in them.
Buy Tata Motors at these levels because we spoke about it before markets open.
Yeah, it is down. It is like, I think after opening to the levels of 680, 85, it moved to the levels of 700. But see, the stock is going to take time to recover sharply from lower levels. But based on its technical formation and the way there is a divergence in the price activity, I am of the view that it is going to get, it is like going to stabilize between the range of maybe 670, 680 levels.
Okay, all right. Thank you so much, Shrikant. Great speaking with you. We turn our focus to our company now, which has posted a stellar set of numbers in Q3. Will be joined by the management in just a minute. But before that, Anushi, who tracks the space very closely, is setting up the conversation for us.
Right, thanks for that, Tamanna. So the key takeaway for the Brigade Enterprises is its pre-sales number. Now we have looked at a strong number, 29% of the growth, and this is despite some of the challenges in terms of where the approvals are concerned have been persisting, and especially in south markets. We've spoken about this in the second quarter as well, that the residential market had seen challenges related to approval. So strong sign in terms of where the pre-sales growth is concerned, pre-sales volume is concerned, 29% of an uptick here. While if you look at the bookings, that have risen up to 63% at 2,492 crore. Collections also a healthy growth of 27% is what we are seeing. Now this growth that we are looking at in terms of the pre-sales, it is a mix of both the new launches. We had 2 new launches in the quarter gone by and some steady sustenance sales, which is from the previous launches also continuing. Average realizations has continued to improve for the company. This is on the account of the better product mix, which has a commentary on how these realizations are expected to shape up in the upcoming quarters is something we should be watching out for. And 9 month, if you look at the pre-sales number, that stood at 5,400 crore, achieving at 68% guidance. So this is overall in terms of what we should be looking out for Brigade Enterprises. Even in the lease rental business, they were achieved up to 98% of an overall leasing.
Okay, Pavitra Shankar with us, MD of Brigade Enterprises, joining on the show. Pavitra, great to speak with you and thank you so much for your time with us here on NDTV Profit. It's been a good quarter on the face of it, and I think why the street is also excited today is because there were expectations that the approval issues that we've discussed last quarter would sustain. Let's start with some visibility on that. Has there been some kind of a resolution of those approval issues in the state? And is that what has also lent itself to the kind of numbers that we're seeing?
I think we do still have approval delays. It's a little slower than what we would like. But fact of the matter is we're working through them. We do have a very strong pipeline of launches. So they're coming through. This is we're happy we showed good sales, but we would have liked to have more launches because they're ready and in the entire approval cycle. Same story goes for Q4. We have always communicated that our numbers are heavily dependent on launches, although we are still seeing good show on the sustenance sales aspect. So our performance still depends on these approvals coming through. I wouldn't say it's resolved. It's just that we are working through them, and over time we're getting the approvals out. I think that's standard across what others are also seeing.
Just one follow-up on that. When you say you're working through them, and the context of me asking this question is trying to understand sustainability, because are your Q4 launches then going to be on track? The solutions that you found in Q3, though not entirely to your satisfaction, can they continue? Just trying to get a sense here on how far this problem is behind you in terms of how it's impacting your performance.
Well, I would say, we're across 3 different markets in South India, so Bangalore, Chennai, and Hyderabad. Hyderabad, our approvals are through, so we don't have any approval dependency for the remainder of our launches. For Chennai, we have a couple of them, and hopefully are towards the end of the process in another project. In Bangalore also, we're towards the end of the cycle for the projects that we wanted to launch this quarter. So what could happen is that they could slip into the next quarter, but we're not looking at heavy delays where we're not having any visibility. It's just that in terms of timing and in terms of what we'd like to see on a quarter-on-quarter basis, it's sort of not up to par with what we would like.
Pavitra, good morning. Neeraj here. So this 12 million square feet launch pipeline that you am I understanding this correctly? You're saying is not heavily dependent on timely execution due to approvals. Yes, approvals would help you execute in the way you want, but suffice to say that this pipeline is the one which provides strong visibility for growth.
No, my comments were actually related to Q4.
Only
when
Q4.
I say rolling, so the 12 million is actually applicable for the next 4 quarters.
Yeah, of course.
I have good visibility for Q4, but beyond that, of course, like we are still in various other stages of approvals for the launches that are coming out in say Q1 FY26 and beyond. So for Q4, we have decent visibility. And I think for the remainder of the next 3 quarters after that, we are still working through those.
Some interesting signings, West Chennai, Bengaluru, etc. on Whitefield. I just wondering, are you sticking to the product offerings that you've consistently worked for you, Pavitra, or are you moving up the notch a little bit? Because I'm presuming that real estate prices, they haven't moved up in Mumbai at all, or very marginally, but I'm guessing in the markets that you're operating in, there are some upsides that you've seen.
Then it's a good time for you to buy, Neeraj, if they haven't moved up at all.
You think Mumbai prices will move up?
I'm not as familiar with that market, but it's a great market. In Bangalore, where we have predominantly a lot of our portfolio, we are seeing prices increase across our portfolio. We've seen it improve 37 to 40% year over year. But that's a mix from both. A comment to what you were saying about the product mix, is it changing? For sure, for Brigade, over the last year, we have gone into the more premium segment, whether it is Brigade Icon in Chennai, Brigade Gateway in Hyderabad, Brigade Insignia in Bangalore. These are all much higher end launches, and that's also contributed to the increase in the overall price, the average price realization that we're showing. That said, the average price for just mid-segment and upper mid-segment has also gone up. So that has also contributed to the increase in pricing. Overall, I think we are looking at maybe 20-25% of our portfolio coming in from the premium segment. But I think we will still continue focusing on mid-segment and upper mid-segment, because that's where the true demand comes in, and that's where we see a more scalable opportunity, whether we're talking about Bangalore, Chennai, or Hyderabad.
Pavitra, just one point on the core numbers and the margins that we've seen this time round, robust improvement. What is contributing to this? And is this now the metric that you're looking at in terms of margin in the 28% range?
So the margins, if you're looking across Brigade Enterprises, it's contributed both by the office segment, hospitality, and residential. Residential, some of the projects that are coming up for the revenue recognition have been able to show, we've been able to lock in those higher margins. So that's why you're seeing that overall increase compared to a few years ago, where some of those projects were slightly lower margin. The price increases that have been coming through, the land costs at which we were able to acquire these projects that are getting registered today, all of those things are contributing to these higher margins. But I think, apart from like a few basis points difference here and there, it's more or less what we will see going forward, because the projects that are being sold and constructed over the next couple of years is where we've seen the higher price realization. So I think the margin outlook is still pretty good in that sense.
Pavitra, we're speaking with you a couple of days before the union budget. What is your expectation from an industry perspective and from a company perspective?
Quite honestly, the real estate industry keeps asking for a few things. Typically, the industry status for the sector, which would help in terms of lower, interest costs and single window clearance and faster approvals and streamlining of a lot of the regulations. I think while it's not necessarily part of the union budget, GST is something that really has to be rationalized, not just for real estate, but also related sectors like, the GST rate on cement, which is, say, 28%, extremely high. Definitely some more incentives for home buyers. Interest rates are good, but it would certainly help if interest rates were also lowered and some kind of tax benefit reintroduced on affordable housing. Affordable housing is something that I think should be on the government's radar, just because we are seeing a dramatic ramp up in pricing, and at some point affordable needs to be a priority again. So whether it is in terms of bringing back something like the Section 80IB benefit, maybe lowering GST on input costs for the affordable housing segment, even relooking at what should be considered affordable housing. Today it is still 45 lakhs, which is considered as the ticket size limit for affordable housing, which where customers can avail of a 1% GST for those kind of products. That's been the same since 2016 or 17, whenever the regulation was first introduced. So I think all of those things would really help if we could make a kind request.
Well, maybe some bit of it is being heard through this medium, if not now, then digitally at a later point of time, Pavitra. But wishing you all the best for all of the approvals and execution of this very healthy pipeline for the next 12, 24, 36 months. Thanks so much for speaking to us today.
Thank you so much.
That's Pavitra Shankar of Brigade. The stock is duly reacting to the kind of numbers that they came out with, as is KPIT, by the way, to the kind of numbers in the commentary. Let's get across. I had a conversation with Kishore Patil. Let's hear out what he has to say about deal wins, geographical expansion, and more.
So I think there are 2-3 things. First is we are very, very, as you know, the business model is working closely with the client. So we understand the pain the client has, what are the real issues they are facing. It is not only generally only about the cost, but certain issues in terms of their competitive pressure, what they have. The one important factor about KPIT as compared to any company, I can tell you, is the most spread out revenue portfolio across the regions, whether it is US, Europe, and Asia. It's a very well spread. So what happens is, in case there is some pressure somewhere in a quarter or two, we are in a position to really generally get over it because of our presence in the other parts of the world. And basically that has helped us. I think, as you can see, the Asia has really grown significantly in last 2 quarters, and that has really helped us. And this quarter, actually, again, it is driven by Asia. It is driven by actually propulsion and connected services area. So actually, that's what has helped us in terms of the revenue side. On the margin side, we have been saying that actually over the last 1 year, actually if you look at last 3 years, we have increased our revenue per person and contribution per person consistently. And that really gave us the confidence, and specifically the revenue mix, both in terms of areas where we could get the better license or platform sales. Also, the offshoring helped us in increasing the margin. I think that's what basically gave us that confidence on the revenue and margin side. The last but absolutely very important, you can see that reflected into a very strong cash flows during the quarter, and the deal wins. The deal wins, basically, if you look at 236 million, one of the strongest in this quarter, that gave us that confidence to talk about the overall year and increase the guidance on the profit margin.
The interesting part about deal wins, Mr. Patel, is that while Asia has done well for you, the deal wins, I believe, includes European OEMs as well. The larger belief is that European OEMs are struggling, and yes, China's market share has gone up per se in the world, and therefore, the belief is that because they are struggling a bit, their purse strings would not be loose. In fact, they might tighten that. I would love to know what is that side of the equation shaping up for you, because you have a strong presence with some of the top customers there.
Yes, absolutely. And I think there are 2-3 at a high level, I may just say. One is the kind of offerings we bring in are absolutely relevant to the client at that point of time. So that is very important every year, every time. I mean, we just had a very good CES in US. And we bring in the offerings which are relevant to the client for the next year. And that way of presenting and giving those, solving their problems, solutions, giving them the solutions, that helps us. And that has helped us absolutely. The second thing we believe is our share of wallet is very, I mean, it can be more than doubled over the period. I'm not saying in a year or two, but over the period. So that actually means that in case we come up with a value proposition, in case we deliver a better value to the client, there is an opportunity for us to grow.
Wow. Mr. Patil, here's an ER&D player, Autofocus, telling me that while the sector may have its idiosyncratic issues, but because these are large companies, you can actually grow your revenue per customer over the course of the next few years from where it is right now, which leads me to kind of ask you a question about you likely not being very perturbed about growth rates, not just for Q4, but presumably for the next couple of years as well. We know the long term is good. The next couple of years is well, the people had question marks. I know you will give your formal guidance at the end of the year, but I'm just trying to get a sense that you're not too perturbed about growth rates.
See, as a philosophy, when we decided to focus on automotive and mobility, basically we thought there are, in automotive world, there are 2-3 factors I would like to lay down. One factor we thought is if we really become the true leader in terms of value to the client and the relationship, then we will grow when they are growing the revenues, right? They are increasing their spend, absolutely. If they are not increasing their spend or cutting on that, we'll get a higher share if we bring a better value to the client. The third thing, which is actually more interesting right now in the automotive, is they are reducing the conventional spend and increasing the new tech spend, which is the sweet spot for KPIT. And that's one part which we would like to do. We understand the markets are not really the best, and as you can say, it's a bit of a lean period. But what we believe is there are opportunities. There is we have also expanded in terms of off-highway commercial, our presence. We believe that there are, again, as I said, new tech spend which OEMs will do. So overall, we believe there are good conversations. I cannot say exactly how the growth will be, etc. But I can only say that our pipeline has grown substantially in last few quarters.
So good to know. I mean, your comments around how new relationships are being built with truck makers as well. You're adopting this in China and rest of Europe outside Germany, and all of that is maybe not newer areas, but developing areas or adjacencies, if you will, in the geographies that you were present in. Just one last maybe couple of questions. Is this whole thing around skilling? So now I know the people issues are a thing of the past, but the new issue that seems to come up is what AI can potentially do to businesses and to manpower-focused businesses. Any thoughts here, Mr. Patil, about whether this disrupts the business, enhances the business, or can you actually improve per employee productivity as a result of using AI skillfully in your business offerings to your clients?
Undoubtedly. And as I mentioned, last 3 years, we have increased our productivity per person significantly.
Right.
In last 3 years, you can see consistently. So we believe AI will be a great, again, a great technology for us, which we are adopting wholeheartedly. All the three things we are doing. One is how we run our business, every part of our business. How do we do the software development and integration? And the third is how we bring us a differentiated value proposition to the client. We are bringing in all the three areas, the AI part, and we are very focused. We believe it will improve it will certainly improve the productivity for us.
Okay, one focus stock that we need to talk about for a bit is Laurus Labs, moving this morning after the US has approved an emergency humanitarian waiver for HIV treatment. Now, this is important because, first of all, context, yesterday the US president put in place a funding freeze of the aid that the United States gives to various countries in various ways. It was an all-round blanket funding freeze. Today, a waiver has come specifically for HIV treatment in 55 countries, and it's being called an emergency humanitarian waiver, which allows people in 55 countries to continue receiving HIV treatment. This was approved after the freeze in the first place threatened life-saving supplies. Now, a US program is called PEPFAR, supports over 20 million people with HIV globally. The freeze had halted delivery of HIV medicines, malaria drugs, and supplies for newborns. The waiver has restored this. So why is Laurus Labs in focus? Because PEPFAR, that's the US humanitarian aid program, related business is 9% of consolidated sales for Laurus. The maximum impact on their EBITDA could be 4 to 5% for FY26. So Laurus has stopped investment for ARV business almost a year back, but this relief over here is something which has perhaps helped Laurus Labs for today. So Laurus Labs in focus. So is Raymond. A good set of numbers there coming in from Raymond, and my colleague Mahima had a conversation with Amit Agarwal, the group CFO, just a short while ago.
Look, fundamentally, if I look at the engineering business, it comprises of three components. Number one is an aerospace component, second is auto components, and third is the engineering consumables. As we all know that aerospace components have got few customers, and one of the large aircraft manufacturer, I don't have to name, everyone knows, that was going through its own challenges in terms of labor issues. And therefore, what happens is they were not able, or their tier suppliers were not able to take the supplies from us during the last quarter. And that obviously for us is a very high margin business. Now, because of that reason, if your volumes are low, sales are low, then your ability to get the margin on that business is low. Secondly, we have also seen that in the third quarter, that the auto component business, especially in Europe, most of the auto companies have taken an extended shutdown or have reduced their deliveries from their plants. So that also impacted. However, the fourth quarter seems to be very, very different, where we are seeing a little uptick on the auto component side, that people are resuming back in Europe and continuing to demand for the products, as well as in the aerospace. As we all know that aircraft manufacturer has resolved its labor issue and is coming back to life in terms of production, and the whole supply chain is gearing back. So to that extent, we are seeing an improvement in the fourth quarter and going forward. So we expect that margins to recover back. and we do not see that pressure which we had seen in the third quarter. It is a temporary pressure because of these two extraneous reasons which we had to take up. And it's a B2B business, so you can't change from today to tomorrow the customers.
Right. So in terms of the outlook for engineering business, that is, in the 3 to 4 years, you expect 2 to 3,000 crores of revenue and EBITDA of 500 crores. Does that change or does that still hold true for you?
It still holds very, very strong. We are on a journey which is not having any aberration because of impact of 1 or 2 quarters. As you know very well that the whole progress is very well planned. We have invested capex, even to your news that on 27th of January, we launched or we completed the installation of another 1 million ring gear capacity at our Sinnar facility, which was received very well by our auto customers. And I think slowly it is just a small shift of production for the third quarter by the European guys, and slowly it will come back. And India, we continue to believe, is going to do very, very well, which is, again, we enjoy a great market share in the Indian domestic market.
Got it, Ms. Agarwal. In terms of the real estate margins, we saw an uptick this quarter. But 9 months, if we see, there's a slight downtick in the real estate margins. I want to understand as to, when do we expect a bounce back there and what will be the levers?
So as you rightly said yourself that you've seen the bounce back in this quarter with hitting a 23.8%. And if you look at it, when you launch a project, and as I mentioned last time also, or I think 2 calls before, that in the month of February 24, we launched our Bandra project. And when you launch, and this is the first project of Raymond Realty launched outside of Thane. So you have to do a little bit extra marketing, extra effort in terms of telling the world that this is a project of Raymond Realty, which has seen such a great success in Thane, is coming into a newer location outside of Thane, which is in Bandra. And I think that all expenditure, extra expenditure we have to incur, based of maybe call advertisement, putting the brand together, because we are a brand builder. We are not just a common developer or a real estate player. So therefore, it requires, when we do things, we have to do things in a Raymond way, which makes us a long-term sustainable player. So therefore, we are not looking just a 1 quarter impact, as I mentioned for the engineering business. We are looking to create an impact over a long-term cycle. And as the quarters come by, you have seen yourself that in this quarter, we have seen a margin of 23.8%.
Right. Right. Go ahead.
So like we have told you earlier that we will continue to maintain our margin profile in that range of 20 to 25% in the real estate business. I think we are well on track for that.
Got it. In terms of the new launch, the new tower in the Address by GS 2.0, I just wanted to understand as to what's the pre-sales been like, because now you would have started receiving bookings there. And what's the ticket size like for this particular tower?
So again, it is one more tower of Address by GS 2.0, which is actually, I feel call, is a hit product or a hit configuration for the group. I think we have launched more than 4 towers, and this is the 5th one. So therefore, we are seeing a very, very good traction into this, and we have sold almost 50% of the inventory. So therefore, the whole Address by GS philosophy of tower launching is that when you are finishing the inventory to the tune of 80-85% of your launched product, then you launch a new tower, and then you start getting the booking. And I think if we look at it, the Address by GS2 first tower, we are about to give the delivery, which is in any case 2.5 years ahead of the RERA timeline. So therefore, there is a lot of conviction coming into the people that this company did not deliver only one first phase of the project of 10x reality earlier. It is also the second project getting delivered. So it is the theme of Raymond Realty to deliver its project ahead of the timeline. And I think that builds a lot of confidence, and therefore you get the bookings.
That's Raymond for you, but we hit a short break now. On the other side of the break, we speak to Veer Advani, Chairman and MD of Blue Star, about the quarter gone by as well as outlook ahead, and talk about markets and macros with Manish Dangi, founder at Macro Mosaic Investing.
the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
The union budget is around the corner. What could be announced and how will it impact the market? UBS comes out with a key report. UBS thinks the impact of the budget on the stock market would be muted as the capital expenditure and consumption boost could be limited in this time around. But what does UBS estimate the government could announce? We bring you what UBS expects in 5 key aspects.
Welcome. We're talking about Blue Star's results this morning. A good quarter, actually. Revenues up about 25%, EBITDA at close to 35% at 209 crores, a tad above estimates as well. Margins at 7.5% and net profits up 32%. The stock seeing a bit of pressure at this point, however. Veer S. Advani, Chairman and Managing Director, Blue Star, with us on the show right now. Mr. Advani, thank you so much for joining us on NDTV Profit. Let's get your take of going through this quarter and where do you think market share has ended specifically in a quarter which gets some buoyancy because of festive season, etc.?
Good morning. Thank you so much for having me. So at a company level, we grew 25% in revenue and EBITDA grew actually 35%. So we had a good quarter. Margins have improved as well, largely on account of scale. And of course, our operating expenses also have been under control. You asked about the room air conditioner business, I presume, in the market share and festive season. So I'll take that first. The festive season was a strong season for us, and December was a strong month as pre-buying going into the summer was also strong. The industry itself has done well. Blue Star has done slightly better than the industry on account of some of the measures we've taken in backward integration and getting our product portfolio rejig done. So overall, for the quarter, on a standalone basis, our room air conditioner market share improved to 14%. On a full year basis, of course, it will not be 14, but we are very happy to see that for the first time, we've touched that 14% mark, even if it's only for a quarter.
Mr. Advani, let me just come and you spoke about the room air conditioning segment, and yes, that your market share has improved there. Give me a sense of what is happening in the commercial air conditioning segment as well. You've talked about liquidity challenges and delays in order finalizations. Can you expand on that?
Sure. So, our segment one is actually made up of 2 very different businesses. We have our projects business, our MEP projects business, and then we have the commercial air conditioning equipment business. I'm happy to say that, these are both B2B businesses, as you rightly pointed out. Demand has been relatively good. Our execution actually has been very good. So really the quarter is about very good execution on our part, both in order inflow as well as in billing and execution. On the equipment side, we have seen some challenges around customers' liquidity. So while order inflow has been good, we have been controlling some of the supplies because we want to make sure that we're managing our working capital well as well. We're seeing a little bit of easing in liquidity as well as in, overall on the B2B side, it had slowed down in the first half, largely on account of the central government elections. That has begun to ease out, and we're quite hopeful that Q4 should be a return to growth as far as segment one execution is concerned as well.
Mr. Advani, good morning. Neeraj here. The belief always would be that Q1 of a financial year, because of the seasonality impact, will be very strong. I dare say summer seems to have come in early, at least in Mumbai and some of the other regions that I've gone to. Are you sensing a decent Q4 as well? And I'm asking this because not quite clued in on the quantum of inventory build up in the channel versus the demand existing. So it would be lovely to have your thoughts there.
Sure. So, of course, you're aware that the summer season that we have just gone through last year was an excellent season. So both Q4 of last year and Q1 of last year were very strong for the industry. We had supply challenges in Q1, as we had explained. We had not planned for that kind of demand. So our business got impacted in Q1, but the industry did very well. We're expecting a reasonably good Q4 coming into this year. Of course, like you said, summer may have set in early. We're unsure right now. We can never predict the weather, of course, but early signs are good. Of course, compared to last year, we should see demand growth. We are expecting 20 to 25%. We're expecting Blue Star to do slightly better than the market demand. So we're fairly optimistic about the outlook for this coming season. Of course, Q4 versus Q1 really depends on when that summer sets in. It could be in March or April, just depends on how things unfold. But as a summer season goes, we're fairly optimistic about the outlook for the industry. Of course, consumer products and consumer goods demand has been lower than last year. I will tell you that it's the same in air conditioning as well. It is not that air conditioning has been sort of excluded from the overall reduction in demand, but on an absolute basis, even at a reduced level, growth rate should be very good for our industry. We're expecting at least 20%.
Okay. The other thing is how has been cost inflation? Because again, the jury is out there. So how has it been for you? And what's your sense about how do input cost pressures weigh in on the near term? I'm guessing predicting 12 months out is almost futile in such a volatile environment, but maybe the near term?
So, there's so many moving parts here on cost. I'll first talk about, our margins and how we manage our margins. It's really through driving economies of scale. So as we scale up our in-house manufacturing backward integration, we get a benefit from scale. So that's on that side. But having said that, input cost pressure is mounting. You've seen the rupee moving, and now with the RBI, I don't know whether they've stopped defending the rupee or whether they've just reduced the defense. We expect that depreciation will move a little faster. So that's a big impact on our industry because you know that we're a net importer, although we have been localizing a lot. So between the INR dollar, as well as overall, copper, steel, there's now talk about steel industry looking to impose some import duties. We'll see if anything comes in the upcoming budget. So we have to watch that. And then there's the entire other angle of the US and Trump and what the US will do vis-a-vis China and India. While we don't import a lot from the US, but once the US decides what they're doing with their tariffs, I think we may see some consequences on this side of the world. So it's a little early to comment on that. I know we'll know more in the next 4 weeks, but the INR dollar, is a concern for us, and that will put pressure on input cost.
Since you mentioned the budget, Mr. Advani, and you'll wait and see what happens there, what would you hope to see from the budget? What would help the sector, the industry, and would boosting consumption be a big focus?
So there are two things that drive our business, as you know. In our segment one, which is our B2B business, we really need public capex to come back at the level that it was before the elections. So we're very hopeful that there may be some push by the government to move a lot of that capex along. So that's one ask or request or hope that we have. The other one is on the B2C part. Our segment two business, as you know, is all consumption driven. Anything that can put more money in the hands of our consumers will be a big help for us. I think that's the only two things we need. We're a very regulated industry. There's a lot of push from the government for improving energy efficiency and decarbonization. We are making large investments in R&D, in supply chain, in manufacturing to support that goal of the government. So all we really need is consumers to get some more money in hand so that many more can come out and buy air conditioners.
So, just going back to some of the things that have come out of the results as well is the flow coming in from e-commerce. And I just want to get your sense whether you're seeing that in consumption patterns as well. Typically, the products that you sell, one wouldn't think that it's something that people want to buy from a website or an app. People want to come to the store. Just would be interested in seeing what your observations have been.
So, e-commerce has been, we've been an active player in e-commerce. Our category has been active in e-commerce now for the last 4 to 5 years. Really post-COVID is when it picked up. Frankly, we had expected a much faster move to e-commerce. It seems to have got stuck at a particular level. I think that it is partially, like you said, we're really selling to first-time buyers in tier 2, tier 3, tier 4, tier 5 markets. Of course, e-commerce is active there and is an alternative channel, but we feel that those consumers prefer to go into physical stores. I think the physical channels have responded quite actively to e-commerce and have upped their game. And so the e-commerce seems to have got stuck at that 10-12% level. Now, having said that, that doesn't mean that it's not going to change. What will happen, I think, is with this quick commerce coming into play, while I don't think anyone's expecting an air conditioner to be delivered in 10 minutes, but quick commerce will push the industry and will, of course, and consumers will expect delivery of something they buy within 2 or 3 hours. So I don't call it, it is quick commerce in relative to what we do. Today we do a next day delivery and installation. I think they'll expect a 2 or 3 hour delivery and a same day installation. That's going to put a lot of pressure on the industry and on companies like us to fulfill that customer expectation. So I think that is where the industry will go. And we should see e-commerce share trending up, but we're not expecting it to become the largest channel or really disrupt the entire distribution of our industry.
No, so that's interesting. So I'll do a follow-up on that, Mr. Advani. And yeah, I mean, that would be the day, an air conditioner delivered in 10 minutes. But frankly, 2 hours and installation same day would also be great. Because, sometimes just coordinating when the guy will come and, when you can get time becomes difficult. What does it mean for you cost-wise if you have to deliver to those expectations which you say you see coming?
Yeah, so that is the $1 million question. We are working through that. As you know, quick commerce is very new. So we're working through it. It's a little early for us to comment. There will be an increase in cost, of course, but customers are getting more attuned to same day. So we will put in place some infrastructure in the coming season. We will probably experiment in 1 or 2 markets to see how we can meet that expectation before we roll out anything. So this is all brand new, but an opportunity, I think, for the industry to perform and meet our customers' expectations.
Of course. Meanwhile, a healthy quarter for Blue Star and an edge there in market share, which is what I think is something that the street will watch, whether that persists. Thank you so much, Mr. Advani, for speaking with us on NDTV Profit today. But let's turn our attention to a stock which is clearly in focus, which is Tata Motors, having a very, very rough morning. It was a miss on most metrics in terms of their earnings, but brokerages have a mixed view. Puneet is joining in with more details.
Well, thanks for that. So, brokerages, they have cut target prices for Tata Motors today. Morgan Stanley, while it's maintained its equal weight, it's cut a target price to roughly about 853 rupees per share from 920 earlier. It's a significant upside from these levels as well. But, they are mentioning that, JLR's miss in terms of guidance, as well as lowering its guidance in this particular quarter was one of the key negatives. They've also mentioned that the EBIT margin guidance, while maintained, will put pressure on the Q4 numbers because they'll have to report 10.5% in EBIT margins to fulfill the FY25 guidance, and that seems a little stark. And compared to what the market conditions are in China as well as the UK, is something to watch out for. They've also mentioned that a miss was driven by weaker than expected average selling prices led by higher discounts. So that's a negative on that. Goldman Sachs has maintained neutral view, cut target price again to roughly about 800 from 830 rupees earlier. They mentioned that the China uncertainty has been stark versus the local players, and that's been affecting the performance in China, while Nuvama also has retained its reduced rating with a target price of 720 from 750 earlier. The only positive aspect out of all of this will be the valuations. It's at 9 times EV to like 9 times price to earnings actually, and that's roughly half of what something like a Maruti or an M&M trades at. But for Tata Motors, because it has the JLR division, the EV to EBITDA might be a better metric to look at, and it's cheaper on that aspect as well. So overall, it's a miss across all fronts for something like a Tata Motors, and the focus and impetus goes on the fourth quarter. If they can meet the guidance of FY25, I think that's going to be the next big pivot, along with other launches as well.
Okay. Puneet, thanks. 7.5% lower and not quite perking up despite a slightly positive commentary. But as Puneet said, the margin is the key issue. Meeting that guided number for the year might be difficult. Is meeting guided numbers across board becoming difficult? Let's pose that question to Manish Dangi, founder of Macro Mosaic Investing and Research. And Manish, great having you as always. Thank you for taking the time out and being with us. The question really, that I want to start off with is not about what individual earnings have looked like, but it does seem that earnings are depicting what the economy seems to be going through, which is a patch of sluggishness, of which coming out of is not becoming predictable. Management after management at the end of quarter 2 had said that H2 will be better than H1. We've seen only sporadic instances of strong results. By and large, it's been a tepid quarter 3.
Hey, good morning. So that's pretty much routine, right, Neeraj? Things go up and come down in economy and pretty much everything else that we've ever discussed. So we are in the midst of a cyclical slowdown in the economy, and it's totally expected that relative to bullish expectations, majority of things would be disappointing you. And there is a clear, about 5-7 months back, we were discussing about, potential slowdown in economy. That was a speculation, but it's very evident anywhere and everywhere you see in India and in its economy that, things are slowing. And that's reflecting in last 2 quarters results. This hope that, these slowdowns last very short for 1 or 2 quarters that I hear from many people is, of course, incorrect. Typically, 2 things happen. One, these slowdown tend to sort of drag on for 5-7 quarters at least, if not more, and they never recover without a solid assistance from policy stimulus. So either a major fiscal or monetary stimulus is brought in, or some kind of an external support comes into economy, and that is only when sort of pace of deceleration slows and eventually things begin to recover. So in a sense, the template of both slowdown and recovery is sort of fairly known and historical, and sort of recur again and again, and that is what I think should happen over next 1.5 years as well.
So Manish, can I ask you, in a scenario like this, and we'll get to nuances, but in a scenario like this, I'm just trying to think of the possible assistance that could come to the economy. Because the government is on a guided glide path towards fisc deficit, and because the revenues haven't been that great this year relative to the past, if we assume that the government's hands are a bit tied, even if the capex spends haven't been high, is the mantle with the Reserve Bank to give out something, and therefore does Feb 7th or Feb 8th in that sense become a lot more important in the near term than what Feb 1st does?
So I agree to it. The government is tied to a variety of things. One, of course, the consensus in the world is not to do further stimulus, fiscally, more importantly. Also, our public debt to GDP actually has not rolled down after the COVID stimulus. So to that extent, our hands are tied. Along with, of course, there's sort of a general consensus in Delhi, if you meet people, that these FD has to be brought in as promised. So I totally agree to your view that the likelihood of a major fiscal splurge is sort of a very low probability. And therefore, of course, majority of weightlifting will have to be done by Mint Street, that is RBI, of course. Unfortunately, its hands are also tied to what is happening in our currency. It's very, very sort of unlikely that an emerging market begin to cut rates when its currency, quote unquote, is being attacked. Some sort of folks are writing, to short INR for a variety of, structural or cyclical reasons. And so to that extent, an outright monetary easing, is a difficult proposition from RBI standpoint. I think what should happen, of course, is what is happening outside of the policy, which is, liquidity easing by way of, a variety of instruments, at disposal with RBI. It's also, it is sort of a soft regulatory unwind that is happening right now. Under the previous governor, the regulatory oversight and, of course, tightness had risen dramatically. I think a lot of those policies are being unwound both by, a direct communication, but also soft communication to the participants. I think that should ease a little bit of a pressure. But again, if you are looking for something dramatic, in terms of rabies, we're not living in that context right now. If you heard Fed, right? Powell has actually pretty much pivoted back to hawkishness, and that's not a regime, when actually you can actively and pursue a super light or super easy, rate policy, so to say.
Manish, hi, Tamanna here. I was going through your note and listening to what you've said in your response so far, and the picture, frankly, is quite bleak. We are in the slow lane. There's concern about jobs, the quality of jobs that we are putting together or creating. Household debt has spiked. All of that. But then I see this one line in your note which says, but super pessimists have always been wrong on India. So my question to you is, what is the optimist's case for the India story right now?
The optimists look back in the past and, conclude that, anyone who's super bearish on India has always been wrong. I think the history is the best guide of actually predicting future. And to that extent, for 25, 30 years, and, why 25, 30 years? Since the beginning of this country, everyone has been super bearish on India's both politics and economics. And I think we've proven them wrong collectively. It's a messy setup, the way we work. We really, of course, can't achieve what East Asia and China could achieve. But, to call India a failed state at times, and of course, a failed economy has always been wrong. We somehow chug along, we seem to deliver a 6% growth, irrespective of all the constraints that we face. So to that extent, of course, I make this argument, which everyone does, whoever is guided by the history, that super pessimists are always wrong. What's good in India, of course, it's a great demographics. Your labor population is still growing by 1%. Everything, from education to healthcare to infrastructure, steadily has been improving for not just 5-10 years, but forever, for the last 30-40 years. And all that means that, a lot of our, sort of labor stock, capital stock is will likely continue to sort of improve in terms of productivity. And that should sort of, over a long period of time, should deliver at 5-6%. My quib always has been on the other side, these, so-called, super bullish wallas that, who argue for every 5-7 years, once people forget about the real thing, that, this super bullishness of, India's sectionalism and stuff like that, of course, they've been wrong. And they take people for a ride, so that's also wrong. So in a sense, the truth is somewhere in the middle as far as India is concerned, that it's okay, we're going to go at 5.5-6%, most probably over like next 5-10 years. Also, it is important to recognize that while the big picture growth is 5.5% or 6% is absolutely all right, but in near term, we're going to have a cyclical slowdown. And to that extent, once you sort of contextualize vis-a-vis the market valuations and expectations of investors, you might get a root shock there.
You know, Manish, I'm just wondering how you're looking at the slew of corporate results which have come in third quarter. And I half suspect you'll say that this was expected, but this was worse than expected, isn't it?
I mean, see, listen, Tamanna, as a matter of fact, isn't it surprising that, we're in the midst of a slowdown? Last, growth print was in 5 handle when, a year ago we entered with 8 handle. And yet, the margins actually, until about 2 quarters ago, were actually super elevated relative to any time since GFC. So frankly, there's a big moolah, for corporates have been absolutely making phenomenal profit margins. And so therefore, I believe in rotation, I believe in cyclicality, and it's very, very difficult to imagine that, profit margins would stay as elevated as they are, when the revenue growth is, and the GDP growth, nominal growth is so sluggish. So, I think one of the brokerage report puts out this beautiful chart where it actually argues that how the corporate margins sort of has steadily gone up for last couple of, and I do mention that in my report also, that have gone up, despite revenue growth has been sort of steady and sluggish. So to that extent, I think this rollover is totally expected, the thing about, once educated by history is that you never can time future very well, but moti you sort of know the, direction of it. And I think, this is a little bit of an inflammation in corporate margin in the context of sluggish revenue growth is certainly something which is kind of an odd man out and should mean revert is how I would think for next 1.5 years.
Manish, my final question, I'm just trying to mix some of the things that you've spoken today with what eventually the market likes, which is a slave to earnings. And because the market is comprising of the top 50 companies, who presumably are the most efficient of the lot, even if the wider economy may not grow at the pace that is desirable, can earnings growth still belie what is the common reality on the ground, and therefore ensure that the headline indices stay okay? I think Manish got a call if I'm not wrong, and maybe that's why this just got a bit mixed. But okay, Manish, if you're here, yeah, just wondering if earnings growth can belie what the larger sluggishness on the ground might be because of some of the factors, including what you said, right? Yes, the margins may mean revert, but they may stay higher for a bit longer.
I mean, of course, certainly happen. You sort of look west and, in US, top five economies, NVIDIA, Meta, Alphabet, Amazon, they've actually, the earnings have grown at 45-50% CAGR for last 2 years, even when, economy was so-called growing at just about 2%. Rest of S&P 500, actually, those 495 companies earning growth was just 2-3%. So if you're saying that, if something like that can happen in India, purely from the point of view of, does it happen ever? Yes, it can. And, to that extent, answer to that is yes. Then you could look for, questions and answers to the question as to why. In US, you could argue those 5 or 7 companies did so remarkably well because of the productivity growth, the new terrains that they're actually charting. Is that something similar to happening in India? Is there a sort of pocket where the productivity boom at margin at play? Could you imagine something that, someone has come up with some new tech that essentially helps you produce something that you were otherwise producing for $100 but now 90, and therefore the margins would expand at margin? It did happen, by the way, post-COVID, and that led to a massive margin expansion and therefore the earning growth of 18-19%, even when the revenue growth was just 10%. It's just that, that pocket doesn't seem emergent at any point in any other place right now. I think on the other side, what we see is that, banks, though better priced today, but are struggling because at margin, the source of rapid credit growth there are actually slowing, which is household credit or the retail credit. That's a significant part of indices. Manufacturing, especially tradable one, are right now or are likely to fail major deflationary pressures if US were to erect tariffs. Imagine if US were to have a 20% tariff on anything that it imports from China. China would flood the world, including India. Those wares will actually come to us. And would create massive deflationary pressure. So to that extent, it is not in a macro setup like this. We can imagine the new wave of margin expansion without a technological breakthrough. A frontier economy, Neeraj, and I don't see any major technological breakthrough apart from just one area which I've been bullish on, which is IT. I think we are sort of very well plugged into US tech at least, and I think our firms are agile. They've reinvented themselves over and over again. And I think we'll be great beneficiary of this AI robotics arms race, which is playing out between US and China. There are going to be lot of collateral damages in India, especially in India manufacturing. But I think IT services would actually do exceptionally well. So within India, if I go to pick up where there could be a unleashing of a new productivity gain, so to say, I think I would sort of bet on Indian IT, not too many other places.
And this, Manish, thank you so much for that. Not too many people say this, but yeah, I mean, since Manish believes that history is the best guide of forecasting what the future might hold as well, IT firms have done that over and over since Y2K. Written off, obituary is written, and then coming back.
This time more so than ever after DeepSeek, etc. That how far are we from where we need to be? But you never know what happens. I don't know. I wish there was something more solid than history has shown us. Don't be pessimistic on India. No one wants to be, but we need maybe a clearer light. Maybe you'll see it on the 1st of Feb. That's all the time we have though on India Market Open. Stay tuned. Ask Profit up next, where we get our experts to answer your queries.
This is the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs, and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well for the policymakers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget as well as has been in each one going into the same. We look at some of the key moves that has seen in the Nifty before as well as after the budget, and get you some of the biggest measures that were announced in these budgets and what could have led to the strong Nifty reactions. Let's first look at 2024, because we had two budgets announced in this particular year. One was post the elections as well, and we did see a 1.5% move in just a week after, and that momentum was continued in the month as well. Leading into this budget, there were a lot of speculation, so we saw a downward reaction of the Nifty in the past week, and we did see some of the measures such as the standard deduction being increased to 75,000 for salaried employees from 50,000 earlier, as well as the new tax regime now in having tax-free status for up to 3 lakh rupees per annum for the investors as well. Apart from that, we saw custom duty reductions on mobile phones, gold as well as chargers as well, And these were some of the key moves in this particular budget. Leading up to the election, we had, the 2024 budget in February as well. Let's see some of the reactions, as you can see in this particular time frame as well. One of the key moves was increasing the budget for capital expenditures to 11 lakh crores, the first and a very huge budget as well compared to the last decade. And we did see one of the positive reactions in the week and the month after as well. For 2023, it was a very budget going into this particular budget. Speculations were rife. We did see a negative 2% reaction just in the week before leading up to the budget as well. While the momentum wasn't very strong, and in this particular budget, we did see.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew, and with me is Mahima Bachrajani, and we will take. I stumbled for the first time in a long time on that, but we will take you through the next 1 hour of trade, and we've got lots to talk about. So let's jump straight into the action. Markets looking actually pretty decent at this juncture. Thankfully. So hopefully we'll be building towards gains for a third day in a row, and hopefully we will sustain this through the rest of the session, because what you've seen is towards the end of the session, you have been seeing selling pressure come through, and we've been ending off the high point of the day, certainly. But today, remember, also is going to be expiry day of the monthly contracts, and so as a result of which, expect there to be volatility in the second half. By the way, volatility also the name of the game, and it's not going anywhere. And actually, in fact, it is down a little bit today, but it's still above that 18 mark. Pull up the India VIX, and that will show you what the move today is. Of course, it continues to remain above 18, but it has given up a little bit. Broader markets are actually doing reasonably well at this point as well. You have the mid-cap index that's up about 0.7% or thereabouts, and you have the small cap index that's inching towards 1% higher. And the reason is, and the talking point today, of course, is that the earnings snapshot for the day or post-market yesterday and today is much better than the rest of the earnings season. Can you say that, Mahima?
Absolutely.
Because there are a lot of the stocks that we've seen that we marked at the start that are doing particularly well. Pull up something like a Hitachi, which was on my list at the start today before market hours, and that stock is running up quite substantially. It's at upper circuit, in fact, as we speak right now, because the numbers for the quarter gone by were fantastic, but you also have the outlook on account of an order book that is over 18,000 crore at this point. So prospects are good. What were the others that stood out? Of course, you have on the downside a company that is not reacting to earnings, but the intention by the parent company to sell, and that's Whirlpool of India. It's down in the dumps today, and it's seen quite a bit of a crack, and I'm sure there are more stocks on Mahima's radar that she'll tell you about, but these two stocks stand out to me, Mahima.
Absolutely, and look how it's locked in lower circuit. So one locked in upper circuit with 20% and the other one locked in lower circuit with 20%. Well, Voltas is the other counter which is seeing pressure today on the back of losing its market share. The expectations were higher in terms of the festive season sales, but it's not done very well. It's down about 11.5%. On the other hand, Blue Star is doing very well because it has gained market share in the room AC segment. Good festive season. The management has also guided that they're expecting a 22 to 25% growth going forward as well. It did start with on a good note, up about 4%, but it's down to about 0.8% right now. But some counters which are not doing very well is JK Paper on the back of earnings. Raymond Limited is doing very well. Good set of numbers, revenue up 40%, EBITDA up 75%. JK Paper down by about 6.7%. Raymond has cooled off from its day's highs, but up about 1.3%. Hotel stocks, Sami Hotels and Chalet Hotels also came out with the numbers, but both are a tad bit under pressure, although the earnings were in line. Chalet Hotels is down by about 1.3%, and Sami Hotels also, if you can pull up that, is down by about 5% odd. Afcons Infra is another counter which is buzzing in trade. Allied Blenders is also one of those counters which did very well. Their volume growth overall was 11%, but the prestige and above category saw 42% growth and a 52% growth value growth as well. The stock did see a significant up move in the start of the trade. It's cooled off and now trading about 3% higher. So all of these counters, Alex, are buzzing on the back of earnings as well as news flow post-market hours.
Certainly. All right. And you've marked quite a few. Incidentally, we've got our first caller of the day. But before I go to Anup from Kerala, let me introduce our experts for the day. We've got Kush Bora as well as, let me just get this right, Samir Dalal. Samir, good morning to both of you. And thanks so much for joining us this morning. Let me go straight to our first caller of the day. We've got Anup from Kerala who's calling us. Anup, good morning. And how can we help you today?
Yeah, Alex, hi, good morning.
Good
so
morning.
last week I called Alex regarding this one stock. So they told me to call after results.
Okay.
Same show.
Yes, and that's
So
Ratnavir Precision, right?
This is correct.
Yeah. So go ahead. What is your question?
So results are out actually. So I wanted to know the opinion on like, can I buy or wait?
And what is the time horizon that you have?
18 months.
18 months. Okay. Samir, any chance you've looked at this? It's a very small company. Okay. It's 857 crore market capitalization. It is in fact stainless steel washers manufacturer. I'm not sure. I can't gauge by the look on your face whether you have. Okay, so you're shaking your head. You don't have an opinion. All right. Kush, I'll come to you on this particular counter. Not much in the way of fundamentals, unfortunately, Anup, that we can tell you. But how do the technicals stand up?
Hi, Alex. I think this is one day where you're getting these names perhaps a little mixed up to begin with. I'm just bracing for another.
Did I get your name wrong again?
No, no, Mahima, you fumbled for a second and you paused for Savis, so I'm just bracing for.
No. I have etched your name in my brain, so hopefully that doesn't go wrong again. Please go ahead, Kush.
Hopefully, no. I would recommend waiting out, on Ratnavir Precision. While yes, we are seeing some sort of a positive divergence on, Ratnavir Precision on a daily chart. The weekly setup is actually showing, a fair degree of, downward momentum. Anyway, the stock has crossed below the 200-day moving average for the past 3 to 4 sessions, has not been able to recover. So I think any meaningful buying on this one should be done once the first test of the 200-day moving average is crossed, which comes close to the 169, 170 mark. So I would be a buyer above that. Up until then, I think you should wait out. There could be some more downward pressure coming into this stock.
Right. So that's the view coming in on Ratnavir Precisions. Moving on to the next query. I don't have the query here, Hal.
Let's pull up Hal, in fact.
Let's pull up Hal.
I got it.
Go ahead.
Aarti from Thane is writing in. She's asking about HAL and whether it can be bought at this level. Look, ahead of the budget, a lot of these stocks tend to move, and even post the budget, right? But anything that you want to say, Samir, on the fundamentals and on the valuations, are they looking at least a little more attractive right now?
So definitely they're more attractive than what they were previously, right? So now it's trading at about 22 times or 23 times current year, which is not very, very expensive. But, I mean, look, the business model is very good. They're making certain things which they kind of have a monopoly of. If what we're talking of the India and the Indonesia, or Malaysia's already procured some planes from HAL, and I think Indonesia will also probably do that. If they get some order flows coming from there, the Indian order flow we know is going to continue. They have enough orders to execute over the next maybe 3 years, and that will allow the top line and bottom line to grow. So if the stock corrects closer to the 3,200, 300 odd levels, we are definitely buyers in the stock. At 5,000, if you remember, we were vehemently telling you that, look, this is not a stock to buy at these valuations because there can be many a slip. And there was a couple of slips where, some of the engines that they were procuring from one of their vendors was taking a lot longer to come in, which would delay some of their projects. So if the stock comes to 3,200, where valuations go below the 20 times forward earnings, I think that might make the stock quite attractive from a 2-year perspective, where one can expect a decent return with low risk and capture a decent 20-25% CAGR return over the next 3 years. So closer to 3,200, 3,300, I would definitely be a buyer.
All right, so that's the view coming in on HAL. Moving on to the next caller, Shankar from Chennai is calling in. Shankar, a very good morning to you. I believe you have a query on Laurus Labs.
Yes, very good morning.
Good morning.
Day before yesterday, I bought Laurus shares, 200 shares at the rate of 515.
Right.
Suddenly it went up to around 580 levels yesterday and today.
Right.
My question is, I hold or accumulate at this rate also?
All right. Do you want a technical view or a
only
fundamental?
3 months to 6 months time frame.
Understood. Kush, I'll come to you. The stock is up because of the US waiver that restores HIV treatment in 55 countries. But what's the view on charts?
I'm a little pleasantly surprised by the surprise in his voice that the stock has immediately gone up. But kudos to you on buying it at the right price. You've bought it near bottom level, so take some courage, that one. I think what you can do now is place a trailing stop loss at 555. If you see the last a month and a half, 2 months, that's the support zone that the stock has respected for the most part. Today you've seen a gap up opening, so that might perhaps come into fill. But then I think with the kind of price momentum and the volume action that you're seeing, there's a good possibility that the rally might continue. I won't suggest accumulating more because there is resistance near the 610 mark. But definitely with the kind of moves that we saw yesterday and continuation today, I think you should continue to hold with a trailing stop loss of 555. If the stock crosses 610, you should bump up your trailing stop loss to the current price, which is 585. So ride this momentum, a good catch, a brave one at the low price, and now continue to ride the momentum. Don't accumulate, but ride this momentum.
Okay, we've got an interview with Maruti Suzuki lined up in a very short while from now, so we've got a couple of minutes. In the automotive space, though, let's talk about a counter that's not doing well. Tata Motors, let's pull that up. And Hashmi wants to know whether or not it can be bought. It's off the low point of the day, which incidentally was 8% lower thereabouts. On the fundamentals, would you suggest that you can enter? Essentially, what they're looking for is a bottom fishing strategy. Samir, what would you say?
If you're a long-term investor, yes, definitely I would recommend Tata Motors as a buying opportunity. Seeing significant correction from the highs. And rightfully so, because, if you remember at the end of Q4 last year, the management had very clearly guided that this year they're going to see a bit of pressure on the profitability and growth because of the global situation that exists, because the biggest part of their profit comes from Jaguar Land Rover, and they were seeing difficulties in Europe and China. I don't think the Chinese problem is over. And also, if you remember yesterday, the con call was there. They clearly said that they are reviewing the situation that is in China because they're not sure of how the sales are going to pan out there. And that is one of the reasons that the stock is up. But I believe now the worst for the stock, which you ask me on the correction basis, is over. So if you're asking for a short-term bottom fishing, I don't have an answer. Can the stock slide a little bit more? Probably can. But if you have a 1 to 2 year horizon, and I believe that Europe will see a recovery, I think China will see a recovery, India continues to do well, the commercial vehicle business did well. The passenger vehicle, they have new launches which are lined up, which will also see good traction. And if you see in the electric vehicle Jaguar Land Rover side, they have a good order backlog also. So we believe the profitability from there will also start increasing. It may take a couple quarters more before everything stabilizes. So also I would recommend a buy on Tata Motors.
Okay, there's a buy on Tata Motors. Incidentally, Maruti Suzuki, we were talking about it just before we started this program. Some of you will remember the old advertisement, right, about petrol cars. Papa ki kara petrol khatam hi nahi hunda. And essentially, this is a company that's now talking about becoming the largest electric vehicle manufacturer in the country. How does that pan out? This is one of the questions that I asked Rahul Bharti, who is Executive Director, Corporate Affairs at Maruti Suzuki. But I started by asking about the margin picture. There was a bit of a deceleration. Here's what he had to say.
Our net profit increased by about 12.6%, almost in line with the volumes. And in terms of margin, our EBIT to net sales ratio was 10%. It was almost in line with street expectations. And sequentially, it was down by 30 basis points, but year on year, it improved by about 10 basis points. As you rightly said, sales promotion did impact by about 20 basis points. There were higher advertisement expenses by about 40 basis points. Forex was adverse by about 20 basis points. We had some higher depreciation because of Kharkhoda, some facilities, 20 basis points. So a total negative impact of 100 basis points of adverse factors. And there were positive factors of about 70 basis points, owing to about 40 basis points commodity and 30 basis points some operating leverage. So that was a net result. Broadly, we were able to maintain our EBIT margin.
Okay. Mr. Bharti, now one aspect of that and what has negatively impacted the margins to a certain extent, and you measured that, was the discounts. And that really is a prevailing trend in the market. But one of your products, what you've relaunched, you're talking about the Desire, and a lot of people talking about the star rating on the NCAP ratings and the fact that you've got very strong bookings for that. That should be a big shot in the arm, shouldn't it?
Yes, it is. And as you rightly said, the Desire is one sedan which does more volumes than all sedans put in the market across the entire industry put together. So that's a huge advantage for us. And the relaunched Desire is even better with all those technology and features, etc. And we've got very positive response to the Desire in the month of December. We've closed with about 20,000 pending orders. There was some production constraint also in December, but we'll remove that in going forward in January onwards.
Looking at, so obviously the battery at this juncture will be brought in from outside?
At SOP, yes, the battery will be imported. Yes,
so, but the rest will have very, very high localization, right?
Generally, EVs would have a higher import content than IC engine cars for obvious reasons. IC engines have been around for more than 40, 50 years. EVs have just started, but we are increasing our local content, components like the motor and other parts, the axle, etc. We will be making efforts to localize.
Just the last question from my side. If and I'm sure that this will come to pass. We're talking about the largest car manufacturer making a statement that it will manufacture a certain number of electric vehicles. But how will this change the mix in terms of the margin picture? Will that materially shift?
We have to acknowledge that EVs will have lower margins than IC engines for obvious reasons. If the margins were equal, why would the government have to give so many, financial incentives or subsidies, whether it is central government or state government, whether it is demand side or supply side? So obviously there is a viability pressure, which is why the government is also intervening. But that is something that we have to take in our stride, and we have to balance the interest of all stakeholders, our investors and society, our environment goals. That is the task at hand. And one thing that helps towards this is presence in multiple technologies. So we will be using all technologies to reduce carbon, of course, starting with electric to like hybrid or natural gas or biofuels.
Okay, so I do want to point out that the last two questions had to do with the launch of the e-Verito, which is something that the company is focused on very keenly. Remember, Maruti Suzuki is one of the late entrants into the electric vehicle space, and they've made a very big statement when it comes to electric vehicles. What they've said is that in the first year of launch of the e-Verito, they want to be the largest Indian manufacturer of electric vehicles, and that's a very big statement to make. e-Vitara rather. So what they're saying essentially is that they're going to manufacture 70,000 units, and there's going to be a component of that that is going to go towards exports. So they're going to export to several markets initially, and they're going to bolster the infrastructure in the domestic space as well to facilitate that transition to electric mobility. The last couple of questions which you just heard, one had to do with the fact that they're going to be bringing the battery in, and initially at least the e-Vitara is not going to have a very significant amount of localization, but they'll build that up going forward. There will eventually be a little bit of an impact on the downside on margins, because electric vehicles have a smaller margin or lower margin than petrol vehicles or ICE vehicles, internal combustion engine vehicles. But certainly something to track, and you'll be able to hear the entire interview later on in the day. We've got a caller from Bengaluru. Manohar is calling us. Manohar, hi. Thanks so much for calling. How can we help you today?
Sir, I want to buy Cordon Future Tech shares.
Okay.
For a period of 6 months to 1 year.
Okay.
Is it the right time to enter?
6 months to 1 year. Okay, so you've seen the price action and you're interested in buying the stock. Is that right?
Yeah, exactly.
Okay, fantastic. Kush, on the charts, quadrant future tech. It's done pretty well. Do you have enough data to talk about this for the short term?
I'm afraid I don't, Alex. But 10-15 not trading sessions, not too much. So I'm going to have to pass.
Okay. So, Samir, then if you've tracked this, okay, you're shaking your head. In this, in the space, then, would you say there's, but is it a good idea to buy something like this, or would you wait for the dust to settle?
So honestly, I don't know what this company does, so I don't even know what space it is in, to be very frank. I mean,
I don't blame you because you've got quite a big coverage. And let me ask you this then, Kush, from the stocks that you've got, and if you're talking about a 3 to 6 month trading view, what would you buy in today's market so that Manohar has something to take from this conversation?
Oh, absolutely. I think the banking space is starting to see some revival. I have one stock which has actually done very well, and has only come in to see some sort of profit booking, which is Karur Vysya Bank. If you see the moves on this one for the last year, and I mean year, whatever has happened in the recent past will only seem like a bit of a blip. So, and this dip actually is a very good opportunity to start accumulating Karur Vysya Bank. I think from a perspective of 3 to 6 months, perhaps even longer, this is one stock that he could keep adding in his portfolio. Just recently, we've initiated a call again on Karur Vysya Bank. Very near-term targets are 235 and 242 with a stop loss around 222. But I sincerely believe that this stock has a potential to go to 260, 275 levels as well, by the end of the year. So Karur Vysya Bank on our radar has been doing rather well, could continue to do so.
All right, so Karur Vysya Bank is the pick that Kush has given. Just for viewers' context, Quadrant Future Tech basically manufactures specialty cables and develops train control and signaling systems. So it's an interesting space to watch out for. Moving on to the next query, Vinay has a query on Bandhan Bank. He's bought 300 shares at 192 a piece, and he's saying that now the price is around 150 rupees. He's sitting on a loss of around 12,000 odd rupees, and he wants to know whether he should keep holding it considering the earnings that will kick in. Samir, I'll come to you. Bandhan Bank, what's your view?
So, last time, I think, or time before that, we spoke also, we discussed Bandhan Bank. And the biggest problem that we have is every time we think that the worst of the pain for them as a company is over, something else spikes up. Now, in the sense that they have huge microfinance loans as a percentage of their overall book. And that segment is where the struggle continues to happen. So there's a very strong possibility that we get maybe 2 more quarters of bad numbers, unfortunately, and provisioning remaining high. So the stock may remain where it is. For me, I think I would take my loss and find another banking stock to put my money into and try to recover it there, no problem. But I believe there might be more upside for other companies that don't have to deal with problems and can focus more on growth rather than solving the problem in the microfinance, which is a very large component of their overall book.
Okay, let me ask a follow-up on that, because we've spoken about your picks in the banking space as well, and you are nodding very agreeably with Kush when he spoke about the banking space. So IDFC first, would you say it was a bit of a disappointment in the third quarter? Are you still very strongly thumping the table and saying it's a buy? And IndusInd Bank, I believe you had said, is a good buy as well. ICICI Bank, if I'm not mistaken, I hope my memory serves me right.
So ICICI is there, but the top pick, of course, is HDFC in the large cap space. IndusInd and IDFC, yes, they're both buys. IDFC may have a similar problem because they do have a microfinance loan. So we remain very constructive on IndusInd because, of course, that part of the book, microfinance part of the book, even though it's large, is much smaller than that of Bandhan Bank. And I believe that they probably have more checks and balances. They've had more checks and balances in place there. Given the cost of funding was cheaper, they could probably attract better clientele and things like that. So I believe that turnaround for IndusInd Bank would be faster. So yes, and IDFC Bank remains a buy. Look, the worst for them is over. If you ask me, the management has also very clearly stated that maybe Q4 will see some amount of provisioning because of certain slippages that happened in Q3. But once that is done, because once they cross the 120 days, they provide for those loans in 100%. So that bit of provisioning might be required in Q4. But going forward, we believe that will start coming down. Now, IDFC First Bank, only 5% of their not even 5, it's 4.8 now. 4.8% of their book is microfinance. The rest of it is the other businesses, which the NPAs have actually remained quite stable. They haven't gone up, and their provisioning also remains stable. So once this problem of this MFI for them, which is a very small component of their book, comes to an end, I think you will look at a re-rating. We remain, like you asked me, is it a thumping buy? Yes, it is a thumping buy for me. I remain very constructive. And just as a disclaimer, at 58, when it did correct, we did add some more.
All right, so that's a comprehensive view on the banking space. We have to slip into a very quick break. We've got more on the other side. Do stay tuned.
This is the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs? And what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well for the policymakers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget as well as has been in each one going into the same. We look at some of the key moves that has seen in the Nifty before as well as after the budget and get you some of the biggest measures that were announced in these budgets and what could have led to the strong Nifty reactions. Let's first look at 2024 because we had two budgets announced in this particular year. One was post the elections as well, and we did see a 1.5% move in just a week after, and that momentum was continued in the month as well. Leading into this budget, there were a lot of speculation, so we saw a downward reaction of the Nifty in the past week, and we did see some of the measures such as the standard deduction being increased to 75,000 for salaried employees from 50,000 earlier, as well as the new tax regime now in having tax-free status for up to 3 lakh rupees per annum for the investors as well. Apart from that, we saw custom duty reductions on mobile phones, gold as well as chargers as well. And these were some of the key moves in this particular budget. Leading up to the election, we had, the 2024 budget in February as well. Let's see some of the reactions as you can see in this particular time frame as well. One of the key moves was increasing the budget for capital expenditures to 11 lakh crores, the first and a very huge budget as well compared to the last decade. And we did see one of the positive reactions in the week and the month after as well. For 2023, it was a very budget going into this particular budget. Speculations were rife. We did see a negative 2% reaction just in the week before leading up to the budget as well. While the momentum wasn't very strong, and in this particular budget, we did see the new tax regime increasing the rebate to 7 lakhs. But apart from that, there were some continuations of policy measures, but nothing big to report as for. For 2022, it was a very interesting budget because we did see a strong reaction going into the budget just a week before by roughly about 2.5% on the positive side. But in the next week, as well as the month after, we saw sharp reaction.
Welcome back. You're watching Ask Profit, a show that answers all your stock-related queries, whether they're fundamental or technical. For viewers who are just tuning in, you can either call us or WhatsApp us on the number that's flashing on your screen. We have our next caller, Ricky from Mumbai is calling in. Ricky, a very good morning to you. How can we help you?
Hi, very good morning. Actually, I was tracking a company named Zaggle since quite a few days. and I want to know, is it the right time to enter this company, and how much percentage of my portfolio can I give to this counter?
All right, Ricky, when you said you were tracking the company, were you tracking it fundamentally?
Yeah, fundamentally. I have seen the last 3-4 quarter results, and I think it is doing comfortably well.
Got it. Samir, Zaggle is the counter. What's the view?
Yeah, so the company has been doing quite well. They've been able to get a lot of partnerships in place for their prepaid cards and things like that. Every quarter you see the profitability is moving up. Fundamentally, the business model is good and the opportunity to grow is quite large. But the problem simply is the valuations. If I'm not mistaken, it's trading close to about now, after the run-up, it's trading at close to about, I think, about 65 times at current year earnings. And if we extrapolate certain growth numbers that we have, I think closer to 50 times. So there's very little benefits that can come out of investing at this point of time. Yes, growth is good, but everything comes good. Even growth is good at a price, not at any particular price. So at this point, I would probably avoid it. Maybe if you see a correction of a good 25% plus, then it would probably start looking at something that we could look to add it to make a decent sized return over a period of time.
In any case, you're not going to be able to buy it today since it's locked in upper circuit unless that circuit opens. But Ricky, to the earlier question, I don't think that Samir can answer that question for you. It's based on your risk profile. How much of your portfolio should be dedicated towards one stock? It really is dependent on the size of your portfolio, one, and the conviction that you have. And generally, a lot of fund managers are forced to keep, I'm talking about mutual fund managers, they're forced to keep only 10% of their portfolio in any given scheme in one particular stock, and that's a prudent limit that they're meant to keep. If they are doing that, perhaps you should consider doing it as well. We've got a question on Vaibhav Global, and Sridhar from Coimbatore is asking this question. He's got 50 shares at 799. He's looking at what he should do and the time to exit. He's in a loss right now. So, Kush, on the charts, what's your opinion?
Well, there's a recovery that's being attempted at the moment. So my suggestion would be to keep a stop loss near the support zones of 270. It's not too far from the current price, but that will give him some hope of a recovery close to the levels of about 315. Once that is taken out, perhaps a 350. Still some distance away from, quite a bit the distance away from his buying price. But keep a tight stop loss. If 270 is breached, then the recovery that you're seeing in the stock will also fizzle out. And the medium term downturn that the stock is into might just continue. So tight stop loss at 270, continue to hold, exit near 315 to 350 kind of levels.
I just want to point out, we're getting a lot of questions on very, very tiny companies, micro caps, less than 500 crore even. Synoptics was the last one that I was asked about. It is only 100 crore company. Unfortunately, we're not going to be able to give you a fundamental view on that. If at all, I might be able to stretch it and ask Kush for a view. But even then, I wouldn't hold a gun to his head. Anant is calling us from Bengaluru. Anant, okay, incidentally, I want to say that I would never hold a gun to Kush's head. But having said that, Anant, what's your question?
Hi, good morning.
Good morning.
I was holding Vinati Organics, say around 25 stocks I have. I have it at 1788, and it's been almost 2 years.
Okay.
So the stock has actually not been doing good.
Yes.
So I just wanted to know, can I hold it, or if it comes down, can I average it, or should I get out of it and buy any other?
So quite a bit of that crack, Anant, has taken place over the last 3 months to 6 months, right? You've lost value over the last 6 months, right?
Yeah, I'm holding it from actually 2 years.
Yeah.
But say when it came to 2000 level, it was there for very few days. But I thought it was actually fundamentally a good stock because it is there from a very long time and lots of ups and downs. However, from 2-3 years after the COVID, I see the entire chemical market itself is down due to this Chinese dumping and things like that.
Yeah, you hit the nail on the...
People are...
Yeah, you hit the nail on the head ultimately. And we've been, I think it was Samir that is pointed this out, right? We're looking for turn around the corner, but it's been a corridor, straight corridor. Samir, I can't remember if you said that, but then what would you say about this particular company? Would you hold on?
No, it was me that said that. Alex, I'm quite impressed with the memory.
Yeah.
So yeah, we continue to remain constructive on the chemical space. Like we've been telling you for a while that we've been hoping for a turnaround. We thought that some of the dumping from China globally would start reducing, but obviously it hasn't. The pricing pressure persists. The destocking was the first thing that happened. After that was this China dumping. We are hopeful that if the US government puts in some sort of taxes from China on the chemicals, maybe the Indian companies will stand to benefit. Now, coming to Vinati Organics in particular, they have a couple chemicals that go into the FMCG space, and we believe that there has been a bit of a slowdown when it comes to growth in the overall FMCG within India. And overseas also, if you look at it to some extent, you will see that growth in that space has not been that great given the high inflation. But once we see inflation tapering off, which we starting to see, and we see growth recovering, we believe that these companies will do well. ATBS is one of the largest products. It is kind of like a substitute for a lot of export products, and they've got good tie-ups in place where they're able to leverage that and been able to grow that. They've also got into new products, which is ibuprofen and things like that, which will obviously see a good amount of growth. So we believe that Vinati Organics remains a good company to stay invested in. Yes, the stock has come off from the highs, but as the chemical sector recovers and as the FMCG sector globally recovers, I think the stock will recover. So please hold on is my call.
All right, so that's the view coming in on Vinati Organics. Now, shifting focus to Ask Automotive, it came out with its earnings where it was a beat across all fronts. The highest ever EBITDA margin was recorded in Q3 FY25, and they've also started production of their 18th facility. Now, to discuss as to how the quarter has gone by and with respect to the new production facility as well, we are joined by Kuldeep Singh Rathi, Chairman and Managing Director at Ask Automotive, who is joining us now. Welcome to the show, Mr. Kuldeep. My first question to you is, it's been the highest ever margin quarter for you. You've recorded margins at 12.1%. I just wanted to understand with respect to the margins, will you hold that 12.1% going forward? And where do you expect FY25 to end at?
Good morning, and thank you very much for giving me an opportunity to talk to you. Well, this quarter has been our best in terms of margins. We have achieved 12.5%. And first of all, let me assure you that we'll be not only keeping it, we'll try to slightly improve upon it. That's what I can say.
What are the factors that have led to this, Mr. Rathi, if you can help us understand, just so that we understand whether this is, Q4, how does it pan out? Does the trajectory go even further, or have you hit a cap?
See, we have invested very heavily, 600 crores in the last 2 years, as you know, in our Karoli plant and in the 18th plant in Bengaluru, which got commissioned on 14th January. Now, as the capacity utilization increases, we'll be just improving and not only maintaining, little bit improving these EBITDA margins.
So capacity utilization and therefore better operating metrics taking place, right?
Yes, yes.
But is it also a factor of the mix in the revenue that is aiding you? And
yes, mix is also there because as more and more focus on the high margin items, and especially in our ALPS segment, which is the aluminium lightweighting segment, and that is our sunrise sector, because there is the maximum growth in that sector. So there we are doing pretty well.
Can you help me with the breakup currently in the revenue mix, and with this new facility coming on stream heading into FY26, what is going to be the kind of split in the revenue mix?
This year also the split has changed by about 2%. So the aluminium segment is going to 44.5%. And our brake segment is 36.5%. These are the two main sectors, and the safety control cable remains at 4 to 5%.
Right. And Mr. Singh, in terms of the EV...
I just want to ensure, that was the last year's split, right, Mr. Rathi? What happens in FY26?
No, FY26, maybe it gets better by 1% or 2% more.
For the aluminium space, right?
Aluminium space, yes, please.
Okay.
Right. And Mr. Singh, with respect to the EV, what were the kind of revenues for 9 months FY25 and what were the margins like in that segment?
EV, the margins are quite fine because we are doing very tough and complicated products. But the EV volumes are pretty low. They are only 5% of the total vehicle production in the two-wheeler segment.
With respect to the new plant that is,
Sorry.
Go ahead, Mr. Singh.
But the way, we have EV, the focus is on the lightweighting and thermal management. So our aluminum section will be more profitable and it will keep on increasing, provided the number of the EVs percentage increases, in the total.
Got it. And Mr. Singh, since you mentioned the new manufacturing facility at Karnataka, I just wanted to understand as to what kind of products will you be manufacturing there. And you're seeing that you're expecting better capacity, the utilizations going forward. How much of a revenue uptick are you expecting from that particular plant going forward, let's say by the end of FY26?
See, we are expecting at least 100 crores per month revenue, from that plant. 50 crores per month revenue from that plant going forward in the next year.
Okay, so help me understand then at the top line level, what is the kind of growth that you're anticipating in the new year heading into FY26? And in terms of capacity expansion, what's on the cards? Are we more or less done for now?
We are done for the capacity expansion at this particular moment because we are sorted not only for the next year, we are also sorted for the next 6 months of the next even further financial year. So for 18 months, we are sorted. So any capacity expansion that will come in the maybe second half of this next year, But good part is that our aluminum alloy wheel, which is a new product in the high pressure die casting, that was going to be hit sometimes in the second half of next year. And even that will add to the volumes quite substantially.
Mr. Rathi, then, do you have a question?
As far you asked the growth part, as far as the growth part is concerned, we have always outperformed the industry. And I'm very, very confident that we'll be growing next year also, at least in the mid-teens, minimum.
I do want to ask on leverage and on debt, right? Because I want to understand how this expansion has been funded and where do the gearing ratios currently stand at?
See, all the internal accruals that we have generated this year or will be generating, that is all going into the expansion. And our debt profile will be much better at the close of the year in spite of such heavy investments. And last year, our debt equity was 0.42. This year, I think will close at 0.38. And next financial year, will be closing at 0.3. So the debt equity is going to improve every year because we have a clear-cut philosophy that we will not increase our debt beyond the 1-year EBITDA level. And this year also, our debt will be less than our 1-year EBITDA margin.
Got it, Mr. Singh. One last question before we let you go. 2 days to go for the union budget. Your expectations with respect to the budget?
My expectation is last year also the government had allocated a very good amount of funds for the infrastructure sector, that was 11.10 lakh crores, which the government could not spend. So there'll be heavy spending probably. That's what is the expectation in Q4 as well as the Q1 of the next financial year. Plus, I feel more and more money will be allotted. This money will definitely flow right to the rural areas, right through the common man. And that's what our customers are, the two-wheelers. So I see a good potential for two-wheelers even next year.
Fantastic.
I remain very positive.
Fantastic. On that note, Mr. Rathi, thank you so much for joining us and for being so frank and sharing all the details that you did.
No, thank you so much. Thank you, David. Thank you.
All right.
Good day.
Good day to you as well. All right, so that's Ask Automotive. I just want to very quickly check with Samir. Samir, any thoughts on Ask Automotive and what Mr. Rathi just spoke?
So, we do study the company, although we don't have active coverage on it at the moment. But we think that, look, the growth opportunity for them is there, given the scale-up that can happen in the electric vehicle side. in India, like he said very rightfully, that it's only at 5%. And as that scales up, the aluminum components, because they're lightweight in nature, that product sells more, and you will see that part of the business growing to a larger percentage. And of course, the margins are slightly better there compared to the braking segment. So that would lead to some amount of margin expansion. Growth on mid-teens are about, say, even if he delivers a 15% with some margin expansion, we're talking of about a 22% growth in profitability next year. If we assume that and take a PE valuation multiple based on that, I think the stock still trades at about 34 times FY26. Which is a little bit, I wouldn't say cheap, but not expensive. I mean, not cheap, but not expensive either. So, upside in the near term may be capped. I think we could see the stock probably consolidate. Corrections down closer to 380 levels could throw out buying opportunities for decent returns. But we believe the long term remains good. Fundamentals are decent. And growth will continue to happen, but they will need to put in more capex after a year and a half. So, in this kind of a business, capex requirement will always remain high. So, cash flow throughout will not be that great. But like I said, growth is good, and as long as the company can continue growing, it makes a decent investment.
Fantastic. Okay. And that's exactly what Mr. Rathi also spoke about. The need for capex will come through maybe after the first 6 months of next financial year. That's certainly something to watch. Sameer, thanks so much for that view. Pradeep is calling us from Kerala. He's asking about Paytm. Pradeep, you've bought at levels of 983, which is elevated levels. When did you buy?
Good morning, Alexander.
Good morning. Good morning to you.
How are you?
Very well. Please go ahead.
Good. Yeah, I bought actually, I don't have the system right now, not right with me right now. I think it's like 1 month or something like that.
Okay, 1 month. Okay. No, basically you want to know whether it was a recent acquisition. What do you want to know?
Right. I would like to know is, it's add more or just to hold for until wait little more going down.
And what's the time frame that you're buying for, Pradeep? Long term or short term?
I got a 10%. Actually, most of the share, I have a set. My thing is I almost 10% or 12% when the profit coming, I just remove and buy another one.
Okay.
So that's the way I do.
So you churn your portfolio quite often, but have you bought Paytm on the fundamentals or is it a technical call that you have?
Yeah, the technical, hopefully the technical is fine.
Okay, got it. Kush, Paytm 983, so slightly elevated levels. I know a lot of people got in at the bottom and managed to do that, right? So, but what's the view on the charts?
Not too encouraging just yet. The stock started cracking way before actually the markets did, and with market falling, the fall has actually only accelerated. If you look at the revival that the stock has had from those 300, 320 odd levels, all the way up until about 1,000 or so. The stock, if you see on a daily basis, is only at about 38% retracement. I'm afraid, even a 50% retracement comes to 700 odd levels. So there could be a possibility that he might see some sort of, a downtick before the stock starts to move higher. My suggestion would be to keep, a strict stop loss near the 700 mark. If that is breached, then, the near-term structure will actually be disturbed quite a bit. But till the time that level is held, not a bad idea to continue holding on to this one. I don't expect a V-shaped recovery on a lot of these names, Paytm included. But yes, a stop loss around the 700 mark and a hold on Paytm.
All right, hold is the view coming in on Paytm. Moving to the next query, Vijay from Chennai wants to invest 1 lakh in DRL. He wants to know whether he should invest at the current levels or wait for further downside. What's your view, Kush, on this?
A lot of these pharma names have actually seen quite a bit of correction. The good thing about Dr. Reddy's is that it's very close to the medium-term support zone of 1150, 1100 odd levels. So from a risk-reward perspective, and that the stock has actually reached oversold territory, it's not a bad idea to start accumulating at these levels. My stop loss on this one, as I said, slightly deepish, would be close to the 1100 mark. On the way up, you could look at a 1250 kind of a level first. Once that is taken out, even at 1280, where the gap was created, a few sessions ago. So from a risk reward perspective, I think this is starting to look attractive. Once this gap is filled, I actually expect the stock to move higher to 1350 levels also. So a couple of levels there on the upside to watch for. Stop loss 1100, not a bad time to start accumulating DRL.
Not a bad time to start accumulating Dr. Reddy's Laboratories, the view coming in from Kush. Moving on to the next caller, Manav from Delhi is calling in. Manav, a very good morning to you. How can we help you?
Good morning, everyone. This is Manas Chawla. I'm calling from Delhi. And I just want to inquire that I'm holding 100 shares of Amara Raja at the price of around 12.30 a piece.
Okay.
And I need a fundamental view. I'm a long-term investor, and I just want to know whether I should hold it or accumulate it, because the stock is trading around, I think, 1,000, 1,050, somewhere around that mark.
Okay.
So should I add more? I can hold it like to 4 to 5 years. I need a long-term view.
All right, the query is pretty comprehensive. It's trading at 1034 a piece right now. Samir, I'll come to you. 4 to 5 years, Amara Raja, should he keep holding and accumulate more at current levels?
Hi, Manav. Congratulations for being a long-term investor. We like people like you in the market. Yes, I absolutely believe you should continue to hold and average out. Look, they're getting into the electric vehicle battery manufacturing space and lithium-ion battery. And that is going to be the big growth phase, if you ask me, in India over the next many years. It's going to take a bit of time for them to set up that factory and get it on stream. And, once all of that starts happening, I think you'll see the top line and profitability continually increase. The valuations are not challenging. It's trading at about 20 times current year earnings. And if I project, look, next year may not be the greatest of year again because they're still in the capex phase. But going forward in FY27, I believe you will start seeing some decent amount of growth and profitability. So any corrections like we have right now are time to add on. And if it slips further, please add on some more to that as well.
Okay. All right. Critical player in the automotive space, battery manufacturer. We've got Keshav calling us from Tamil Nadu. Hi, Keshav. Good morning. How can we help you?
Hi, good morning. Thanks for this call. I need one information regarding this Waaree Energy.
Okay.
I'm planning to hold for 1 year.
Okay.
The query is, right now, my average is 2801.65.
Right.
So can I accumulate in the meantime, or what shall I do next?
And you've got a 12-month time horizon. When do you acquire these shares, Keshav?
I think since September, I would say.
And you've accumulated over a period of time, right?
Yeah.
Got it. Kush, it's seen a beating, and in fact, quite a few of these stocks have. But would you suggest the prospects for the next 12 months are good enough to suggest a hold and even accumulate at these levels?
Alex, I'd like to toss it over to Samir, just because for a long-term view, the data is fairly limited, only 3 to 4 months of data on this one, maybe a little more, but not enough for a long-term view, I'm afraid.
All right, Samir.
So, Waaree Energy is one of the stocks that I would probably avoid at this point of time for the simple reason that they are very focused. They have focus on export market and the US market in particular, where Donald Trump has exited the Paris Treaty, which is setting up of renewable energy in a particular point. So we are going to see more of reduction in the subsidies that the US government gives. So that profitability for Waaree Energies is going to take a bit of a hit. Now, if you want to be in the renewable energy space, one more thing, they make solar panels. So now when obviously reduction in demand comes to solar panels internationally, they have to cut prices to sell it maybe in other markets like India or wherever else. So the profitability for Waaree could come under some pressure. You want to play a space in the renewable energy space. There are EPC players in India, or there are players who cater to the domestic market. So I'll give you two stocks. One of them is Sterling and Wilson Solar, which is part of the Reliance stable. They are pure EPC manufacturers. So you give them an order, they tender for it, and they earn about a 10% margin on setting up the business. So their stock price is corrected from 800 to 300 because of the reduction in guidance in the current year. But the guidance for the next year remains strong. It remains at 10,000 crore turnover. And if they're able to deliver that, if we extrapolate the profitability that can be generated for that, it's trading at close to about 24 times earnings, which is actually quite reasonable given the growth opportunity that lies there. A similar company in India is another one which has also seen a huge correction, is KPI Green Energy. It's a Gujarat-based player. Now, where they differentiate a bit is they own the land. So what they do is they don't set up these huge parks, but they go to players who want to set up small capacities. They set them up on the land that they have, and they charge a rental, and they charge a fee for setting it up, and then they charge the O&M. So they have three streams of revenues that come from them. For rental income, from setting up of the EPC part, and then the O&M. So that business also will continue to see scale up. So the smaller companies who can't set up these huge gigawatt plants can go to them and get it done, and they're able to generate renewable power at a decent price compared to what they're probably procuring from the grid. So that is another opportunity. You've seen a good correction over the last year or so. That would be something that one could look at. These are the two stocks I would recommend over Vari at this point.
Okay. All right. So I didn't interrupt you because you were giving us such a comprehensive view, and this is useful for everybody tuning in. But we are completely out of time. Samir and Kush, thank you so much for joining in. Always a pleasure having you on the program, and look forward to the next one. All right, that brings us, as I said, to the end of this particular edition of Ask Profit. I know a lot of you have written in and not gotten your answers, but then we've discussed quite a few interesting stocks and ideas that you can take as well. From Mahima and myself and the team that put the show together, thank you so much for watching. This is NDTV Profit.
This is the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs, and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
Well, the union budget is right around the corner, and we get you some of the major wish lists according to Bajaj Broking, the key sector expectations, as well as the three key stocks that you should watch out for in this particular budget. Let's start with some of the key budget expectations in terms of sectors. In terms of banking, they have mentioned that they're expecting no favorable terms in terms of deposits to come in, but capital infusion for PSU banks as well as insurance companies will be something to watch out for. When you move on and look at the other key expectation from banking, they are expecting that the focus of the banking and the financial space will be on sectors such as cement as well as the metals, which haven't done too well over the last 2 years. Import duty changes to support any kind of domestic production will be something to watch out for, especially for the metal space, because we are expecting and hearing rumors as well in terms of some anti-dumping duties on metals coming from China. When you move on and look at the key other expectations from the infra space specifically, a key sector to definitely watch out for, capex allocation for roads and railways is something that's been standard. It's been increasing steadily over the last 6 to 7 years, and this time again it will be something to watch out for. Apart from that, announcements of any kind of large-scale projects according to Bajaj Broking, likely a new freight corridors will be something to watch out for as well. When you move on and look at specifically from the auto space, it is expected that the allocation for PM E-Drive and the auto PLI policy will be something to watch out.
Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Today, we're talking about a company which has moved from strength to strength over the last 1 year. Hitachi Energy India. The code name on BSE is Power India. Now, this used to be a part of ABB India back then, and well, we've seen the company will eventually become a JV with Hitachi back then. So it was ABB Power Products and Systems. And in 2020, Hitachi and ABB Power Grids business formed a JV. And that's when we got this particular business. On December 22, ABB divested its balance in this particular JV. And since then, we only had Hitachi. Since then, it's also called Hitachi Energy, fully transitioned into Hitachi Limited. Now, and which is why at the moment, this is Hitachi India. What does this company do? Well, composed of 4 business units. The first one is grid automation. That's also followed by grid integration. Well, I'd reckon that to a certain extent, smart metering also forms a part of this. High voltage products and transformers are the other 2 aspects of this. And as we know, the transformers in this sector has picked up substantially over the last few quarters. In terms of its key clients, it does serve the utility space particularly, and as I was talking about smart metering, but besides that, industries, transportation, data centers and infrastructure sectors as well. That's where the gamut lies with respect to where the clientele comes from for Hitachi India. But on that note, let me talk about, once again, the factors that have determined how Hitachi India has moved. So as usual, we talk about the fundamentals of the company. We talk about how the company has done over the past few years in terms of your revenue and profitability, growth, what sort of an order book it has, because it'll give you a better visibility with respect to the order book coming in. Then, of course, we have the balance sheet. Let's not forget the cash flows, of course, are important. And all these will form an important part of your income statement. Financial statements. But moving beyond just that, we also talk about the shareholding, street credentials, which will mean how the company has done in terms of its price action, the current valuation picture, and the street coverage as well. And joining me at this point in time is my colleague Anushi, who's also going to give us a lot more in terms of insight as far as this particular company is concerned. Anushi, welcome and thanks for joining in. Let's start by talking about how things have panned out for the company's revenues and profitability. I reckon that the quarter gone by has been a strong one, which is why I believe that's also locked in upper circuit right now. But the last 9 months have also been strong. What can you tell us about all these aspects?
So Agam, let's see how the company has been doing since FY22, and then we'll take the Q3 and the 9-month picture into consideration. So looking at FY22, 23 and 24, so if we are seeing the figures over here, in 23 we did see a dip in sort of where the revenue growth is concerned, but then FY24 we had a double-digit growth coming back for the business. So on the revenue front, it has been going strong. Even if you look at the Q3 numbers, 27% of a revenue growth is what we are looking at. And even 9 months, this is also 27% of growth is what we are seeing. This is with a revenue of 4,501 crore at the end of 9 months of this financial year. As compared to, if you look at FY24, that figure stood at the total revenue for FY24 was 5,237. So comparing FY24 to, and just now that 1 quarter is remaining, we are looking at a significant amount of revenue growth in terms of where that is concerned. EBITDA margins have remained majorly in the 6 to 7% of range, with the EBITDA seeing a little bit of dip in FY23, and 24 it picked up again. Net profit, we've seen significant growth from 23 level onwards. Now, if we take yesterday's numbers in consideration, the company came out with its numbers yesterday. So here we are looking at EBITDA was up around 146%, margin stood at about 10% versus 5.3%, and net profit at 137 crore as compared to 23 crore. In the 9-month performance, we are looking at margin expansion to 7.94% in comparison with 4.7%, and net profit seeing about a 299% of a jump. So this is in terms of the operational metrics. In terms of where the income statement is concerned, we are looking at this sort of growth.
Okay, so that's as far as your income statement is concerned. I'll talk to you about the order book, and the order book does seem to be very, very strong at the moment. At present, the total order book stands at around 19,000 crores. It has won orders worth nearly 11,500 and in fact 11,600 crores for the quarter gone by in the third quarter. However, we must remember that this is on account of one very large order, and this is for the Khavda-Nagpur HVDC order. If you leave that on the side, it's still a relatively large order inflow. And given the fact that we have 19,000 crores in terms of your revenue, on an average, the company is slated to do around 5,500 to 6,000 crores. And I'm making an assumption here. It does look like it has a visibility of another 2.5, 3 years, and this is just based on the current order book. We must also remember that the fourth quarter is the quarter in which you tend to have a higher amount of awarding activity. So it's going to be a wait and watch in terms of what kind of orders does the company get. And where does this overall order book stand at towards the end of this financial year, and that will give us a much better idea in terms of visibility. That said, when it comes to your current order book at around 19,000 crores, it's certainly a very, very healthy one, and it does give you a good amount of visibility over the course of the next few years, which is possibly why we're looking at the valuations at which it is currently trading at. But we'll come to valuations in some time. Let's talk about the balance sheet as well. Anushi, what can you tell us here?
Right. Before we go to balance sheet, I just want to make a quick mention in the order book that you've mentioned. This surge that we are seeing in the order book is because of the HVDC orders. Yeah. And the company is very focused on increasing the shares of these HVDC orders that are there. In fact, they're bidding for higher projects as well. So that is something we can keep a track of, and how this higher order books in terms of execution, what this could mean for the business going ahead. But where balance sheet is concerned, we are looking at a net worth of about 1,360 crore. This in terms of where the short-term debt is about 150 crore and with the cash balance of 128 crore. So it's a healthy balance sheet figure that we are looking at if you take the debt and the cash account in consideration. So even the financial metrics over here for the balance sheet looks healthy. But cash flows also, I think it's a similar picture that we are building on, right?
Right, absolutely. It is, good cash flows from operations are pretty steady. So if you look at FY23 and FY24, again, 352 crores from FY23, that's cash flows from operations, and 250 crores from, FY23. Maybe in terms of the net cash flows, you've seen actually an outflow in FY24 to the tune of nearly 199 odd crores. But given the fact that you have a positive stance coming in from CFO, that's cash flows from operations, it's going to be pretty steady, which is why we're giving it a thumbs up here as well. I'm going to shift focus to the shareholding as well at the moment before I toss it over to Anushi for the street credentials. In general, if you consider how things are panning out for the company, since of course it's since ABB products have moved out, we have Hitachi India, which holds about 75% in the company. That has remained steady. There's been no change. What we have seen over the last few months, that is the first 9 months of this financial year, is that your FII holding has increased by nearly 1%. Your DIO holding has also increased considerably, and that's the reason why we're actually looking at a little bit of a drop in your other holdings. Now, those two numbers need to be switched because there's an error there. But if you actually consider the way things are panning out for FIIs and DIIs, these are positive moves as well, which is why we're going to give it a thumbs up. Besides the fact that the promoters hold 75% in the company. So that's certainly a positive as well. And Anushi, I reckon that it's done very well as well in terms of price action.
Absolutely. If you see the last 2 years price performance, it's gone up around 4x. So a multi-bagger for all the investors out there who were looking to invest in the stock 2 to 3 years ago. If you look at 1 year chart and also 1 year performance, in fact, we are looking at gains of around 100% plus. So in terms of where the street credit is concerned, in the last 6 months, however, we've seen about a 3% of a growth. But let's see that even if it's peers, if we take those in consideration also, they have done more or less similarly to what Hitachi Energy is doing. But over the long term, it's been a multi-bagger for the investors out there in terms of where the street performance is concerned.
Okay, so a very good performance out there. I'll talk to you about the valuations. And valuations look rich. There is no doubt about that. So Hitachi Energy currently, I'm going and I'm making an assumption that it will make about 400 crores in terms of its bottom line. Do remember in the first 9 months, the company has already made 200 crores in its bottom line, which is why, 400 crores may be a tad bit on the higher side is in terms of the expectations. But even if you consider, 400 crores on the bottom line and its market capitalization currently standing at around 51,000 crores, that comes to your price to earnings ratio for the ongoing financial year at around, 127 times. It looks expensive. There's no doubt about that. What if the company doubles its revenues in FY26? Under those circumstances, its price to earnings ratio comes down to around 65 times, which is still on the higher end, especially if you consider the price to earnings at which ABB, CG Power and Siemens are going at. Sure, CG Power is also currently at around 94 times. And, if you compare it to Hitachi Energy, again, it's comparable. CG Power is at a discount as compared to Hitachi Energy. But we must also keep in mind the kind of growth that all these companies are seeing. So it's like it's about a double-digit growth for ABB and Siemens. CG Power will depend on the kind of year it has and how it converts a lot of its opportunities. But Hitachi Energy, it does look like it's going to look at around 25% growth in terms of your top line, and that will have a consequential impact on your bottom line as well. That's as far as your growth is concerned. Now, so the question comes down to, what does it mean for ABB as well as Siemens India? The other aspect that we need to remember is that ABB follows the calendar year as the financial year, and Siemens India follows the October to September period as the financial year. So, that's where we're also, we have different periods, slightly different periods when we're considering the price to earnings ratio at the moment. However, if you forget all of this and just keep in mind as to how your current valuations are stacking up at the moment, what we are noticing and what we are seeing is that Hitachi India is at the moment more expensive as compared to its other peers, but there is a reason behind it, and a faster profitability growth is the reason why it's been ascribed such a high price to earnings ratio. That's as far as valuations are concerned. But Anushi, what can you tell us about street coverage then?
In terms of street coverage, we don't have a lot of analysts tracking this company. We have around 4 analysts who have a buy call on this one, while 1 have a hold and a sell call respectively. So the upside potential building up for this is around 27%. But that is as far as where the street coverage goes. But I do also want to talk about the outlook that the business has given. So in the last quarter, if we go back and check what it announced 2,000 crore of a capex, which was for the next 4 to 5 years. And this was across their various segments, which is that's transmission, distribution, data centers and railways as well. And the investments would be utilized for green hydrogen and power transmission business. Guidance, now if you look at that, the standout point of this result was also its expansion in the margins that we are looking at. So this is in line with their target of achieving the double-digit margins picture that we are holding. Along with that, we also spoke about the order book, wherein we are looking at more than 100% of a jump in terms of where the order inflows are concerned. So with the company bidding on these several HVDC projects and expecting at least one of these to finalize, we should see how the execution of these could come into picture, what is the timeline for that, and what this growth could bring for the company going forward.
Okay, so there you have it. So if you consider all these factors, it does look like Hitachi India has done well. It's slated to do even better based on the kind of visibility of its order book right now and the kind of quality of orders that it's making. But where does that leave us in terms of the total rating, in terms of all the things that we have discussed so far? So if we were talking about the income statement, the balance sheet, the cash flow statement, the order book, they were all thumbs up. Shareholding, again, and along with street credentials in terms of how the price action has panned out, it's a thumbs up again. In fact, again, locked in an upper circuit after moving below the mark of 9,000 rupees a share, moving back above the mark of 12,000 rupees a share. Valuations, they do look expensive at the moment. But as Anushi was mentioning, they're also weighing and going in for a relatively larger number of orders, the kind of orders that they've already had in the quarter gone by, and which is why the street is probably, that's the reason why the street is ascribing that valuation. The street coverage, of course, is the other one. And based on all these factors, what we have come up is around 6.5 out of 8. For a thumbs up, you get a mark of 1. For a neutral, you get a mark of half, and nothing for a thumbs down. So overall, certainly in a very good space as far as Hitachi India is concerned. But let's take this conversation forward, where we spoke to the management of the company as well. And we spoke about the quarter gone by, the visibility going ahead, and we caught up with Mr. N. Venu, who is the MD and CEO of India and South Asia of Hitachi Energy, and this is what he had to say. Listen.
So this quarter 3 for us has been a very strong, solid performance in all key metrics. And our orders have grown in this quarter almost 800% year on year, driven by HVDC order, which we have booked in this quarter. Our revenues were higher, almost 31% in year on year. And our EBITDA margin expanded 380 basis points in this quarter. And in addition to that, our other growth levers, exports have also performed very well, and then service has also performed extremely well in that. So all of them have combined together in addition to our execution and operational excellence have added our margin and improvements in that. We have also have very robust order backlog, almost close to 19,000 crores order backlog, which has got a visibility of quite a long, quarters of revenue going forward in that. But even if we leave our large HVDC order, our base order also has a solid growth in that. So all of what we have been saying is that we have been investing in India, we are manufacturing, localizing it. That way we are creating a very competitive portfolio, and with that we are able to win the orders and create the order backlog. And from order backlog, the revenue growth is happening in that. So we expect going forward also, we grow in line with the market or above the market, and we continue to expand the revenue growth.
All right. So at the moment, your order backlog being around 19,000 crores, what sort of an order visibility, what sort of a business visibility does this give you? Over what span in time? How much of this is executed over FY26? And what about the balance? What are the timelines that you're working with?
Yeah. So, we don't give that, how much of the order backlog will go into the each, quarter-wise or financial year-wise. All we can say is that, when you have a strong order backlog, and that will give you, growth in the revenue going forward. And that's exactly what happened. Even if you look at our 9 months of this year, so we have our revenue is around 4,500 crores, which is we have grown almost close to 25-26% on a 9-month basis in that. We believe that this kind of growth is sustainable going forward. A few percentage this way, that way, but that's how we are looking at it. All in all, what we say, we have invested here, we are continuing to invest, and we want to grow in line with the market and above the market, and not only in India but also in other parts of the world where we sell our products.
So, and how is your overall business split between grid automation, grid integration, high voltage products, and transformers?
Yeah. So we have not been giving that, but all I can tell you is that our transformer is one of the biggest portfolio, and followed by grid integration and high voltage, and then grid automation. So
and so is this mix likely to change in the upcoming quarters and years, or do you think that it will more or less be this way?
It more or less will be there. Maybe at some point in time, with a lot of HVDC revenues come in, then grid integration business might almost come in the same level or slightly above level. But that's how it's almost in the same level, because if you look at the energy transition tailwind, you need all our portfolio. You need our transformer portfolio. You need our high voltage portfolio, automation, HVDC. So the growth is also what we have seen, across all our businesses.
Right. So in that case, considering you have such a robust order book at the moment, what can you tell us about your requirement of working capital, also in terms of expansion? Do you think that you guys will be needing more funds Under those circumstances, will you eventually look to raise funds through debt or equity, or are at the moment internal accruals good enough for you to go?
So as you know, this quarter we have also, including advances we have received from the large order, and also a very high focus on our cash. So we become, as of 31st of December, we have a debt-free company. But having said that, we are looking for expansions. In October last year, we announced expansion of our facilities worth around 2,000 crores, and then we have also announced on 18th of January, our board has approved to raise the capital, and which is basically the enabling resolution, and which gives the flexibility for us, to quickly raise the capital as and when it is required for our growth opportunities.
Okay. So in terms of the latest orders, I believe in Q3 you clocked an order inflow of well over 11,000 crores, if I'm not mistaken. And please correct me if I'm wrong there. Where are these orders coming from? What areas are these orders coming from?
So the 11,594 crores what we have received orders in the quarter that includes an HVDC project, which also includes our data center orders and the renewable orders, and also the export and the service orders. So this is how has been the thing. And we have, from the segment standpoint, it's the utilities, industries, data centers, renewables have clocked very high double-digit growth. And we have a bit of slowdown in this quarter from the rail segment. Otherwise, barring that, the rest of all the segments have really given a huge amount of growth in this quarter.
Sure. So I also want an understanding on the current capital expenditure environment. What is CapEx looking like? Of course, we have the upcoming union budget where we're expecting the government to also make a little bit of an outlay here with respect to capital expenditure, maybe spur it a little bit further. Your expectations from the government and what can ideally work and play out in favor of your sector?
Yeah. So my expectation on the budget, if you're talking about, is basically, we expect that the government to continue to focus on investing on the infrastructure, which is very, very crucial on that. So rather, they should further increase the outlay for the infrastructure spend. So then the second wish from my side is that, the energy transition tailwind is a huge, and it's a big opportunity for India to really position well in terms of the technology, and we are extremely doing very well in adoption of the renewable, etc. But we expect that the government to provide some kind of production-linked incentives for a critical equipment like semiconductors, which are required for the energy sector, like HVDC equipment, which is required for this energy sector, and also many other critical elements which are required. So that will really fuel huge amount of manufacturing ecosystem in India.
So there is this aspect of one-time large order for the HVDC. I reckon that to a certain extent that has pushed up your order inflows and your order backlog. So my question then is, in terms of your expectation, in terms of order inflows, what sort of a number can we expect ballpark over the next few quarters? Of course, we also must consider the fact that we are going into the fourth quarter, which is seasonally a quarter in which a sector like yours sees the largest amount of inflows in orders. So can you give us an idea about what the next 2 or 3 quarters could look like based on your conversations with clients?
Well, what I can tell you, yes, this quarter has been largely driven by a large HVDC order, and this HVDC order will not repeat in every quarter. That's also a thing. But as I said, if you take out this large HVDC order, our base order growth is also very robust in this quarter. So all I can say and confirm that, on quarter, our order inflows growth will be there. Depending upon the market situation, at least a high single digit to high double digit is what we are looking at.
All right, that's the management of Hitachi India telling us about what's in store for the upcoming years. But on that note, we are out of time on this edition of KYC. Lots more lined up on the other side. Stay tuned in.
STT. STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets. General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs? And what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
The union budget is around the corner. What could be announced and how will it impact the market? UBS comes out with a key report. UBS thinks the impact of the budget on the stock market would be muted as the capital expenditure and consumption boost could be limited in this time around. But what does UBS estimate the government could announce? We bring you what UBS expects in 5 key aspects. The first one's, of course, the impact on the stock market. Government's fiscal deficit, which occurs when the government's total expenditure exceeds its income. The third aspect would be infra companies to be impacted in this key budget, changes in the capital market structure and taxation, and finally, what government companies could be divested this time around. Now, UBS feels that the budget might not boost the market as the expenditure on consumption as well as capex might be lesser compared to the previous budget. Now, this time it is assumed that if the fiscal deficit is contained at 4.5% of the GDP in 2026, it could of course be a shortfall met by borrowings. Apart from this, UBS feels Good afternoon and welcome back to NDTV Profit. This is Markets at 12 and I'm your host Puneet Zaveri. Let's first look at how the markets are doing because we are seeing the Nifty being in the green today, and let's also pull up the Nifty quickly as well as the Nifty contributors because you're seeing a lot of stocks react on the back of quarter 3 earnings as well as expectations today as well. We are expecting a lot of Nifty 50 companies to come and report numbers today, the likes of L&T as well as BEL. So the defense pack will be active. Some positives today on the Nifty, of course, is contributed by Reliance. Bajaj Finance on the back of its good quarter 3 earnings also, in the green, while M&M has also been in the green on the back of earnings of other competitive peers not being up to the mark. We are expecting a strong quarter for something like an M&M also in Q3. On the losing side, we are seeing some pressure on Tata Motors definitely, and we're going to address the stock today as well. The quarter 3 earnings, net profit down 22% in this particular quarter, and that's not and apart from that, some other key commentary as well, and what to watch out for in terms of Tata Motors will be something to watch out for. Let's also quickly look at the advances and decline ratio as well, because we are seeing a consistent move over the last couple of days, sometimes on the downside or on the upside. Today we are seeing roughly 1,500 stocks advancing in trade while 700 are on the declines. Let's also quickly look at the broader market indices as well. So the mid cap, and the small cap indices to watch out for. We are seeing 0.4% on the mid cap 150, the small cap 250 is also roughly trading in a similar range, and finally the Nifty 500 as well, the top contributors, because we are seeing some big moves coming in stocks on the back of quarter 3 earnings. And we are seeing Hitachi Energy being one of the biggest gainers. The company's earnings were through the roof in this particular quarter, while RCM is also up almost 13%. The other two stocks is JBM Auto, and we'll also help pull up Electra in a bit because we are seeing some strong moves there. On the downside though, Whirlpool on the back of promoters selling again by the foreign promoter Whirlpool will be something to watch out for. There you go, Electra Green Tech almost up 12%. Whirlpool, it's been a down day, but let's also pull up the Nifty 500 contributors on the losers as well. Because that's apart from Whirlpool, there are some other movers as well in trade today that's affected Voltas again on the back of quarter 3 earnings. So in this particular quarter, there is no getting away in case your earnings are not up to the mark. We do see a lot of action there. But another stock that is currently seeing a lot of action is KPIT Tech, which is in focus as the stock has jumped almost 5% on the back of its quarter 3 earnings. My colleague Rucha joins in with the fine print of the same.
Thank you so much. So KPIT reported its third quarter numbers and also raised its guidance, and the results actually came out yesterday during the market hours is when the stock was up around 9%, and today as well the stock is up about 5% in trade. Now let me talk to you about the numbers. Revenue largely flat, margin came in at 17.2%. Our profit was actually down by about 8%, but that is not why the stock is buzzing. The stock is buzzing on the back of guidance that the company has raised. The constant currency revenue growth stands at 18% to 22%, which is unchanged, but EBITDA margin at 21% or more than 21% versus 20.5% guidance earlier. This is one thing. The other thing is the deal wins were also very strong, up about 14% on a quarter-on-quarter basis is what the company has reported. Apart from that, the company also mentioned that they are exploring new relationships and they are building these relationships with passenger car and truck makers, and they are actually adopting this in China and rest of the Europe outside Germany as well. And they also mentioned that they are seeing greater interest in clients. A strong commentary from the management is what we are hearing from, and clients are also interested in spending in areas like vehicle cost reduction, cyber security as well as data oriented services. If you look at the revenue share split in terms of geography, 26% of its revenue comes from US, which saw a degrowth of 2.5%. Europe was also kind of soft, which saw about 1.5% of degrowth, revenue share about 47%. But Asia region was strong, up about 13% quarter on quarter, which contributes 26% of the revenue. Good client mix also, which the company had reported. Active clients up by 3 clients. Strategic client revenue was up almost by about 4%. Headcount largely was lower by about 300 employees, but attrition remains at all-time low levels. So this is what we have on KPIT with respect to numbers. But if we talk about more why the profits were down about 8%, this is because last time the profits that's had a one-time impact of 30 crore after tax. So largely numbers are, in line, but strong commentary from the management and upbeat in guidance is what is making the stock buzz.
Thanks for that. We also caught up with the company's CEO, Kishore Patil, and here's what he had to say about the company's growth potential going forward as well.
I think there are two, three at a high level, I may just say. One is the kind of offerings we bring in are absolutely relevant to the client at that point of time. So that is very important every year, every time. I mean, we just had a very good CES in US, and we bring in the offerings which are relevant to the client for the next year. And that way of presenting and giving those, solving their problems, solutions, giving them the solutions, that helps us. And that has helped us absolutely. The second thing we believe is our share of wallet is very, I mean, it can be more than doubled over the period. I'm not saying in a year or two, but over the period. So that actually means that in case we come up with a value proposition, in case we deliver a better value to the client, there is an opportunity for us to grow.
Well, that was KPIT Tech, and some of the projects outside Europe will be something to watch out for as per the management commentary as well. The other stock which we want to address is Tata Motors. Now the stock is down almost 6.5% today in trade on the back of its Q3 earnings. Now, while revenue was up almost 2%, EBITDA has fallen in this particular quarter, down 15%, with net profits tanking down by 22% in this particular quarter, coming in at roughly 5,400 crores versus estimates of about 6,400 crores. So definitely a miss there. What's also negative about Tata Motors is that while Jaguar forms roughly about 70 to 75% of its revenues, in this particular quarter, the company has cut its FY25 guidance in terms of revenue for Jaguar Land Rover. They're estimating now a £29 billion revenue in the whole of FY25 versus £30 billion earlier. They've also cut the ROCE targets, or return on capital employed targets, to 20% versus 22% earlier. But we could have seen a sharper reaction on the stock, but they mentioned that they maintain the EBIT guidance of roughly about 8.5% for the JLR business despite cut in the revenue, and hence we might see some bottoming out in the stock right now. But overall, it puts a lot of pressure on the fourth quarter for Tata Motors in terms of the Jaguar and Land Rover business to achieve that kind of target for FY25 as well, because they'll have to report more than 10% in terms of EBIT, something that they've not done in any of the first three quarters. Something to watch out there as well. Let's also quickly pull up Maruti Suzuki as well, because we are seeing that while there was a slight miss on the EBITDA front, we are seeing a positive reaction on the stock on the back of its commentary as well, and something which has been doing very well, the e-Vitara launch. Now the company has mentioned that they are looking to be the #1 player in India in terms of manufacturing of electric vehicles in the country, and that will surpass the likes of its competitors like Tata Motors. It's looking to be the largest one in the first year itself. And while currently they are importing a lot of components in terms of battery as well, it's interesting that the company has aspired to be the largest EV manufacturing in India. So definitely a stock, and also the new Dzire has been doing very well. It's the first safety car of Maruti which has a 5-star NCAP rating. So they have roughly about 20,000 bookings of the same. So it has mentioned that in this particular quarter, the commentary is what's going to be driving the particular stock as well. Another stock on the back of the Q3 earnings is Bajaj Finance. Now the stock is the talk of the town with its Q3 earnings. Harsh joins us now to tell us what our brokerage is saying about the company's earnings, as well as something to watch out for going forward as well.
Generally, when you speak about Bajaj Finance, giving positive commentary generally trickles down to the sector as a whole, and therefore positive for the sector at large as well. But talking specifics, credit costs likely have peaked. They'll probably come down by around 0.1% in the next quarter, and thereafter taper to sub 2% on the credit cost number, on the absolute credit cost number, which is currently at 2.16%. So clearly positive. Two-wheelers, three-wheelers, probably some bit of asset quality issues still there, but rural B2C, growth coming back and asset quality improving. And that's the key, because that's been the one big drag over the last couple of quarters at the very least. So that's the one big positive. what brokerages seem to be suggesting. One, we see brokerages hiking target prices. I'll give you two examples. Citi maintaining their buy, they've hiked target price to 9,060 from 8,150. Morgan Stanley hiking target price to 9,300 from 9,000. Huge increase by Citi. Second, credit cost improvements continue is what Citi says, and growth horizons are expanding. The 3.0 strategy along with the Airtel partnership will enhance growth prospects, and the managing director exhibiting his intention to stay with the Bajaj franchise is obviously another big positive as per Citi. Morgan Stanley, on the other hand, they believe well set for FY26. Lower stressed asset formation is what they are already seeing. They're seeing visibility for 25% EPS growth in FY26. Again, a very big positive. And they believe that this makes Bajaj Finance an interesting quality large cap in a tough market. That's how they term it.
Well, thanks for that, Harsh. But shifting focus, air conditioning majors Blue Star as well as Voltas reported their third quarter results yesterday. Both companies saw an uptick in their revenue, but we're seeing a very strong downtick pressure coming in on something like a Voltas today. While Blue Star is down 1%, it's seeing that negative reaction after opening in the green. My colleague Mahima joins in with a detailed overview of which company fared better in this particular quarter.
Right. So, in terms of how Q3 has panned out for both the companies, well, clearly Blue Star is an outperformer. It also gained market share is what the management said today in Q3 itself in the room air conditioner segment. And it's a beat across revenue, net profit, margins as well as the EBITDA number, whereas for something like a Voltas, the revenue was a hit, but the EBITDA, the margins and the net profit was a miss. Let's take a look at how revenue has fared so far. In terms of Q3, for Blue Star, the estimate was around 2,600 odd crores, but it came at 2,800 crore. So a complete hit in terms of the revenue, and the growth was 25% YOY. For Voltas also, it's a hit in terms of when it's compared to the estimates, but the revenue grew by around 18% for Voltas. Moving on to the EBITDA numbers, Blue Star saw margins at around 7.5%, expected was 7%. So again, a hit in terms of margins, and the margins expanded by 60 basis points. Now for Voltas, the margins did expand by 527 basis points because Q3 FY24 for them margins were not on a stronger basis, and that is why we've seen that there is a huge uptick in their margins, but the expectation was much higher than what they posted. The next parameter that we are observing is profit. They were expecting 135 crore for Blue Star, which came at 133. So in line with the estimates, and it was a growth of around 32%. Voltas, on the other hand, the estimates were 158, but it came to around 132. So it's a miss in terms of estimates for Voltas. And last quarter, the company was in losses, and now it's become profitable. So in terms of all of these parameters, we've seen that Blue Star clearly stood out. Now, in terms of the unitary cooling products services specifically, for Blue Star, the revenue was up 22% at 1,160 odd crores. And for Voltas, it was up 20% at 1,770 crore. And lastly, in terms of margins in the unitary cooling product, for Blue Star, it was 8.1%, up 103 basis points, versus that of decline of 244 basis points at 5.9% for Voltas. So this is how the two companies fared in Q3, and clearly Blue Star was an outperformer.
Well, thanks for that, Mahima. And we also saw the CLSA note on Voltas this morning. They have maintained the underperform rating with a target price of 1,500 rupees per share on that aspect as well. But earlier today, we also caught up with the company's chairman and managing director, Mr. V.S. Advani, who talked about the growth outlook for the coming quarter. Listen to what he had to say.
Sure. So, of course, you're aware that the summer season that we have just gone through last year was an excellent season. So both Q4 of last year and Q1 of last year were very strong for the industry. We had supply challenges in Q1, as we had explained. We had not planned for that kind of demand. So our business got impacted in Q1, but the industry did very well. We're expecting a reasonably good Q4 coming into this year. Of course, like you said, summer may have set in early. We're unsure right now. We can never predict the weather, of course, but early signs are good. Of course, compared to last year, we should see demand growth. We are expecting 20 to 25%. We're expecting Blue Star to do slightly better than the market demand. So we're fairly optimistic about the outlook for this coming season. Of course, Q4 versus Q1 really depends on when that summer sets in. It could be in March or April, just depends on how things unfold. But as a season goes, as a summer season goes, we're fairly optimistic about the outlook for the industry. Of course, consumer products and consumer goods demand has been lower than last year. I will tell you that it's the same in air conditioning as well. It is not that air conditioning has been sort of excluded from the overall reduction in demand, but on an absolute basis, even at a reduced level, growth rate should be very good for our industry. We're expecting at least 20%.
Well, that's the management of Blue Star, and while the level of inventory for ACs have been building up compared to the same time last year, it's still, strong growth phase, and that's something that will benefit EMS players as well, who manufacture a lot of ACs. So Amber Enterprises, PG Electroplast, something to watch out for as well. Another stock that's buzzing on the back of its quarter 3 earnings is Hitachi Energy. My colleague Anushi joins us with what has worked for the company with a strong 20% up move in trade today. Anushi, Hitachi Energy, what worked for the company in this particular quarter?
Right, Puneet. So before I go, for Hitachi, the standout was obviously the kind of orders that they have received. In fact, before I go to that, let's talk about the numbers as well, as they have seen a healthy growth, 27% of the revenue growth. This is in line with even the 9 months, the revenue growth stood at about 27%. Margins have expanded considerably to 10.3% as compared to 5.3%, while the net profit stood at about 137 crore to 23 crore. Now, if you look at what the order book positioning for the company is now, their order inflows were up around 839% for the quarter at 11,594 crore. So in terms of both the sequential and the YOY basis, we are looking at a significant uptick in terms of where the orders are concerned. And if you look at order surge in 3Q, this was on the Khavda-Nagpur HVDC order that they had received. Order backlog stood at about 18,994 crore. And in line with what the company is stating, a double-digit margin guidance, the margins have expanded considerably. So this is on why Hitachi Energy is working in trade today.
Well, thanks for that, Anushi. But stay on, because we also have ABB India that's just seeing some downward pressure in trade over the last 30 minutes or so. Talk us through what's affected the company and what has been the recent reason for the price correction over the last hour or so.
Right. So ABB India is in pressure today, and this is after ABB Group reported its Q4 numbers. Here, the significant commentary and the significant highlight of this result was on what has happened in their India business. Now, while ABB India, the revenues have seen about a 4% of an uptick in terms of where the revenues are, and the orders are also up around 4%. The negative for India was the 21% of a degrowth that we've seen in their order inflows for the India region. Now, ABB Global, if you go back and see in the previous quarters, they've reported a 3 to 9% of a growth for the India region in the last 2-3 quarters. So, seeing a 21% of a dip in terms of where the inflows are concerned is significant. But do note that there are discrepancies in terms of where ABB Global reports its numbers and where ABB India's numbers actually come out in terms of order inflows. So it is not necessary that ABB India will also follow a similar path wherein we can expect such numbers. This is due to the another entity which ABB Global has for its India business. So track and focus would remain on ABB India's performance, their numbers which will come on 18th February. Now, Nuvama believes that the quarterly order inflow rate of this 3,500 crore which we have been seeing won't be particularly maintained for this quarter. And for the quarter going ahead, where there could be some sequential pressure that we can persist. So it is because of this order dip, a significant order dip, in fact, that we are looking at for ABB. This is the reason why the stock is down 5% in trade today.
Well, thanks for that, Anushi. Because, my colleague did highlight that that order inflow or outflow in terms of slowness in the global market might not directly persist with the India region, but yes, definitely, I think one of the key aspects and the most important one is that 21% orders inflow degrowth, for the India region is something that the market is not liking for the likes of ABB. And the valuations of the company hasn't also been cheap. So any kind of negative news flow in a market like this will affect the stock tremendously as well. And that's something that's hurting. Let's also quickly pull up the 6-month and the 1-year chart of ABB as well, because while we have seen some strong reaction. The 6-month is down roughly about 26%. Let's also look at the 1-year chart performance. We have seen some decent moves up about 22%, but we have seen over the last few months there has been a lot of correction in stocks like ABB, and there you go, especially in the last 3 months, because you have seen the broader market correct valuations of high PE stocks, and capital goods were the highest, roughly about 80 to 90 PE, and price to earnings ratio for all these stocks has been something to watch out for investors. And that's one of the key negatives as well, because for ABB specifically, while they've reported a 3 to 9% growth on the global level, for the India region in the last 2 to 3 quarters, I think the commentary as well as any kind of order inflow going forward is something to watch out for on ABB as well. And my colleague did mention that the kind of outlook on on Nuvama, we've seen that order inflows specific commentary as well. But let me get in Anushi back into this conversation for ABB as well. We also want to just talk about and stay with the story, because we're seeing a lot of pressure on the stock right now.
So Puneet, let's see what ABB India, we spoke about how the commentary for this time in terms of where sequential growth and the order inflows is concerned, we are looking at a 21% of an downtick. But let's go back to some of the quarters and see how ABB Group has done and ABB India has done in terms of the order inflow growth. So if you look at Q4 CY23, that's the last year base that I'm taking at, a significant 35% of an increase is what we are seeing. This is as compared to the 16% of an increase. So India has done fairly better in the last year Q4 period. This is a pattern that we are seeing repeating in the other quarters as well. Q1 also 15% of a growth versus 5%. Second quarter 13% growth as compared to 3% growth in the ABB Group. And Q3 of this one 11% as compared to 9%. So now that Q4 has seen about a minus 21% of a dip. So focus would be on how ABB would do. We've already spoken about how these two companies can differ in terms of where the orders are and order inflow growth are concerned. So obviously focus would remain on that, and 18th Feb is their result date, so that we can see. Another point that we should be highlighting is how Nuvama believes that this order inflow growth is expected to show degrowth sequentially, and believes that the company's inflow rates of 3,500 crore may not be maintained this time. So this negative can flow in for the other companies as well. In fact, if we go back to the presentation of ABB India on what their outlook was, now if we go to the order book positioning of the company, the order backlog stood at about 9,995 crore, which was up around 25% on a YOY basis, but the total orders were up around 11% in the last quarter. So key highlights here was that the revenue growth was led by execution of base orders, but the large order execution still maintains to gather that momentum. In the conference call, the management had also indicated that the conversion rate velocity may not seem as what it was before, and the new segments like data centers will become significant. So again, this is all a lot of play on what is happening in terms of where the order inflows are concerned. So this is where ABB India is in focus.
Well, thanks for that, Anushi. And that's the aspect, because we have seen a lot of change over the last couple of quarters, specifically, of course, for ABB India. And we did see the large order backlog had increased to almost 25% in the previous quarter. And, Nomura had also mentioned about, the execution pace has started moderating. But to take this discussion forward, let me get in Renu Pugalia, the Senior Vice President of Research of IIFL Capital. Mr. Renu, thanks so much for joining me today. Just wanted your lowdown firstly on what do you make of this news of 21% order inflow degrowth for something like an ABB India, and your first cut on the same.
Sure. So first and foremost, I would just want to highlight that typically there is always a divergence between the group inflows, which the group announces from India, and the order inflows for ABB India, because it does not include export orders or certain orders which are received from the group. So the group announces external order wins, and for ABB India, this number has to be adjusted for export wins, etc. So for the quarter, we had an assumption of almost flattish QOQ inflows, or a YOY inflow growth of about just 6%. But given the fact that group has announced a 20%, 21% drop, So this is in USD terms. If we first adjust it to INR terms, it is still about 18 to 19% drop. We still have to make adjustments for exports, etc. But nonetheless, this could potentially imply that the inflows for India would be weaker. It may be flattish or even a decline, single-digit kind of decline to that extent. So the read-through from this is India inflow numbers would be relatively weaker than what is expected by us and probably even by consensus. So there seems to be some miss. I would not read it too much into it because this quarter would have had some impact post-elections in terms of order flows coming in from government sectors. And some of the readings from other industry peers have indicated that the order finalization rate was a bit tardy this quarter. So to that extent, it may have a shade of impact from the external environment and slowdown in government ordering or capex as well.
This is Anushi joining in. So I want to ask you, now you've mentioned that we should not be connecting this to, but usually, just for the viewer context, when ABB Global reports its India numbers and ABB India, their own, government related also, there's a lot of impetus on that as well in terms of where the inflows are concerned. So what is the usual connect that we see and what is the quantum of hit that you expect in terms of where the ABB India order inflow and order backlog is concerned?
So I think if you go through ABB India's present investor presentations for the last couple of quarters, they very beautifully highlight the divergence between the group rates and the India inflow, and they even explain the adjustment with respect to large orders or exports. And it varies quarter to quarter, so there is no specific correlation which runs on a quarterly basis. It also could also include timing differences of the way orders are booked by the group and orders are booked in India by the listed entity. So that can be referred. Nonetheless, with respect to the likely impact, as I mentioned, we are forecasting about 6% YOY growth in inflows in rupee terms. And if we go by this number, adjusting for some divergence, instead of a growth, actual inflow numbers for the quarter could be flattish or even a decline. So we'll have to see how the actual numbers come through when the company announces its result in Feb. But there seems to be some disappointment on the inflow side, which will obviously result in terms of relatively lower order backlog for them. But I think I would not look too much into a quarter number because some of these portfolios have delays of large orders, timing differences. So I would rather slightly wait and watch till the actual results are announced for India.
Right. So that is as far where the order inflows are concerned. But let's see what are the other things that we could be watching out for ABB India. Do you think that in terms of the revenues and margins also there is some bit of pressure that might persist in the near term?
May not be. Let's see, as in we are forecasting. Typically, the December quarter is the last quarter for ABB India, and 4Q growth rates tend to be slightly lofty. It's the last quarter for them in terms of billing. So to that extent, our forecast, we are forecasting 13% growth in revenues for ABB India in the fourth quarter and a mix of better profitability and operating leverage. The expectation for EBITDA and PAT growth is nearly 30%. So to that extent, we expect that they should be able to maintain the quarterly profit run rate of almost 4.5 billion rupees, which has been the case in the preceding 3 quarters of the last calendar year. So we don't forecast, as in inflows for this quarter and the revenue execution are 2 different things, may not be in direct sync to that extent.
Well, Renu, thank you so much for joining in today, also giving us a lowdown of what this news flow could be for ABB India, as well as, her Q4 projections for ABB India in this particular quarter as well. And thank you, Anushi, for joining us as well in this particular interview. But with that, it's a wrap on this edition of Markets at 12. Stay tuned to NDTV Profit for more.
STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets. General elections.
Union budget.
2 more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well for the policymakers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget as well as has been in each one going into the same. We look at some of the key moves that have seen in the Nifty before as well as after the budget, and get you some of the biggest measures that were announced in these budgets and what could have led to the strong Nifty reaction.
Hello and welcome to NDTV Profit. A very good afternoon to all the viewers. You're watching Profit Buzzers. I'm Hital Datia and with me is Rucha Somaya. Rucha, good afternoon. Clearly in terms of markets go, let's just quickly pull up Nifty 50 on the screens. 2 good days of gains is what we're seeing ahead of the budget currently as well. Nearly not at the day's highest levels, but near the day's highest levels with gains of almost 117 points coming in there. But we're yet below the 23,300 mark. Let's just pull up the sectoral indices as well and see what's happening on that end, because overall the advance decline ratio is in favor of the advances. If you see the sectoral heat map as well, real estate the top gainer today, followed by oil and gas, energy, pharma. Infra is doing pretty well. Metals has seen a good bounce back in today's session as well. But what's losing out? Consumer durables, that's down almost 1.3%. media is also under pressure. So that's where the pressure is coming in. But clearly, in terms of Nifty 50 stocks, names like Cipla, 2.5% uptick coming on that one. Power Grid seeing a good move. Bajaj Finance reacting on numbers. M&M is strong in trade. ONGC as well seeing gains of 2.5%. Tata Motors reacting to numbers. ITC Hotels, that stock is down 4.5%. It's going to be interesting to see what happens with ITC because 3 days. After 3 days, in fact, ITC Hotels will move out of Nifty 50, and this is with a caveat that it does not hit 2 consecutive sessions of lower circuit. Does not seem to be the scenario in today's day, so probably Friday will be the day where you could see ITC Hotels moving out. Shriram Finance is also under pressure. Wipro Infosys from the IT pack trading under pressure. So that's with regards to where what the large caps are doing. Clearly, the direction is upwards, Rucha.
Definitely, for sure, but let's have a quick look at the broader markets as well. A good day for them as well. Nifty Midcap 150 index up about 0.5%. The Small Cap 100 index up again about 0.75% as we go. Yes, trading slightly below the day's high, but let's have a quick look at the constituents of the Midcap 150 index. Down in the red, we have Voltas, Emphasis. If you can pull up the mid-cap 150 heat map, we'll also see that Voltas is down about 12% in trade. Emphasis down about 4%. Infosys there, actually, but Infosys is one of the benchmark indices. But Coforge is also down about 4%. But holding up the index is what we have. Hitachi Energy upper circuit 20%. KPI Technologies on the back of its third quarter numbers up about 6%. We have Suzlon Solar Industries up about 5 to 6%. But let's also have a quick look at the constituents of the small cap 100. We have CAMS, which is Computer Age Management, which is down about 8% because of its third quarter earnings. So that is what we have on the broad index. But to talk to us on the show today, we have Mr. Sanjay Shetty, the MD and CEO of Chalet Hotels. It's a pleasure talking to you, Mr. Shetty. Thank you so much for joining us on the show.
Good afternoon. It's a pleasure being back. And being in the midst of you.
Thank you so much. So my first question to you, Mr. Sethi, will be around the growth outlook in FY26 and the exit rate in terms of revenue growth and margin for FY25. If you can give us some color on that.
Sure. So look, Rucha, Hiral, clearly a good quarter. And we seem to be moving from strength to strength every quarter. It's again a record-breaking quarter for Chalet Hotels, the highest ever, not just the quarter three. The growth's been very solid, 22% revenue growth, 23% margin growth, EBITDA growth. So clearly going from strength to strength. On 2026, I see no reason why we shouldn't be growing at a pace that we've done this year. In fact, with the addition of new assets coming into play next year for Chalet, we do expect it to be an exceptional year going forward.
Sanjay, good afternoon. This is Hiral on this side. Clearly, I mean, it looks like a good quarter with good growth coming in there, but pretty much in line with what the street was estimating. If you could help us understand, in terms of the third quarter, were there any exceptional gains on the back of special events like concerts, etc.? Because that has been the crux right now. And will that be a one-off? And will we see a similar growth trend otherwise in the next quarters?
So here, it's been pretty much structural growth. So this is growth that's sort of built in for future also. At Chalet, we haven't had any events that have happened in Q3 that supported any unusual jump. So as I said before, this is pretty much structural growth, and we look forward to growing further on this.
Okay. Apart from that, if you see in terms of the occupancy, how has that been across? And any pockets where you're seeing some bit of a lag?
Well, occupancy has been stable. Let me put it like that. It's around the 70% mark, which is pretty much similar to same quarter last year. The rates have grown very aggressively on the back of normal business. And therefore, it gives us a lot of confidence on the way forward. There is no specific market that we need to identify in terms of any gaps in the occupancy. Mumbai has probably grown less than everyone else because it already comes off a large occupancy base. But the rate growth in Mumbai has been also very, very strong.
Sanjay, when you talk about the occupancy, there was a slight dip that did come in terms of MMR as well as Hyderabad. Any reason for that?
Well, Hyderabad has been flattish. The Mumbai did drop a bit, but then you have this holiday season this time in October, which impacted October very adversely for everyone almost, especially if you're in the business city hotels, and that's where our portfolio is. This time, Diwali, Dussehra, a lot of other holidays came in October, but the November was very strong, significantly stronger than last year November. December again tracked very well. Overall, a very satisfying quarter.
For sure, Mr. Sethi, but one update on the ongoing project which you highlighted last quarter, like there was a quarter delay in the Duke's retreat, and you expected it to launch with all new avatar by the end of this financial year is what you had said. So any update on that one, if you can give us some color?
So there's a slight slip on the dates, but it's an operational asset. Let me sort of caveat that 73 rooms, a restaurant, the bar, the swimming pool, all are already activated. It's not a full asset in play as yet, but in about 3 to 4 months' time, we'll have it completely ready and going strong. It's coming out very well. It's been received very well with the limited inventory that we've opened. The rates are looking very strong. So we expect it to do extremely well. And, a slippage of a quarter here and there on a project this size shouldn't be a matter of concern for anyone.
Can you expect this to launch?
Next quarter.
Okay, next quarter. And one clarification, did you mention 73 rooms? Because
yes, 73 rooms are already operational.
Because in the transcript, I see 37 rooms of the last quarter.
It was 37 till most of the quarter, but then in December, we opened some more rooms. It's now 73 rooms.
Okay, one follow-up question on the inorganic part. Any inorganic kind of expansion that you're looking forward to, because you already had an acquisition of 11-acre beachfront land parcel last quarter. So what kind of inorganic growth are you targeting?
So we got quite a bit going actually, on a base of 3,050 rooms. We've got 1,100 rooms under development, which in itself is the third more supply coming in our portfolio. In addition to that, our business development team is extremely active. And we'd like to add at least another 1,000 rooms to the pipeline going forward. So overview, between operational and pipeline, I'll expect it to be around 5,000 odd rooms in the next couple of 2 or 3 quarters, actually.
Okay. So when you talk about this kind of addition and the development pipeline, Sanjay, what's the incremental revenue growth that you're then expecting post FY27? Because I think majority additions will be done by then.
That's right. So we expect, to be able to, and it's a guideline, an internal guideline, so please do not take it as a guidance for any investors. But we are looking at roughly growing our EBITDA 2.5 to 3x in the next 4 years.
Okay. And with that said and done, then how are you seeing the revenue per room move from here on, because we've seen double-digit growth already. So is that something that will continue?
I'm very confident that double-digit RevPAR growth is pretty much on the cards for the next year.
Okay. And with the kind of room additions that you're looking at, what is the kind of capex that you've already put aside, and any addition that you will need, and how are you planning to fund it?
So overall capex may be around the 2,500 mark. This year, in the next year, it should be around somewhere between 1,200 to 1,500 crores. But look, most of the current pipeline that we've announced will be funded largely through internal accruals. So in terms of the balance sheet side of the conversation, we believe the debt, which is currently at 1,580 odd crores, will peak at between 1,900 and 2,000 crores for the announced pipeline.
Okay. And how is the outlook looking like if you have to look at the commercial rental portfolio?
Looking very strong. We've got roughly 2.4 million square of office space, which is ready. Out of that, 1.6 million is already locked in. We've got another 800,000 to lease out. I think in the next 2 or 3 quarters, we should be able to complete that leasing. The rates are looking very solid, better than what we expected earlier. So the office assets, which is our hedge to the cyclicality of hospitality industry, are looking very strong. I must also add here that with the office assets coming into play, the exit rental in December is already at 20 crores a month. And I think this will move up to about 30 crores a month when we were sort of leased out about 90% of the 2.4 million square foot of office space that we have. which should flow through all, should have an ability to flow all of it into EBITDA, into the company, which creates a massive annuity EBITDA bottom line, which will support the business going forward.
Okay. And Sanjay, lastly, if you have to look at the next couple of quarters, the way competition is also increasing in this space, what is it that you think you will be doing differently to differentiate yourself from a business perspective?
So Chalet has done a few things very correctly in the past, and I think we will build on those as we go forward. 2 or 3 things. One, the pipeline, of course, will grow, which will increase the efficiencies in the system. Second, we've got a couple of assets coming up in very exciting locations. Delhi, for one, is one of them. Talking about the next 2 quarters, quarter 4 is always better than quarter 3, and we believe that's going to be the trend going forward. Quarter 1, we see this time weddings coming into play, which wasn't the case last year. So we expect quarter 1 to have sort of an upside on the back of weddings and events. We also believe the corporate travel is going to continue to be very robust and strong going forward. Our leisure portfolio, which is slowly building up between the Courtyard by Marriott Aravali in Delhi area and the Duke's Retreat, will again support an alternate sort of segment in the hospitality business.
Okay, well, thank you so much for that, Mr. Sethi. It's always a pleasure speaking with you, and all the very best for your upcoming quarters. But with that, let's move on to another counter from this space is Samhi Hotels, where this is buzzing on the back of its numbers. Revenue was up about 10.5%. EBITDA came in up by 30% at about 110 crore rupees. Margin were at 37% over here. But the key takeaways on higher profitability is that there was a reduction in employee cost with higher revenue growth, and this also aided margins down there. And the company also focuses on a growing share of upper and upscale hotels. Now, talking about the recent developments, well, the company has approved an acquisition, 100% stake acquisition in Mar Tourism and Hotels for a value of about 205 crore rupees. They've also signed a long-term variable lease agreement with the High-Tech City in Hyderabad over there. 170 to 175 rooms are expected to have a revenue potential of up to 0.5 crore, of course, on a per room basis. Now, let's look at the capex, that is capital expenditure plans for the next 12 to 18 months, which is important for such kind of a counter. They anticipate about 70 to 80 crore kind of capex in Bangalore hotel and 180 to 190 crore in the Hyderabad asset. Lastly, talking about the guidance over here, the net debt as of September stands at around 1,880 crore rupees for the company, and they therefore expect to maintain a net debt to EBITDA ratio of 4.5 times by FY25. So yeah, that's an ask for net debt to EBITDA ratio for the company. And lastly, they also expect to increase the revenue share from variable leases from 13% to about 20% going there. But the guest on our show today is Mr. Raghivendra Kedia, the founder of Prosperity Advisors over there. Thank you so much, Mr. Raghivendra, for talking to us. Good afternoon. What's your take on the hotels space, and what are your picks?
Good afternoon. Broadly, we have seen post-COVID, the entire hotel industry has gone on an uptake, and there was no expansion in terms of capacity for the entire period of around 2015 to 2020. Now, the companies which have actually had good capacity or were pre-planning on the expansion, their margins are going up. We have seen the average room rentals going up and also the occupancy rate going up above 70%. So these two factors in terms of the average room rentals and occupancy rate is reflected very well in the numbers. So broadly, we do like hotel sector as a lifestyle stock to be kept in the portfolio, and Samhi Hotels, which has actually done well in terms of their overall margin reduction, in terms of their margin expansion. We believe that even at levels of 180, there is a good upside of around 20% for a 9 to 12 month horizon, for a target of around 215, 220 in a 1 year time horizon. So we are bullish on the entire lifestyle space. We are bullish on the hotel sector, And Sami Hotels also remains as a good pick at levels, corrected levels of 180 for a target of 220 for a 1-year investment time horizon.
220 on Asami is the target coming in there. But shifting focus to the auto pack, you have Tata Motors that is in focus. An interesting one, major downtick coming on that one. Slight recovery. It was down almost 8.5%. Now seeing cuts of little over 6%. My colleague Puneet joins us more, to tell us more. Puneet, clearly there is pain. Is it the domestic business or major coming in from JLR?
Well, with roughly about 70 to 75% coming in revenues from Jaguar Land Rover, that has to be even a slight pain point affects the consolidated numbers, and that's what's happened. But we bring you the 5 key reasons for the fall in something like a Tata Motors today. The first one, of course, has to be on the back of its Q3 earnings. EBITDA was down 15%, but net profit is down roughly 22% in this particular quarter, and that's one of the key negatives. And the company has mentioned also as the number 2 reason that might be down, affecting the stock is the cut in revenue guidance specifically for the Jaguar and Land Rover business. That's number 2. They've cut it to roughly about 29 billion pounds from 30 billion pounds earlier. They've also adjusted the return on capital employed ratio for JLR business to 20% from 22 earlier, while they have mentioned their EBIT guidance maintained at 8.5%. That will depend on fourth quarter results. Specifically, they'll have to do more than 10% EBIT to reach that stage as well. Third key reasons, of course, the EV market share. We've seen a lot of competition in the electric vehicle space, and Tata Motors market share has dropped to roughly 53% this particular quarter. It was 65%, in the previous quarter, and roughly 75% in the previous quarter as well. So, roughly over 3 quarters, the market share loss of about 20% has been something that's hurting the stock. And while the market as a whole is, roughly just about 1 lakh units on an annual basis, the competition from MG has been very stark. The fourth key reason which I can think of stocks down is because of the car business, the passenger car business EBITDA margins, excluding the one-offs of PLI, have been down by roughly about 30 to 40 basis points. Forex costs have impacted it, while the average discount has also increased both in the Jaguar business as well as the India car business. And finally, the fifth key reason is, brokerages have come out and cut target prices. So we've seen Nuvama, Morgan Stanley as well as Goldman Sachs cut prices on Tata Motors today. We've seen the Morgan Stanley cut prices to 853 rupees from 920 earlier. Something like a Goldman Sachs has cut it to 800 rupees from roughly 830 earlier, and Nuvama is one of the key, as you can see on the screen, roughly 720 rupees target price now from 750 earlier. So it's a bearish sentiment and puts a lot of pressure on Tata Motors for Q4 to achieve the FY25 guidance.
Absolutely, Puneet. Major pressure coming in there. The target price is in 3 digits. Raghvendra, from a 52-week high of 1179, the stock at 700. What do you make of it? Because it's a complete one-side downward trend.
We would still avoid Tata Motors, and as you said, it's a one-side downtrend. We believe that it could continue. Basically, the China growth story, which was actually very pivotal in the entire stock move from 600 to 1150 levels, that has become very unpredictable now. So it's relying more on the Europe space, but which is also a very slow growth in terms of the PV business coming out of Europe. So across the global sales from China and Europe, we are not optimistic even at current levels. We believe that Tata Motors would actually doing a lot of capex and investment in their electric vehicle EV and IC, internal combustion engine business. So there could be some investment pressure in the quarters ahead for Tata Motors. Also in the EV space, the market share reduction from 65 to 53 is definitely not impressive, especially when you see a year back, they had a first mover advantage in the EV market and gained a significant market share. But we are seeing a change of tide and a U-turn in terms of market share for Tata Motors. So with all the global factors also not impressive and the domestic front not great, plus this demerger of commercial vehicles and PV passenger vehicles, we believe that could be also largely a non-event. So with absence of any positive catalyst and triggers, even at 700 and a 40% correction from highs, we would still not find it attractive and stay away from Tata Motors even at levels of 705, 710 and wait for it to actually gain market share and see some growth in terms of global. Until then, it is a wait and watch and avoid.
Wait and watch and avoid in terms of where Tata Motors is concerned. Stay with us, Raghavendra. We'll quickly slip into a short break. Up next, we'll be joined by the management of Aarti Drugs to decode their numbers. Though the stock is up on a year-on-year basis, not a major good news in terms of numbers. Sequentially, there has been some bit of improvement on the margin and the profitability front, and there has been some pain in terms of the API segment. We'll talk more about this after the break.
This is the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs? And what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
STT. STT definitely needs to change.
Old tax regime.
1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
The union budget is around the corner. What could be announced and how will it impact the market? UBS comes out with a key report. UBS thinks the impact of the budget on the stock market would be muted as the capital expenditure and consumption boost could be limited in this time around. But what does UBS estimate the government could announce? We bring you what UBS expects in 5 key aspects. The first one's, of course, the impact on the stock market. Government's fiscal deficit, which occurs when the government's total expenditure exceeds its income. The third aspect would be infra companies to be impacted in this key budget, changes in the capital market structure and taxation, and finally, what government companies could be divested this time around. Now, UBS feels that the budget might not boost the market as the expenditure on consumption as well as capex might be lesser compared to the previous budget. Now, this time it is assumed that if the fiscal deficit is contained at 4.5% of the GDP in 2026, it could of course be a shortfall met by borrowings. Apart from this, UBS feels if the capital expenditure for 2026 is budgeted at a similar levels of rupees 11 lakh crores, similar to the FY25 budgeted capital expenditure, it could be negative for companies like L&T as well as the other core infrastructure companies. UBS also says the importance of domestic orders for the infrastructure companies is now higher given the limited overseas opportunities, especially in the Middle East. In this regard, UBS thinks companies exposed to private emerging infrastructure and power value chains are relatively better placed given the private sector capex growth remains in the double digit. Now, UBS also does not expect any changes in the tax policy, especially for the capital markets in their base case estimates. UBS also expects the administration to maintain a lower target for divestments of around 30,000 crores for FY26. UBS's revenue collection estimates are marginally improved in line with the nominal GDP expects, and the gross tax revenues will be in a growth phase of about 11.5 to 12% in FY26 versus about 10.7% on a year-on-year comparable basis between April and November of 2024. In terms of divestments, as mentioned, the target is around 30,000 crores for FY26, which is lower than the 50,000.
Back here watching Profit Buzzers. Let's quickly pull up a Bajaj Finance on the screens. Clearly, if you see in terms of the numbers, the stock is taking a downtick. But let's just quickly address the numbers. In terms of the profit number, that has seen an uptick of around 3.4%. That's come in at 2,231 crores versus a 2,158. In terms of the total income, an uptick of around 10% coming in there at 2,042 crores. Those are the two numbers that we're seeing. They've approved appointment of Ramandeep Singh Sahani as the CFO, and this will be effective the 1st of February. And S. Srinivasan will be stepping down as CFO but will continue as President of Insurance and Special Projects. One of the aspects, if you see at the EBITDA level, operational level, is where life insurance has made a loss of around 220 odd crores versus a profit in the previous quarters. So that's where there is some bit of a downtick coming in there. A marginal uptick with regards to where the general insurance business goes at around 448 odd crores at the operational level. So that's in terms of the segmental between life insurance as well as general insurance, and it seems that the street is not very happy. You're seeing marginal downtick, Rucha, that's coming in with regards to Bajaj Finance. Let's just pull up a Bajaj Finance on the screens as well and see what Bajaj Finance is doing in trade. There you go, 2.5% up move on that one though.
Yeah, for sure, over there. But with that, let's also shift focus to Laurus Labs. Well, this one is on a free ride, up about 9% in trade. But if you have a quick look at the last 5 days chart, maybe you will see that this is largely flat because 2 days back it was also down about 12% or so. Now, actually, this is buzzing, on the back of its US waiver, which allows people in 55 countries to continue receiving the HIV treatment. But we have Varsha joining us, who tracks this sector closely, and possibly they can give us more information on why is Laurus Lab buzzing in trade. Varsha, please take it over.
Thank you, Rucha. So yes, if you see 2 days back, Laurus Labs was down 12% because US had suspended new funds for HIV treatment. But now this has been reversed, and a special US waiver will let people in 55 countries continue to get this important HIV treatment. Now, why Laurus is in focus? Because all this program is called PPFAR, wherein Laurus contributes almost 10% to its sales. Now, this waiver, called the Emergency Humanitarian Waiver, was was approved by US Secretary. It ensures that the people in these countries still get access life-saving medicine through the US funded program called PEPFAR. Now, why Laurus is in focus? Because it contributes 9% to the overall consolidated sales, but because this business is a low margin business, it will only contribute 3 to 4% to its FY26 EBITDA, and Laurus has also stopped investment for ARV business a year back.
Thanks, Varsha, for getting us the details. So, an interesting move coming in for Laurus. In fact, Laurus is one of the biggest beneficiaries. Few other companies also that will benefit out of this move. But moving on and staying with the pharma space, you have Aarti Drugs that is in focus on the back of earnings. Let's quickly pull up the stock and see what the counter is doing in trade. Gains of 3.5% coming in there. If you see in terms of the numbers, now, on a year-on-year basis, the revenues are down around 8%. A marginal uptick in terms of profitability, and in terms of the margins, 11.1% is the number. However, what's the highlight is there is a sequential growth coming in on the margin front and the profitability front, and I think that's what the street is reading positively. Joining us is Adish Patil, CFO and COO at Aarti Drugs. Adish, good afternoon and welcome to the show. If you could help us understand, yes, a growth coming in on a sequential basis, but on a year-on-year basis, a pretty flattish number on the profitability front, a slight dip on the margins and on the top line. What is it that has not worked if you have to look at the numbers year-on-year?
Yes. So if you look at year-on-year, first of all, the formulation segment did not do well in December quarter. As far as standalone company was concerned, where we sell APIs and spec chem and intermediates, there only in the domestic market, especially in the API, in the antibiotic API category, there was less demand. So there we faced a little bit lower volumes, lackluster demand, whereas export demand was quite good. So if we look at the standalone company's gross contribution, it has actually improved on a sequential basis by more than 0.5%. But going forward, we feel that margins should further improve. And if you look at year-on-year, there was a negative price variation of roughly around 2.2%, December 24 versus December 23. And even on sequential basis, it was restricted to around a couple of percent. So what we see is that the pricing scenario has now stabilized in APIs, and we don't see any further downward trend of API prices from here on.
Okay, well, thank you so much for that, Adish. But my next question to you will be around the kind of exit growth that you had guided to be, around 7% of revenue growth is what you expected in FY25 and largely revised to flattish growth because of pricing pressure. So by when do you expect this to reverse? Do you think that FY26, as you had mentioned, would be a turnaround year? Then what could be the key levers for such kind of growth? And of course, margin outlook as well.
Yeah. So mainly the reason for demand not doing that well for current financial year was first was our salicylic acid plant, which was a greenfield project. It was an in-house developed process. So it took a little bit more time. There were a lot of teething problem at the plant level. And as of today, we have sorted out that problem. So January month's production has already ramped up. So Feb and March will do even better. So that was one of the main reason which was creating a lot of drag in terms of profitability, in terms of margins. And secondly, the export demand was not good in the first half of this year. Fortunately, the Q3 did well in exports, and Q4 will do even better as far as exports is concerned. And it is the export sale, the export component, which drives, it gives better gross contribution margins. So hopefully, that reversal in export demand trend will definitely help us increase our gross contribution and margins. And going forward in the next year, that is FY26, there are three main levers. One is the salicylic acid teething problem is over, so that will reduce the drag in the profitability and also give us volumes in terms of revenue enhancement. Second is the Saika Greenfield project is going online now in the month of February itself. That technology is it's a proven technology. So we are hoping that there won't be any teething problem like salicylic, because salicylic was the in-house technology. So once that starts, it's a backward integration project it will help us increase the gross contribution in anti-diabetic space, which is around 12 to 14% of our total revenues. And in addition to that, there will be more methylamine-based products which will be selling outside, which has relatively higher profitability. So both these greenfield projects doing well in next year, along with the regulatory approvals what we got recently, should help us drive the volume growth as well as the profit margin for FY26.
Stay with us. I just need to address one earnings that has just come in as we speak. Adani Ports, the revenues are up 13% at 7,964 odd crores. The stock is seeing gains of 0.9% higher. The profits have seen an uptick of around 14%. That number has come in at 2,520 odd crores. Let's look at it in terms of the EBITDA as well. A 14.7% up move, 4,800 crores is the EBITDA number for this time around versus 4,186 crores is what we're picking up. The margins at 60.3% versus a 60.5. So that's with Adani Ports. These are the four numbers that have come in so far. And if you see in terms of the stock, seeing gains of nearly 1% in trade. But coming back to Aarti Drugs, Adish, when we talk about, Rucha did speak to you about what the growth could look like. Now, you've revised the guidance for the next 2 to 3 years at 3,500 to 4,000 odd crores. Earlier, the guidance was 4,200 to 4,500 crores, right? So, why that revision? And considering the situation that you're talking about with the positives, the pain in the API segment, which is over, does it give you the confidence that probably you could jump back to the earlier guidance and not the 3.5 to 4,000?
Yeah. So the thing is like this, the fact that the prices has revised for last 3 quarters sequentially means we almost saw a drop of more than 10% since we started the year. So that is one of the main reason why we have revised down that target. So we are considering the current API prices. But if we see that if the crude goes up back again, because on the back of the sanctions on the Russian oil or for other factors, and other inflationary cost. If the prices go up, then definitely those numbers will be back. But as of now, with the current pricing trend, we estimate that 4,000 crore mark is the correct one.
And when are you expecting peak revenues of around 1,200 odd crores to come in there from the capex of 600 crores that you've already looked at? Because this number is since 2022. So how do you add that?
So we feel that by the end of FY27, that is 2 years from now, FY26 and FY27, we should be able to hit that means more than 70-80% utilization as we exit that particular year. We may not enjoy those revenues for the entire 12 months of FY27, but by the end of it, we should be reaching that utilization. The main confidence behind that is because of the fact that it is not an API plant. It is a spec chem and intermediate plant. So typically the gestation period, the approval times are a little bit lower when it comes to intermediate and spec chem. So we feel that it will pick up faster.
And very lastly, with regards to the Tarapur facility, how much will it contribute to your revenues? Because currently, I think if I'm not mistaken, VAI status is what it has by the US FDA, right?
Yes. So we were under import alert for almost 10 years for that particular facility. So finally, we got the import alert lifted. So we are under voluntary action initiated status. So we can export to the US market. Obviously, it will take a bit of time though certain products are already live. And we do have US DMFs. So we will be starting off with those existing APIs. And those APIs, we are very comfortable as far as technology is concerned, because we are manufacturing at a very loose scale in other plants, which are for other markets, the same API. So we are pretty confident that it should give more than 30% EBITDA margins from that plant. And the full potential would be around 70 to 80 crores. However, we do have a land parcel in the same FEI number. So we will expand. We can double the capacity in that particular area. So we will be doing.
Right, so that's going to be a bigger facility that could be contributing to revenues as well. Thank you, Adish, so much for joining us on the show and sharing the views. So, pain with regards to the API business, that seems to be over, and that's one of the key points we should be looking at. But other two earnings that should be in our focus is Voltas and Hitachi. Voltas, the quarter has been weaker than what the street was estimating. There has been a decline in margins, and this is specifically with regards to the unitary cooling product business. Apart from that, if you see in terms of the profit, 132 odd crores versus a loss of 30 crores, a good number on the profitability end. And if you talk about Hitachi Energy as well, the revenue growth has been driven by a favorable execution mix. The operational efficiencies have also improved, and that's what has kept the stock locked in upper circuit. In fact, let me go across to Raghvendra to ask his views. Raghvendra, Voltas and Hitachi Energy, how are you looking at both these counters?
Well, Hitachi Energy might look expensive in terms of the valuation metrics, in terms of a P multiple of more than 150 times to its earnings. But these engineering, power equipment, technology stocks actually have been trading the entire sector at a P multiples of more than 100. So we have to ignore or actually take it with a pinch of salt that the valuations are expensive and might continue to be the same. Now, what the earnings tell us that the execution mix has been very fantastic. They have beaten the expectations of the street, and broadly the commentary from the management is also very impressive for the quarters ahead. So we believe that even any correction in the prices of Hitachi Energy to levels of around 11,500 or 11,000 might be a good entry point. But yes, if someone is holding, continue to hold. This stock might look expensive, but it would continue to give good returns, let's say north of 15% annualized returns, even from current levels. Voltas, there has been some yellow flags in terms of their market share overall, and that is a concern where the stock price is taking a beating. So let it continue to fall, maybe at levels of 1100 or 1150 could be a better entry point. But until then, we would wait for another quarter earnings to see if there is how the market share in terms of the refrigerator business, in terms of their washing machine business on the white goods side of appliances fares for the next 2 quarters. Until then, we would avoid Voltas at current levels of 1300. So Voltas, it's a wait and watch, and Hitachi Energy, it's good even at current levels and expensive valuations.
Voltas is a wait and watch. There we go. Thank you so much, Raghvendra, for joining us. It's always a pleasure speaking with you. But let's move on to the banking space. Well, Fino Payments Bank is out with its third quarter numbers. The results, as we speak, the total income at 461 crore, largely flat. Operating profit was up about 10%, but ROA came in at about 2.52%, just about 8 basis points uptick on a quarter-on-quarter basis. But to talk to us more about this one, we have Mr. Rishi Gupta, the MD and CEO at the company, joining us on the show. Well, good afternoon. Thank you so much for joining us, Mr. Gupta. My first question to you will be around the kind of
I can't
growth.
hear them.
Yeah, Mr. Gupta, can you hear me? Okay, meanwhile my team fixes that. Let's talk about the results. I have Harsh, who's there sitting with us and who tracks this sector closely. Harsh, talk to us more about how one should read these results. Are they good, bad, or largely in line?
Yeah, it's a very interesting company because it's more like a new age bank rather than one of the traditional banks. What they do is they have ATM vending machines and speaking in a very simplified fashion here, they have ATM vending machines in rural areas which are set up with kirana stores and pharmacies, and they behave as ATMs for everyone. So you're virtually like an ATM, within a kirana store. It's pretty interesting, and thereafter, that's how they've actually grown, and now they are transitioning to a small finance bank. But Rucha, you want to take the first question?
Yeah, sure. I think the management is now connected, Mr. Gupta. I hope you can hear us over here. My first question, thank you so much for joining. My first question to you was around the kind of growth that you are expecting FY25 to end with, and a little bit perspective you can give us for FY26 as well.
So for 25, we had given a guidance of 25%. And we are in line with that guidance. If we look at the Q3 performance, we are at 25% growth. For the 9 months, we are at 26% growth. So our guidance on 25% is continuing, and we will come back to you for the guidance of 26 maybe in the next earnings call.
But sir, hi, Harsh also joining in. Always
Hi,
good,
Harsh.
always good speaking to you, sir. Sir, but tell us, potential-wise, a 25% growth clip for the next 2 to 3 years looks decent, in your opinion?
See, what you have to see is that as a company, we have been transforming for the last couple of years, starting from a physical network of merchants, which now becomes our go-to point for transaction business and also for our ownership business, which is CASA. Over and above that, we have built up CMS as a good ecosystem play for our B2B customers. 2 years back, we started to push on the UPI digital ecosystem, and now you can see from the results also, the digital ecosystem revenue is now 24% of the overall revenue. And we expect that part of the revenue to continue to grow. With the growth in the digital ecosystem and coupled with the growth on our ownership, which is our CASA. CASA business itself has grown by 24% in this year. We should expect somewhere between 20 to 25% growth for next year also as we look into our plans coming up in the next year, because there are a lot of products, especially on the digital payments ecosystem, which we are trying to roll out in the next 3 to 6 months. In the growth of those products, coupled with our growth in the digital existing digital products and CASA, should lead to a healthy growth. But coming specifically for 24-25, we continue to remain positive on a 25% growth number for this year.
My question to you is, when you're banking on digital payments business to this extent, to what tune are you expecting it to contribute to your top line going ahead? And in turn, will we see a positive impact on the operational front, and if so, by how much?
So the digital business, while the net profit margin is relatively lower than the physical business which we do on our transactions and our CASA accounts, but on the profit level, it is better numbers. So you would have seen that our net profit margin has actually come to 6.2%, which is one of the highest till date for us. We expect that our digital ecosystem should play around 25% to 30% in the coming year also. And maybe with more products coming in, it could lead to maybe 1/3 of our revenue coming from digital related products in the next couple of years.
Okay, Mr. Gupta, wanting to understand from you how transitioning to a bank will change some of these plans. If small finance bank license comes through, what changes for you?
So for small finance bank license, one is that there are a lot of restrictions on the liability front, because you can't take more than 2 lakh of rupees of deposit. Current account also has similar restrictions. Then we can't do RD, FD. So all those liability related restrictions will go away. Asset product, which is a big hook product for both the liability as well as for our customers, when I look at giving them loans to our infrastructure is already set up. We can extend them loans in that process. So those two big things will come up on the liability as well as on the lending side. Just to give you a number, our liability, which is our biggest franchise, which we have built on our CASA platform, actually grew 11% on quarter. Between Q2 to Q3, our liability CASA balance actually grew by 11%, so to say. And on an overall basis, there's 39% growth on a YOY basis. So we are pedaling on a liability franchise. We have the infrastructure on the ground. We are now putting more emphasis in terms of how do we pick up the right technology for our lending products. We are also thinking how do we build the team. So a lot of that work has started. As you are already aware, RBI has also published about 10 days back the list of new executive committee, the external committee members list. So with that going into, we expect that the discussions will further strengthen over the next
Absolutely,
couple of months.
Rishi. I think this is what the street is watching out for, because the stock is actually way below the IPO price. So investors are slightly unhappy. But with your plans from here on, I think it should make them happy as well. So let's see where it goes from here on. Thank you so much, Rishi, for joining us on the show and sharing the views. Thank you, Harsh, as well. So completely out of time. With that, it's a wrap on this edition of Profit Buzzers. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you. STT. STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
Well, the union budget is right around the corner, and we get you some of the major wish lists according to Bajaj Broking, the key sector expectations, as well as the three key stocks that you should watch out for in this particular budget. Let's start with, some of the key budget expectations in terms of sectors. In terms of banking, they have mentioned that, they're expecting no favorable terms in terms of deposits to come in, but capital infusion for PSU banks as well as insurance companies will be something to watch out for. When you move on and look at the other key expectation from banking, they are expecting that the focus of the banking and the financial space will be on sectors such as cement as well as the metals, which haven't done too well over the last 2 years. Import duty changes to support any kind of domestic production will be something to watch out for, especially for the metal space, because we are expecting and hearing rumors as well in terms of some anti-dumping duties on metals coming from China. When you move on and look at the key other expectations from the infra space specifically, a key sector to definitely watch out for, capex allocation for roads and railways is something that's been standard. It's been increasing steadily over the last 6 to 7 years. And this time, again, it will be something to watch out for. Apart from that, announcements of any kind of large-scale projects, according to Bajaj Broking, likely a new freight corridors will be something to watch out for as well.
When you move on and look at specifically from the auto space, it is expected that the allocation for PM E-Drive and the auto PLI policy will be something to watch out for. Do note they've already announced the PM E-Drive scheme. It has reduced the subsidies over 25 and 2026 as well. Any kind of movement in that will be something to watch out for. Tax cuts as well as increased funding for Manrega will also be something, as apart from that the Bajaj broking expects is something to watch out for as well. Apart from that, any kind of tax break specifically on the housing loan interest as well as increased allocation for housing will be something to watch out for in terms of this budget as well. When you move on, look at some of the other key expectations such as from pharma as well as healthcare. Support for R&D will be something to watch out for through PLI schemes. There have been some PLI schemes and action on that aspect as well, with special focus on anti-diabetic as well as weight loss drugs, something that's gaining popularity, especially in the US and the developed markets. Any kind of move on that will be something to watch out for. Funding for, of course, the Ayushman Bharat as well as institutions such as AIIMS is another key trigger according to Bajaj Broking. When you move on and also look at the defense space, another key sector in the budget has always been in the news. Any kind of capital allocation is something to watch out for. Initiatives boosting defense exports, and it has increased steadily to around 20 to 25,000 crores now, as well as increased procurement from domestic defense companies is something apart from that to watch out for as well. In terms of, apart from other measures such as support for the renewable energy initiatives is something else in the defense space as well. When you finally look at, the consumer sector, and that's been in a lull over the last, a year or so, the consumer staple companies also not reporting very strong results. And any kind of, increase in digital taxes, in cigarette taxes specifically is one of the key triggers. Now, brokerages have mentioned that, this will be a key negative.
Hello and welcome. You're watching Top Trades on NDTV Profit. I'm your co-anchor Soumit Sarkar, and I have Anushi with me, who will be joining and anchoring with me for this for the next half an hour. Well, when it comes to the benchmark indices, be it the Nifty Mid Cap or the Small Cap indices, all three indices are gaining in trade, though we have seen a small selling when it comes to the Nifty Small Cap Index, but overall we are up in trade. But a lot more that we are seeing when it comes to stock specific action that we are seeing in the markets. Firstly, it's Hitachi Energy, which has locked in an upper circuit of 20% after reporting a stellar set of numbers. Then we have Laurus Labs on the F&O side, which has gained nearly 8% after US has said that they will continue to provide funding when it comes to important drugs on humanitarian grounds. Now, do remember that earlier when they had said that they will not fund WHO, Laurus Labs share prices had fallen around 15%, and we are seeing some recovery on the back of this announcement. Now the stock is up around 8%. KPIT Tech is seeing follow-up buying after the company reported a strong set of numbers yesterday during market. And then there is GAIL India, which is up around 3% in trade, just ahead of numbers. When it comes to losing side, it's Voltas, which has dropped more than 10% in trade after the company reported a weak set of numbers when compared to analyst estimates. Now, if you look at YOY basis, the numbers might look better, but when you compare it with the analyst estimates, yes, it's a weak set of numbers, followed up by CAMS, which is down around 8.5%. Tata Motors, the numbers are pretty much in line, but the guidance is something that has not excited the street, and hence we are seeing such kind of a downtick on Tata Motors. Then there is ABB India, which is declining on the back of weak guidance coming in from the global company, which is saying that the order inflow in the fourth quarter has declined by around 21% on a YOY basis. So that's pretty much what we are seeing in the markets. But it's a capital goods day, right, Anushi? Right. A host of stocks that are there. There is L&T and BL, which are coming out with numbers, and there is Hitachi, which has hit an upper circuit of 20%, and then there is ABB, which is down around 6%, and Adani Ports has also come out with numbers. So firstly, let's tell us about the Adani Ports number.
Right. So Soumit, when we are talking about Adani Ports, the key highlight of this result is the EBITDA margin guidance. Now they've upped that, but before we go to that, let's talk about the numbers. Revenue has seen about a 15% growth at 7,963 crore. Margins has more or less remained in the flat range at 60.3% versus 60.48% of last year, and net profit reported about a 14% of a growth. Now the 15% of a revenue uptick that we are seeing is on account of the ports revenue seeing about a 11% growth, while the logistics revenue is the one which is pulling the leg, about 22% of an uptick that we are looking at. The net debt to EBITDA level is about 2.1 times as compared to 2.3 times in 2024. Now, the highlight is the FY25 EBITDA guidance, which has been increased to 18,800 crore to 18,900 crore. This is in comparison with 17,000 to 18,000 crore, which was the figure that we were seeing before. They've also clocked in about a 7% of a growth in terms of where the cargo volumes were for the 9-month FY25 picture, and about a 4% of a growth in their Q3 FY25 numbers in cargo volumes. If you have to look at the share of the company, the cargo market share for a 9-month FY25 stood at about 27.2% versus 26.5%, and container market share for the 9 months stood at about 45.2% from 44.2%. So this is the overall overview that we are seeing for Adani Ports, Sumit, and that is why it is in focus right now.
Well, we have Sneha with us. Sneha, any idea what's how are Adani Port numbers looking like? They have also upped their guidance, EBITDA guidance for FY25.
Okay. Very good afternoon. So Adani Ports numbers has been slightly above our estimates. In fact, they have given a very strong volume growth, which came as a surprise. So definitely with the management increasing its guidance, that has gone really well with the market, and that's why the kind of reaction that we are seeing. Now the overall outlook remains quite positive, and with the overall the budget focusing on the capex theme, we believe that the Adani Ports will actually emerge much stronger post the budget. So we continue to remain positive on the company.
Okay, so that's a view for ABB. But Sneha, there are some other couple of stocks also which will be in focus today on the back of their Q3 earnings. We have L&T, which is set to report its Q3 numbers. Now we are expecting a 17% of an uptick. This is what the consensus is suggesting, while margins may remain flat at 10.5% to 10.4%, and net profit may see about a 27% of growth. The key things would be to watch out the order pipeline prospects, because if you look back, they had reduced their order line prospects in the previous quarter. So how that would pan out in this quarter is something we'll see. Other than that, the Middle East commentary in terms of where the order inflows are concerned is another factor that we'll be watching out for, and the EBITDA margin guidance, if they are sustaining that for the next fiscal, or how is the outlook building on. So I want to get your view on L&T as well.
So as you mentioned, even we would be watching out for its overall outlook on the Saudi market, as well as along with the domestic market. With regards to the international markets, the orders had slowed down a little, but of late we have seen some sort of uptick with the order inflows coming in from that market. So hopefully the commentary should be positive on that side. With regards to the domestic market, the budget will play the key role with regards to whether the government actually goes ahead and pushes the capex or not. Because the overall outlook for FY26-27 order book will largely depend from this. Having said that, since the company is well diversified into other segments as well, given the upcoming segments like defense, data center, and real estate and everything. So given its diversified book, somewhat it would be a little immune to, it's not completely dependent on the capex revival. It will also depend upon how the government pushes the new emerging sectors. So even that will play an important role for the company. So we would watch out for the commentaries that would come post the results today, as well as the budget, how it pans out on that day.
Right, Sneha. Well, shifting focus from capital goods to AC manufacturers, both Blue Star and Voltas reported their Q3 numbers yesterday. But which of them performed better, and how are the numbers looking like, and why Voltas is down in trade? We have Mahima joining us to give us all those details.
So in terms of how Q3 has panned out for both the companies, well, clearly Blue Star is an outperformer. It also gained market share, is what the management said today in Q3 itself in the room air conditioner segment. And it's a beat across revenue, net profit, margins, as well as the EBITDA number, whereas for something like a Voltas, the revenue was a hit, but the EBITDA, the margins and the net profit was a miss. Let's take a look at how revenue has fared so far. In terms of Q3, for Blue Star, the estimate was around 2,600 odd crores, but it came at 2,800 crore. So a complete hit in terms of the revenue, and the growth was 25% YOY. For Voltas also, it's a hit in terms of when it's compared to the estimates, but the revenue grew by around 18% for Voltas. Moving on to the EBITDA numbers, Blue Star, saw margins at around 7.5%, expected was 7%. So again, a hit in terms of margins, and the margins expanded by 60 basis points. Now for Voltas, the margins did expand by 527 basis points because Q3 FY24 for them margins were not on a stronger basis, and that is why we've seen that there is a huge uptick in their margins, but the expectation was much higher than what they posted. The next parameter that we are observing is profit. They were expecting 135 crore for Blue Star, which came at 133, so in line with the estimates, and it was a growth of around 32%. Voltas, on the other hand, the estimates were 158, but it came to around 132. So it's a miss in terms of estimates for Voltas. And last quarter, the company was in losses, and now it's become profitable. So in terms of all of these parameters, we've seen that Blue Star clearly stood out. Now, in terms of the unitary cooling products services specifically, for Blue Star, the revenue was up 22% at 1160 odd crores. And for Voltas, it was up 20% at 1770 crore. And lastly, in terms of margins in the unitary cooling product, for Blue Star, it was 8.1%, up 103 basis points, versus that of decline of 244 basis points at 5.9% for Voltas. So this is how the two companies fared in Q3, and clearly Blue Star was an outperformer.
Well, thanks for that, Mahima. Sneha, coming to you, Blue Star, a clear outperformer. I want to understand your outlook on what some of these air conditioning companies are doing. What is your pick in this, if you prefer this space, and your outlook on the same?
Okay. We are quite positive on the overall space. Definitely, I mean, there's a lot of scope with regards to the penetration in the tier 3, tier 4 cities. So there's a lot of market opportunity. Now, when we talk about the numbers in Q3, obviously, there was some sort of pressure that was seen on the margin front. We'll have to understand from the Voltas management, the call is due today, as to the reason why the margins took hit in the UCP segment, but we believe that this could be just a 1 or 2 quarter phenomena, and the lower margins is not likely to sustain. So we're quite bullish on the overall opportunity. Both the the project space as well as the UCP space is expected to do well, and especially with the capex revival on the cusp. So probably we can expect, in fact, the Blue Stars, the industrial segment can see a very sharp uptick. So both the companies, we're quite positive. Blue Star, we don't really have a coverage, so I won't be able to comment on it much. But Voltas, yes, we are positive. In fact, the Voltbec has actually turned, it has been able to turn around from the losses to profitability, which is a very good sign. So we continue to have a positive view on the company, and the today's call will give us more clarity on it.
Okay, so optimistic view for Voltas, and further details awaited in the conference call slated later in day today. But coming to a very interesting story, 8.62 lakh crore households out of 1 crore receives Muft Bijli. That's the update that we are getting at the moment. Vikas joins in with more details on the same.
Yes, Anushi. So we have achieved around 8,62,000 crores of 8,62,000 installations as far as the PM Muft Bijli Yojana is concerned, and this is almost 8.6%. Although the response had been muted this year, but this year was also marked by general elections and also 3 state elections. So that had impacted the overall implementation. If we see, there were around 44 lakhs as far as applications were concerned, and 1.7 crore registration. So this is likely to pick up in the second and the third phase, which is expected to reach 1 crore by FY27. So by March also, government expects around 10 lakh new installations to happen, and by October 20 lakh. This is expected to grow to 40 lakhs next year and 1 crore by 27. So the reason also because the supply chain got impacted, and India's, if we look at the peak module capacity production, is also not very high. But over the last 1 year, it has picked up, and this is also likely to go up in the coming 2 years. So that will help to supply for the rooftop solar projects also. And the subsidy allocation under this scheme has also been around 5,000 crore out of 78,000 crore that was proposed under the scheme. So that is for the entire 1 crore households. but 5,000 crore out of that has already been disbursed, right?
Well, thank you, Vikas, for bringing us that exclusive. Moving on, EBB is another stock that remains in focus. It's down around 6% after the global. That is, the parent company said that the India business has seen a 21% drop in the order inflow. So, Anushi, how important is this guidance coming in from the global player for the India listed business?
Right. So, Samit, what we have to watch out for is ABB India's order commentary now for Q4, especially, and the next quarter also. What this could mean in terms of order inflow. If we see what ABB Global is saying, we've seen about a 4% of an uptick in terms of where the revenues are concerned. In the orders, they've seen about a 7% of an uptick. But the pain point, which is for ABB India, is the 21% of an order inflow degrowth that they are looking, the global company is looking for the India region. But it is important to highlight that what the global company is doing, it's not necessary that the ABB India would also report a similar trend, as both the companies have another reporting methods and there are discrepancies in terms of where the orders are coming for both of these companies. In fact, if you just pull out the trend as to how they have performed, ABB India and ABB Group, if you look at the last quarter, that's last year's quarter Q4 number, we've seen 35% of our order inflow growth for ABB India, which is quite significant as compared to where there was 16% of an growth in where the ABB Group is. This pattern has followed in other subsequent quarters as well, in 15% of a growth in ABB India in Q1 as compared to 5% of growth in ABB Group. Even for this quarter, fourth one, 21% is the decline that we are looking at. So there are reports suggesting, there are analysts believing that this may persist in the Q4 region as well. So there would be some bit of pressure in terms of where the orders are concerned. In fact, some analysts also believe that the quarterly order inflow run rate of 3,500 crore won't be maintained in this particular quarter. So we have to watch out for further details in terms of where ABB India's outlook is in terms of order pipeline and order growth. Their results are slated on 18 February. So more details awaited on this. But let me go across to Sneha for this one. Sneha, I want to get your perspective on ABB India, what the parent, what the global company is saying, and how this could mean in terms of where ABB India is.
What I believe is that though the parent company has lowered down the overall guidance, but probably it might have limited impact on ABB India. What ABB India is doing, they have done a strategic shift more towards the large-scale, long-term projects. Earlier, they were focused more on the short-cycle projects, which they have strategically shifted away from and moving gradually towards long-term projects, which will give them a sustainable growth over the long term. Now, having said that, in the near term, definitely there will be some rub-off effect, and thus there might be some negative impact. So execution will become really important for next 1 to 2 quarters. But overall, the demand scenario remains quite healthy, as a company is well present in the high-growing sectors like data centers, railways, renewables. So definitely it's well placed to capture those opportunities. So from a long-term perspective, its strategy is likely to provide them a sustainable growth. In the near term, there might be few challenges.
Okay, so that's the view for ABB India. But very interesting company, Bharat Electronics, also in focus on the back of their Q3 numbers, which will be released soon. The con call is at 4 p.m. So further details of it. But let's talk about what the street is and what the analysts are expecting. So the consensus suggests that 21% of a revenue uptick is what we can see at 5,023 crore mark. Margins may see a decline to 23.8% versus 25.8%. Do note, for these defense companies, it is the product mix which is important. So execution of a particular product of a low margin product may lead to a margin contraction. In this, net profit may see about a 9.6% growth. Now, in terms of where the order book positioning is, the company is aiming for order inflows of around 25,000 crores. And if you look the Q3 trajectory, we are somewhere roughly around order inflows have stood at about 7,500 crores. This is at the end of Q2 FY25 figure that we are looking at. So very important to see how the order inflows pan out for this quarter. as the target is for 25,000 crore. For most of the defense companies, a lot of orders have been bunched up in the Q3 and Q4. So execution and new orders is something that we should be tracking for. Outlook on orders in terms of any non-defense segments is also something we should be tracking as the company wants to increase its mix. So Sneha, I want to understand from you, what is your view on Bharat Electronics?
Okay. Bharat Electronics, as you rightly mentioned, it really depends upon what is the product mix during the quarter, and that could actually lead to sharp variation in the margins. We are expecting that the post the spike that was seen in the second quarter, margins will normalize a little in this quarter. So far, they have a very strong order book, and thus that provides a good revenue visibility. Plus, their export share is rising, and they have done a good diversification into the non-defense space. So the contribution from that side is increasing. So from the long-term perspective, while we are quite positive that the company is well positioned to benefit from the defense indigenization, at the same time, the non-defense space also provides a good opportunity. Thus, it's a good blend to actually hold on into your portfolio.
Well, thank you, Sneha, for that. Well, with budget around the corner, before wrapping this edition of Top Trades, NDTV Profit brings to you the wish list from various sectors, and our focus today is renewable energy sector, which is hoping for policies that will turn the turbine for the space. Mihika brings us more on this.
The government of India's focus on renewable energy stands very strong, and our country has set some ambitious target of 500 gigawatts for 2030. Our shift to clean energy is no longer just a trend, but the transition cannot happen overnight, and it certainly won't be smooth without strong government support. We need a comprehensive energy transition policy to accelerate the transition while also making energy security of the country strong. So with the Union Budget 2025 just around the corner, here is what the analysts believe and industry wants for the renewable energy sector. Let's first start with 5 key expectations. This is spread across various sub-segments of renewable or clean energy. The first key expectation is higher capital allocation for the PM Surya Ghar Bijli Yojana scheme in FY26. The current allocation stands at 75,021 crores in order to install 1 crore household rooftop installations. More support for this program can benefit players like Tata Power, Warri Renewable Tech and Adani Green Energy. Next, Jefferies awaits tweets on duties on solar modules and cells. Positive policies in this area could benefit Warri Energies and Premier Energies. The third key expectation is for higher budgetary support for offshore wind energy. Carriage ratings note that incentives for project cost funding, larger turbines, as well as mandatory sourcing from distribution companies could help the space. The need comes due to low developer interest in offshore wind, despite the 6,853 crore viability gap funding scheme announced last year. The major driver for the low interest is the 2.5 times higher setup cost for offshore wind projects when compared to onshore projects. The fourth key expectation is for battery energy storage, an ecosystem that is key for 24/7 power supply. Nuvama expects the government to take measures for energy storage technologies. Carriage Ratings, on the other hand, notes that how domestic battery energy storage ecosystem can benefit from initial subsidy support via a PLI or viability gap funding schemes. The rating agency also adds how tax for crucial raw material imports can help adoption. Furthermore, it is key to note that media reports have noted a budget proposal which has been sent to the Finance Ministry, and this proposal includes a mandate for developers to establish battery storage facilities. The fifth expectation is for higher fund allocation for green hydrogen over and above the SIDE program. Current production costs for green hydrogen are not comparable despite government efforts, and this needs to be addressed. Nuvama also expects mandates for the use of green hydrogen, ammonia in key sectors like steel, refineries, fertilizers, and more. The government could also implement blending green methanol with petrol in transportation and other sectors by providing incentives for producers. This would help consumers adopt the fuel. And lastly, we also spoke to different companies operating in the space, so here's the industry wish list. As per Warri Energy CFO, expansion of rooftop solar programs to increase adoption remains key. The company also mentioned how anti-dumping duties for solar modules and cells is critical to diversify and indigenize the supply chain and mitigate any short-term price fluctuations. Warri Energies also notes how an increase of export subsidies on renewables from 1% to 5% will be a significant boost to the sector. Apollo Green Energy notes how the budget should address the need for modernizing infrastructure as the current grid stands outdated and ill-equipped to handle growing demands. Renew Power states that the budget needs to introduce focused funding for green skilling to ensure that India's workforce is prepared for the clean energy transition. And lastly, manager of O2 Power, which was recently acquired by JSW Energy, states how extending the conventional 15% tax rate under Section 115 BAB by 5 years would be a significant boost for the sector. The company's CFO also noted how the industry needs long-term financing challenges which have to be addressed. Well, that was what analysts expect from the budget 2025 for the renewable sector and what the industry wants. Stay tuned to NDTV Profit.
STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well
for the policymakers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget as well as has been in each one going into the same. We look at some of the key moves that have seen in the Nifty before as well as after the budget and get you some of the biggest measures that were announced in these budgets and what could have led to the strong Nifty reactions. Let's first look at 2024 because we had two budgets announced in this particular year. One was post the elections as well, and we did see a 1.5% move in just a week after, and that momentum was continued in the month as well. Leading into this budget, there were a lot of speculation.
Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. With me is Neeraj Shah. And, quick check on where markets are at. The Nifty doing okayish. We've hit the high point of the day, which was, which was 23,311. And then we've come off it. So we're looking okay at this point. But broader markets is where some bit of that pain is. Let's pull up the advanced decline. And broader markets were doing fine till at least midway through the day, after which we've kind of fallen off, 1/3% lower on both. And the advanced decline is looking slightly skewed towards the positives, but largely looking even Steven. The Nifty 50 though doing relatively better in that sense, where the breadth is concerned. Let's pull up the Nifty top contributors, gainers, losers on both sides. And Bharti Airtel, Reliance, HDFC Bank, M&M. Reliance and HDFC Bank sitting on the positive, definitely holding markets in the green in good stead. But you're looking at plenty of losers. Tata Motors on the back of those numbers, quite a bit of disappointment. Infosys, Kotak Bank, as well as Adani Ports. Some of those dragging the index a wee bit. A couple of those on the back of numbers, even though Adani Ports, the numbers were quite decent. Well, the stock reaction has gone the other way.
The EBITDA guidance also has been raised,
yes,
Harsh.
EBITDA guidance raised, a decent set of numbers, maybe a marginal miss on margins, but I'm not so sure that a 60% margin business, missing margins by maybe 20-30 basis points, really should have that kind of an impact on the stock, frankly, Neeraj.
Yeah. So it's down and trying to figure out the reasons, but the intraday is interesting because it was down about 7.5
it's recovered
and has
from
recovered a little bit of lost ground as well. Yeah, so that's interesting.
Okay, now I want to go to an exclusive story here. 3 senior officials at Kotak Mahindra Bank's retail lending team have resigned. This is what sources tell Vishwanath Nair, who's joining us exclusively for all of those details. Vishy.
Right, Harsh. So, 3 senior leaders from the retail banking division. There's Ambut Chandra, which the bank has now confirmed. They've set out a statement saying that he's resigned from his position to pursue opportunities outside the bank and that they will announce a new leader for the position later. But what we understand from our sources is that this exit has been in the works for a couple of weeks at least. And finally now the bank can come out and say it that Ambut Chandra will be leaving the consumer banking division. The other 2 officials who have likely exited Kotak Mahindra Bank include Mr. Janardhan as well as Narendra Agarwal, both who are senior officials within the bank's branch banking and retail banking division. Remember that this is coming in about a year since you had a large exit of KVS Manian from Kotak Mahindra Bank, who then went on to become the MD and CEO of Federal Bank. The exits are also coming in about a year since Ashok Vaswani took over as MD and CEO of Kotak Mahindra Bank. So it's important to note that these exits are now coming in at Kotak Mahindra Bank, while the bank is saying that this is part of our natural, normal business as usual, and people come and go, and that's not really that much of a material difference for the bank, and that they will announce, people taking over at these positions later on. But still quite interesting because Kotak Mahindra Bank is under a lot of scrutiny. The RBI's regulatory restrictions have not really stopped at Kotak Mahindra Bank. They still can't bring in customers through the digital mode. They can't issue fresh credit cards. That is still ongoing, and this churn in the top deck is something that's important as far as Kotak is concerned.
Yeah, I mean, it's been a bit of a concern, Vishy, Neeraj. It's this particular topic has been a bit of a concern for Kotak. The overhang has been there for the last 12 months or so, and there have been a couple of those overhangs which Vishy spoke about. RBI as well as top brass.
Yeah.
Top brass continues to be a problem.
Yeah.
So and of course the counter has done decently, Vishy, since the result. It's still up 5%, so it's holding fort bravely. But
I'll tell you the problem. No, just the small thing. The problem for Kotak also. I mean, just think of it that some of these things have been spoken about for a while. Maybe 5 years. Kotak has moved from 1700 to 1893. So in some sense, an issue or two plaguing it here and there has been hitting the stock regularly.
Correct. So Kotak, over the entire COVID period and then post-COVID as well, has always been hesitant to enter that unsecured loan rally that a lot of the other lenders were doing. They were always cautiously optimistic. That's the language that the management at that point in time used. They said that we don't want to accelerate too hard and then risk a crash. While that logically made sense, but some of the larger lenders, the larger peers have all done reasonably all right. HDFC Bank, ICICI Bank have done reasonably all right. Axis had a little bit of a problem, but still within their parameters of risk. So it's not like you would have done very badly had you taken on that rally, but decision wisdom of the management.
And then they reversed it also very, very sharply.
Exactly.
They came out and they said that we're currently at 7. We're going to double this book to 15% of loan mix.
They have to do that because your credit card business is not growing since April, right? Yes. And at some point in time, you need that margin to kick in. While this quarter, Kotak did see its margin expansion slightly, but that was all cost play, right?
Yes.
It was not yield on advances that is actually contributing to the margins, which is what the bank wants now. They want that higher return business while protecting the asset quality metrics, but still they want that return to come in. And credit cards being a big driver of that, if that is blocked, then the other businesses have to kick in at some point.
So I'm just going to play devil's advocate here. Sure. So while in the last 3 years the stock has done nothing, you've gone from 12,000 crore bottom line in FY22 to nearly 23,000 crore bottom line FY25.
Yeah.
Stock has done absolutely nothing. Right, and I'm not sure, Neeraj, maybe some part of it has already had played out back then, so there was maybe a bit of overvaluation, but currently valuations are undemanding in that sense compared to 5-year averages.
I'll tell you something interesting, Harsh, here. As far as Kotak is concerned, the management transition is also something that has played a role, right?
Yes.
So once it was clear that Uday Kotak was going to step down from the MD and CEO position and a new incumbent would come in, and then Ashok Vaswani's name was announced. Briefly at that point in time, there was a lot of optimism that Ashok Vaswani is going to bring in a new era of growth for Kotak Mahindra Bank. Of course, his hands are tied at this stage, right? Like he can't really push that pedal to the metal, so to say. He can't really grow that fast because there's a clear restriction from the Reserve Bank of India. So till that gets resolved, now the bank has been repeatedly saying, we hope it will happen soon. We cannot give you a timeline, right? Other lenders have come under restrictions, gone out of restrictions, have done well already. So the point is that Kotak has to, at some point in time, these things have to go off of the discussion table, and finally the bank has to come back to its neutral sense so as to grow further.
Fair point. No, absolutely fair, sir.
No, that's it. So there's a great break, and good to have this break as well because it's timely to have this going. So it's an NDTV Profit exclusive by our colleague Vishwanath Nair, our banking editor, bringing this out for our viewers. Meanwhile, some results out, so maybe talk about that as well. Anything pending, Vishy?
Nothing on Kotak at this point in time, Neeraj. If you want to ask me something for sure, I can.
Yeah, just if you can hang on for a minute. Sure. Just wanted to, because I need to address a couple of results that have come in. I'm told maybe Kalyan results are also out and they will be watched out for. But Bharat Electronics, the first one, is a large index name. Net profit number much higher than estimate. Margins looking better than estimate, and I think that's why BEL has seen this bit of a spike. Remember, it's not as perky as normally some of the other stocks are, so you got to bear that in mind, but some numbers out there on the screen. Heidelberg numbers also come out, and a slam dunk in terms of profitability. It's happened across the companies you've got acquired. Sanghi didn't have great numbers. This one is also having good numbers. So Heidelberg is come off quite rapidly because of this. We'll wait, maybe in case Kalyan Jewellers numbers are out, we'll try to mark them as well. And before we get to our guest, just one last thing, Vishy. Anything that is expected from Kotak over the course of the next 6 months? So now we've seen talks of exit, talks of some to and fro, etc. between the regulators and Kotak, etc. and all of that.
Yeah.
What else? Are all problems behind, if you will, except for personnel problems?
As such, Kotak didn't suffer from a lot of the problems that the broader sector does suffer from, right? For example, their microfinance book is a problem, but it's relatively smaller than comparatively, say, for IndusInd Bank, right? If you were to look at that portion of the book, now this quarter they reported a loss on BSS Microfinance, which is their microfinance subsidiary. That needs to turn around for sure. On the asset quality front, even in personal loans and existing credit card book that they built over time, needs to improve further, and that's when things start to look better.
Okay. Well, watch out for Kotak for sure. Thanks a lot for that. Vishwanath Nair, our banking editor, with those details. Nishal Maheshwari, market expert on the fundamentals. Rajesh Palviya, SVP Technical and Derivatives, joining in on the technical and the derivatives. And it's an important day. Rajesh, I'd like to start with you first from that perspective, because it's the expiry day as well. Are the indices looking like waiting for an accident or something?
Good afternoon, everyone. So Nifty has already shown good, move in last couple of days, and almost struggling to cross 23,200. That's the major call concentration area for the this expiry. So I think 23,200 to 23,300 zone is the tough zone for Nifty to cross. Until the Nifty not crosses this level, maybe some pressure would be there for expiry as well as in the coming day also. On the downside, 23,100 to 23,050 are the critical and important support area for this pullback. If market has to continue this pullback further higher, then market Nifty needs to hold above a 2350 level. That level needs to watch closely for next 1 or 2 trading session. So if we slip below to that level, then again we may see some sharp selling in the market. But at this juncture, I think one should hold there long with stop loss of 2350. We are expecting expiry around 23,200 only, plus minus 20 point from that level. If at all Nifty crosses in next 1 hour of trade above 23,220 level, then there could be some possibility of short covering action, and that can give some sharp up move in the market towards 23,300, 350 zone. But chances are slightly still on the low side for that breakout. So we may remain in the tight range, maybe dip towards 23,100, 120 should be used as a buying opportunity for intraday trader. And towards 23,200, 250 zone, one should book profits. For Bank Nifty, we believe that based on the data, I think 49,300 to 400 zone is the important supply zone. If at all Bank Nifty crosses above 49,400, then rally can extend to 49,650 to 700 zone. But I think in today's session, I think most of the movement is already done for Bank Nifty also. So maybe some pressure towards expiry and Bank Nifty may slide further to 49,200 to 100 zone. That's again important support area. So I think one should hold their long position. Those who wants to play for next couple of days on the long side, to 49,000 is the stop loss to hold position.
Okay. Nishal Mahe, thanks for that, Rajesh. Those levels are well noted, and especially on an important day today, and the fact that we have the budget in a couple of days. Nishal, thanks for joining in as well, and both of you, thank you for being patient while we were breaking that news story. But Nishal, financials and selectively are coming out smelling like roses this quarter. I mean, led by Bajaj Finance, of course, but some others, and including PSU banks, haven't done too badly. Are you a buyer in the financial space, Nishal, in a market scenario like this? No, Nishal, can you hear me? Okay, I think Nishal can't hear me. Rajesh, your stock ideas and a word on Bajaj Finance.
So first, I'll give you on Bajaj Finance. Today we have witnessed a very strong buying action in this counter, and after a long consolidation, today stock attempted to give breakout of its October 2024 swing high, but from higher level some profit taking was there. But even even if we look at the near-term, short-term structure is on the bullish side for the stock. And till the stock is holding above 77.50 mark, I think there is a possibility that again we may see a continuation of rally towards 8100 to 8200 on the Bajaj Finance. So I think one can hold the position with 7750 stop loss. Moving to my stocks ideas for this afternoon. First one is from the chemical space, that is SRF. Very strong buying action, and at the end of this expiry, I think stock is trading near to its highest point. And the way stock managed to give breakout of its multiple supply zone, if you look at the weekly chart, almost stock is now managed to give breakout of last 2-3 year a consolidation supply zone on a long term chart. So that's the strong breakout on long term chart, and we believe that if stocks continues to hold about 2700 mark, I think there is a possibility that this rally can extend further to 3000 plus kind of level also. But for trading point of view, we are projecting target of 2845 to 2860 with stop loss of 2725. Another stock is from defense sector, that is Bharat Dynamics, BDL. Again, here also there is a stable structure. Stock is trading about 20-day, 50-day moving average, comfortably holding these levels. And strong recovery has been already there in the stock from its recent swing low. We believe that ahead of budget there could be some buying action we may see in next couple of days. So BDL can be looked at for buying side. 1320 to 1340 is the target. One can keep stop loss towards 1245.
Nischal, let me get you in the conversation. Nischal, lenders, Bajaj Finance, and everything that's happened and transpired with regard to numbers, how do you read in to them? And we also had a news break. Not sure if you had a chance to catch that. I guess you did. But some senior exits from Kotak Mahindra Bank. Is it a concern? Sorry, double question, but very quickly if you can address that. Your views.
So thanks for having me. So I think as far as Kotak is concerned, basically I don't think so there's going to be, I think it's all short-term things basically. It's a large institution. I've been around for more than 25 years. So I think they have got a deep pool as far as talent is concerned. So I don't think so basically it's going to impact them. What was the other question?
So with regard to Bajaj Finance, how do you read the numbers and what do you make of the commentary as well?
So I think Bajaj Finance, I think okay numbers. The challenge now with Bajaj Finance is basically going ahead is going to be growth. I think they have reached a stage where basically now a 25% kind of a number is going to be a bit tough given the size of the balance sheet. So I think one should start looking and saying that it's going to be around a 20% kind of growth. Basically, that's where they are going to be there. And as far as numbers is concerned in the current quarter, I think a good set of numbers. But the challenge remains to be the growth as we go ahead.
Okay. Fair call. Now, trying to think of numbers that will be interesting to watch out for. We've had some of the chemical names, Nischal, come out with some very strong numbers, particularly the CDMO side. So chemical pharma, but ones with CDMO have had some good performance, right? Ami Organics, Lotus Labs, maybe Divi's comes out with that. And there was some commentary from Divi's last time around as well with regards to this. Good time to pick in some of these CDMO players, or are they expensive?
So they have always been expensive. I don't think they ever become cheap. If you remember, Divi's has been around these levels for like last 15 years. So, but I think so is the growth. So I think the growth potential is pretty big basically for the whole CDMO space. So one shouldn't be really looking at that. But I'm saying some of these companies, especially I think Lotus, and I want to make a declaration here that I'm an owner of Lotus, so I may be a bit biased, but I see a great potential basically, given that they have all gone ahead and made huge investments, and the China plus one theory is going to play out in the next 3-4 years. And there is a fair chance basically that each of these guys, especially Laurus, which I've done work on, the CDMO space could be like 3-4 times here in the next 5 years. So I'm saying there is a huge potential. I don't think so. We are as yet late in the space. If one wants to look at it, I think it's a good place to be in.
Okay, well, that's the long and short of this for sure. Okay, point well noted. Nishal, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time.
Thank you.
And just before we get to Jupiter Wagons, Rajesh, quick 30-second or 50-second view, Rajesh. Some of these railway companies, do you like any of them?
So the first company that comes in my mind, that is IRFC. That stock is looking attractive. The way stock has broken falling trend line on daily chart, I think here we may see traction ahead of budget. 155 to 160, we are projecting target with stop loss of 140.
All right, time to go to the management of Jupiter Wagons. We have Vivek Loya, Managing Director, Jupiter Wagons, joining us. Good having you here, sir. Want to quickly understand, Vivek, what's the sense like? Is you've had FY24 very strong growth over FY23, but FY25 is looking slightly softer on a full year basis. Give us perspective on that and how the outlook is for the next couple of years in terms of growth.
Yeah, so thank you for having me here. So in terms of FY25, I think it is as per the projections which we had done at the beginning of the year. So FY24 definitely, because the base was much smaller, as you're aware that that was the period where railway released the biggest order in their history, and that's when all the execution and everything happened. So definitely I think for us to again go back to that kind of a growth will be difficult. But if you see, if you look at the trajectory, in terms of the order book and the growth, that has been pretty strong and consistent. So compared to last year, I think last year we had done a little less than about 8,000 wagons which we had supplied to the Indian Railways. Whereas this year we will be supplying close to 9,000 plus wagons. And going forward, we are looking at definitely to take this number up to beyond 10,000. And that is where we see, the demand playing out at those numbers. Beyond that, it again depends on how strongly railway is able to execute all the infrastructure projects which is in the pipeline. I think that would again determine going forward how the demand will shape up. But beyond again the freight numbers, all the other businesses which the wheel business which we had acquired, Bonatrans, that has grown close to 300% this year post the acquisition, and next year we are looking to double those numbers. And post that, once the complete integrated facility which we are setting up in Odisha that kicks in, then you are looking at revenues of close to 2,000 crore plus from that business, and a substantial portion of that will also be exports to the European market. So in terms of and also the braking business itself, this year, we have already started supplying to Indian Railways as well as exporting out of those businesses. So I think all the incremental businesses are now going to start delivering, and that's where you are going to see the maximum growth coming in.
Vivek, so is there a slowdown in the order inflows currently, and would there be an event that could trigger some of the flows? Your order book is good, but has the last 3 or 6 odd months seen a slowdown? I hear some of your peers say that.
See, for us, as you are aware that a substantial amount, more than 50% of our order book is private. There we don't see any kind of slowdown. We have been accumulating sizable orders. So if you see our order book over the last 1 year, most of that order book has come from the private side. And going forward, also we see a very strong momentum because we are constantly picking up order books there, and we are in negotiations with a lot of players. On the railway side, we believe that this in the next 3 to 4 months, railway will come out with a sizable order book because again, as you may be aware, they had given a huge order book and which the deliveries are still ongoing. So the deliveries of the same will be completed in FY25. So we expect another round of order books to come in the next 3 to 4 months. But definitely in terms of size, it will not be close to that 70, 80,000 kind of numbers because that was railway had a very low base, so they had to build up the base. But the numbers will not be that big, but definitely it will be substantial.
Okay, and how should we look at Bonatrans? So what was the revenue a year back? What have you 3x'd at? And where does it go from here? That's my first question. Second question is with regard to the facility in the east, which is going to get you 2,000 crore of revenue. How quickly does that come on stream, and how quickly does that revenue trickle through on your financials?
So when we acquired Bonatrans, it was doing a revenue of a little less than 70 odd crores, and it was a loss-making company. This year, I think we should touch close to 300 crores of revenue with 12% plus EBITDA. And next year, we are looking to double the same. And the integrated forging facility which we are setting up, I think that is in two parts. One is the axle plant and one is the wheel plant. I think the axle plant should be commissioned early or mid next year, and the wheel plant should be commissioned by end of 26. So that is what we are looking at. And I think from 27 onwards, and that's what we have projected also, from 27 onwards is when those revenues will start kicking in.
So can we say FY27 top line of roughly 6,500 odd crore? Is that a reasonable number to work with?
Yeah, definitely. Okay. FY27 is that is what we are looking at.
Okay.
And also you have to also understand that we are launching our ELCVs also in February, and there also we have got a very strong demand from the market, and also on the BESS, especially on the railway side, things have started moving. So those businesses also will start becoming significant contributors.
And Vivek, sorry, very quickly, 30 seconds. What should your margins be at that point as you grow? You're currently sitting roughly 14.5%. Sorry, yes.
Yeah, we are sitting at 14.5. I think we are definitely, again, very difficult to give, exact numbers, but we are looking at margins which are going to be beyond 14.5%, definitely.
Okay, fair point. All right. Okay, thank you so much, Vivek, for coming in and speaking with us. Always good chatting with you.
Yeah, thank you.
Okay, now quickly moving on, it's time to hear out the management of Adani Ports decoding the Q3 earnings, listening to the whole-time director and CEO Ashwani Gupta talk.
APSEZ delivered all-round growth during the first 9 months of fiscal year 25, with PAT crossing rupees 8,000 crores. Revenue was up by 14%, EBITDA increased by 19%, and PAT grew by 32% year-on-year. EBITDA margin increased to 62% from 60% last year. Driven by the momentum across our businesses, we are upgrading our FY25 guidance to rupees 18,800 to 18,900 crore from the previous guidance of rupees 17,000 to 18,000 crores. We witnessed fantastic momentum across our business drivers, including market share gain, coupled with volume price mix increase, traction in logistics vertical, and operational efficiencies, along with technology-led gains. We launched a new trucking management solution. This platform acts as a transformational marketplace as well fulfillment solution to streamline supply chain for customers. While the initial focus is on trucking, the platform will eventually cut across the rest of the value chain and make us a true integrated transport utility company. Our domestic ports saw year-on-year revenue growth of 11%, along with 80 points increase in EBITDA margin. Overall, India cargo market share increased to 27.2%, while container market share went up to 45.2%. Logistics revenue grew by 22%, driven by double-digit growth in container and GPWIS volumes. Our international operations revenue increased by 16%, driven by Astro and Tanzania operations. We commenced operations at Vizhinjam Port. Vizhinjam berthed more than 140 vessels during the trial period and has handled 70,000 TEUs in its first month of operations. We also closed the acquisition of Gopalpur Port and Tanzania concession. We added 5 new vessels to Astro Offshore's fleet of 26 at the time of acquisition, taking the total to 31 OSVs now. We also placed India's largest orders for 8 harbour tugs with Cochin Shipyard. This order aligns with government's Make in India and Atmanirbhar Bharat initiatives. We will continue to invest in marine assets in line with our roadmap to become one of the world's largest marine operators. Sustainability has always been core to our operations. We are delighted to have been recognized by S&P Global CSA among the top 10 companies globally in the transport industry. ISS ESG also recognized APSEZ among the top 12 companies globally in transportation infrastructure. Overall, momentum across our businesses remain robust, as evidenced by our EBITDA guidance upgrade, and we look forward to close FY25 on a strong note. I take this opportunity to thank our valued customers and stakeholders. Your unwavering support has been pivotal in our growth journey, and we are truly grateful for your trust and partnership. Thank you.
This is the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs? And what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you. STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets. General elections.
Union budget.
2 more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
The union budget is around the corner. What could be announced and how will it impact the market? UBS comes out with a key report. UBS thinks the impact of the budget on the stock market would be muted as the capital expenditure and consumption boost could be limited in this time around. But what does UBS estimate the government could announce? We bring you what UBS expects in 5 key aspects. The first one's, of course, the impact on the stock market. Government's fiscal deficit, which occurs when the government's total expenditure exceeds its income. The third aspect would be infra companies to be impacted in this key budget, changes in the capital market structure and taxation, and finally, what government companies could be divested this time around. Now, UBS feels that the budget might not boost the market as the expenditure on consumption as well as capex might be.
All right, back with India market close right here on NDTV Profit. And remember, the markets have cooled off completely. Nifty IT is really sulking in trade. Small caps also 1/3% lower. Rajesh, you gave us levels at the start of the show, but IT stocks in particular have taken it on the chin today. What do you do here?
IT stocks are, now struggling to cross their, breakout levels. So most of the IT stocks, large cap IT stocks are, facing the supply at their near-term resistance zone. And the behavior is same for most of the IT stocks, be it TCS, Infosys, Wipro, all stocks have corrected from their, recent swing high. I think weakness is there in the most of the stocks. And if we go with the Nifty IT index also, so Nifty IT index is also witnessing resistance at higher level. On the higher side, until the Nifty IT not able to take out 42,500, 42,600, I think whatever minor pullback which we are getting in Nifty IT will also meet to the supply as the index is struggling to cross its 100-day moving average at this juncture. So 42,600 is the key level to watch for on the Nifty IT. If it crosses, then rally can extend. But till the time it's not able to take out, some weakness would be there. So I think TCS is going down. It's approaching to its next support level of 4,000. If it breaks below 4,000, then we may see further more downside towards 3,900 also. So most of the large cap stocks are struggling to cross their near-term resistance. We may see further more weakness in the coming days.
Looking slightly wobbly is, I must say, some of the stocks have really turned. So, before we get to our segment Heard on the Street, just wanted to mark Deepak Fertilizers, right? Look at that stock. After having a really strong result reaction, it's down about 13% today. And a big sharp downtick all through the day today. So some stocks are really sulking in trade. But what's being heard on the street, I think it's important to dissect that. Sumit Johnson on to our segment with the chatter on the street. Sumit, good afternoon. What are you learning?
Well, firstly, it's on Polycab. Now, selling pressure has been seen on the FIR desk when it comes to Polycab as a counter, and dealers are indicating that there could be some negative development around Polycab. So keep an eye out for Polycab in trade. Apart from that, it's JSPL and LIC Housing, delivery-based buying seen on the DI desk ahead of the numbers for both these counters. For LIC specifically, dealers are suggesting that cheap valuation is also one of the reasons the stock is still trading at just 1.1 times their price to book 12-month forward. So ahead of result, we are seeing strong buying action in these two counters. Then there is Black Box. Now, dealers are saying that selling pressure could continue for this counter because a few large HNIs who were given shares of this shares of Black Box recently on the back of the fundraise that the company had done, they are looking to exit this counter. So selling pressure might continue for Black Box. It has been volatile in trade today. This is second time in trade the stock has hit a lower circuit of 5%. So keep an eye out for Black Box as well. And lastly, it's PG Electroplast. Now, large HNIs have been seen accumulating this counter. There has been a 30% drop in the share prices, and this stock could also benefit from some likely announcements that could come in budget related to PLI. So PG Electroplast is the fourth stock that has been in focus. Large HNI has been accumulating this counter at lower prices.
Very interesting. Thanks so much, Samit, for all of that. Sudeep Bandopadhyay also joining us, Kush Bora also joining us, Rajesh Palvia has been with us. Thanks for staying on. And excuse me, let's take the discussion straight to them. Let me first ask Kush. Kush, first on the index, what's the sense like? What's the view like? We're seeing weakness over the last half an hour or so creeping in. What's your sense?
Hi, Harsh. A very good afternoon.
Good afternoon.
And from the pinpoint level, practically of the 23,300, mark that we spoke of for a while, that we have been speaking of for some time now. Just glad to see that that's transpired the way we've actually discussed, or maybe the data has shaped up. I think the norm for maybe the day or two, or perhaps there isn't much time left, could be consolidation within this band of 23,000 and 23,300. While you could see some gyrations of 100, 150 points here or there, might seem like big volatility, but it might just be within this band for a day or two. Beyond that, it's anybody's guess in the sense that what does the budget actually hold for markets, and the economy will define the course. But right now, it does look like that the positive divergences that are shaping up, plus the 23,000 foot base that is shaping up for the next week also, might act as a base, and we might see some sort of an upswing. But I would trade with caution on the long side if I were trading, just because of the event, nothing else.
Interesting. And views with regard to the Nifty Bank, Kush, what's the sense?
Again, slightly more bullish here. The falling trendline resistance that we discussed 2 days ago was crossed yesterday. The Bank Nifty is sustaining above that today also. The broad resistance zone, 500 point, slightly broadish, but in the 500 point resistance range on this one is 49,500 to 50,000. I think that should be respected for the next couple of days. On the downside, you're seeing 48,800, 48,700 kind of support zones acting up. So here too, I think consolidation will be the norm until the event is out of the way. But purely technically speaking, I think the bias here is a little more bullish than it is on the Nifty. I would actually perhaps go out, create a long position on the bank Nifty for targets of 50,000 and higher. It could well be with a very strict risk management system in place, or maybe just a light position, but still erring on the long side on bank Nifty.
Okay. Sudeep, what should one do at this point? We saw a bit of a recovery, but that recovery is currently being sold into. Would you wait and watch for the budget, or before the budget would you venture and load up on a couple of names?
Well, I think if you are not really a little aggressive investor, I think it's better to wait and watch. However, our view is that budget will probably will be on the lines which markets and the economy needs. And hence, if you are a bit aggressive, it may be worthwhile looking at buying into a couple of pockets, couple of stocks. You need to take some risk when you are in the market. So our view is that probably if you are willing to do that, you should buy into some stocks.
Okay, so that's the advice coming in. Rajesh, if I can come to you very quickly on Hitachi Energy, because we're going to discuss that in a little more detail, but just on charts, how is that one looking? Locked in upper circuit, I believe, even now.
So there is no opportunity now left with the Hitachi Energy, as the prices are already at locked for the day. So I think looking at the structure, I think the stock has potential to continue furthermore upside, as stock has broken about 12,000 mark. So I think till the stock is trading about 12,000 mark, I think there is a possibility that this stock can extend gain towards 12,600 to 700 zones. So I think those who are already long in trade can hold the position with 12,000 stop loss.
Okay, so those are views coming on Hitachi Energy. Kush, your picks for this afternoon?
Sure, a couple of them, both of them on the long side. The first one is Karur Vysya Bank. We've spoken about this, couple of times. In the grand scheme of things, if you see the moves that it's seeing recently is, what can at best be called consolidation in a brief, a brief period of outperformance. I think this is a good time to accumulate stocks like this one. From a near term, the target on this one is 235, 242, 222 being the target. Since it's very close to target 1, you might want to play for target 2 and up that stop loss. On the second long call, it is Torrent Pharma. This stock has seen a very good, very sharp revival on the back of very good volumes in the last couple of sessions, comfortably trading above its 20 and the 50-day moving average. Slightly flat today, but I think this is a very clear sign of consolidation that's going on because the volumes have actually picked up today. So 34.60, 35.60 are the targets. 32.60 is where you place that stop loss.
Interesting. Okay, so those are some ideas. Now, we want to ask Sudeep about Hitachi Energy, but before that, let me go to Anushi to try and figure out the extent of the strength in the Q2 numbers and the reasons thereof. Anushi.
Right. So if you look at the numbers, very strong set of numbers that we are seeing in terms of Hitachi Energy. Revenue growth of around 27% at 1,620 crore with the margins. Margins is the key highlight here in the results. We've moved across to 10% as compared to 5.3% in the quarter. So if you look at what the management had indicated in its previous conference call as well, that they want to take their margins to the double-digit line, double-digit growth line. So it is something wherein it is in line with that. Net profit stood at 137 crore as compared to 27 crore. In fact, if you also look at the 9-month performance, we are seeing a similar trend in terms of where the revenue is concerned, 27% of a growth here. Margins have moved upwards to 7.94% as compared to 4.71%, and net profit seeing about a 300% jump. But other than that, even the order book positioning of the company has remained very strong for the quarter. This is because of one mega large order that they've received, that is the Khavda-Nagpur HVDC order, which took their order inflows up around 839% at 11,594 crore. So significant growth in terms of both the annual and the sequential basis that we're looking at. With the new order in place, the order backlog has also stood at roughly around 19,000 crore as of December 24. So very strong numbers in terms of where the financial metrics are concerned and what this order will bring for the future revenue visibility of the company also going forward.
Okay, thanks for that. Thanks for that, Anushi. That's very interesting as to what they've done and the dissection thereof. Sudeep, expensive names, some of them are getting clobbered, the likes of ABB, etc., because of adverse news flow. And some are seeing even heightened gains after maybe strong quarters. Hitachi Energy, a case in point. 20% higher for a stock which on a trailing 12-month P is trading at whatever, 130 times, 1 year forward trading at some 80 times. Still sees some traction like this.
Well, absolutely right. I think, when you are quoting at that kind of valuation, there is no margin of error. So if your results or the news flow around you is not to the liking of the market, you are getting really hit hard. And that's what is happening in case of many of these scripts. However, on the other hand, if the news flow around these scripts, which are quoting at high valuation, and the results are to the liking of the market, I think the market, for lack of other better opportunities, are latching onto these. And that's the one way to explain this. Of course, in the specific case of Hitachi Energy, I think they are in a sector where there is a lot of traction, and I believe this is a structural change is happening in the entire energy space. And Hitachi Energy being in that space with kind of equipments they supply, and they, particularly in the transformers and other equipments for the energy services, I think that has a long way to go. They are getting orders left, right, and center. And I think the order flow for these kind of high-tech equipments will continue, considering the demand of power and demand for better distribution as far as India is concerned. So the company definitely has potential, but even I'm scared at these kind of valuations to recommend a buy.
Okay. Yeah. And then, so viewers, here's the piece. Somebody's buying Hitachi, it's locked on an upper circuit. But somebody who looks at markets very closely, fundamentally is scared of buying it. Rajesh Palvia, who looks at it from a technical perspective, also says that it's done its course, and therefore it's very difficult to do this and go out and buy Hitachi Energy at the current prices. But clearly somebody's bought it. As people are buying Suzlon, as it is that people are buying, let's say, Laurus Labs, which is 7-8%. Actually, Sudeep and Kush, come in on Laurus Labs as well before we move on to the next piece. Sudeep, I'll come to you first. Stock got hammered because of a US or a Trump order. Stock reversing the losses because of this. It didn't have too much of a material impact, 4% on EBITDA, as our analyst Varsha says. But the larger point is around the fact that some of the CDMO businesses have done really well. What is your sense on Laurus, for example?
Absolutely right. Look, Laurus have been disappointing us for many quarters. I think after a very long time, they have come back and posted a set of numbers which we all liked, the market liked, and it was a pleasant surprise. So the prices definitely shot up post their numbers. Unfortunately, that the US PFAR order created a lot of confusion in everybody's mind, and the stock took a beating. I had mentioned even then that I think these issues are very temporary, and they will be resolved one way or the other. WHO will find ways of finding alternate funding if that it comes to that, because these are life-saving drugs, and I don't think the world will stop requiring those. So I think today I see it going up again, and some clarity as far as those orders are concerned. Some sane action is being taken in different parts of the world. So Laurus definitely deserves a better valuation, and it has now started showing. Quarterly results were definitely very good, and we'll look forward to their performing even better in the coming quarters.
Well, certainly doing very well for itself. Kush Bora, is there a trade here? It lost and it's reversed the losses quite swiftly.
Yeah, but even before that, Neeraj, it was consolidating and gave way quite a few times, right? So I don't think, even if you discount the last 4 days of move, I don't think the dust has settled on this one. Plus, there are multiple resistance zones around the 595 and then the 615, 620 mark. So for me, the risk-reward ratio at this point is not very favorable. So I would give it a miss. In fact, any move towards the 610, 620 zone, I would actually for now just take it as an opportunity to exit if I've been holding it from lower levels.
Okay, just a word, Harsh, on SRF, because Kush, thanks for that. A word on SRF, because I think the con call is on, and they are giving out decent commentary, I think, on a few things. So they're saying that the refrigerant gas operations will improve on stronger volumes and better realizations. They are also saying that they expect the performance of the agrochemical business, which had a bit sluggish this time, to improve in the Jan to March quarter as well. So that is interesting. And talking of increasing the proportion of value-added products. So Harsh, we'd spoken in the morning, right, about the con call will make the stock move. It's actually slightly ahead of the con call, but it's certainly resting at the high point of the day.
And positive commentary as well. And I wonder if some of the other AC makers are also moving on the back of some of this commentary. That's probably
Harsh, I
something
think,
that we'll have
yeah,
to
I think they have an issue with your mic. So I'll just take in a moment and get in. But yeah, some of these chemical companies should certainly be watched out for. What should be watched out for is what Mahima is getting us, and that's Whirlpool. Well, still locked on that lower circuit. And a history behind this stake sale as well, because Mahima, it's exactly 12 months later that, or 12 months on, that we have Whirlpool parent deciding that, hey, it wants to sell off some more of its equity. Fill us in on the details.
Right. So, as you rightly mentioned, it's exactly been a year when, Whirlpool Corporation had reduced their stake in Whirlpool India from 75% to 51%. And now Whirlpool Corporation has planned to cut its stake in Whirlpool from 51% to 20%. They'll cut this stake in mid to late 2025 is what the company has said. And they're holding around 51% of the company right now. Earlier, 24% stake was sold in February last year, and this was done at 1,277 a piece. So roughly it was a deal of 4,000 odd crores. And the stake sale was done on the back of higher valuations as well. In terms of stock performance, the stock hit a high of around 2,449 on 22nd of October 2024, and it's down around 36% from its highs. Now, why the stake sale? Well, the move will give Indian unit more autonomy, is what the head has said, and Whirlpool will continue to support Whirlpool India operations through sustained brand licensing and technology agreements. Whirlpool aims to maximize their shareholder return and strengthen its balance sheet, is what the management has said. And as per the last stake sale, Whirlpool Corporation said that it will use the transaction proceeds to reduce their debt levels and enhance the balance sheet flexibility. It earmarked around $500 million for loan repayment in last December, that is December of 2023, and debt for the company stood at around $641 million. So they did plan to pay off their $500 million debt through this. Well, how much will Whirlpool earn from this stake sale? For this particular stake sale, the company is expecting to receive another $550 to $600 million. That is net cash proceeds. And despite of reducing this stake, Whirlpool will remain the largest shareholder in Whirlpool India.
Okay. Sudeep, views with regard to this one? What do you make of it?
I think the only reason why they would do this is because they need money for their international business. As last time they had reduced debt, probably this time also they need for some corporate purposes. That's probably the reason for them to cutting down stake in India. They have been an investor in India for some time, and they want to book profit and take part exit. They will still continue to control the company, being the single largest shareholder. And I think that's the only way to explain this. I don't know, the timing hasn't been probably so ideal, and it doesn't augur well for Whirlpool India share price. Till the time this this exit doesn't happen, there will be a hangover in the counter, and the stock will not really appreciate significantly from current levels, is what I anticipate, till the time this stake sale is done and dusted.
Worried even after that, Sudeep? Just this event happening, would it worry you as a shareholder?
Well, to an extent, it would, because a Whirlpool investor would have invested considering the global parentage and what all they can bring. They are continuing to maintain that through licensing agreements, and otherwise they will continue to support Whirlpool India. But obviously cutting down stake from 51% to 20%, not even 25, 26, I think is a bit of worrying signal. And if I was a shareholder, I would have been definitely worried. But I must say that I wouldn't have rushed to sell the share at this stage, because it doesn't make sense to sell now. It's better to wait and watch before you exit.
Okay. let's slip into a very short break. On the other side, we'll get you top BTST ideas. We'll also continue to talk specific stocks. Stay tuned.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
STT. STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well for the policymakers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget as well as has been in each one going into the same. We look at some of the key moves that has seen in the Nifty before as well as after the budget and get you some of the biggest measures that were announced in these budgets and what could have led to the strong Nifty reactions. Let's first look at 2024 because we had two budgets announced in this particular year. One was post the elections as well, and we did see a 1.5% move in just a week after, and that momentum was continued in the month as well. Leading into this budget, there were a lot of speculation, so we saw a downward reaction of the Nifty in the past week, and we did see some of the measures such as the standard deduction being increased to 75,000 for salaried employees from 50,000 earlier, as well as the new tax regime now and having tax-free status for up to 3 lakh rupees per annum for the investors as well. Apart from that, we saw custom duty reductions on mobile phones, gold as well as chargers as well. And these were some of the key moves in this particular budget. Leading up to the election, we had, the 2024 budget in February as well. Let's see some of the reactions as you can see in this particular time frame as well. One of the key moves was increasing the budget for capital expenditures to 11 lakh crores, the first and, a very huge budget as well compared to the last decade. And we did see one of the
Okay, welcome back. You're watching India Market Close, and in the wake of auto companies coming out with their third quarter numbers, it's been a mixed bag. In fact, my colleague Puneet has drawn up a comparison chart between the big three PV manufacturers. You have Maruti, Tata Motors, Hyundai. Puneet, over to you.
Well, thanks for that. So, when the two-wheeler numbers came in, we saw that, it could be a resurrection of the auto sector finally, because, strong numbers from all three, two-wheeler makers. And then came the passenger vehicle makers, dominated the industry with all kind of negative news. And, that's reflected in the table that's right in front of you. While Maruti has, missed EBITDA margins slightly, you can see that stark difference across all metrics for something like a Maruti Suzuki. So when you compare it with Tata Motors and Hyundai in terms of revenue, it's outperformed up 13%. While, on volumes as well, the company has done pretty well in this particular quarter. That's, of course, led by the Diwali sales. But we are seeing that kind of impact of portfolio gap, so as to say, for Hyundai Motor Corp. While for Tata Motors it has been a dull 9 months, and outlook and pressure on the quarter 4, as we spoke about this morning, across JLR and the PV makers to maintain the FY25 guidance continues. You can look at the margin growth as well, and that's one of the starkest difference between all these passenger vehicle makers. Maruti at roughly 14%. Tata Motors mentioned it has some pressure from JLR in terms of warranty cost in the US and the UK. But the Hyundai margins were down because of a very puzzling reason, because they've entered Africa now in a bigger way, because Middle East growth in the export market has slowed down, and they're giving more discounts in Africa because they're competing there with likes of Maruti Suzuki as well as the local players. And hence, that kind of difference on change in strategy, change in execution has impacted numbers severely. On profit growth as well, 12% for something like a Maruti Suzuki. Tata Motors, we spoke about it, 22% down in this particular quarter because of lack of revenue growth. And for Hyundai as well, that 18% sharp this thing, and they had a discounting strategy of roughly around 381 crores is what they mentioned, was lost in terms of profit before tax, in terms of discounting, and hence that stark difference is visible, and we're seeing, brokerages upgrade Maruti today, while they've cut target prices of something like a Tata Motors today, and a couple of days ago, similar fate for Hyundai. So overall, it's a big beat for Maruti Suzuki. And quarter 4, they mentioned Maruti that they expect a 3.5% retail growth, similar to Q3. So, and I think, the market will reward that kind of number right now.
Okay. Sudeep, how do you read into some of these numbers? Maruti far outperforming peers.
Absolutely. I think, it comes very starkly clear that if you have portfolio gaps, you cannot fight in a market which is now evolving and maturing. So that's very clear between Tata Motors, Hyundai, and Maruti. Maruti the portfolio is absolutely tailored towards a market like India. And that's why they're reaping the reward. Also in export market, they have been well entrenched. And other players like Hyundai, who is now trying to enter Africa and all that, obviously needs to, use tools like heavy discounting to gain market share and establish themselves, which is getting reflected in their, the numbers, profit numbers, which is suffering because of these discounts. So undoubtedly, Maruti continues to maintain their leadership in the industry by a wide margin. Even as far as performance is concerned, they're the leaders once again.
Interesting. Kush, I want to also take a quick technical check with regard to Maruti. It's been an outperformer with regard to fundamentals, about what are charts looking like. Before I take, of course, your and Rajesh both's view on Tata Motors.
Well, we did see some sort of a recovery, on Maruti, but for the last 10 odd sessions, it's been resisting near the 200-day moving average. You're seeing some negative RSI divergences pop up. I think Maruti also is perhaps waiting for the budget to get out of the way. If there are any benefits that come about. But other than that, I think one should just wait and watch and see a very clear candle emerge and close above the 200-day moving average. It's not too far. 12,000 or 12,100 is thereabouts the level. Once you get a clear close above that is when you should perhaps consider going long. Otherwise, there's a possibility that we saw last couple of times the stock does resist at a level after a bit of a recovery and then gives way again. So I would actually wait and watch to see as in when it closes above the 12,100 mark. Then there is a very clear run, and that's when you should consider fresh long position. If you have an existing position, not an issue at all, because on the downside as well, 11,800 is a good base. So that is where you place your stop loss.
And Rajesh, Tata Motors, what do you make of that?
A series of low top, low bottom formation in Tata Motor that clearly suggests that the trend is down on the near term as well as on the short term chart. Looking at the breakdown today, stock now slipped below to 700 level. So I think if it continues to remain below 700, there is a possibility that we may see furthermore down move towards us 660 to 640 kind of zone also. So trend is still on the weaker side. This is the sixth consecutive month where the stock is making lower high low formation. That clearly shows that sustained supply pressure is there in the stock. So I think those who are already short in the stock can hold their position with the stop loss of 720. Possible down move can extend to 670 to 660 zone.
Okay. Kush, your view with regard to Tata Motors?
Slightly contrarian, Harsh, on this one. Because we're seeing positive divergences on the multiple time frames, daily and weekly. Plus, if you see the Fibonacci series, there is the pinpoint 61.8% retracement from the early 2023 lows, and we've typically seen stocks rebound from those levels. So while I won't go and bet the house on this, but if I have a view of 12, perhaps 18 months or slightly longer, around those levels or around that time frame, I would say this is a good time to start accumulating. V-shaped recovery, perhaps not on the cards, but definitely good levels to start your accumulations at.
Okay, Sudeep, I'm going to quickly ask you a question with regard to Bajaj Finance, as well as Shriram Finance for that matter. Both asset quality turned out to be slightly better or ahead of what the street was anticipating. Bajaj Finance, in fact, suggesting that the worst is over. We've peaked out in terms of credit cost worries. What's your sense like, both in terms of the commentary, what do you make of it, and what do you make of valuations at this point for a Bajaj Finance?
Bajaj, outstanding numbers. I think much better than what we were expecting, very honestly. So very clearly, this is one company which has surprised positively the market continuously for a very long period of time. And the growth opportunity going forward is significant. We strongly believe that interest rates will start coming down. We don't know whether it's going to happen in February or not, but it's a matter of time before interest rates starts coming down. And as and when interest rates come down, efficient BFSI companies definitely gain more than proportionately. So under the circumstances, also considering the asset quality improvement and performance of Bajaj Finance, I think it's definitely a good buy from a long-term perspective.
Sudeep, you understand these businesses better than most, right? What have you made of the mid-sized NBFC performances in the last couple of quarters? I mean, there is NBFCs with MFIs which obviously have had struggle. What do you do, and what do you think the near term is in store? Because, I mean, 3 years out, everybody's future may look rosy. What about the next 6 to 12 months?
Well, specifically NBFCs with microfinance exposure will have challenges, and they are having already challenges. And I think The jury is still out whether Q4 is going to be the last of the pain or it will spill over into the first half of the next fiscal. But I believe that the pain is still there and it's going to remain for some more time. And whenever these kind of issues crop up in microfinance, we have seen different state governments also acting a little irrationally. We have seen the entire Andhra Telangana episode, and now we are seeing something similar being enacted in Karnataka. So this entire sector is in a flux, and people having exposure there are going to suffer for some time. So yes, to your specific question, short to medium term, I think it's better to be a little away from companies with exposure in microfinance space, and also overall in the unsecured space. There is genuine stress in the economy, particularly in the, we have seen that getting played out in consumptions coming down, consumption not picking up. And we are all hoping that the budget will do wonders. If it does, well and good. Otherwise, I think it's better to be a little away from lenders with unsecured exposure.
Yeah, and viewers, I mean, Sudeep Bandyopadhyay runs an NBFC himself, so which is why his understanding of this is second to none almost. So keep that in mind, and thanks Sudeep for that. Now Dabur numbers on your screen as well. Revenue is up 3%, EBITDA up 2.1%. The stock is up and about a little bit. Harsh, any other details? Because we starved for good FMCG numbers as well this quarter. Emami was one, reacted. What about Dabur? Any sense? The margins seem to be flattish.
Yeah, margins seem to be flattish. Seems to be a toughish sort of quarter when it comes to volumes as well, Neeraj. Doesn't seem to be much with regard to where volumes is concerned. Raw material costs, though, seem to have come slightly better, if at all. And I'd be curious to know as to whether it's getting even better in Q4, and is that raw material cost, pressure easing as we head into Q4 and FY26 as well. Those are a couple of things that I'd be curious to know. But of course, for that, we'll have to await management commentary. But for the moment, the stock is spiking, nearly 3% higher. So the street definitely looking at the numbers in a more constructive light than we seem to be looking at it, on all counts. But Sudeep, let me take a quick view from you with regard to Dabur. The numbers are at best low single digit, if I can call it, on growth. Anything that stands out for you?
Well, I think we have to see the internal search. It's too difficult to comment. At this stage, it doesn't look very, very impressive. But one has to remember that Dabur has a significant exposure to rural India. And what we have been hearing is that rural consumption is slowly picking up. The challenge was in the urban part. So let's see. I mean, Dabur commentary, Dabur internals will be very, very important.
20.3, Neeraj, was the margin projection as well as per Bloomberg estimates, and the PAT projection was at 509 versus the number which it has come in at of around 522. So marginally better, if at all, marginally ahead in terms of profit after tax. And the top line was expected to come in at around 3,300 crore, and yeah, it's come in at 3,355 crores. So it's largely the top line which has contributed to slight bit of PAT, the PAT number coming slightly ahead of estimates. That's
3% now. I wonder if there's a trade here, though. And I'm inclined to ask Rajesh Palvia that, right? Did we ask him? No, we haven't, right? Rajesh, 3% higher, Dabur, trending at the high point of the day. Would you buy it?
Yeah, so Dabur is looking bullish. On a weekly chart, stock is now managing to give breakout of last 4-week consolidation. Even if we look at the other FMCG also, the same kind of behavior we have witnessed for most of the FMCG stock after a correction. Now, almost most of the stocks are consolidated for last 3-4 week, and then now breakout is already there on near-term chart. Possible upside target towards 548 to 555 we may see for Dabur at this juncture. Those who are already long or want to buy can buy with stop loss of 528.
Kush, you were beaming. Were you long Dabur?
Was it that obvious? Did I make it that obvious?
It seemed to me.
It's just 28th January, just 2 days ago. Dabur was our BTSC call with targets of 535 and 545. The stop loss was 515, so that was missed yesterday by a whisker. The low was 515.5, so missed that by a whisker, and today we're seeing target one hit. So I think the happiness comes more from there. I hope all the viewers who actually bought into this are looking at handsome profits today. My suggestion: continue holding on to this one. Tail your stop losses to your buying price and hold it for targets of 545.
Okay, so still positive, Dabur, 3% now, nearly 3.5% higher. That stock doing fairly well for itself. But let's go across. We have Mahima joining us to give us more perspective with regard to Dabur's numbers. Mahima.
Right, so basically the numbers are in line with estimates, which is why we're seeing an uptick in the stock. Revenue is up 3.1%, which is expected to be around 2.6%. EBITDA is up 2.1%, which is kind of beaten the estimates because the expected was 1.3% growth. Margins are in line with the estimates. The analysts had estimated roughly margins will be around 20.3, and it has come at 20.3. And net profit was expected to decline by 1%, whereas the net profit has increased by around 1.6%. So it's almost in line with what the analysts have had expected. Now, in terms of how the other segments have fared, consumer care business has grown by around 4%. Food business has, however, fallen by 3%, and the retail segment for the company has been flat. Now, in terms of how the volumes have grown, considering the past trend from FMCG companies, the volumes might be flat, and we might have to see that this revenue uptick of around 3% would be on account of price hikes, but that we'll know once the press release is out. So this whole view is with respect to the numbers. Overall, it's the numbers are in line. The net profit is, however, slightly beaten the analyst estimates.
Okay, so it's a bit of a pat beat there coming in with regard to where Dabur is concerned. A couple of other stocks which have fared fairly well in trade today, and I want to just quickly mark them out. You have something like a Granules India, which is up nearly 6%, and Azad Engineering, which is up 5.5%. A couple of them on the back of announcements as well, but let me quickly take a technical view on a couple of those. Granules, Azad, Rajesh, any views?
So Harsh, Granules is still, in the weak zone. Weekly chart is suggesting that, until the stock not crosses above 580 zone, it will remain under pressure only. On the downside, the major support is placed at around 555. So I think we may see some more consolidation range of 575 to 555 zone for some more couple of days. Either side breakout will decide the major direction for the stock from here onward. Azad Engineering, yes, there is an uptick of 5%, but still the stock is trading below to all its near-term, short-term moving averages. It's just in pullback action. So on the higher side, the major supply zone is placed at around 1540 zone. So I think until these levels are not taken out by the stock, again, we may witness supply pressure in this pullback. So those who have bought at lower level should try to book some profit around 1500, 1520 zone.
What's not doing well, Neeraj, in trade today is Blue Star and Voltas, the AC majors. Third quarter numbers, of course, and the reaction hasn't been very, very good at all. Both companies saw an uptick with regard to where revenue is concerned and margin expansion. Mahima joins us with a detailed overview on which company fared better. Mahima.
So in terms of how Q3 has panned out for both the companies, well, clearly Blue Star is an outperformer. It also gained market share is what the management said today in Q3 itself in the room air conditioner segment. And it's a beat across revenue, net profit, margins as well as the EBITDA number, whereas for something like a Voltas, the revenue was a hit, but the EBITDA, the margins and the net profit was a miss. Let's take a look at how revenue has fared so far. In terms of Q3, for Blue Star, the estimate was around 2,600 odd crores, but it came at 2,800 crore. So a complete hit in terms of the revenue, and the growth was 25% YY. For Voltas also, it's a hit in terms of compared to the estimates, but the revenue grew by around 18% for Voltas. Moving on to the EBITDA numbers, Blue Star saw margins at around 7.5%, expected was 7%. So again, a hit in terms of margins, and the margins expanded by 60 basis points. Now for Voltas, the margins did expand by 527 basis points because Q3 FY24 for them margins were not on a stronger basis, and that is why we've seen that there is a huge uptick in their margins, but the expectation was much higher than what they posted. The next parameter that we are observing is profit. They were expecting 135 crore for Blue Star, which came at 133. So in line with the estimates, and it was a growth of around 32%. Voltas, on the other hand, the estimates were 158, but it came to around 132. So it's a miss in terms of estimates for Voltas. And last quarter, the company was in losses, and now it's become profitable. So in terms of all of these parameters, we've seen that Blue Star clearly stood out. Now, in terms of the unitary cooling products services specifically, for Blue Star, the revenue was up 22% at 1160 odd crores. And for Voltas, it was up 20% at 1770 crore. And lastly, in terms of margins in the unitary cooling product, for Blue Star, it was 8.1%, up 103 basis points, versus that of decline of 244 basis points at 5.9% for Voltas. So this is how the two companies fared in Q3, and clearly Blue Star was an outperformer.
Okay, well, so Blue Star was the outperformer. Voltas has taken it on the chin in a really bad fashion. But I must say, the Blue Star commentary was good, not necessarily the best. Now, Sudeep, we entered a busy season. Like, before I thank you, we entered a busy season. It is already hot in Mumbai, maybe in the rest of the country as well. Would you buy a cooling solutions company currently?
I think Blue Star has been continuously improving its performance. Voltas, a little unfortunate. This quarter there were some expectations post last quarter's loss, but somehow their the operational costs, I think they have not been able to manage, and that's why the numbers were, though the top line numbers were okay, but the bottom line numbers, particularly the margin and the profit, came below expectations. So if I have to buy, I'll go and buy Blue Star, not Voltas. Also, Voltas did see change in management, I think, which was not really on the expected lines. So let things stabilize a bit in Voltas, then we'll look at that. If I have to buy, I'll go for Blue Star.
Now,
we just need to thank Sudeep. So, Sudeep, thanks for joining in today. Really appreciate your time. Many thanks for those views. But yeah, sorry.
Super duper stretched for time. So I'm going to quickly go to Kush. Kush, 30 seconds BTST.
United Breweries, target 21852260, stop loss 2050.
Wow, excellent. Outperformed. Rajesh, yours.
Bharti Airtel looking bullish. One can buy for target of 1680 with stop loss of 1616.
What do you make of L&T, Rajesh, ahead of numbers?
So we have witnessed correction in the stock, and looking at the near-term structure, still stock is in weak zone. Stock slipped below to all its important moving average. So if it breaks below 3400, I think we may see further more downside towards 3340 kind of zone also. So I think stock is in oversold trajectory. So ahead of number, I would avoid to trade anything in the L&T. Let the reaction to the number to settle down, then only one should take a call at this juncture.
Okay, and Tata Consumer, Kush?
So Harsh, incidentally, a lot of these consumer names are starting to show spike. Britannia, Dabur, these were the two calls that we had already discussed. Tata Consumer also, but it seems more of a consolidation move right now. So not a very aggressive buy, but just levels for someone to watch out for. 945 on the downside and about 985, 990 on the upside.
Okay. Well, what to watch is the important one. But before that, Kush, Rajesh, gentlemen, both of you, thank you so much for being with us today. Great getting your thoughts 2 days ahead of the big day. So thank you for that. Very quickly, what to watch out for? US jobless claims come out. So that is something you keep an eye out for. Advanced GDP estimates, QOQ. Important after the sluggish consumer data that the US came out with. Japan unemployment rate and CPI. In terms of earnings, what we watch out for tomorrow. Bandhan Bank, IndusInd Bank, Nestle and Marico from the consumption space, Sun Pharma from the pharma space, as well as ONGC. And of course, some dividends and some ex-dividends and a bonus issue for IGL. So that's something we got to keep an eye out for as well. But very quickly, before we start wrapping up, Anushi Johnson with a very quick perspective of what to expect from L&T. Anushi, we have about 60 seconds, not more. What's to be anticipated?
L&T would be in focus as its Q3 numbers come out. The expectation is of a 17.4% of a revenue growth, while the EBITDA may see about a 17.8% of an uptick. Margins are expected to remain more or less flat at the 10.5% range, while net profit may see about a 28% of an increase. The key things to watch out for the company would be the inflows growth, which is expected at 15% to 69,000 crores. Now, this is to be led by T&D, civil infra and power segments. Order inflow growth trajectory from the Middle East is something very important to track for. If you had so go and back and see the order prospect pipeline, that was revised downward. So how the order prospect pipeline turns out is something we should be watching out for. Other than that, a commentary on domestic and international outlook on the order prospects is something we'll be seeing. If we take the FY25 guidance in consideration, 10% of growth in order inflow is their guidance, along with 15% of a revenue growth, and projects in manufacturing segment margin guidance is set at 8.2 to 8.5%. So this is the overall expectations built in for L&T.
Okay, sharp on the dot, 60 seconds. Thanks so much for that, Anushi. Quickly on to where we are on the Nifty. Where are we closing in at? Well, we're up 0.6%. It's been a bit of a choppy day again. Let's pull up the intraday chart. We'll see exactly that. The Bank Nifty is up around 0.5%, thereabouts. There you go. We've fallen to the bottom where we've done 23,139 and we've reverted back to near the day's high. 23,305 is where we are closing in at, in around. And we've just clocked a new intraday high, 23,322. We've just done that as we speak. So positive with regard to where the Nifty is, that surge. Let's pull up the Nifty IT. Let's also pull up the Nifty Bank. Want to understand where it's come from. So a bit of recovery on the Nifty IT. So a bit of that contributed by the IT index, but it's the banking index which has done or rather pushed the Nifty 50 higher. Let's pull up the Nifty Bank constituents and let's just quickly look at what's doing very well. IDFC first. On top of that, you're seeing HDFC Bank also do fairly well for itself. IndusInd up 1% as well. Some of the heavyweights not exactly firing. ICICI Axis around 0.5% thereabouts. SBI also up around 0.75% thereabouts. So that's how it's really shaping up where the banking index is concerned. And that's what's likely driving the Nifty 50 higher as well. Let's look at the broader end of the spectrum and whether there's a recovery there as well. The Nifty mid cap, well, as flat as it can get, around a 1/5% higher. And the Nifty small cap index also slight negative bias, around a 1/10% lower. So that's how it's playing out. Let's look at the advanced decline, the breadth, how we've closed in at. We've closed for the day, by the way. Okay, so it's not a bad breadth by any standard. We saw a bit of a reversal on that number somewhere around 2 to 2:30 p.m. and we've seen that reverse back. So positive in that sense. Let's look at the sectoral heat map as well. Try and see which sectors have done well. The India VIX coming off 6% is definitely a positive. You're seeing the Nifty Auto slight mild bias. The Nifty IT is trailing all the other indices sectorally. What's done well, the Realty Index for a third day in a row has done fairly well for itself. You're also seeing good traction on the Pharma and FMCG Index after Dabur's numbers likely aided that count. And you're looking at the others doing mildly okay, largely in line with the Nifty. But quickly onto the BSE 500 top gainers, top losers. Those are some names for you. Hitachi with earnings. Lotus Labs with developments in the US impacting that stock. SRF with both earnings as well as some amount of commentary. Whirlpool promoter sell down. Voltas earnings. Deepak Fertilizer reversal after the gains it made yesterday. You also had the likes of an ABB on the back of the orders getting impacted by 6% thereabouts. But with that, completely out of time on this edition of India Market Close. From Neeraj, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action right up on the other side.
the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you. STT definitely needs to change.
Old tax regime.
1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time, but as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
Well, the union budget is right around the corner, and we get you some of the major wish lists according to Bajaj Broking, the key sector expectations, as well as the three key stocks that you should watch out for in this particular budget. Let's start with, some of the key budget expectations in terms of sectors. In terms of banking, they have mentioned that, they're expecting no favorable terms in terms of deposits to come in, but capital infusion for PSU banks as well as insurance companies will be something to watch out for. When you move on and look at the other key expectation from banking, they are expecting that the focus of the banking and the financial space will be on sectors such as cement as well as the metals, which haven't done too well over the last 2 years. Import duty changes to support any kind of domestic production will be something to watch out for, especially for the metal space, because we are expecting...
And welcome to Investor Guide Budget 2025 special. This is going to be an interesting one because not only our speaker is interesting, but our audience is also absolutely interesting, who's actually wanting to know what should we do from here on? Welcome Saurabh Mukherjee, founder and CIO at Marcellus Investment Managers. Along with him, we also have the students of NMIMS Students College in Mumbai and our very own researchers at NDTV Profit. Guys, you're getting a great opportunity to be a part of this conversation with Saurabh because he himself has started his journey without knowing anything about equities, and this was in his 20s as well. So I'm sure you're going to be able to connect with him very quickly. Saurabh, first thing, we are just around the budget. The key that everyone wants to know is how is investing ahead of the budget different from regular investing?
I think, look, all event-based investing, whether it's monsoons, budgets, elections, all event-based investing is inherently risky because you've got a certain take on the event. So some people watching this might say that I feel the budget will be expansionary, right? And that sort of investing is very risky because making a right call on a specific event, whether it's monsoons, elections or budget, is very tough. So I would urge those watching to use the budget to understand the state of the country. For youngsters like this, it's a great opportunity to learn about how the economy actually functions, but wouldn't recommend trading around the budget, shorting the market, buying stocks, selling stocks around the budget. That's sort of, if you want to do that as a hobby. Don't do that with an expectation of making money.
But with everything said and done, when you say that do it as a hobby as well, do you think it could be a learning experience where a new time trader, a new time investor, I would say, would be able to limit their losses to an extent when they know, okay, this is the money that I'm going to allocate, this is what I'm going to learn out of it, and probably if I lose this, I shouldn't be crying over spilt milk then.
So the only challenge with trying to learn investing through through events like the budget is there are so many moving parts inside the budget. Even if you make money on the back of it, you've got no idea whether you made money because you read the budget right or because something else happened in the world that day to make you go right. So I stress again, event-based investing is difficult, it's risky. If you want to do it as a hobby, consider doing it, but as making money out of specific events like the budget or the monsoons, in my 20 years of being in markets, I haven't seen too many people do it. But that said, it's a great opportunity to learn about the country and about the economy.
So what should an investor do, and to make the most of the budget, how should he or she navigate from here on? Because clearly when you talk about not looking at investing, taking specific events into consideration, but all of these events hold a lot of importance when it comes to markets, right?
Sure.
So to look at an event, take for example, you're talking about the budget now. You had Trump 2.0, which has come at play as well. You've spoken about Modi 3.0 as well, but everyone has been looking at these events very closely. So what should that perspective be then?
So I'll give a very simple framework to think about long-term investing and the budget being one of the items in a long-term investing framework. So one of the most rudimentary things we learn when we begin our investing career is जब economy down cycle में जाती है, when the going gets tough for the economy, think about defensive in inverted commas sectors like IT, pharma, FMCG, right? That's kind of investing 101 in any country. In a down cycle, think about IT, pharma, FMCG. Now, either basis you're reading of the newspapers or watching NDTV, a viewer might have formed an impression that the economy indeed, after three good years, to F22, 23, 24, the Indian economy has entered a cyclical downturn, right? So that's a mental model you build. If you tell yourself you've entered a cyclical downturn, it makes sense to buy IT stocks, pharma stocks, FMCG, even I'm not 100% sure, but high quality banks would be my third area, IT, pharma, high quality banks. Now, so my hypothesis is economy thandi ho rahi hai, down cycle mein ja rahi hai. The budget is an occasion for me, is an event for me where I can either get my thesis validated. The FM will talk about both tax collections and her hope for tax collections for the year ahead. She'll have to give some economic commentary. There will be the economic survey published the day before the budget. All of that gives me information on, is my perception that the economy is in a down cycle, is that perception correct? If it is, it gives me greater confidence that I'm on the right track by buying IT stocks, high quality banks and pharma stocks in bulk over the last 3-4 months, right? I'm not expecting to make a ton of money on the back of the budget, but I have a mental model of the economy and the budget gives me information on, is my mental model correct or have I got my thinking awry about where India is going?
Right. So that's the way you should be looking at the markets whilst reading the budget. Ahead of the budget now, with what's happening in the markets, you've seen a significant correction that's already coming in after the upcycle of the last 4 years. And this is something which is warranted, right? You cannot avoid a down cycle in the markets. How do you tread from these kind of events? And do you think these opportunities should be used to invest in markets and pick pockets of growth or pick pockets of value?
Right. So I think economic upcycle and down cycle are like summer and winter. You don't get worked up because the economy is going down, just like you don't get worked up because summer is ending and winter is coming, right? What you try to do is make money through the cycle. And as we were discussing, a simple framework is, as we go into tougher economic circumstances, which could last for 1.5 years, you load up on sectors which are more export-oriented. IT being a classic export-oriented sector, pharma being an export-oriented sector, and in my case, I've chosen high-quality banks because high-quality banks had a rough time in the post-COVID rally, and I think their time has now come. Now, over and above that, there's another way to think about this, right? India and America are the world's best performing markets over the last 10 and 20 years. These are the only two markets which have given double-digit dollar returns over 10 and 20 years. But the even better news is not only are these the world's two best markets, these markets have very little correlation with each other, right? So when India struggles, America does well. When America struggles, India does well. And therefore, if you're able to build a portfolio, which is say half India, half America, it actually gives you much better chance of generating superior long-term returns, right? Just to use 2024 as an example, calendar 24, our market struggled, the Americans did well. I think over the next couple of years, the Indian market is likely to have a tougher time. Over the next couple of years, the American market is likely to have a happier time. So as we go into an economic down cycle, other than buying export-oriented sectors like IT and pharma, it's also worth figuring out how can I invest abroad. In our case, 2 years ago, we started investing abroad through a portfolio that we opened in Gift City. Our team in Gift City invests into America and Europe. And we think that's a great opportunity to consider, right? The rupee is giving up value to the dollar at roughly 3 to 4% per annum since 91.
Correct.
And that naturally means that if you earn, say, 15% in dollars, it becomes more like 18-19% in rupees, right?
Terms.
So beyond looking at export-oriented sectors, in the Indian stock market itself, consider taking a sort of mental flight into America and look at companies, not just the Magnificent Seven, not just Amazon, Microsoft, but go down the batting order and look at high-quality American manufacturing companies. Gift City makes that very easy for all of us to do.
And I think with Trump 2.0 as well, where he's clearly indicating that he wants to make US the manufacturing hub, and is talking about tariffs, that either you're manufacturing in the US or look at tariffs. That's going to be interesting. But let's also get in all our students who might have questions on this aspect of the budget as well as Trump 2.0. Let's go with, who has the mic over here? Yes, you can take the first one. Introduce yourself and you can take the first question.
So I'm Harish Sarda, and I'm an MBA student at MIMS Mumbai. So, crude oil is one of the largest imports in India. So, in the vision of Viksit Bharat, so how would replacing a significant portion of oil imports with renewable energy or with domestically produced ethanol contribute to the balance of payment equation or the economic growth?
Yeah, so look, lovely question. I think one of the beauties of our country is because services is 60% of GDP, and services grows much faster than the broader economy. Okay? Services is the largest part of the economy, and it grows much faster than the economy. And because services is not particularly energy consumptive, right? To run an IT services company, you don't need a lot of oil, right? That's meant that India's oil import bill, as a percentage of GDP, has actually steadily come down over the last decade. I remember 10, 15 years ago, it was around 13% of GDP. It's now 7-8% of GDP. So my reckoning is, given that it's highly likely that services will be the leading part of our economy and highly likely that the services sector will grow faster than the broader economy, I think as it is, this is a natural construct of the economy, will reduce the energy bill as a percentage of GDP. So I'm not in that camp which aggressively wants the government to give subsidies and do chillana baji to promote alternative fuels. I think the natural construct of our economy actually is one that reduces the importance of fossil fuels, because we are largely a services-oriented economy, and our services sector is actually very competitive, world-class. All of you probably would have heard about global capability centers, right? So Microsoft, Google, Wells Fargo, JP Morgan, all of these firms employ lakhs of people in India. So every week, 3 new global capability centers are opening, creating 30,000, 40,000 jobs, right? So the entire world's office work is coming to India, which is great news, because that sort of office work is lucrative work, अच्छे salaries हैं, good salaries, and it doesn't need a lot of energy consumption. So I think there's plenty for the government to do. It's a very tight, tough fiscal situation for the government. I think the tax dollars are better spent in stimulating the economy in other means rather than worrying about the energy transition. Not least because Trump himself has said, immortal words from the US president, drill baby drill, right? So the US president is saying drill baby drill, and we are here jumping up and down about methanol. थोड़ा सा odd लगेगा.
Yeah.
Hi sir, I'm Juisha Gandhi.
Hi there.
So what you said about drilling down, using that only, the agriculture is other basis of rural consumption in India is one of the key drivers, right? So sir, how do you think this budget will focus on their or increasing financial access to rural communities, or in general credit access to most of MSMEs or marginalized communities?
Superb question. So this is let's now use this to contextualize why the budget is so good. So if you read India's income tax data, right? It's freely available, income tax data. I would strongly recommend everybody goes to the government websites and understands how the income tax data works. Those earning between 5 lakhs per annum to 1 crore per annum, right? They pay 75% of India's income taxes. But that's only 4 crore people, right? Just 4 crore people pay 75% of the income taxes. And where do those income taxes go? They go to those who earn less than 5 crores. 80% of India's population earns less than 5 crores, the folks you mentioned. They are the big vote banks for our political class, right? And I think the message that the political class has taken on board over the last 12 months is that percentage of the population, those people who are below 5 crores, are really the only politically relevant people, right? We have 64 crore voters in India, out of which 4 crore are in that middle class segment. So you can see politically it's really irrelevant. The income tax paying population, they pay taxes, people like us, but politically we really don't matter. The people who matter are the people you mentioned. So my reading is the next 4 or 5 years, across political parties, there'll be a rush to give goodies, freebies, rebates, subsidies, doles to people below 5 lakhs. I think this budget will have some of it. Obviously, as we approach the 2029 general elections, that will ramp up. And as an investor, and this is why budgets are useful to learn, right? Not because of you want to trade on the budget. As an investor, you start building a mental model कि सरकार गरीब को पैसा बांटेगी, and what stocks can I buy? कहाँ पे निवेश करूँ जिससे मेरी कमाई हो? That I can earn on the back of the government being generous to the poor, because they are the only people who politically matter, right? So lovely thing. That's exactly how you need to start strategizing around the budget. हाँ जी, आप चूज कीजिए.
I'm Muskan. I'm from NMIMS Mumbai. My question is that government has a goal of Viksit Bharat by 2047, and infrastructure investment plays a major role in that. Last year we saw in budget there was an investment of 11 lakh crores going into the budget. What are your expectation out of the budget this year, and what do you think is an ideal amount that is required for India given the roadmap ahead?
Right. By the way, I should say at Marcellus we are big NMIMS fans. We have got several NRC1G people in our
Yes, NMIMS. Yes, yeah. It's a tongue twister.
So I think you have to be practiced on that, yes. Right? So we have several NRC1G people in our office, and you guys are clearly very well prepared for this, and I'm happy that historically Marcellus has recruited from NRC1G. But coming to your question, right? I think infrastructure investing के लिए पैसा निकालना will be really tough for the government. So let's again do some basic math. Nominal GDP, right? This is real GDP plus inflation, is going to grow at max at 10-11%. Okay? So nominal GDP will grow at 10-11%. The government has been very clear. They want to reduce the budget deficit. Abhi 4.9 is F25 में 4.9 के आसपास आएगा. They're probably going to try to get it down to 4.4, 4.5. Now, if they want to reduce the budget deficit total government spending will be growing less than 10%, right? If your GDP is going to grow at 10 and you want to reduce the ratio, तो जाहिर है आपका total government spending is going to grow less than 10. Now, if it's going to go less than 10, will you really be killing yourself to spend on infrastructure, or will you look after core vote banks, which is the 80% of the population? I think the lesson that has been learned at the general election, the 24 general election, was look after vote banks. Infrastructure spending, I think, increasingly becomes secondary, and all those in the stock market who have loaded up on infrastructure stocks, I think really need to rethink their obsession about government capex oriented stocks, because I simply can't see, given the political realities of India, I simply can't see where the government will find the money to spend on infra, given that critical vote banks have clearly shown that if you do Ladki Behan, you get immediate political dividends, right?
But sort of to this point, I'll come in over here is, as much as the vote bank is important, I think the money making process for your population is also important, right? And a lot of people are becoming dependent on the stock markets for the same. To that, if we are talking about, okay, an infrastructure spend does not mean it's only one avenue. There are multiple avenues where the government has to look at in terms of infrastructure spend. This financial year itself, there has been a delay. They've not been able to meet that number because of elections. They've not met the guidance at all, right? The ambition is, or probably the expectation is, that FY26 mein aayega.
I think paisa nahi hai. So wo soch, I mean, I agree with you, people are thinking like that, but those are the people who don't understand the fiscal and political process. Paisa nahi hai, and that's why I turn to the youngsters again and say, if you do the fiscal math, 10% nominal GDP growth, government wants to fiscally consolidate. Remember, they have to fiscally consolidate in the 2 years immediately after the general election. नहीं तो जब approach करेंगे 2029, पैसा नहीं होगा, right? So जाहिर है, it has to be the case that the first two budgets after the general election, July 2024 and Feb 25, these are bound to be consolidating budgets. तो अगर आपकी total tax rate 10% से grow करेगी, right? This year, remember, it's growing at 8. Assume कीजिए अगले साल the tax rate grows at 10, and you want to reduce the deficit, your overall spending can grow at, say, 5. In that context, where will you find money to spend on infrastructure, right? And again, reflecting back on election results, right? Remember, politicians are incredibly smart people, right? They look at election results like, say, we look at our portfolio performance and they say, where did we screw up? What can we course correct? I think the big course correction will be on infra. I think there'll be a far greater focus on benefits for the poor. With regards to the point about the stock market is a big source of earnings, right? It feels like that, right? But again, आप RBI का data देखिए, the RBI has published several times said in the last 6 months, the RBI has said several times in the last 6 months that net household savings, net matlab household savings less household borrowing, is at its lowest level since 1977, right? So it's not even evident that stock market में चिल्लानाबाजी से a lot of money has been made for the middle class. The poor obviously are not going to be the big participants. The middle class are the big participants. But given that the RBI data is so emphatic that net household savings are at the lowest rate since 77, the benefits of the stock market boom, I think, have more likely gone to a concentrated economic elite. In fact, 3 days ago, the Unilever CEO said that in urban areas, debt levels are so high in urban areas that people are having trouble buying FMCG items, right? So it's relatively clear that the middle class is in a tough financial position. But as I said, that's not the core vote bank. The core vote bank are people below 5 lakhs, and recent elections in multiple states have shown that there is a recipe to win votes from them. And I think our politicians are smart people. They'll follow that recipe.
Right. So I think the strategy with regards to investing clearly needs to change from what is expected versus what people are looking at.
That's exactly what the economic cycle does, right? As the economic cycle changes, you go away from, say, public sector capex plays. When the economy is thriving, government has plenty of money, public sector capex plays work, right? I missed out, we at Marcellus missed out because we don't invest in public sector companies. But as the economy slows down, naturally the government has less money. Usually economic slowdowns also make the going tough for politicians. And naturally, when the going is tough for politicians, they turn to gratifying their vote banks. And therefore, if you change your tack and say that in a slowing economy, I'll focus on export wala investing, IT, pharma, And then within domestic investing, I'll focus on stuff that the poor buy. So in our case, over the last 12 months, we've bought companies which make tractors, we've bought companies which make fertilizers and pesticides, because we think the big focus will be revving up non-urban India. That's where the power and the votes lie.
Absolutely, power in the hands of rural India, and how the shift in mindset is going to happen from here on, probably to get a developed nation status by 2047 is what we need to talk about next. But let's quickly slip into a short break. Up next, we will be discussing lots more with Saurabh and a lot of interesting questions coming in from the NMIMS students. Stay tuned.
STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure, because of the iconic 1991 budget speech.
STT definitely needs to change, because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax, because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022, where capex was done in a very big fashion.
There were several actually. 1991 was something that...
Welcome back to Investors Guide Budget 2025 with Saurabh Mukherjee. Saurabh, let's pick it up from where we left before the break. You're talking about rural India, positive in terms of tractors. How are you then looking at consumption as a pack? Because we're talking about a slowdown in consumption, where there has been a slight pickup in terms of rural India, but urban is absolutely something that even the companies are worried about. So how do you link consumption to rural India and tie that together now?
No, you're right. It's very difficult to find consumption plays which only sell to rural. So far we've done tractors, what is Escorts Kubota, and we've done pesticides, fungicides. So we bought a conglomerate called Godrej Agrovet. Godrej Agrovet has some ice creams and milk and pesticides, fungicides, animal feed, so cattle feed, fish feed, and it also has oil palm. So we thought, let's do multiple rural plays too. Godrej Agrovet. You're right, the consumption piece is tricky, right? And one part of what we have tried to do is see if dairy, paneer, ghee, ice cream is a place. So after doing lots of rural traveling in South India, we ended up buying Dodla Dairy around 6 months ago. So that's our main in inverted commas consumption play, but clearly if urban is slowing, as all the FMCG companies are saying, is urban is slowing, perhaps that will also impact Dodla. So the consumption piece, I agree, is tough, because there's no company which only sells specifically to rural, but the tractors and pesticides, fungicides play, cattle feed, animal feed we thought was straightforward, and hence in our portfolios we have Escorts, Kubota and Godrej Agrovet. I stress I'm invested in the same portfolios, and so are my parents.
So, but you know, the other key theme with consumption, what happens is everyone's talking about bite-sized. In fact, they're saying that there is a major push where all of these FMCG companies are saying we are going to sell smaller packs. But that is not what is giving them the bottom line. That's only giving them the top line. Volumes are coming from there, but value is coming only from your larger packs, right? Do you think then the strategy should be where a company has 70% exposure to bite-sized and 30% to, you know, a bigger pack, or vice versa? How should you look at that aspect on a balance sheet?
I think as soon as you see this sort of behavior from FMCG companies, you know they're under the pump. And given where valuations are on the FMCG companies, I think caution is warranted, given, especially since they're being very vocal that they're under the pump, right? So ऐसा नहीं कि वो छुपा रहे हैं. So my suggestion would be just go light on consumption, especially middle class consumption. Load up big time on export oriented companies. IT, pharma are easy ones, but there are other sectors as well. And then coming back to leaving aside rural, which we've discussed, I would say coming back to the financial system, given that this sort of outlook, right, weak middle class consumption, rising NPAs, tight liquidity, I think liquidity will tighten further. It'll help the high quality private sector banks who haven't done anything really in terms of stock price performance over the last 4 years.
Correct.
I think it'll help them shine again. We've already seen microfinance NPAs go through 10%. We've seen unsecured NPAs go through the roof, right? The RBI had to step in. We've seen credit card NPAs go through 5, 6, 7%, and they're climbing. My travels suggest credit card NPAs are going to rise quite sharply across banks. We've also seen in this result season the beginnings of two-wheeler financing mein panga.
Correct.
Right? So I've done this for 20 years, and all the red lights are going off, ding, 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 ding. And that suggests to me that NPAs across the board, across all lending categories, will soon become a pervasive challenge as we go deeper into 2025. In such circumstances, banks who've been beaten down because they were not sexy enough, I think could stage a comeback. So we are big shareholders in HDFC Bank, have been for many years. I admit we haven't made any money over the last 3 years being HDFC Bank shareholders, but the results that they've published this quarter look to be in a different planet to other banks. In a country where other banks are struggling for double-digit deposit growth, they had 16% deposit growth, and their net NPAs are an order of magnitude lower than even the other private sector banks. So when the going gets tough in banking,
it's the quality that comes at play.
So in banking, I would say there will be a reversion to quality. I'll be astonished if there isn't. But leaving aside banking, export-oriented themes and rural-centric themes, that consumption homework exercise you've given me, we'll try our best, but it is bloody hard to find consumption placed.
I think, staying with consumption, I think our colleague Puneet, who's in the audience as well today, has a question because he tracks the auto space pretty closely. Puneet.
Thanks for that. So just one question. You mentioned about consumption slowing down. My question was, why is it slowing down? Because we've seen the free grain scheme to 80 crores Indians, direct benefit transfers, health insurance benefit now via Ayushman Bharat. What is your assessment of slowdown in consumption? And you always write about the women economy where you have plays like Titan in stock performance, but how is that impacted also because of slowdown in consumption? And how would we track consumption coming back as well? Would you see any of the signs that you would suggest in terms of that coming back as well?
So look, let's break consumption up into below 5 lakhs, earners below 5 lakhs and people earning above 5 lakhs. Those earning below 5 lakhs had a really rough time. Demon, COVID, GST, right? The informal economy getting disrupted. They are gradually finding their feet, right? As I was saying, that both in our travels and in corporate results, it's evident that those earning below 5 lakhs are finding their feet. And as is also evident, the election results make it very clear to the political class that if you give money to those earning below 5 lakhs, they will actually reward you politically in elections, right? So that story is recovering, but between 2015-16 to 2022, for 6 years, the below 5 lakh constituency really had a very rough time. I think they're going to rise again over the next 2, 3, 4 years, and we're working very hard to find investments around that theme. 5 lakh ke नीचे कमाने वाले लोग. With regards to those earning above 5 lakhs, I think it's a rough situation because ever since Raghuram Rajan did AQR with the banks in 2015, the entire banking system has focused on lending as much money as possible to the middle class. The middle class is up to their necks in debt. If you leave aside secured loans or unsecured loans as a percentage of income, we're amongst the highest in the world, right? So we've created a very indebted middle class. Job creation for the middle class has become a challenge, courtesy AI, courtesy robotization, mechanization. Jobs for the middle class are proving to be tough, and it's not something government can't sort of suddenly announce jobs for the middle class. That's largely the domain of the private sector. And this combination of the middle class being the main tax piggy bank for the government, slowing job creation and high debt, I think is creating a concerted middle class consumption challenge. ये उतना आराम से जाएगा नहीं. This will take a couple of years. We'll need a rate down cycle. We need a 200 bips cut in rates over 2-3 years to ease the pain on the middle class. Unfortunately, what Trump is doing is jacking up the dollar, which makes it very difficult for the RBI to cut rates aggressively. And that's why I think next couple of years, the consumption story tilts away from class back to mass and below 5 lakhs.
So your assessment of, you said services like IT and pharma will be the next big thing. The government has been doing a lot for the manufacturing to come up in across sectors, and with PLI scheme, do you think that's working on the ground as well? Do you see whatever conversations with corporate India, especially in the EMS space, since it's mobile manufacturing has moved into India, we become an export from an import destination for mobiles. White goods is the next thing. Do you see those companies, because valuations are very high, but do you think that will drive the employment as well and eventually lead to consumption via the PLI schemes across sectors?
Yeah, so look, I mean, you're right. I mean, in mobile phones and in electronics, it's worked, right? And I think listed companies in that space have done very well. They'll continue to do well, is my reckoning. I don't think the government will give up on PLI. They'll try it. I'm not an expert on why it hasn't been as successful in other sectors. It seems to be a raging success in mobile phones, more qualified success in auto, and uske aage there isn't a big success story. Now the challenge here is the job creation needs of the country are colossal, right? So just to put it in context, every year 10 million graduates enter the labor force, and roughly 20 million people enter the labor force, right? Those sorts of gargantuan numbers, right? How do you create 20 million jobs a year, right? Because giving PLIs to mobile phones or medical devices or footwear can't result in that sort of job creation. So the government's PLI scheme has to be lauded. It's an attempt to create jobs. At the July 24 budget, Nirmala ji also announced an internship scheme, where she said, I think BSc 500K companies have to do 5,000 interns per company. It'd be great to hear on 1st February how that internship scheme went. But even there, you can see 5,000 per company across 500 companies. You're still creating a few lakh jobs, not the millions of jobs that 20 million people joining the labor force need. Now, if you sort of do the obvious inference from this, that you simply cannot create jobs on this scale. You have to create an economy where people like us pay taxes, and our taxes are used to give benefits and subsidies and basically universal basic income in another name. I think that realization has dawned on the political class that koi aur solution hai nahi other than to tax people like us and distribute it to poor people. They're trying to do it in a way which doesn't distort the economy. So I think increasingly you'll see benefits or subsidies linked to gender, linked to going to school, linked to going to college, linked to getting your children educated. So they're trying to make it a good dole rather than a laziness wala dole कि घर में बैठ के आप कमाओ. And I think that attempt is also laudable. You're making it a conditional basic income. आपको basic income मिलेगा conditional on ABC rather than saying आपको हम पैसा बरसा रहे हैं आपके ऊपर. But that's the way I think most economies in the world will have to go, giving money to the poor basis the high earnings of the more affluent people.
Right, thanks. So one question I have over here for you is, when you mentioned about export-oriented sectors as well, you have Trump 2.0 which is coming. How do you think India has the potential to then integrate further into the global value chain? Because there is a potential tariff war which is already on. Initially, we were talking between US and China. Now, I don't think so. India probably might be spared, might not be spared, right? Mm-hmm. How do you stride over this kind of a situation now?
So look, I think there are three sectors where I think India will be spared, and those three sectors I think will turn out to be very big. We've discussed one of them already. I think mobile phones clearly will end up being a big sector. Apple is a politically powerful company. Apple is, I think, making $30 billion worth of phones in India. They still make $170 billion in China, and I think that $170 billion, a lot of that will end up coming to India. Beyond Apple, other lesser phone makers will also come to India. So mobile phones is a $400 billion industry. I think iska 100 billion India aana to banta hai.
Okay.
Right? So that's the first area. I doubt Trump is going to suddenly mess that up. This doesn't make any sense. Dusra hai dawai, API, active pharmaceutical ingredients. That's a $200 billion global industry. At the moment, we only make around 20 billion.
Correct.
It's improved courtesy the last 3-4 years, China +1 initiatives by the Western pharma companies. But if Trump imposes tariffs on Chinese API, that will lead to a massive flight towards India. We've made a lot of money on Divi's lab over many years, and we are staying invested in Divi's lab in the hope that Trump does ramp on.
But do we have the capacity ready to supply that kind?
Much as we saw with iPhones, right? 5 years ago, there was nothing to do with iPhones in India. Apple decided strategically, they sent a team to India. I think between Foxconn or in Bharat FIH and the Tatas, they worked together. The Tatas, I think, this morning I read they bought Pegatron as well. So in India, jab zarurat padti hai, things move fatafat, really fast, right? I reckon we could see a similar outcome on API, right? So it'll be very interesting to watch what Trump does on APIs. As a Divi's shareholder, obviously I'm optimistic that हमको पैसे बनाने का chance मिलेगा. We also invested in some suppliers to Divi's. So there's a company called Ami Organics we own, which is a supplier to Divi's. We also have alkyl amines, which is a supplier to Divi's. So ये हो गया दूसरा theme. Mobile phones, active pharmaceutical ingredients. Third category is medical devices. Colossal industry, same size as mobile phones actually, $400 billion industry. There is a PLI scheme here, but I'm not so sure how effective it is. But natural area for India too. I think we only make $2-3 billion worth of this stuff.
Correct.
Right?
And now I think you have Siemens and the likes which are going very big in this segment.
So I think this is an area where, which similar to mobile phones, यहाँ पे बड़ा बन सकता है. And we've invested in a company called Polymedicure in the hope that Polymedicure will supply more and more medical equipment made in NCR, made in Faridabad, into the Western world. Iske aage, beyond these three, right, I struggle to figure out where is our competitive advantage in beyond this three, right? So there's a lot of hope that jute mein hum kuch kar payenge. There's a big footwear park outside Chennai. But given the labor costs in India are much higher, 3x higher than Bangladesh, I would say higher than Vietnam as well. I'm not so sure how competitive we'll be globally in footwear. Similarly, apparel. Can we become a global exporter of apparel? I don't have a grip on, are we really competitive on land prices, labor costs, and cost of capital to be competitive in stuff which is not dimag wala kaam. Dimag wala kaam, our large workforce of graduates comes into play, right? So knowledge intensive, light manufacturing. We are at in our element, and I think we'll end up between these three sectors alone. We'll end up creating $300 billion of GDP.
That's going to be a good number on that front. But with that, you also mentioned a point about you looking at investing some portion in the US markets, European markets. I'm sure everyone over here wants to understand how should one invest in European and US markets from a operational perspective also, and is it, I mean, are there any further regulations to it? Because I think for a student who's looking at investing, right now the avenues are only Indian markets.
Right. So just to quickly figure out why should we invest abroad, right? जाएं क्यों वहाँ जाए तो at a very simple level, America has been the most lucrative market in the world over the last 1 year, 10 years. Over 20 years, we are better than them, but over 10 years, they're better than us. And these are the two big markets in the world. दुनिया का 2/3 पैसा, 65% of world stock market wealth is created in these two massive free market democracies, right? Now, their market, the Western world in general, has three things our country's market doesn't have. Firstly, they have very high-tech manufacturing. So, for example, all of those phones that you're carrying, inside there's a semiconductor inside the chip. On that chip is lithography. Lithography is the etching of circuit design. So there'll be, say, 10 billion circuits etched on an iPhone 16 chip, right? So the iPhone 16s which are being made in Bangalore area, There are 10 billion circuits in that. There's one company and one company only in the world that can etch 10 billion circuits on a wafer the size of a grain of rice, right? It's called ASML. It's a $400 billion market cap company in Eindhoven in Holland. So the first reason to go and invest abroad is very high-tech manufacturing of the sort our country doesn't have. The second reason is technology as a utility, right? The basic technologies which drive our day-to-day life are owned by the Western world. So simple example being, say, Amazon or Microsoft, right? Microsoft alone will be as large as the Indian stock market, and for obvious reason, very few of us can live a day-to-day existence without using Microsoft in some shape or form. And the third reason for investing abroad is deep luxury stocks, ultra luxury stocks, which are primarily from France and Italy, right? So over the last 25 years, the number of dollar millionaires has gone up every year at 7%. And there's a colossal market now for very rich people to buy very expensive things, right? So for example, handbags costing $40,000, $50,000 are sought after by rich women the world over. Only one company makes those. It's called Hermes. It's listed in Paris, right? Now till 3 years ago, it was reasonably tricky for any Indian to invest abroad. Combination of technology and government liberalization, especially Gift City, has made it much easier. So we set up our office in Gift City 2.5 years ago and started investing abroad. We worked with a brokerage called Interactive Brokers. There are several brokers. Any of you can try to open a brokerage account in the Western world. Opening the brokerage account is reasonably straightforward. If you do it yourself, you end up paying slightly higher taxes, right? Long-term capital gains tax is now the same. The July 2024 budget, Nirmala ji harmonized the long-term capital gains tax regime. It's 12.5 both places. Short-term capital gains tax is much higher though. It'll be lower for you guys because you're students. So short-term capital gains tax is at maximum marginal rate. So if your maximum marginal rate is 0, I would say do foreign investing now, rather than when you get to my stage in life where the maximum marginal rate is closer to 40%, right? So for youngsters, open a global brokerage account, right? Several of them, we use Interactive Brokers, but feel free to choose your vendor. And long-term capital gains tax is the same as India. Short-term for youngsters like you will be actually pretty low, right? Now, in our case, because our clients are slightly more grown-up people, we've gone and created a fund structure in Gift City. And from our Gift City fund, we invest into America, Europe, and Canada.
Right. I think we'll be running out of time on the show, but very quickly, let's just take a couple of questions from the audience. The first one.
So I'm Vyomkesh Bhatt. I'm from NMIMS Mumbai. So my question is, in an era of rapid automation and AI, how could the government incentivize industries to reskill their workforce instead of replacing them?
Yeah, I think massive, lovely question here. I think it's a huge task. I can't see how can the government do this. I think the education system in our country will have to be rewired, right? Our education system, and I'm part of it, all of us are, focuses a lot on rote learning. As I think you're already alluding to, AI makes rote learning useless, right? There's no great value in knowing the 16 times cut tables, because soon there'll be an AI chip in my spectacles that will give me 23 times cut tables and 49 times cubby tables, right? So the rote learning wala education, which is what our education system specializes in, is gradually becoming useless courtesy AI. And I think from top to bottom, from kindergarten through to university, I think our education system needs to be revisited. Basically what we have, if you think about it very deeply, challenge is we have a socialist education system in a capitalist economy, right? So the socialist education system simply does not heed free market signals. It keeps churning out students with the same purane zamane ka skill set in an increasingly modern economy, right? Now, should the government be solving that, or should the free market be solving that? As an entrepreneur, I would like to believe that your generation of bright young people will be the free market entrepreneurs who will solve this colossal problem and make a lot of money out of it, right? Because as I think is evident, right, lots of young people are graduating from college, but the reason they're not getting jobs is not because there are no jobs, but because there's a mismatch between their skill set and the job and the skill sets required by employers.
I'm Mihika. I'm an equity research analyst at NDTV itself. My question is more broad-based. In a market where everyone's talking it's overvalued. You just mentioned there's, it may not be a very happy picture for Indian markets in the next few years. For someone who's just become eligible to invest or someone who's just entering the market, where do you find value? Because, while there are stocks out there that have made returns for other people, their time frame was longer. So how do I, put my strategy forward in a way that a better half of my portfolio is not in losses for the next few years?
Right. So I think the simplest way to think about that is think about sectors which have good companies, but sectors which have been out of fashion for several years, right? The whole area around non-urban India, low-income people, agri-related companies, right, has been out of fashion. And within that ecosystem, there are several good companies. We've invested in Escorts Kubota, but there are other agri-related plays which are high-quality companies. For your generation, for analysts like you, the data is widely available, the annual reports are all available. For journalists like you, you have access to the management teams as well. So there is a multitude of good companies in the agro and non-urban ecosystem. Similarly, whilst IT stocks have now run up considerably, in pharma ancillaries, the ecosystem which supplies ancillaries into pharma, there are several good companies who are waiting to be discovered. And finally, the least fashionable sector for many years was private sector banks, right? And as we discussed, some of the private sector banks are coming back into fashion because they're conservative, strong institutions. So the beauty of the stock market is at any point in time, there'll be things which are in fashion, revved up to high heaven, and there'll be things which everybody has given up on. And as we go through the next couple of years, there'll be some of the darlings of yesterday, say the PSU capex plays. A lot of people will give up on them, but they will take to new darlings. The new darlings will come from, I suspect, the strata of India's economy, which caters to non-urban, rural, and people earning below 5 lakhs.
So do you feel like themes like railways and renewables that had quite of a dream run in the last 2 years would see a slowdown? They've seen correction already. Do you see that will continue, or could we see an uptick?
So as I said, anything around government capex, right? I'm not so sure where the money will come from, right? Given that the government wants to consolidate fiscally, which I think is the right thing to do, if you want to consolidate fiscally, you don't have that much money. So where will you find the money to spend on railways? Renewables slightly different. Renewable private sector companies are doing spending. So if the private sector keeps at it and the government gives tax incentives to the private sector to do the renewable piece, it'll be. I think that will sustain. We need to see how, given that Trump has no interest in participating in these global climate accords, if he completely says ye sab bakwas hai and forget global climate accord and we keep getting hotter year after hotter year after hotter year, we'll have to see how our corporates deal with it. Because remember, the promoters in India who are investing in renewables, are doing so with a view to make money. They're not doing charity here. And if the world's richest economy says we have no interest in renewables, the business case gets a little tougher.
So there are going to be challenges coming in for that space, probably on global uncertainties as well. Thank you, Mika. In fact, thank you everyone for joining us as a part of the audience. Thank you, Saurabh, because this was absolutely an interesting conversation for the millennials, for the Gen Zs, I would say, which now we are moving to, I think, alpha and beta very soon. But an absolute interesting conversation with regards to what investors should be doing with regards to budget 2025. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
STT definitely needs to change.
Old tax regime.
1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
2 more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure, because of the iconic 1991 budget speech.
STT definitely needs to change, because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax, because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022, where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
This is the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well for the policymakers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget as well as has been in each one going into the same. We look at some of the key moves that have seen in the Nifty before as well as after the budget, and get you some of the biggest measures that were announced in these budgets and what could have led to the strong Nifty reactions. Let's first look at 2024, because we had two budgets announced in this particular year. One was post the elections as well, and we did see a 1.5% move.
Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Today, we're talking about a company which has moved from strength to strength over the last 1 year. Hitachi Energy India. The code name on BSE is Power India. Now, this used to be a part of ABB India back then, and well, we've seen the company will eventually become a JV with Hitachi back then. So it was ABB Power Products and Systems. And in 2020, Hitachi and ABB Power Grids business formed a JV. And that's when we got this particular business. On December 22, ABB divested its balance in this particular JV. And since then, we only had Hitachi. And well, since then, it's also called Hitachi Energy, fully transitioned into Hitachi Limited. Now, and which is why at the moment, this is Hitachi India. What does this company do? Well, composed of 4 business units. The first one is grid automation. That's also followed by grid integration. Well, I'd reckon that to a certain extent, smart metering also forms a part of this. High voltage products and transformers are the other two aspects of this. And as we know, the transformers in this sector has picked up substantially over the last few quarters. In terms of its key clients, it does serve the utility space particularly, and as I was talking about smart metering, but besides that, industries, transportation, data centers and infrastructure sectors as well. That's where the gamut lies with respect to where the clientele comes from for Hitachi India. But on that note, let me talk about once again the factors that have determined how Hitachi India has moved. So as usual, we talk about the fundamentals of the company. We talk about how the company has done over the past few years in terms of your revenue and profitability, growth, what sort of an order book it has, because it'll give you a better visibility with respect to the order book coming in. Then, of course, we have the balance sheet. Let's not forget the cash flows, of course, are important. And all these will form an important part of your income statement. Financial statements. But moving beyond just that, we also talk about the shareholding, street credentials, which will mean how the company is done in terms of its price action, the current valuation picture, and the street coverage as well. And joining me at this point in time is my colleague Anushi, who's also going to give us a lot more in terms of insight as far as this particular company is concerned. Anushi, welcome and thanks for joining in. Let's start by talking about how things have panned out for the company's revenues and profitability. I reckon that the quarter gone by has been a strong one, which is why I believe that's also locked in upper circuit right now. But the last 9 months have also been strong. What can you tell us about all these aspects?
So Agam, let's see how the company has been doing since FY22, and then we'll take the Q3 and the 9-month picture into consideration. So looking at FY22, 23 and 24, so if you are seeing the figures over here, in 23 we did see a dip in sort of where the revenue growth is concerned, but then FY24 we had a double-digit growth coming back for the business. So on the revenue front, it has been going strong. Even if you look at the Q3 numbers, 27% of a revenue growth is what we are looking at, and even 9 months, this is also 27% of growth is what we are seeing. This is with a revenue of 4,501 crore at the end of 9 months of this financial year, as compared to if you look at FY24, that figure stood at the total revenue for FY24 was 5,237. So comparing FY24 to, and just now that 1 quarter is remaining, we are looking at a significant amount of revenue growth in terms of where that is concerned. EBITDA margins have remained majorly in the 6 to 7% of range, with the EBITDA seeing a little bit of dip in FY23, and 24 it picked up again. Net profit, we've seen significant growth from 23 level onwards. Now, if we take yesterday's numbers in consideration, the company came out with its numbers yesterday. So here we are looking at EBITDA was up around 146%, margin stood at about 10% versus 5.3%, and net profit at 137 crore as compared to 23 crore. In the 9-month performance, we are looking at margin expansion to 7.94% in comparison with 4.7%, and net profit seeing about a 299% of a jump. So this is in terms of the operational metrics. In terms of where the income statement is concerned, we are looking at this sort of growth.
Okay, so that's as far as your income statement is concerned. I'll talk to you about the order book, and the order book does seem to be very, very strong at the moment. At present, the total order book stands at around 19,000 crores. It has won orders worth nearly 11,500 and in fact 11,600 crores for the quarter gone by, in the third quarter. However, we must remember that this is on account of one very large order, and this is for the Khavda-Nagpur HVDC order. If you leave that on the side, it's still a relatively large order inflow. And given the fact that we have 19,000 crores in terms of your revenue, on an average, the company is slated to do around 5,500 to 6,000 crores. And I'm making an assumption here. It does look like it has a visibility of another 2.5, 3 years, and this is just based on the current order book. We must also remember that the fourth quarter is the quarter in which you tend to have a higher amount of awarding activity. So it's going to be a wait and watch in terms of what kind of orders does the company get. And where does this overall order book stand at towards the end of this financial year, and that will give us a much better idea in terms of visibility. That said, when it comes to your current order book at around 19,000 crores, it's certainly a very, very healthy one, and it does give you a good amount of visibility over the course of the next few years, which is possibly why we're looking at the valuations at which it is currently trading at. But we'll come to valuations in some time. Let's talk about the balance sheet as well. Anushi, what can you tell us here?
Right. Before we go to balance sheet, I just want to make a quick mention in the order book that you've mentioned. This surge that we are seeing in the order book is because of the HVDC orders.
Yeah.
And the company is very focused on increasing the shares of these HVDC orders that are there. In fact, they're bidding for higher projects as well. So that is something we can keep a track of, and how this higher order books in terms of execution, what this could mean for the business going ahead. But where balance sheet is concerned, we are looking at a net worth of about 1,360 crore. This in terms of where the short-term debt is about 150 crore and with a cash balance of 128 crore. So it's a healthy balance sheet figure that we are looking at if you take the debt and the cash account in consideration. So even the financial metrics over here for the balance sheet looks healthy. But cash flows also, I think it's a similar picture that we are building on, right?
Right, absolutely. It is, good cash flows from operations are pretty steady. So if you look at FY23 and FY24, again, 352 crores from FY23, that's cash flows from operations, and 250 crores from, FY23. Maybe in terms of the net cash flows, you've seen actually an outflow in FY24 to the tune of nearly 199 odd crores. But given the fact that you have a positive stance coming in from CFO, that's cash flows from operations, it's going to be pretty steady, which is why we're giving it a thumbs up here as well. I'm going to shift focus to the shareholding as well at the moment before I toss it over to Anushi for the street credentials. In general, if you consider how things are panning out for the company, since of course it's since ABB products have moved out, we have Hitachi India which holds about 75% in the company. That has remained steady. There has been no change. What we have seen over the last few months, that is the first 9 months of this financial year, is that your FII holding has increased by nearly 1%. Consider the way things are panning out for FIIs and DIIs. These are positive moves as well, which is why we're going to give it a thumbs up. Besides the fact that the promoters hold 75% in the company. So that's certainly a positive as well. And Anushi, I reckon that it's done very well as well in terms of price action.
Absolutely. If you see the last 2 years price performance, it's gone up around 4x. So a multi-bagger for all the investors out there who were looking to invest in the stock 2 to 3 years ago. If you look at a 1 year chart and also 1 year performance, in fact, we are looking at gains of around 100% plus. So in terms of where the street credit is concerned, in the last 6 months, however, we've seen about a 3% of a growth. But let's see that even if it's peers, if we take those in consideration also, they have done more or less similarly to what Hitachi Energy is doing. But over the long term, it's been a multi-bagger for the investors out there in terms of where the street performance is concerned.
Okay, so a very good performance out there. I'll talk to you about the valuations. And valuations look rich. There is no doubt about that. So Hitachi Energy currently, I'm going and I'm making an assumption that it will make about 400 crores in terms of its bottom line. Do remember, in the first 9 months, the company has already made 200 crores in its bottom line, which is why, 400 crores may be a tad bit on the higher side is in terms of the expectations. But even if you consider, 400 crores on the bottom line and its market capitalization currently standing at around 51,000 crores, that comes to your price to earnings ratio for the ongoing financial year at around, 127 times. It looks expensive. There's no doubt about that. What if the company doubles its revenues in FY26? Under those circumstances, its price to earnings ratio comes down to around 65 times, which is still on the higher end, especially if you consider the price to earnings at which ABB, CG Power and Siemens are going at. Sure, CG Power is also currently at around 94 times. And, if you compare it to Hitachi Energy, again, it's comparable. CG Power is at a discount as compared to Hitachi Energy. But we must also keep in mind the kind of growth that all these companies are seeing. So it's like it's about a double-digit growth for ABB and Siemens. CG Power will depend on the kind of year it has and how it converts a lot of its opportunities. But Hitachi Energy, it does look like it's going to look at around 25% growth in terms of your top line, and that will have a consequential impact on your bottom line as well. That's as far as your growth is concerned. Now, so the question comes down to, what does it mean for ABB as well as Siemens India? The other aspect that we need to remember is that ABB follows the calendar year as the financial year, and Siemens India follows the October to September period as the financial year. So, that's where we're also, we have different periods, slightly different periods when we're considering the price to earnings ratio at the moment. However, if you forget all of this and just keep in mind as to how your current valuations are stacking up at the moment, what we are noticing and what we are seeing is that Hitachi India is at the moment more expensive as compared to its other peers. But there is a reason behind it, and a faster profitability growth is the reason why it's been ascribed such a high price to earnings ratio. That's as far as valuations are concerned. But Anushi, what can you tell us about street coverage then?
In terms of street coverage, we don't have a lot of analysts tracking this company. We have around 4 analysts who have a buy call on this one, while 1 have a hold and a sell call respectively. So the upside potential building up for this is around 27%. But that is as far as where the street coverage goes. But I do also want to talk about the outlook that the business has given. So in the last quarter, if we go back and check what it announced 2,000 crore of a capex, which was for the next 4 to 5 years. And this was across their various segments, which is that's transmission, distribution, data centers and railways as well. And the investments would be utilized for green hydrogen and power transmission business. Guidance, now if you look at that, the standout point of this result was also its expansion in the margins that we are looking at. So this is in line with their target of achieving the double-digit margins picture that we are holding. Along with that, we also spoke about the order book, wherein we are looking at more than 100% of a jump in terms of where the order inflows are concerned. So with the company bidding on these several HVDC projects and expecting at least one of these to finalize, we should see how the execution of these could come into picture, what is the timeline for that, and what this growth could bring for the company going forward.
Okay, so there you have it. So if you consider all these factors, it does look like Hitachi India has done well. It's slated to do even better based on the kind of visibility of its order book right now and the kind of quality of orders that it's making. But where does that leave us in terms of the total rating, in terms of all the things that we have discussed so far? So if we were talking about the income statement, the balance sheet, the cash flow statement, the order book, they were all thumbs up. Shareholding, again, and along with street credentials in terms of how the price action has panned out, it's a thumbs up again. In fact, again, locked in an upper circuit after moving below the mark of 9,000 rupees a share, moving back above the mark of 12,000 rupees a share. Valuations, they do look expensive at the moment. But as Anushi was mentioning, they're also weighing and going in for a relatively larger number of orders, the kind of orders that they've already had in the quarter gone by, and which is why the street is probably, that's the reason why the street is ascribing that valuation. The street coverage, of course, is the other one. And based on all these factors, what we have come up is around 6.5 out of 8. For a thumbs up, you get a mark of 1. For a neutral, you get a mark of half, and nothing for a thumbs down. So overall, certainly in a very good space as far as Hitachi India is concerned. But let's take this conversation forward, where we spoke to the management of the company as well. And we spoke about the quarter gone by, the visibility going ahead. And we caught up with Mr. N. Venu, who is the MD and CEO of India and South Asia of Hitachi Energy. And this is what he had to say. Listen.
So this quarter three for us has been a very strong, solid performance in all key metrics. And our orders have grown in this quarter almost 800% year on year, driven by HVDC order, which we have booked in this quarter. Our revenues were higher, almost 31% in year on year, and our EBITDA margin expanded 380 basis points in this quarter. And in addition to that, our other growth levers, exports have also performed very well, and then service has also performed extremely well in that. So all of them have combined together in addition to our execution and operational excellence have added, our margin and improvements in that. We have also have very robust order backlog, almost close to 19,000 crores order backlog, which has got a visibility of quite a long, quarters of revenue going forward in that. But even if we leave our large HVDC order, our base order also has a solid growth in that. So all of what we have been saying is that, we have been investing in India, we are manufacturing, localizing it. That way we are creating a very competitive portfolio. And with that, we are able to win the orders and create the order backlog. And from order backlog, the revenue growth is happening in that. So we expect going forward also, we grow in line with the market or above the market, and we continue to expand the revenue growth.
All right, sir. So at the moment, your order backlog being around 19,000 crores, what sort of an order visibility, what sort of a business visibility does this give you? Over what span in time? How much of this is executed over FY26? And what about the balance? What are the timelines that you're working with?
Yeah. So, we don't give that, how much of the order backlog will go into the each, quarter-wise or financial year-wise. All we can say is that, when you have a strong order backlog, and that will give you, growth in the revenue going forward. And that's exactly what happened. Even if you look at our 9 months of this year, so we have our revenue is around 4,500 crores, which is we have grown almost close to 25-26% on a 9-month basis in that. We believe that this kind of growth is sustainable going forward. A few percentage this way, that way, but that's how we are looking at it. All in all, what we say, we have invested here, we are continuing to invest, and we want to grow in line with the market or above the market, and not only in India but also in other parts of the world where we sell our products.
So, and how is your overall business split between grid automation, grid integration, high voltage products, and transformers?
Yeah. So we have not been giving that, but all I can tell you is that our transformer is one of the biggest portfolio, and followed by grid integration and high voltage, and then grid automation. So
and so is this mix likely to change in the upcoming quarters and years, or do you think that it will more or less be this way?
It more or less will be there. Maybe at some point in time, with a lot of HVDC revenues come in, then grid integration business might almost come in the same level or slightly above level. But that's how it's almost in the same level, because if you look at the energy transition tailwind, you need all our portfolio. You need our transformer portfolio. You need our high voltage portfolio, automation, HVDC. So the growth is also what we have seen, across all our businesses.
Right. So in that case, considering you have such a robust order book at the moment, what can you tell us about your requirement of working capital, also in terms of expansion? Do you think that you guys will be needing more funds? Under those circumstances, will you eventually look to raise funds through debt or equity, or are at the moment internal accruals good enough for you to go?
So as you know, this quarter we have also, including advances we have received from the large order, and also a very high focus on our cash. So we become, as of 31st of December, we are a debt-free company. But having said that, we are looking for expansions. In October last year, we announced expansion of our facilities worth around 2,000 crores. And then we have also announced on 18th of January, our board has approved to raise the capital, and which is basically the enabling resolution and which gives the flexibility for us, to quickly raise the capital as and when it is required for our growth opportunities.
Okay. So, and in terms of the latest orders, I believe in Q3 you clocked an order inflow of well over 11,000 crores, if I'm not mistaken. And please correct me if I'm wrong there. Where are these orders coming from? What areas are these orders coming from?
So the 11,594 crores what we have received orders in the quarter that includes an HVDC project which also includes our data center orders and the renewable orders and also the export and the service orders. So this is how has been the thing. And we have from the segment standpoint, it's the utilities, industries, data centers, renewables have clocked very high double-digit growth. And we have a bit of slowdown in this quarter from the rail segment. Otherwise, barring that, the rest of all the segments have really given a huge amount of growth in this quarter.
Sure. So I also want an understanding on the current capital expenditure environment. What is CapEx looking like? Of course, we have the upcoming union budget where we're expecting the government to also make a little bit of an outlay here with respect to capital expenditure, maybe spur it a little bit further. Your expectations from the government and what can ideally work and play out in favor of your sector?
Yeah. So my expectation on the budget, if you're talking about, is basically, we expect that the government to continue to focus on investing on the infrastructure, which is very, very crucial on that. So rather they should further increase the outlay for the infrastructure spend. So then the second wish from my side is that, the energy transition tailwind is a huge and it's a big opportunity for India to really position well in terms of the technology. And we are extremely doing very well in adoption of the renewable, etc. But we expect that the government to provide some kind of production-linked incentives for a critical equipment like, semiconductors which are required for the energy sector, like HVDC equipment which is required for this energy sector, and also many other critical elements which are required. So that will really fuel huge amount of manufacturing ecosystem in India.
So there is this aspect of one-time large order for the HVDC. I reckon that to a certain extent that has pushed up your order inflows and your order backlog. So my question then is, in terms of expectation, in terms of order inflows, what sort of a number can we expect ballpark over the next few quarters? Of course, we also must consider the fact that we are going into the fourth quarter, which is seasonally a quarter in which a sector like yours sees the largest amount of inflows in orders. So can you give us an idea about what the next 2 or 3 quarters could look like based on your conversations with clients?
Well, what I can tell you, yes, this quarter has been largely driven by a large HVDC order, and this HVDC order will not repeat in every quarter. That's also a thing. But as I said, if you take out this large HVDC order, our base order growth is also very robust in this quarter. So all I can say and confirm that, on quarter, our order inflows growth will be there. Depending upon the market situation, at least a high single digit to high double digit is what we are looking at.
All right, that's the management of Hitachi India telling us about what's in store for the upcoming years. But on that note, we are out of time on this edition of KYC. Lots more lined up on the other side. Stay tuned in.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs? And what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
STT. STT definitely needs to change.
Old tax regime.
1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well for the policymakers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget as well as has been in each one going into the same. We look at some of the key moves that has seen in the Nifty before as well as after the budget, and get you some of the biggest measures that were announced in these budgets and what could have led to the strong Nifty reactions. Let's first look at 2024 because we had two budgets announced in this particular year. One was post the elections as well, and we did see a 1.5% move in just a week after, and that momentum was continued in the month as well. Leading into this budget, there were a lot of speculation, so we saw a downward reaction of the Nifty in the past week, and we did see some of the measures such as the standard deduction being increased to 75,000 for salaried employees from 50,000 earlier, as well as the new tax regime now in having tax-free status for up to 3 lakh rupees per annum for the investors as well. Apart from that, we saw custom duty reductions on mobile phones, gold as well as chargers as well. And these were some of the key moves in this particular budget. Leading up to the election, we had, the 2024 budget in February as well. Let's see some of the reactions as you can see in this particular time frame as well. One of the key moves was increasing the budget for capital expenditure.
Hi, you're watching Your Money Matters on NDTV Profit. This show gets you actionable insight on everything personal finance related. And we've been speaking about mutual funds in all of the episodes this week. And the reason is that you've probably seen significant drawdowns in your portfolios over the course of the last few weeks when you've seen frenetic selling in the equity markets here in India. Now, a lot of the strategies that worked incredibly well in 2024 and perhaps even leading up to 2024, I'm talking about the year before that, are not doing so well as of 2025. In fact, they started doing a little badly towards the end of 2024 itself. Here I'm talking about a few momentum strategies. I'm talking about small cap mutual funds, which have seen significant drawdowns over the course of the last month and a half. What should you bear in mind if you've gone a little too aggressive on some of these strategies that worked very well? We'll talk about that, and we'll talk about what your strategy should be over the long term so that you can actually make the most of these corrections. Joining me to talk about this at the start is Prableen Bajpai, the founder of FinFix. Prableen, always a pleasure speaking with you. Thank you so much for joining me. Let me start with the conversation on momentum, because really it was the buzzword. There were a lot of schemes that were launched using this strategy. It did work, but anything that goes up very sharply also tends to go down very sharply, right?
Absolutely, Alex. And I think in the last 4-5 months, almost all strategies across categories, we've seen that there has been a huge correction. So yes, absolutely, it's gone up. And there is, since September of 2024, most of the momentum indices are down 20% plus as compared to Nifty, which is around 12%. And that is the basic premise on which it is built, actually, Alex. I mean, these are aggressive strategies. They work on the principle of buy high and sell higher. And so you are chasing the price momentum. And in any kind of a sharp downturn or a correction like we've seen, this is bound to happen. And it's not that it's the first time it's happened. That has been the trend if you look at the past drawdowns in the data over the last 15 years as well for these indices.
For those people that are curious about how this works, and even for those people, Prableen, that jumped in just because they saw the past returns and said this is great, let's explain to them how it works, how these indices are constructed, how this factor works. Essentially, it's identifying stocks from a basket, a wider basket, and those that are doing particularly well, the assumption is momentum will carry them even higher, right?
Yes, absolutely. So it works on that premise that there is a investor sentiment, and price is truly reflected by the investor sentiment, Alex. And that is why it believes that whatever is going up, there are price inefficiencies which happen. There is always a time lag by which information actually reaches the investors, and they tend to buy stocks even after the price has gone up significantly. So it is a very different style of investing, and of course it carries high risk. But absolutely, I think it has worked in the past. There are phases when it does exceptionally well, it beats the broader market indices. But with this kind of a strategy, because momentum is the factor on which it is these indices are created, we have to be prepared for the sharp downturns as well. And the factor, the momentum which is used here, is based on the 6-month and the 12-year price movement of these stocks. For example, in the December, the half yearly, the kind of the rebalancing which is there in the index. For example, Tata Motors has been dropped out because it saw a huge dip. So, a new stock has been added. So if we look at the Nifty 230 momentum index, that means that the investment universe is the top 100 large cap, and then the next, that means the top 100 mid cap stocks. And from those, based on this factor of momentum, that index is created. And we have two others. One is the mid cap 150 index, from where again 50 stock portfolio is created. And then we also have the Nifty 500, from where again a 50 stock portfolio is created. So these are interesting strategies, Alex. In the past, we've seen that they've given phenomenal returns. They've always fallen more than the Nifty 50, or the parent index, for example, the Nifty 200, the Nifty 500, or the mid-cap 150 in these cases. And the recovery period has been, differing depending on the phase when it fell. Currently, we are in the period where this is the 5th largest fall for these indices. And it's an ongoing fall, and which has been there for the last, almost 100 days plus. And during this time period, we've seen less than, almost half of a fall by Nifty 50. Yeah. So
before we get into some of the strategies that you can use and how different strategies yield different results, Prableen, very quickly, can you explain why there is this behavior of the momentum index where in a broad-based selling or broad-based downturn, this index or this strategy falls even further?
Yeah. So because Alex, we are only focusing on the price, and price keeps going up, and more and more investors. For example, there was a time when everybody was chasing defense stocks. So, then your friend tells you, oh, you don't have a defense stock in your portfolio, go and buy it. You want to buy a defense fund. We also saw a lot of AMCs actually launch the defense fund. Likewise, whichever segment starts to do well, the information starts to spread, and there are individual investors, there are AMCs which starts to launch. So there is a further push given to the price of those stocks. But when there is a correction, suddenly everybody starts to look at fundamentals, everybody starts to look at the fair price. And then there is a realization that, okay, maybe, you've overpaid for the stock. So the fall is sharper because the extent to which it had risen was much more than probably where it should have been. And it works well, Alex, because 6 months later, if we're just looking at the index, there are corrections and the rebalancing happens. There's a 5% capping on these indices where, they would sell that stock if it's exceeding that 5%. But because you're somewhere paying a little more than what it should be, what it is worth, as compared to in a market cap based index, the falls are harder. Yeah. And momentum works both ways. So people think that whatever is continuously going to go up will continue to do so, and whatever is going down will continue to do so. So it actually works both ways, but the falls are sharper because the focus is the price.
Okay, so we have to talk about small caps, so therefore this will need to be a little quicker. The SIP returns versus lump sum returns, you've shared some very interesting data. You want to take us through that?
Yeah, I'll just quickly cover it for momentum once, Alex, because I think for those who have already entered the momentum strategy, for example, if we are looking at a 5-year SIP return for, let me pick Nifty 500 Momentum 50 Index, for example, in the 5-year SIP returns have been 24%. But during this time period, Alex, there has been a correction of 32%. There was a phase when the SIPs were actually down by 32%, which is from September of around 21 till June 22. And in the last 1 year, the 1-year SIP returns are actually negative 22%. So the point I'm trying to make here is that these are volatile strategies, so it'll work. You have to have that 5-year plus horizon if you're looking at a momentum strategy in your portfolio. And similar sort of a data is replicated even if you're looking at annualized returns for a lump sum, which was done in 5 years. So that should be a minimum investment period, and you have to be prepared for a 25-30% kind of a fall when we are talking about momentum strategies. And something similar even in the case of small caps.
That's
actually,
exactly.
Alex,
exactly what we were getting to. So you've actually captured the drawdowns since 2016, and this is very interesting data because the tendency is to focus on the very recent past and look at the pain in the portfolio, and obviously that is more apparent right now, but this is something that has happened probably in the past.
Absolutely. So because we are looking at the Nifty 250 small cap index, Alex, and it was only launched in 2016. So of course, we saw that 18 and 19 were very weak for the small caps and mid caps. And so overall, there was a 60% correction. If you're looking at it was almost a time correction since January of 2018 till March of 2020, which also includes COVID. And this, it was almost a 2-year period when small caps, the index didn't really deliver any returns, and it was negative 60%. And again, the second largest fall was about 26%, which happened from January of 22 till June of 22. So even during the recent time periods when investors have invested, there have been corrections. Currently, we are down by about 18+%. And this is an ongoing correction that we are seeing. So it has happened in the past, Alex. And I think the basic rule here, which can help investors survive in momentum strategies or small caps, is that you have a longish time horizon. And I think that's very well proven by how SIPs work. So if somebody invested in January of 18, his 1-year SIP returns would have been negative 27%. 18 till 2020. So 2 years later, the returns would have been negative, almost close to negative 2%. And after 3 years, it would have been positive 13%. And these are the times when investors want to give up and go back to an FD or go back to something which is safer, for example. But 7 years later, today, the same SIP would have given about, and we are still, this is after correction, Alex. We are sitting in January 25, where we've already seen a decent correction. The returns would have still been 22%. So if you're entering the small caps, you have to have a longish time horizon.
And do not
be prepared.
stop. Do not stop
Yes.
the SIPs, because the unit averaging when the market falls is actually tremendously beneficial over the long term. Let's talk about some data in the latest drop, which is December to now, effectively. You've had quite interesting data, right? Because the category average of fall for actively managed schemes, as you've pointed out, is 16.5%. It's quite sharp, right?
It's quite sharp. And 14 of the schemes have actually fallen lesser than the category average, 6 around, and 9 have fallen more. So the highest fall is around 20%, Alex, in this 1 month plus period, with many of them correcting at 18, 19% more as well than the category average. And the lowest fall has been around 12%. So honestly, not many of the actively managed funds have been able to contain fall. It's this period from December till January, December 11th. Till 28th of January, it has been very, very harsh for the small caps. But if we're just widening our time period a little and we look at, let's say since September, because that was the high for the Nifty 250 small cap index, then also there has been a decent correction since then. But the schemes, would vary a bit, which have been able to contain the fall.
Okay, so there are schemes that have lost a lot of money, but I want to focus on the ones that have actually managed to protect money, right? Because you still had a fall of about 12.4%, but that's less than the index. So therefore, what has worked in this case?
So broadly, if we look at these different time periods, Alex, and if we look at the schemes which have been able to protect the downside, I think 2-3 factors have worked. Number one is that they've had some bit of cash with them. That has been one thing. Second is some large cap allocation and mid cap allocations worked for them. And of course, within small caps, what are you holding? That is the main thing, that, what kind of stocks have you held within your small cap portfolio? Because you have to minimum, the mandate is 65% in small caps has to be there in all times. So within that, what is your composition? And beyond, I think how much large caps, mid caps and cash, that has actually made the difference for most of these schemes.
Because, so it's really interesting because in an upcycle, when you have an underperformance of most actively managed schemes in the small cap category versus the benchmark, but some of these very schemes may not have given you that kind of an advance, but they're protecting your money ultimately when the market is falling and equilibrium point is received. I think this is true, Prableen, for everything in life, right? When the tide goes out, the tide comes in, right? Eventually, there is a balance that is sought and found. And I guess you have to utilize both wherever possible. Prableen, thanks so much for joining in and for giving us a perspective that you did. Very interesting data. And I think for me, the big takeaways are continue your long-term investments and keep a slightly longer horizon. Of course, everything that happens that is bad has actually occurred in the past and you've gone past that. Thanks so much for joining in.
Thanks so much, Alex.
It's now time for our special segment on Thursdays. I call it Travel Thursday. This is something that emerged in the pandemic, where I was hoping to help you dream a little about the places that you could go to once the lockdowns ended, and then it just continued. And today, I'd like to talk to somebody who wants to tell you about a place in Europe, and this is very interesting. I'm joined today by Preeti Partharthi, who is globetrotter, travel expert, content creator, founder of Peppy Travel Girl. Preeti, thanks so much for joining me today. And you've selected Canary Islands. What can you tell me about it and why you selected it?
Hi, Alex. Thanks so much for having me. It's really nice to be talking about this with you. So the Canary Islands are pretty special for me. I feel like a lot of my trips have been to Europe in the past, but honestly, when I think about the Canary Islands, there's really nothing like it. It is one of the most unbelievable landscapes, and you can't even believe that you're actually in a continent like Europe when you're over there. So that's why I wanted to talk about it, because it's not as visited as, other places in Europe, but I feel like it really should be on people's bucket lists.
Okay, where is it situated for those that don't know and can't pull out the map quickly enough? And how do you get there?
So the islands are off the coast of Spain. They technically belong to Spain, but if you look at a map, they're actually closer to Morocco, which is actually pretty interesting. But it's pretty easy to get over there. Flights directly to Spain. The easiest way to get there would be through Madrid, but also direct flights do fly in from Germany, to Lanzarote and Gran Canaria. So it's just about an hour and a half from major cities in Europe, and flights are actually pretty cheap. It's not more than 2,000 rupees one way. So it's
2,000
pretty easy to
rupees?
get to. One way, yeah.
Wow. Okay, so that sounds incredible already. Is it a very large place?
So there are 7 islands. There's Tenerife, Fuerteventura, Gran Canaria, Lanzarote, La Palma, La Gomera, and El Hierro. I've been to Lanzarote and Gran Canaria, and these are not really big in that sense. Like each island is pretty small and it takes about 3-4 days to cover each of them. But they are pretty spread out. So if you want to cover all of the Canary Islands, that would take time. But a good way to incorporate it in maybe a Europe trip or your trip to Spain is to maybe, dedicate maybe 4 to 5 days in general to the islands that you want to visit.
Is that where the song is from, the Tenerife Sea? I'm not sure. But anyway, so the point is, and you've rattled those off. You clearly know your stuff. So you've told me how to get there. You've told me how much it costs. It's not very expensive to get there from the mainland. And so that's not your primary expense. Is it expensive to stay there?
Honestly, I feel like if you're traveling to Europe, then you already have that cost in your budget because Europe is an expensive continent. Spain is an expensive country. But surprisingly, the Canary Islands are slightly cheaper. So if I had to think about food, you're actually spending maybe 30 euros a meal compared to 50 euros in Spain, like mainland Spain. And when it comes to accommodation and stuff, again, there's like categories all across. We have really cheap hostels that are really expensive, all-inclusive resorts, and then there are apartments in between for maybe 30, 40 euros a night. So honestly, it can be a pretty easy on your wallet trip with a fantastic experience. So the ROI over there is actually really great.
Okay, so if you are, and as I understand it, you call yourself if I'm not mistaken, the medium budget bestie, is that right? And so explain that to me. You're saying that you can give advice to people who are looking for the best of both worlds, is that right?
That is right, yes.
Okay,
I understand that. Yeah, I understand that when people are traveling, they want to spend as less as possible but have the best experience. And that's also kind of why I picked the Canary Islands, because going there is definitely going to blow your mind.
Okay, so from the accommodation standpoint then, in order to get that, what is the best advice here? Would you say staying in an apartment is better, or are there great options when you're looking for hotels?
I think if you're traveling with friends or, as a couple, then I feel like an apartment would be a really good idea. But if you're traveling as a family with kids, and the Canary Islands are very family friendly, then an all-inclusive resort is actually a pretty decent deal because there's something happening all day long with minimal effort on your part. So there's something for everybody. And yeah, I feel like these are the best options.
Okay, so a couple of questions in terms of when you should go, right? So what's the best place to visit these islands, and how much time should you be willing to spend?
So the Canary Islands are actually a year-round destination. Like there's sunshine throughout. And if you really want to avoid the boiling hot months, then skip summer. I would suggest maybe spring or autumn, which is when it's cool, but it's also warm during the day. The temperatures are great to take a dip in the waters. So I recommend spring or autumn to go. Otherwise, it's actually a year-round destination. You really don't have to worry about when you're getting leave or when peak season hits, because it's actually a really good time all year round.
And how long does it take? Not really to see everything. Obviously, you can't. But I'm saying, how long should you be willing to spend to really do it justice?
I think each island would need at least 3-4 days for one to be able to comfortably see all of it. And while I understand it may not be possible to fit all 7 islands in one trip, I would recommend picking at least 2.
And which would those be?
All of them are different.
Which would those be?
I did Lanzarote and Gran Canaria, and both were extremely different in terms of what they had to offer. So I would highly recommend both. There's also Fuerteventura for people who are into kite surfing or water sports. So if time permits, then maybe add that as well.
What are the must-do activities in those places that you mentioned?
So what sets the Canary Islands apart is that they're all the result of volcanic eruptions that happened millions of years ago. So the entire island is made of volcanic rock and soil. And that is how the ecosystem over there is also built. So when I talk about Lanzarote, it is the landscapes that really, really blow my mind, because you see mountains and volcanoes all across and everything is volcanic. You can go into a volcanic tube and experience the magma drips just like still in time. You can see the result of shell volcanoes empty, like those who are completely exhausted. It's just very, very different in terms of landscapes. There's a green lake that a sunken volcano has kind of birthed. There's a very pink salt lake. So it's actually really different in terms of landscape, and every day will show you something different. So in Lanzarote, that's what really stands out. And in Gran Canaria, there are some amazing hiking trails with some very interesting Aboriginal history about their rituals. So that is something like for nature lovers, I would actually recommend, with a little bit of culture thrown in. And the Canary Islands are actually really famous for wine. So in Lanzarote, if you've seen, I don't know if you've seen pictures, but these landscapes where the volcanic soil is just completely black, and then there are these holes that are made with little rock walls around them. That's where the grapevines are planted. So these are wines that are actually made in volcanic soil, and those walls protect them from the winds coming in from the Azores, and they produce amazing Malvasian wine. So like these are things that really stand out in these two islands for me. And yeah, I think that's what I would absolutely recommend to someone.
Okay, so and you've painted a beautiful picture. I want to talk about budget though, and obviously you need the Schengen visa, right?
Yes.
So because you're going to Europe, but so you're talking about €30 per meal per person, and doing quick conversion, it's about 2,700 rupees. And I know that there's a tendency to convert everything when you go there, but how much should you be willing to spend?
I think if I have to include flights from India plus internal transfers, like, to the Canary Islands and back, plus accommodation, meals, activities, and I'm assuming one would want to pick up, trinkets and souvenirs, I think it could easily be roughly 1.5 to 2 lakhs, something per person, for maybe a 7-day trip to the Canaries. Yeah.
Okay. So when you go to Europe, of course, the desire is to see a lot more than just one place. And obviously, you're going to land in Spain, and so you might want to add a couple of locations to what you're doing, right? So if you're saying 7 days in the Canary Islands, and if you're saying that you hit Madrid first, would you suggest a few more places that you can visit in Spain?
Absolutely. I think Madrid is one of my favorite cities in Spain. So definitely a few days over there. Barcelona has some very interesting memories, and Valencia was one of my favorites. So if you add maybe, another week, you're able to cover 2 or 3 cities at max. Sevilla, probably. I could go on. Spain really needs like 3 weeks on its own. But if you want to combine it into a 2-week trip, then another couple of cities in Spain would actually round it off really nicely.
So let me end this on a very, what I think is the most interesting note, which is the food, right? And you said that there are so many options, but give me a sense. What is your favorite, what are your favorite 2 or 3 things to eat there?
So every meal starts, like even before you order, they come and place a basket of bread and a couple of sauces on the table. These sauces are called mojos. And there is one called the mojo rojo, which is made of chili. And it is delightful. I feel like I could have filled up on just the mojo rojo, and I brought so much back. So that is a very typically Canarian sauce. It's very different from what you get in mainland Spain. So definitely that. There are also a lot of very different cheeses that are made over there. So some of those, there's a soft cheese that's made with a flour. And that was a very interesting cheese that I brought back and everybody loved. So there was that. Plus, as a vegetarian, I don't eat meat. So I found that beans and potatoes are like pretty present in most dishes. So it wasn't very difficult for me to navigate as a non-meat eater in Spain either. So food is actually not a problem. It's actually delightful. Plus, wash it down with a glass of Malvasian wine. I think that just rounds it off.
That sounds incredible. And obviously, I would think that the seafood and all of that is going to be known for it because it's an island, right? So, Preeti, thanks so much for joining me today. And you've got me thinking of about adding this to my bucket list.
Oh, you absolutely must. You will not regret it. Thanks so much for having me, Alex.
All right. Well, that brings us to the end of this particular edition of Your Money Matters. Do stay tuned. Lots more coming up on NDTV Profit.
STT definitely needs to change.
Old tax regime.
1991 budget was truly a game changer.
The rest is history.
Union budget.
Budgets.
General elections.
Union budget.
two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
Well, the union budget is right around the corner, and we get you some of the major wish lists according to Bajaj Broking, the key sector expectations, as well as the 3 key stocks that you should watch out for in this particular budget. Let's start with, some of the key budget expectations in terms of sectors. In terms of banking, they have mentioned that, they're expecting no favorable terms in terms of deposits to come in, but capital infusion for PSU banks as well as insurance companies will be something to watch out for. When you move on and look at the other key expectation from banking, they are expecting that the focus of the banking and the financial space will be on sectors such as cement as well as the metals, which haven't done too well over the last 2 years. Import duty changes to support any kind of domestic production will be something to watch out for, especially for the metal space, because we are expecting and hearing rumors as well in terms of some anti-dumping duties on metals coming from China. When you move on and look at the key other expectations from the infra space specifically, a key sector to definitely watch out for, capex allocation for roads and railways is something that's been standard. It's been increasing steadily over the last 6 to 7 years, and this time again it will be something to watch out for. Apart from that, announcements of any kind of large-scale projects according to Bajaj Broking, likely a new freight corridors, will be something to watch out for as well. When you move on and look at specifically from the auto space, it is expected that the allocation for PM E-Drive and the auto PLI policy will be something to watch out for. Do note they've already announced the PM E-Drive scheme. It has reduced the subsidies over 25 and 2026 as well. Any kind of movement in that will be something to watch out for.
tax cuts as well as increased funding for Manrega will also be something, as apart from that, the Bajaj broking expects is something to watch out for as well. Apart from that, any kind of tax break specifically on the housing loan interest as well as increased allocation for housing will be something to watch out for in terms of this budget as well. When you move on and look at some of the other key expectations such as from pharma as well as healthcare, support for R&D will be something to watch out for through PLI schemes. There have been some PLI schemes and action on that aspect as well, with special focus on anti-diabetic as well as weight loss drugs, something that's gaining popularity especially in the US and the developed markets. Any kind of move on that will be something to watch out for. Funding for, of course, the Ayushman Bharat as well as institutions such as AIIMS is another key trigger according to Bajaj Broking. When you move on and also look at the defense space, another key sector in the budget has always been in the news. Any kind of capital allocation is something to watch out for. Initiatives boosting defense exports, and it has increased steadily to around 20 to 25,000 crores now, as well as increased procurement from domestic defense companies is something apart from that to watch out for as well. In terms of, apart from other measures such as support for the renewable energy initiatives is something else in the defense space as well. When you finally look at, the consumer sector, and that's been in a lull over the last, a year or so, the consumer staple companies also not reporting very strong results. And any kind of, increase in digital taxes, in cigarette taxes specifically is one of the key triggers. Now, brokerages have mentioned that, this will be a key negative in distribution of legal cigarettes as well, because that can go down whenever there's an increase in tax. So ITC might be in focus. Higher allocation for PM Awas Yojana as well as other similar schemes is something to watch out for as well. In the consumer sector, apart from that, tax reliefs for the lower as well as the middle class group will increase consumption. There are some media reports speculating any kind of new, income tax percentage to come in, and that's always been in the news, but something to watch out for as well. When you move on and look at, the NBFC space, and that's been marred by expectations in this particular time frame, the microfinance piece is something that's been affected majorly, affecting earnings for all mid-sized banks, and reduction in the loan limit, enforcing the SARFAESI Act is something to watch out for. Apart from that, the credit guarantee schemes, as mentioned from the microfinance scheme and the sector, will benefit all the mid-sized small finance banks as well as the mid-tier private banks as well. So watch out for that. GST is expected to remain unchanged. There has been, the GST meet in December itself. So anything on that aspect will be, a wishful thinking, but could be something to watch out for as well. When you move on and look at, the oil and gas space, competition for LPG under recoveries is something to watch out for all these companies as well. And, finally, a couple of more to watch out for, going forward as well. But, we have some of the other stocks as well to watch out for. The first stock pick is Park Hotels. Now, the target price that Bajaj Broking is given is roughly about 235 rupees per share, 21% upside from the current market levels. It, of course, manages hotels across the owned lease as well as, the managed models as well. Apart from that, what Bajaj Broking mentioned is that the company currently has 34 properties, roughly 2,410 rooms, and has margins of roughly between 30 and 35% and really strong margins. We have seen, the whole hotel space being in focus, and, stock prices have also corrected very firmly after the, lull in the first couple of years post the pandemic. Stock also, the Park Hotels also has another food and beverage brand called Flurries. They operate kiosks, cafes as well as restaurants. So watch out for this. Is the first stock according to Bajaj Broking. The second one is DCS System. Now, a defense play and a very strong one to say the least. They have a target price of 449 rupees per share, 24% upside from the current market levels. It's a big prominent player in the defense as well as the aerospace industry. And, in FY24, the company reported 1,400 crores in terms of revenue. It's also expected to have margins of almost double-digit over the next few years. The current products does include subsystems, high-end assembly integration, as well as, PCB, which is the printed circuit board assembly. And that's going to be one of the key products as well going forward. They have an order book about 3,500 crores, and any kind of updates in Q3 will be something to watch out for in this company as well. It's a long-term bet for Bajaj Broking, and that's in the defense space. Let's also look at the third stock as well. Eon Exchange is something to watch out for.
To GST and other receipts. The third thing I would say is the freebie should be, and including for the energy industry, wherever, subsidies minimum, freebies minimum, whatever money we collect should go into to smart expenditure, which ultimately keeps inflation low and stimulates capex. So the levers I think the government has to play with are relatively few if these constraints are put. So I'm expecting a practical, consistent budget, no big moves, continuing to work these levers.
You know, just on the point of the freebies, I thought that was interesting, Mr. Bhandari. And if you could just go a little deeper on that. When you say freebies, do you mean even any kind of incentives for your industry that could come in or could impact your industry positively? Because usually before the budget, what companies are asking for is the exact opposite. They want the freebies, though it wouldn't be called freebies in the context of corporates.
I think we keep asking for those, and we keep looking at the budgets and we don't see them. Yeah, the subsidy regime is one that the government's looking to look beyond. I think there'll be more PLI kind of incentives, more requests for regulation to be cleaned up and helping industries take off by clarifying rules in hydrogen, in green transportation, shipping, bio-CNG, whatever the case may be. Yeah, and look to areas where we can do import substitution, bring natural gas under the GST regime, providing incentives for growth, but definitely not freebies. And I think industries ask for freebies is not going to be heard by the finance minister. There will be a few specific sectors where there may be some incentives relating to growth in line with what the government's already announced, things like green hydrogen, etc., coal gasification, green hydrogen. But beyond these industries, in line with what is consistently already developed as a roadmap by the government, I don't think too much more can be expected.
This is something that is going to be watched very closely. What happens in the energy space, particularly in the renewable energy space? What does the government spend on? And where does the target of 2030, what does that mean for the companies that are operating in this space? I spoke about this with the vice chairman and the co-founder of Suzlon, Girish Tanti, on his own budget expectations as well as the prospects for both his company and the space. Listen in.
If we look at today, renewable energy is at its core in terms of the energy development in our country, and already it enjoys significant kind of focus areas across the value chain of implementation. Within this, if you were to see, the two primary sources of energy, solar and wind, are the major contributors. And today, of the 500 gigawatts target that we have for our country to achieve by 2030, we have crossed about 200 gigawatts today, where solar is contributing 2/3 and balances from wind. So with this combination, the couple duo is going pretty well in terms of the growth that we're looking for, and the pipeline of projects which we have today in the country, hitting the 500 gigawatts target by 2030 seems reasonably feasible at this stage. So if you look from a budget point of view, I think several things are being done, and amongst the things that the industry is looking at, we're looking at 2-3 important areas. One is an area where there is a need for harmonizing our policies between wind and solar to make sure that both of them work hand in glove, as ultimately that's very important as an industry to grow and to keep the consumer costs of tariffs under control. And the second one is, made in India. We need to kind of have that strong narrative concluded into policies and implementation to focus strongly on, and wind actually has a significant better situation than solar as far as Make in India is concerned. So that's the other area where we are looking. So these are really the two areas, harmonization of policies and Make in India.
Okay. Girish, your anticipation of the next 300 odd gigawatts that are going to be added over the course of the next few years, do you anticipate that the split is going to be more or less what we're seeing right now, just purely basis the trend that we've seen in the recent past?
Yeah, so there, Alex, we need to see in terms of how this 500 gigawatts was calculated by CEA. So if you see this is designed to ensure that the least cost source of energy is maximized to its full potential. And when we look in the 500 gigawatts, there's a 300 gigawatts to come from solar and about 100 gigawatts to come from wind. So today, wind has just is inching up to about 50 gigawatts. So we are at about 48 point something. And so we have to almost double our capacity. What we've done in the last 30 years in wind, we need to double that in the next 5 years and add a 50 gigawatts of additional wind power. So I think, and the industry is quite well poised to make it happen.
Okay, and I'm glad that you put that into context. There is a bit of an expectation that there will be higher support for offshore because it's not proven as lucrative, some might say, as the onshore wind has been, and you've also not been very aggressive when it comes to the offshore projects. What do you think needs to change for that to be more lucrative?
Yeah, so I think this is very important. I think India is blessed with a beautiful coastline, one of the largest that we have across countries. So from that point of view, we have definitely a significant portion to go offshore wind. However, at this point in time, if we just step back and see the reality of where we are, the total wind potential that our country has onshore is about 1 terawatt. And we have currently just done about 48 gigawatts, which is about 4% of the total wind potential on land. So we've just scratched the surface of what wind energy can do onshore itself, first of all. So there is a 96% growth that is possible onshore first. And already we've proven there that wind and solar both are extremely cost competitive to any conventional source also. And that's why the adoption of green power is moving extremely fast in our country. When we go offshore, things are slightly different. Today, first of all, the cost of building offshore projects is almost 3x of what you would do it onshore. And likewise, the generation benefits which you would get are not in proportion to that kind of scale up. So effectively, with today's technology, best in the world that's available. And we as Suzlon, we have run and operated world's largest offshore wind energy company out of Europe. So we are familiar with all those technologies. Even if we use the best of the technologies today available in the world, the cost of energy to produce offshore will still be about 2.5x of what you can do onshore. And therefore, the economic viability today for offshore is still a little away. And that's the reason government is looking to give the value gap funding, as we call it, to make sure that they bridge up for getting the first kind of projects off the ground. And I think it's still a journey. But if you see the short-term goal of 2030, the first 50 gigawatts which has to come right now for our next 5-6 years, this will all come from onshore. Okay. Offshore journey will start post 2030.
Okay, and developments of technology, I would think, also would contribute to making that easier. Viability gap funding, of course, is one thing that we're looking at very closely. As someone that has looked at the space, of course, your role is the creation of this capacity and the generation of the power. But equally, when you're looking at the utilization of this power, Girish, one would say that the transmission of that power and the utilization effectively of that renewable power is absolutely critical. Do you think, as an allied space, if that develops very, very quickly and if it moves faster than we were envisaged or we had thought possible, do you think that it would be more beneficial for your industry as well?
I think this is a very valid area which you just touched base, Alex. I think if you see today, both for wind and solar, the biggest bottleneck for growth is the electrical infrastructure, the green corridor that is getting built across the country and individually within the states. So I think the more we can speed up that growth of development of transmission and distribution network will speed up. And if you see historically what has happened, we have generated centrally in the conventional energy and then distributed the electricity to the consumers across states and across the country. Whereas the beautiful part about renewable energy is that they are generated almost at the fag end. very closer to the consumers. So really now the challenge is how do you build an infrastructure which can almost in a way set up more distributed generation across different states. And so we avoid less transmission cost on that ground. And one very important part in this is that it's very important that the growth of wind and solar is balanced out, because otherwise the infrastructure which we will build, like just for your example, today the kind of infrastructure that is getting built, say to support the solar ecosystem, effectively that grid just gets utilized during the day for 6 hours. So it's 1/3 of the time the grid is not utilized. But the moment you have hybrid projects where you have wind and solar both, then it is much better utilized. So effectively the return on investment to government for any grid infrastructure buildup, if they do it jointly for wind and solar, is reduces by half. And I think that's where the new system of balancing wind and solar growth is very critical.
Do you think, so I know that you've given us the numbers as well for this target to be hit. You're talking about cognizant of what you've just spoken about. And so therefore the mix, do you think that it's possible to have a higher mix at all, or do you think that it's too tall an order?
Yeah, so I think, so basically, as I'm seeing, actually the mix of wind is even going to be higher, because with the opening up of the private procurement today, a huge amount of India Inc. If you see all the large corporates and even the mid segment, everybody is working to producing their own electricity through renewable energy.
Here are the key expectations from railway sector in Union Budget 2025. Indian Railways remains a key infrastructure player due to its massive role in economic progress as well as improvement in a citizen's daily life. Higher emphasis on modernization and expansion has remained at the forefront of the sector. Thus, expectations on what the upcoming budget brings in terms of this sector is something we should keep focusing on. Here at NDTV Profit, we will highlight some of the key expectations that can be beneficial for us from now on. The number one expectation is higher capex allocation as compared to last year is a key monitorable for the upcoming budget. If we go back to last year and check the key announcements in the railway sector, the sector hardly found a mention in the budget speech 24. This is starkly different to the picture before 2017, when the railway budget used to be presented separately few days ahead of the union budget. In FY25, total capex for railways in budget estimate 24-25 stood at Rs 2.65 lakh crore, while gross budgetary support stood at Rs 2.52 lakh crore, representing a 5.8% growth versus 24. However, the gross budgetary support reported a 51% and 36% growth in FY24 and FY23 budgets respectively. So far in this fiscal, the government has spent 76% of its budgetary outlay at Rs 1.92 lakh crore by December 24. This includes spending Rs 40,367 crore, which is 79% of the budget allocated for rolling stock. In safety-related works, out of budgetary allocation of Rs 34,412 crore, the amount spent is Rs 28,281 crore, which is 82% of the allocated amount. Media reports indicate a 18% increase in allocation for railways in budget allocation this year. So higher growth coming back versus last year should be definitely on cards this time, with focus now also tilting towards any announcements around long gestation, large value projects such as additional dedicated freight corridors. Second is...
All right. So Anushi there with all the details of what is expected from the railway pack, and this is one sector which comes into focus ahead of the budget on the basis of hopes of capex increase. In fact, we're speaking right now with Indrajit Mukherjee, Vice Chairman of Texmaco Rail and Engineering. We'll also be joined shortly by Pratish Chaudhary, Deputy Managing Director of Titagarh Rail Systems. Well, there he is. Welcome to both of you, and thank you so much for speaking with us today on the show. I'm going to start with you, Mr. Mukherjee, and just let's set up the conversation very simply on how crucial that capex figure becomes this budget.
Oh, that's very important because after all, at the end of the day, the capital expenditure, that is what is expected in the rail segment. And as your anchor had said earlier, I tend to agree with her that there should be more growth coming up, at least in the range of 15 to 18% from last year's capex allocation. So answering your question, it's a very vital factor that will decide how the infrastructure development will move in the rail segment.
And let me get a take on that as well from Mr. Chaudhary before we get into the details. Mr. Chaudhary, in terms of outlays compared to what was announced in large budget in capex for rail, there is still some legroom to go. Having said that, how crucial does it become that there is a huge bump up in capex, and do you expect that to actually come in, looking at how robust allocations have been in the last two budgets?
It'll be a huge bump up or not, only time can tell, but we definitely do expect there to be a hike, as Mr. Mukherjee also agreed, as your anchor earlier also mentioned, that we do expect there to be a hike in the capex, total railway capex budget that is announced. And I say this off the basis of the National Rail Plan, which is very clear, which is until 2030, which very clearly highlights the enhancement of infrastructure, enhancement of rolling stock, for both freight and for passengers. So the vision and the plans are very, very clear. And on the basis of those plans, we do expect there to be a little bit of an increase in the railway capex budget.
Mr. Mukherjee, we've spoken a tad bit about the focus on infra a little bit more as compared to railway stock. What do you think that could come through in terms of the upcoming budget? What should be in focus as per you, according to you? What areas of railway infrastructure need a little bit more focus at this point in time?
Let's talk a little globally right now. I think this year budget will have more focus on, I personally feel we have more focus on passenger mobility, because the railways are committed to improve the traveling experiences of the people. So there has been, media has been talking of about 400 new Vande Bharat trains coming in. There would have to be, if that comes in, it just cannot come alone. So it has to come with higher track laying, and I think the target is somewhere about 70,000 kilometers of new track. The moment you load the track with many trains, you have to look at the safety, because I don't think we have a great safety record so far. So there's going to be expenditure on safety related systems like Kavach, the signaling system, the axle counters, etc., the MSDAC. So I think there's going to be a lots of focus onto the passenger mobility. At the same time, I don't think they are going to sort of roll back the plan they have on the National Rail Plan, which is already, I think we are almost halfway through, where they have been talking of the freight car transportation and the percentage increase of the market share increase on the railway freight car compared to the road freight car. I don't think they're going to stop it, but I don't know whether it is going to move at the same way, because at the end of the day, capital is going to play a very important role. So I think there's going to be a lot for the railway industry. May not be all on the rolling stock the way it was moving, but it's not going to go down. It's going to remain at the level at which we are, if not more. But there's going to be lots of focus on the passenger mobility.
Right. Pritish, one of the key objectives of the National Railway Plan of 2030 is to increase the modal share of freight as far as railway is concerned. And I do know that you also are into, making wagons. What do you think the government objective could be for the upcoming year with respect to this specific objective?
You want me to answer?
Yes, Pritish, this is for you.
Okay. If it's for me, then I would say that there would be more focus on more efficient wagons. The wagons which can carry higher load, which ultimately will reduce the carbon emissions per ton of load carried. So there would be focus, but there would be expectations that we will also start inching up on our technology and doing the better types of wagons. I don't think that there is going to be any drastic drop. I didn't want to say that there's going to be a drastic drop in the wagon requirements, but I was trying to say that there would be a renewed focus also on the passenger mobility.
Right, Pritisha, I want your view on this one as well, if you could come in on this.
Sure. Sure. So it's a very good question. I think there was a mega order that was placed by the railways back in 2022, if you recall. And there have, of course, been interim tenders rather, that have been floated, that have been filled out and awarded in the middle. But the end of this calendar year would start seeing the end of that 2022 orders delivery periods for all the vendors of the railways. So I would tend to agree with Mr. Mukherjee on this. We expect there to be a much larger focus on safety related and passenger related items. But we also do expect that the freight tenders or the freight wagon procurement, rolling stock procurement would ramp up a little bit compared to the last fiscal. However, what's to happen, only time can tell.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you. STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
welcome. You're watching The Big Question. I'm Tamanna Inamdar. With just days to go for the union budget, all eyes are on Finance Minister Nirmala Sitharaman and the announcements that she may make. Now, the union budget is something that we look forward to every year. It's a much-awaited economic event, impact on business, consumers, markets, and the economy. But this time round, the budget is a sign that everyone is watching very carefully. A sign that tells us that India is prepared for a challenge on the economic front. The fact is that we have been seeing a slowdown in high-frequency economic indicators. There is an uncertain global environment right now. We don't know what's going to happen with a tariff war which will potentially take place. As Finance Minister Nirmala Sitharaman prepares to present the budget on the 1st of February, the air is thick with anticipation as to how the budget can act as a booster for the Indian economy that is currently navigating choppy waters. It comes amidst concerns about a possible economic slowdown stemming from lower than expected Q2 GDP numbers. Remember, the GDP growth in the last quarter, that's the second quarter, hit a 7-quarter low, and forecasts have been revised downwards. This budget suddenly becomes much more crucial in a sense of, obviously, one budget is not going to change the economy overnight or shake things up. But do we have a plan? This is what will be seen. Adding to the concerns, the Reserve Bank of India has also lowered its GDP growth forecast for FY25 to 6.6%, down from the earlier estimate of 7.2%. So quite a sharp drop there. The first advanced estimates of the GDP have also estimated the FY25 growth to slow to a 4-year low of 6.4%. Now, that is as far as the GDP is concerned. But let's look at other factors that we need to watch closely. Private consumption is showing signs of a strain, especially in urban areas. Listen to any of the FMCG companies that have posted their quarterly numbers in Q3, and they're talking about that pain very, very clearly. They're saying urban consumption, more than even rural, needs a boost. Companies are now selling more and more mini packs of their products in a bid to offset price hikes, which the FMCG sector has been forced to take because there has been a spike in prices of raw materials like palm oil as well. In fact, we have reported a fresh 2 to 4% price hike in the offing for FMCG products already. However, it's not all doom and gloom. While a slowdown is being witnessed in urban areas, rural demand has continued to grow. In some segments, you're hearing that. It's the same story with automakers, where the rural sector seems to have come to the rescue. All in all, I suppose the big question that we need to address today, and we have two excellent speakers with us to put all of that in context for you, is what can the budget do to boost the economy? What are those signs that we need to hear? To speak on this, I'm joined by DK Joshi, Chief Economist at CRISIL, and Pankaj Tibrewal, Founder and CIO at Ikigai Asset Managers. Welcome to both of you, and thank you so much for speaking with us. I'm going to speak to Dr. Joshi first and start with the economic question. Just let's start at the basics. I put a few numbers out there, sir, but your assessment of the economy right now.
Well, I think in the last 2-3 years, we were used to positive surprises. The revisions in GDP were always upwards. I think this is the first year in the last 3 years that we got GDP much lower than what was expected. And we also don't see much upside to this 6.4% that is projected. So that is one. But do remember that this is a pretty fast rate of growth, I think, in the global context. And the context becomes very critical at this juncture, because if you want to push your growth up, I think then you will have to depend more on domestic levers. And budget is one of the critical levers there. Global environment will provide shocks and surprises for which you require resilience, I think, and resilience in terms of enough foreign exchange reserves, enough current account deficit within control. I think all those things become very, very important at this juncture. So I think to cut the chase, I think what the budget is going to do becomes very critical from the point of view of how much support it can give to growth. And here, I think we can talk about investment, we can talk about consumption, maybe some tax breaks. But beyond that, I think we also need to do some strategic things that ensure that the economy remains on the high growth path for a longer period of time. Don't forget that I think whenever there is trouble, it's also a time to do reforms, etc. And I think India during 1991 pushed its biggest reforms, I think, when there was trouble. So I think this is again an opportunity to do something which will.
But Mr. Joshi, what is the nature of trouble? So is this a base effect? All the post-COVID expansion now slowing down? Is there an inherent issue? Are these global issues? If I were to ask you very, very simply, what really is ailing the economy right now?
Well, I think, see, last year was above trend rate of growth of 8.2%. That couldn't be sustained. I think that is beyond our potential. And we also got interest rate hikes. And we also saw fiscal deficit as a percentage of GDP come down, which means the fiscal impulse to growth also reduced. Interest rates also are contractionary in the sense they reduce the GDP growth. So clearly, economy was expected to slow down, I think, and we were expecting around 6.8% GDP growth for this fiscal. Some were expecting higher. Now, I think the issue is that why did it slow down faster than expected? And here, I think some of the reasons are transitory in nature. I think the very long election process, I think that led to reduced investment. So fiscal deficit was anyway expected to come down, and the capital expenditure were reasonably budgeted. But I think even meeting those would be a challenge. So clearly, a slowdown in government spending, particularly capex, was behind, I think, the sudden sharp slowdown in GDP growth that you got in second quarter. In the second half, you'll see some movement up. Now, the other thing that you were also alluding to is the consumption side of the story. I think if I take you back to 23-24, rural wasn't doing well, urban was doing well. Now it is just the reverse, I think. So the urban is not is the one that requires support. And here, I think for urban economy, apart from other factors, I think the interest rates also become important because they bite the urban economy more than the rural economy because we have higher credit penetration in urban areas. So I think these are some of the reasons why I think we saw growth slowing down. And I think beyond this, what happens in the global economy, what kind of budget we get, when do interest rates start coming down? I think all these things, all these factors will shape up the speed of the recovery in the coming fiscal year.
Okay, so one factor is the capex. So simply put, government spends less. That also could be because, remember, we have a target of hitting 4.5% of fiscal deficit. Maybe part of that equation. Government spends less liquidity flowing into the economy. Economy does see that pain point. Other point is, of course, the consumption pain. Pankaj Tibrewal, and I'm so glad that you're joining us on the big question, because we try and go a little razor focus on some of these issues. Markets have been showing pain. Some of that might be factors beyond the economy as well. But in your view, is this something that we will have to deal with for the next few quarters? And then how does the role of the budget come in?
So, Tamanna, if you look at a few things on the expectation side, one, clearly we expect that the finance minister should continue the fiscal prudence glide path which she has been talking about, but not get obsessed too much by it. I think if you look at mathematically, if you are at 16 lakh crores of absolute fiscal deficit, and economy grows at about 9 to 10%, ideally your mathematics of 4.5, 4.6 will come. So not too much of stress, and this will be a lesser consolidation this time compared to previous year. And all credit to the government that from 9.1 post-COVID, we are bringing it down to 4.5 by next year. But at some point, we need to have a focus on growth, which has been slowed down considerably. And on the back of the fact that private sector is not catching up to the pace one would have expected. So in that limelight, in that fact, government needs to do the heavy lifting. So that brings you to my second point on the capex side. So if you look at the breakup of the capex, our sense is a lot of capex announced last year had low multiplier impact. For example, 66,000 crores out of the 11.5 lakh crores was earmarked to DAA, Department of Economic Affairs. We don't know why it was done. Second is about 85,000 crores was done as an equity infusion of MTNL and BSNL. That's clubbed in the capex number. That doesn't have a multiplier impact.
Yeah.
Then about 19,000 crores was parked on the home upgradation, which is Home Ministry upgradation of police. That doesn't have a very large multiplier impact. So if we can rethink in the capex spend, and India does need a lot of urban infrastructure, which is a state subject today. So if we can develop a model, announce a model where center and states could partner, there's an infinite amount of urban infrastructure we all need. Look at the city of Bombay, Delhi, and many other metros and tier 2, tier 3 cities, which is currently a state subject. Can center support it from a capex perspective? I think that will be very, very interesting model to watch out. Plus some SOP on the housing structure, because housing has a very large multiplier impact as you move ahead. So that's on the capex side of the government. The third slowdown, which Mr. Joshi also pointed out, is the urban infrastructure. And that is largely to do with the monetary policy side. And I think a lot of heavy lifting on the economy has to be done now on the monetary side. Over the last 2-3 years, we have seen huge fiscal consolidation as well as monetary tightening to the extent that the systemic deficit on liquidity to the tune of 3 lakh crores. So I think on the urban side, just one data to know, in our estimate, the total EMI of consumers, which includes housing loan, personal loan, jewelry loan, vehicle loan, everything combined, 4.5 years, 5 years back was about 19 lakh crores, the total EMI burden. That, in our view, this year will be about 40 lakh crores.
Wow.
Though the incomes have not kept pace with that. So the leverage, the household leverage has increased, and hence you have seen urban consumption seeing slowdown. Some part on the interest rates or subvention on that side could bode well for the urban class out there. Rural has started to come back, which is a good news. But I think something on the urban middle class is something which is awaited for a long period. It could be outside the budget also, in terms of reduction in petrol prices, in terms of reduction on interest rates, giving monetary impulse to the economy. I think all those things combined would make sure that the economy comes back on the growth path. It should not be a lost opportunity for us after a long time. The economy on the global context looks to be good, as Mr. Joshi mentioned, but our capacity to grow higher and faster is there, definitely, and government should exploit that. Last but not the least, I think private sector is warming up. They are already in the first gear. Many of them, the larger, corporate India. And from first gear to move them to second and the third gear, I think a concessional capex, tax rate, which was already there, 15%, maybe at 17, 18%, I don't know what we are hearing about, should be introduced again to encourage private sector investment again. Also, don't tinker with any capital gains right now. You just did it 7-8 months back. So let that settle down. And personal income tax collection has shown robust growth, but largely that has been because of the STT and capital gains. Just to put numbers in perspective, few years back, this number was 18,000-20,000 crore. Our estimate is capital gains plus STT this year would be in excess of 2.5 lakh crore, which has supported a very strong growth we are seeing on the personal income tax collection. So keep that in mind, and our sense should be that more impulse should be given for growth rather than only focusing on expenditure.
Agreed. Just on the impulse for growth, and I want to come down to one simple point that you made, Mr. Tibrewal, which is on household debt. And I think we should take a second and pause on that number. If household debt, which is the sum of all loans people are taking now, it could be buy now, pay later, it could be your credit card, it could be your personal loan, whatever. If you're saying it has doubled in 5 years, ballooned in this extent, how much of a concern is that sitting in our economy right now when growth, salaries, jobs, incomes are not boosting? What is the sort of red flag you see there?
So it's a quite a bit of a red flag, and that's why you are seeing that first instance of that being reflected in the MFI loan segment.
Yeah.
you saw the numbers being declared by all the players who are exposed to that segment, and the scene is not very great because every borrower has borrowed from 3 or 4 lenders, and that's clearly resulting in default. And these are short cycle loans, so immediately as a lender, you need to write off. So our sense is that absolutely liquidity, one, is tight, and second, the household leverage has increased over the last 5-6 years. Along with that, higher interest rates is clearly putting pressure on the household incomes and disposable income, I would say, and that's clearly resulting in urban consumption slowing down materially. So I think it's a concern where monetary impulse is very much needed, and some kind of a new tax bracket which could give some money in the hands of middle class could be appreciated. But it's a red flag from an economic perspective, and we need to find a solution for that.
Is there scope for it though? Let me take that question to Mr. Joshi. Is there scope for it? I mean, we keep saying this. I think if I just copy paste what we all said last year or the last budget, the last 5 years, this tax boost, put money in the hands of people, consumption booster keeps coming. I just want to understand, is there fiscal space for this from a finance minister's perspective?
Well, fiscal space is not too much because don't forget you are bound to reduce or you have committed to reducing fiscal deficit as a percentage of GDP to 4.5%. Maybe I think you may do a couple of basis point higher than that, but this government has been fiscally conservative and they have stuck to what they have committed. So that reduces the fiscal space. So that you have to spend very prudently, I think, in that case. And here, I think the income tax, maybe there will be some change in the bracket, etc. But that's not going to be a major booster. I think don't forget that I think there are other things also which are playing out. Very high food inflation, both in urban and rural areas. It's got 46% weight in the consumption basket, so it eats into the discretionary spending power of the households. I think that also needs to be brought down. So there are multiple things that we need to do, and here I think promoting consumption via schemes that generate employment and also create assets like Awas Yojana, etc. I think they are more prudent way of promoting growth and also giving a indirect boost to consumption. I think those are the things where you need to focus on. So I think you have a limited kitty. I think whatever you have, I think spend it on as Mr. Tibrewal was saying, high multiplier areas. I think yes, which is essentially infrastructure. I think infrastructure has the highest multiplier. And then second, I think for redistributive purposes, introduce schemes which create jobs and also create assets at the same time.
Fair schemes. In terms of the expenditure on that, directly, indirectly, yes, some of those subsidy schemes are coming via states, but whether it's for political reasons or the need of the hour in the kind of economy we are, Mr. Joshi, how do you look at the subsidy bill ballooning and its impact in the economy?
Well, subsidy bill is a transitory way of supporting the economy. I think the long-term sustainable increase in consumption growth, let's say, only comes when your incomes rise and when your employment opportunities improve. I think that is so. This is the bloating subsidy bill is not such a great thing. Actually, we have brought down a number of subsidies in the past. I mean, for instance, petroleum subsidies, etc., are almost nil. I think close to nil in the last 1 or 2 years. So, but I think there is another part which is rising. So I would say that I think we need to be a little circumspect on this. I think and if it bloats too much, I think it's going to increase your in a way committed expenditure, because subsidies are not very easy to pull back.
No, I was saying near impossible to pull back, just like taxes. Taxes you can pull back more easily, but no one wants to. No government ever wants to do that. Mr. Tibrewal, what is the single most, I would say, important step that can be taken in your view right now to shore up the Indian economy, even as external threats become more and more unpredictable, right? Just on Feb 1st, you will probably see the announcement of tariffs on Mexico and Canada from the United States. We just don't know what's happening on that front yet. What is the single most important thing?
So, Tamanna, clearly we are living in a volatile world, and with Trump coming in, we don't know what the policies will move towards. So, export is a question mark. What government needs to do is that do the heavy lifting as it did in COVID. Maybe at the expense of a couple of basis points, maybe a few basis points on fiscal deficit. Don't get too obsessed by it at the moment, because if the growth momentum gets lost, I think it will be very difficult to revive it back. That's the first. And second, I think we have not been up to the mark on the non-tax revenue side, and especially the disinvestment. So I was looking at the numbers of the last 5 years. We have been able to do only 22% of our disinvestment targets, which I think in a buoyant market like the one which we saw over the last 4 years has not been a good one. There are 66 CPSEs listed in India, market cap about 37 lakh crores. Can we generate a bit of that from the non-tax side and support the capex, which has a higher multiplier effect, or try to give some boost to the urban consumption so that that also has a higher multiplier effect? So I think both the things combined, along with the monetary policy impulse, making liquidity back to neutral territory, making sure interest rates at some point of time starts to come down and the transmission happens in the actual, I think both have to work together to make sure that the growth resumes back again. Otherwise, if the momentum is lost, to revive that back will be a big challenge in my view, because already you are seeing that in the last 3 to 4 months, the entire narrative from India shining has gone away. So clearly, I think markets are taking cognizance. Corporate earnings growth is anemic. 4-5% of the top 500 companies in India, which is not a great news from an overall economic standpoint.
Okay. Mr. Tibrewal, you said that let's not tinker with capital gains tax, let it settle. But I think most people who are investors in the market are saying that, we might not have to pay capital gains because people haven't made money in the markets. Having said that, on a lighter side, some incentive which you would hope from an equity perspective, equity markets perspective?
See, finally, stocks are slave of earnings, Tamanna. Over longer term, you look at the compounding of Nifty, it's exactly the earnings compounder of 18-19%. And over long term, 14-15%. So I think that if economy is in good shape, corporate earnings growth is happening, we need to not worry about too many smaller things there from a liquidity or other things. I think earnings growth is most important, and earnings growth is dependent on overall economic growth. So I think I would be more focused on growth, that how this government starts to address that now and encourage private sector more to come and invest in India. I think it's a great time when so much of confusion going around globally. We have to market it India from an FDI perspective. Last few years, FDI numbers have been dismal. When you take a net FDI number, it's quite dismal in the sense overall. So we need to make sure that that number starts to increase, and hence investments come back on track. I think that something is the only way you can grow and get rewarded in the equity markets.
Yeah, I mean, everyone loves lower taxes if they are there. But having said that, the interesting thing is that what you're seeing from earnings commentary and in the equity markets is also a reflection of the underlying pain. Perhaps it was being overweighed by global flows, etc. But now that that tide has turned, it's all for us to see. Thank you so much, DK Joshi and Pankaj Tibrewal, for joining us on this conversation. Really fabulous. And I hope our viewers have gleaned some insights from it as well. The question we were asking today is, what can the finance minister do to boost the economy? Some great views coming in. But tell us what you think. Tell us what you think of this subject and what you'd like to see on the show. We'll be back tomorrow, same time, same place, with the big question.
the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you. STT. STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well for the policymakers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget as well as has been in each one going into the same. We look at some of the key moves that have seen in the Nifty before as well as after the budget and get you some of the biggest measures that were announced in these budgets and what could have led to the strong Nifty reactions. Let's first look at 2024 because we had two budgets announced in this particular year. One was post the elections as well, and we did see a 1.5% move in just a week after, and that momentum was continued in the month as well. Leading into this budget, there were a lot of speculation, so we saw a downward reaction of the Nifty in the past week, and we did see some of the measures such as the standard deduction being increased to 75,000 for salaried employees from 50,000 earlier, as well as the new tax regime now and having tax-free status for up to 3 lakh rupees per annum for the investors as well. Apart from that, we saw custom duty reductions on mobile phones, gold, as well as chargers as well. And these were some of the key moves in this particular budget. Leading up to the election, we had, the 2024 budget in February as well. Let's see some of the reactions, as you can see in this particular time frame as well. One of the key moves was increasing.
A very good afternoon. You're watching the World News. Let's just first get you the headlines. A passenger jet and a military helicopter collide in Washington, D.C. Rescue operations are underway. For what we know so far is that the plane was carrying 60 passengers and 4 crew members on board, while the military helicopter was carrying 3 officials. And this is what we are hearing. So far, 19 bodies have been recovered after the crash. And President Trump says that the plane chopper crash should have been prevented. It is Donald Trump who has gone on to say that it was going straight for the aircraft. The aircraft had been there for an extended period of time, and this really could have been prevented given the fact that visibility was absolutely clear. An American Airlines flight that has collided in mid-air with a Black Hawk helicopter in Washington, D.C., with both crashing into the river. The small passenger plane, which was coming from Kansas, was carrying 60 passengers on board along with 4 crew members, while the chopper had 3 soldiers on board. According to reports, 19 bodies have been recovered so far. The U.S. Figure Skating Association has confirmed several members of the skating community were on board the plane. The collision happened within minutes before the plane was meant to land on the runway at the Ronald Reagan Washington National Airport. The first call was received at 9:48 p.m. local time, and within 10 minutes, rescuers were on the spot. 300 responders are involved in the operations that are underway and will carry on through the night. The big concern being, as far as the rescuers are concerned, is they're up against various challenges as the weather is extremely rough. The conditions are extremely windy at this point in time, and the weather is very, very cold. It's freezing, and so is the water. It's very late at night, therefore it is also extremely dark. Meanwhile, the US President Donald Trump says that this should have been prevented, questioning why the helicopter didn't go up or down or turn, saying that the airplane was on a perfect and routine line of approach to the airport, and the helicopter was going straight at the airplane for an extended period of time. It's clear, as far as the night is concerned, the lights on the plane were blazing, asking as to why didn't the control tower tell the helicopter what to do instead of asking if they really saw the plane. This is a bad situation that looks like it should have been prevented. Not good is what the message that the President of the United States has said right after that collision. Let's just listen into what the authorities in the United States had to say.
There's currently about 300 responders working. We have boats from all throughout the region, police and fire boats. We're operating under a unified command. Everybody's together. So we also have requested state police helicopters from Maryland, and the Coast Guard helicopter is working. So this is a state and federal response as well. U.S. Coast Guard's got some boats in the water as well. So it's a highly complex operation. The conditions out there are extremely rough for the responders. It's cold. They're dealing with relatively windy conditions. Wind is hard out on the river.
I spoke with the President's National Security Advisor, and I have not talked to the President yet, and I do not know what the mission was.
Just also listening to what the family members and people known to the victims on the flight really had to say as to what really happened from the information they're gathering on the ground.
Who was on the flight that you know? My daughter's best friend and her mom. And who had been travelling to DC, obviously. For what purpose? She was on a athletic trip. She was on an athletic trip. Yeah. And based in Kansas, yeah. Yes. Yeah. And what do you think of what you've heard?
I haven't heard much. I got off work and I came straight here to be with my friends. So.
Yeah. A time of great distress.
Yeah, thank you.
Family members and friends are reaching the airport in order to gather more information, gather the information they can as far as this mid-air collision is concerned. So from what we really know so far, from what the authorities are saying, that the rescuers are up against a lot of challenges and they're going to continue operations all through the night in order to find as many people as they can. So far, they have recovered 19 bodies in all. Well, there were 60 passengers on board along with 4 crew members and 3 soldiers on board that chopper. So the rescue operations are underway. The airport has been shut till 11 o'clock tomorrow morning. Well, let's just also get you a ground report with Nick Harper and Alistair D'Souza, who have the very latest details from the Reagan Airport in Washington. Nick, over to you first. Explain to us what really happened here.
Yeah, just very interesting. You mentioned the fact that the officials who gave that press conference did not want to be drawn on the number of fatalities. Of course, that was the information that many of us were waiting to hear. Those reports that 18 bodies have been pulled from the water came from a police official speaking to US media, but it was not confirmed during the course of that press conference. What they did say is that 300 first responders are working on the scene, and you can see some of what is still taking place at the airport behind me. This is a live shot of what is happening at Ronald Reagan Airport. That crash happening just before 9 p.m. local time. It's now 1:30 in the morning, so it's 4.5 hours more than since that plane crash between the commercial airline and the military aircraft. 60 passengers on board the plane plus 4 crew and 3 army personnel on board the helicopter. Very much a frantic rescue operation was mounted then within the hour after that crash took place. The plane broke into at least a couple of pieces, was partially submerged in the river, the helicopter upside down in the river, and those rescue teams having to work through the night, as they still are, but in very difficult conditions, not just dealing with the dark, but also dealing with cold and wind. It's around freezing at the moment, the wind chill making it even colder. So a very difficult situation, but of course one that started as a search and rescue operation, quickly turning into a search and recovery operation as bodies are pulled from the water, bodies of people who were on that plane and in that helicopter. Just on Donald Trump first, we've heard from him a couple of times. First, an official statement put out by the White House on his behalf, a much more measured tone from the president in that, in which he said that he had been fully briefed. He called it a terrible accident. He praised the incredible work of the first responders and said that he was monitoring the situation. But then, following up in the last hour or so, on social media with a much more social media type response, the type of response that we would normally get from Donald Trump on Truth Social, his platform. And in that, he said, this is a bad situation that looks like it could have been, or rather should have been, prevented. He said not good in clear capital letters. Also saying, quite simply, he didn't understand why the helicopter went up and down, and questioning the control tower and the commands that they were giving. That will, of course, be central to the investigation that's now underway from the National Transportation Safety Board to work out why the plane and the helicopter were in the same airspace at the same time. It is a very busy airspace. It's one of the most highly controlled, highly regulated in the whole of the United States, partly because the White House is about half a mile away, the Pentagon a similar distance away as well. 800 takeoffs and landings take place in that airport, so very busy in terms of commercial air travel, but in terms of the pilots who navigate their way into land at Ronald Reagan, many of them say that it is one of the most challenging approaches that they have to deal with in the world, partly because they have to turn very hard, banking to the right as they come around a number of high-rise buildings, and as they make that approach with the river on the left, with buildings on the right. So therefore, they are focused on what needs to take place. They're listening to the commands from the control tower. They're looking at the instruments and the control panel in front of them. It may simply have been a case that they were not also navigating out the window by simply looking what was taking place right in front of them, and therefore may not have seen that the helicopter was so incredibly close to them, of course so close that it resulted in a crash. But like I say, that will be central to that investigation, really to try and get to the bottom of how this accident could have unfolded. I mean, they would have been looking, they would have been assessing the situation around them. What we do know is that it was a training flight. The Army confirming that the 3 personnel who were on board, who were taking part in a training flight, which is not uncommon at that time of night. The Army say that those training flights often happen when there is less commercial air travel. At 9 p.m. at night, it is beginning to quieten down. It is a slightly less busy time of day. But in terms of flying blind, I'm sure that that was not the case. They would have had their eyes open and been looking at the monitoring systems around them, listening to the commands that they would have been getting over the airwaves as well.
Lots of challenges here tonight, especially because of those freezing temperatures. Remember, once that plane collided with that Black Hawk helicopter, it went down in that Potomac River behind me. You can see some of those flashing red and blue lights. Emergency crews still lined up over 3 hours later, trying their very best to get people out of that water, hopefully people alive, but it looks like it's turned into more of a search operation rather than a rescue operation at this point in time. No word yet on the exact number of casualties, details coming in that perhaps 18 people have died, but confirmation still awaited on other numbers as well. So we're looking at about 60 passengers on that American Airlines flight, along with 4 crew members and also another 3 on that Black Hawk helicopter. Now, the Black Hawk helicopter was on a training exercise, is what we understand. Generally, it would have VIPs on board, VIPs going from various places to the Pentagon, which is not very far from the Ronald Reagan Airport, where I am at right here. But in this case, officials confirming that none of those Pentagon VIPs were on that Black Hawk flight. So rescue operations continuing at this hour, wee hours of the morning. It's going to continue. Hopefully more things get a little bit more easy once daylight sets in, because rescue operators are working here under the cover of darkness. Divers going into that frigid water, trying to perhaps fish out debris, but most importantly, people, in the hope of perhaps finding someone alive. Now I'm going to get out of frame here to hopefully give you a better view of that scene right there behind me, where what you see are those twinkling lights. Those are in fact the emergency crew. You can perhaps again hear a helicopter hovering above. Beyond those lights that you see is the Potomac River, where that plane went down. The cold is, of course, one of the key things that would likely hamper efforts. We do not know what the condition of the river is in that particular spot, but I can tell you I just was on a flight that flew into Ronald Reagan Airport just on Monday, and when I was flying in, I could see that the river was iced over in many places, so it would mean that it would make it all the more difficult for rescue boats to get to the actual place where this plane went down, where the debris settled in. So getting there, cutting through the ice would be obviously very difficult, and then getting divers to go in, it's very difficult. It's an operation that also puts the lives of these people, these rescue operators, these divers at risk as well, coming into these frigid temperatures, having to battle pieces of ice and ice shards into that river there. So that's making it all the more difficult in order to get to any survivors. And like we were saying, it's looking a little bleak, increasingly bleak at this point in time, of any survivors being potentially fished out.
Now, the airport has been shut for all takeoffs and landings till about 11 o'clock in the morning, Washington time. But in the moments after the collision, air traffic controllers could be heard redirecting incoming aircrafts to other airports in the region. Listen in.
Did you see that? Export 72. American 3130, go around, turn left in 250, climb maintain 3000.
Okay, left heading 350, 3000, American 3130.
Blackjack 3, can you return to base? What? Blackjack 3, proceed directly to Glebe. I need you to land. I need you to land immediately. Can you go to Dulles for a few minutes? Muscle 7, proceed due westbound, contact Dulles Tower 120.1. Muscle 13, can you go to Baltimore?
Did you see that? Export 72. American 3130, go around, turn left in 250, climb maintain 3000.
Okay, left heading 350, 3000, American 3130.
Blackjack 3, can you return to base? What? Blackjack 3, proceed directly to Glebe. I need you to land. I need you to land immediately. Can you go to Dulles for a few minutes? Muscle 7, proceed due westbound, contact Dulles Tower 120.1. Muscle 13, can you go to Baltimore?
Mid-air collision that took place between an American Airlines jet flight carrying 60 passengers and 4 crew members. It collided with a military helicopter that had 3 soldiers on board. To know more on this, we have Vimal Rai, aviation expert, joining us to get us more on this all the way from Dubai. Sir, when we say that this collision that took place, when the visuals that we have on our screen, President Trump there saying that this should have been prevented. The question being, how did this happen in the first place, as visibility wasn't an issue? Clearly the plane was there for an extended period of time. How could this have been prevented?
Thanks for having me on. It's very difficult without any data, and that's what the investigators will be looking at the moment. Of course, whether you call it search or rescue, that's going to go on because lives are at stake, but really it's about the data. How could it happen? You could speculate. The point that's not been covered so far is that, upon landing, the aircraft, when it's landing and the speed that it's going, it's actually very similar to the speed of the Black Hawk helicopter, assuming it's cruising. And this being one of the most regulated airspaces on that side of the US because of the proximity with the Pentagon and the White House. So you would imagine that this happened very, very, very quickly. How it happened, it's very difficult to say. Chances are that the aircraft was on a normal landing pattern, so it wouldn't have been anything out of the ordinary. Chances are there was something to do with the helicopter. But what, how, who, it's very difficult to say at the moment.
So what, in your opinion, went down here in terms of where does the buck really stop? Was it perhaps communication with the control room or a technical snag that could possibly explain this? Because from what we do know about the chopper is that it was on a training flight. This was a training session.
Yeah, so training flight could mean many things, right? I mean, it's only 3 people, so you would assume, unfortunately in this case, that training was training for the pilot. And if that was the case, then, lots of other questions need to be asked, which is why I keep going back to the data, because you need to look at the flight logs, you need to look at, what was happening, what were the instructions. The aircraft was clearly on a normal landing path, so nothing anomalous there. It's really down to the helicopter and whether they followed the instructions, whether they were at the height they were supposed to have been, whether they were in the location that they were supposed to have been. They were clearly told to go behind the aircraft. Now, when that was issued, when they executed those orders, all of these things will come into play when they look at the data as to where the helicopter was, what was it doing, what was it not doing, and so on.
Right, Vimal Rai, what are the protocols that are followed for such training sessions that are undertaken by the military?
I'm not privy to those kind of protocols, but you would assume that in this particular scenario where this has happened in such close proximity to the White House, and we all remember what happened more than 20 years ago, this is one of the most controlled airspaces in the world. You would assume that they have protocols in place for things like this because it's an airspace that is used precisely by Black Hawks and commercial aircraft at the same time. Something must have gone wrong somewhere. Somebody didn't follow instructions, right? That's the most likely scenario here.
Right, of course, this brings to mind the tragedy of 1982 in Washington. What lessons can be learned here?
I think the lessons are that, you can never take anything for granted, and you can have protocols on paper and you can have systems, but 2 things will always be different. One is Obviously systems, so we don't know if the helicopter malfunctioned in some way. We just don't know any of that yet. By the same token, we don't know if the aircraft had any problems. Chances are not, because they would have had that as part of the control tower conversations before. And the second obviously controllable factor is humans, right? Human error and with pilots. And I'm not saying that's what caused it. I'm not saying that at all. I'm just saying that those are two things that protocols cannot cover. And in some cases, they go well, as you know, with what happened with Captain Sully, when he landed the aircraft in spite of everything else that trained him not to do it. And in some cases, it doesn't go well. So human error and really systems that fail. Those are the two things that could possibly go wrong here.
Right, this collision that took place in mid-air resulted in the plane to be broken into pieces. That we can see visuals on our screen of that plane colliding with the military chopper, bursting into flames, and of course fell into the water. So both the chopper and the American airline jet went into the water very close to the airport in Washington. From what we know so far is that 19 bodies have been recovered. Rescue operations are underway. There were 60 passengers on board along with 4 crew members and also 3 soldiers on board that chopper. We will keep following this story. We also have Vimal Rai, our aviation expert, joining us from Dubai. Sir, when it comes to landing, so close yet so far, within minutes the plane would have landed. People on board had called their family members saying that they're going to be landing in a matter of a few minutes, perhaps 10 to 15 minutes. And, it's when the family members responded to those on board and the message did not get delivered is when they realized something was wrong. What are the protocols and measures that the planes take when it comes to landings?
Landings, so unfortunately in aviation, some of the most dangerous times for an aircraft is during takeoff and landing. And it's not got anything to do with the fact that the pilots are in control. It's just got to do with the fact that, that's when the plane is closest to the ground and there is obviously the least amount of time available for any kind of human or computer controlled reactions. Landing protocols, we have hundreds of thousands of flights that take off around the world. And by far, nothing ever happens. Landing protocols are extremely safe for all kinds of aircraft in all airports in the world. Pilots are trained for these particular incidents and particular scenarios to the T. You would have to assume that because of the speed at which that they were traveling, that there was very, very little time for any kind of reaction. The speed at which you're landing and the speed at which the helicopter is, if you see something, it's milliseconds of reaction time that you have.
Right. Thank you so much, Vimal Rai, for explaining to us the protocols that are followed. And of course, visibility wasn't an issue. And pilots, like you said, are trained to the T. They're trained even to land with absolutely no visibility. And here, visibility wasn't an issue. But right now, the rescuers are being challenged in many ways in regard to the weather conditions, especially as cold as it is in Washington. The water there even much colder.
STT definitely needs to change.
Old tax regime.
1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
2 more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off?
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022, where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time, but as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs? And what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.